Hello and welcome to the course. I'm so glad you're with us. Hi, I'm Steve Ballinger. I'm the creator and the instructor for the course and a long-time successful investor, and I'm very glad you're with us here. As you can see, it's a very big course. We've got a lot of material to cover, which hopefully that's great for you. And the course is designed that you can start at the beginning and go all the way straight through, and it's in a logical manner, so you can do it that way. Or if you are, depending where in your investment journey, maybe you want to skip around to different sections or different lessons, that's perfectly okay. It works that way as well. Whatever works best for you. Though I would encourage you to watch the next two lessons first. They're kind of good foundational ones around can I make money in the stock market and how much, and then also looking at, well, what's the worst that could happen and what's a worst case scenario. So the two lessons that happen after this one are good foundational ones to watch, and maybe the whole purpose, they'll get you all excited about investing in the stock market. A couple other things to make sure how you can consume the course as best as possible for you in this quick introduction. One is you can change the speed. Udemy allows you to change the speed. They change your look every once in a while, but they'll always have a control as far as how to adjust the speed. So sometimes I get very excited talking about stocks, and I might talk a little fast for many of you. Feel free to slow it down, to change the speed down if you need to do that. Also, the video quality comes out automatically based on your internet connection and other things, your device, and Udemy takes care of that all automatically. But everything I filmed is in 1080p high definition video, so you can always adjust that as well if you want. Just Udemy automatically streams it to be at the best rate. Also, a couple things. Good to take notes. I would encourage you to take notes as you go through the course. Maybe you hear something, you're like, oh, I heard about this mutual fund expense ratio being above 1%. Might want to look at that. And maybe you're thinking, I have mutual funds. Maybe I want to check that. You just make a little note as far as some things you might want to check, or maybe you want to look at a link or something that's included in the course later. You can do that. So it's good to take notes as you go through the course. And lastly, ask questions. That's a beautiful thing about Udemy is you can ask questions, and I answer every single question. And I encourage folks to ask questions. I encourage everyone in the course to jump in and answer questions and share their thoughts as well too. So click the button that says Q&A or questions at the top there, and feel free to ask questions. Once again, I answer every single one. Okay, well, that's it for this short intro. Let's get diving into the course now and learn how we can become great at investing in stocks in the stock market and make some good money along the way to fund our goals and dreams. Well, if I was taking a course on stock investing, probably the first question I would have is, hey, can I make money in stocks? And if so, how much? That would be pretty important to me, and I'm sure it is to you. And the good news is, yes, you can make money in stocks. In fact, stocks outperform things like bonds and cash and other asset categories, so they're a great way to grow your money. I suppose this is a pretty short and lousy class where you said, well, no, you can't. Since it's a good long course, yes, the good news is that you can. The key is historically you can make stocks. That doesn't necessarily mean you can in the future, or the past predicts the future, but we have over 100 years of information. So yeah, stocks can make money in the future here, I believe. Certainly over the long term, stocks make money. In the short term, they can be really risky or volatile, go up and down quickly, but over the long term, they do make money. And I'll show you some charts and things in a second here, and that shows that. And they do tend to go up once again over the long term. Individual stocks might go down and never recover, certainly, but if you have a diversified portfolio of stocks and apply some of the principles you're going to learn in the course here, you're going to be in a much better place than somebody who's just buying stocks without really much education. So historically they go up, there's a long-term investment, and they tend to go up over that long term. So how much? Let's take a look at some charts and some numbers so you get a feel for how the stock market kind of works as far as returns. This chart here just shows some historic market returns. Looking at the Dow Jones, it's a smaller basket of stocks. Only 30 of the largest U.S. company stocks are representative of a variety of industries. Been around since 1896, and I wanted to use this, though it's not truly representative, it really does follow the rest of the larger type of stock market generally. And as you can see over this chart, if you start over in the 1900s, stocks go up, and over the long term, as we get into today, you can see that stocks have gone up by following the upward motion of that chart the whole time. That's the good news. Now the challenging news. You can see there's some drop-offs in there, as it's not just a straight line going up. There are up and downs, peaks and valleys, and when it's going down, that means your investments, your stock has gone down. Maybe that's a great time to buy some new stocks, actually, as you're buying low with the idea of eventually selling high, right? Stock investing 101. If you look at here, like let's look at the end of 1929 here, right at the beginning of 1930. What happened then? All of a sudden, stocks went plummeting. Well, that was the Great Depression, right? That was the Great Depression of the 30s, and you can see how the Great Depression stocks went down pretty quickly, very quickly. But they rebounded, and they overcame the Great Depression. They overcame World War II in the 40s, and they overcame all these things that are these obstacles to stocks and the world and challenges overall, and have continued to rise over a long period of time, outperforming things like bonds and cash and their peers. So long-term investment, it can be really, really good as far as investing in stocks. If we wanted to see how much return that would be, looking at this chart here, I pulled this out of Vanguard. Vanguard has some sample portfolio, so they did a more broader based look at stocks from a larger amount of stocks than just the Dow Jones, so they can give you a feel for average annual return over a long period of time. This is looking from 1926, right before the beginning of the Great Depression, happening in October 1929, all the way up to at least 2015. Not too far in the rear view mirror here for us. And this is a portfolio of 100% stocks, broad base of stocks. And you can see the average annual return is 10.1%. So somebody says, oh, the average return in stocks is 10%. That's kind of where they're getting that number from. It's not totally the total story on that, but it's at least a starting point number to say, yeah, it's not like 1 or 2%, or it's not keeping up with inflation. It well is. So you're looking at 10%, but that could be, it's been less in recent years, maybe more in other years. And you can see the range, the best year and the worst year. Best year overall stocks up 54%. Wow, hooray. Worst year down 43%. Oh my God, that's not fun at all, right? So you can see that broad range. And the interesting thing with that broad range, that's right in the middle of the 30s, right? You got the Great Depression, and stocks went way down, and then they went way back up, and they went down, and all that. You can see that was a very volatile time, and we got some volatility now, but not like that. Years with a loss. So this is saying that out of 90 years of investing in stocks over this 1926 to 2015 time period, 25 of those years you're going to have a loss. It might be only 1 or 2%. It might be as big as 40%. But 25 of the 90 times you're going to have a loss. The good news is the other times, the other 65 times, you've got a gain, or at least breaking even. You've got a gain, you don't have a loss. And so that's some good news as far as investing in stocks. If we looked at it by another chart here, just to give you a feel for it and get you comfortable with it, if we looked at stock market historical returns by decade, you can kind of see where they're at as far as that too. And you can see some of these early numbers here. They got the 10s, 1910s, 1920s, 1930s, all that. Even the 30s with the Great Depression, you can see at the end, if you start at the beginning and then at the end, you lost like 0.63. Yeah, it was 10 years of misery, but it wasn't like you were down 40% for a whole decade. And if you kept investing, you were buying low actually during that period. Then most recent times, you can see we have the 1980s and certainly the 1990s with the internet boom and bust. So you had that. You had the 2000s where it was pretty flat. That was kind of considered, kind of a flat time period. This is once again looking at overall stocks, more U.S.-based stocks for this number. So overall, but worldwide we'll fall a little bit too. But just to give you a feel. And then more recent times, some better returns, but that can be up and down too as well. It's very, very recent type numbers. So the thing to take from this is that, yeah, there's going to be up times and there's going to be down times, but overall there's some up times. And particularly if you continue to invest and continue to take a portion of your income and invest it regularly in the stock market, you're going to do very, very well. In a broad diversification thing, I certainly advocate investing in things like bonds and a little bit in cash possibly, depends on your investing goals and all that. But you can see some returns here. Let's finish this lesson here with one other thing. We're going to do a demonstration here, and we're going to look at one other thing here as far as, well, what if I continue to invest in stocks, and how does my money grow over time? I mean, I'm taking on some risk. Yeah, the returns look pretty good. What will it look like in the future for me? So let's do a demonstration of that. And really where you go is you go to MoneyChimp, you go to moneychimp.com, go to Compound Interest Calculator, and you will find it. So let's go take a look at that and do some demonstrations. Okay, we're here in MoneyChimp.com. I think that's kind of a fun name, right? MoneyChimp.com. You can see in the upper right. We're in the Compound Interest Calculator. If you just go into their calculators or calculator / compound interest, you'll find it. It's a very simple calculator to show how your money grows over time. And we'll do a demonstration here with this, and you can go to this and play with it yourself and put in your own numbers based on maybe how much you have to invest in a particular time and how much returns and things you might expect. So let's say we start with 0, or we're going to walk through this different calculator, and it's going to tell us at the end what is our future value, what are we going to end up with after a certain time period. So let's walk through this real quick here. So let's say my current principal or money that I have right now is zero. I don't have anything invested at all. I have zero. And let's say that every year, annual addition, let's pick a number here. I'll use US dollars. I'm from US, so, bear with me. You could use rupees. You could use pounds. You could use euros, whatever your currency might be. But let's say we'll use dollars in this case. And let's say every year, let's say I'm doing well and I contribute $10,000 a year. Maybe it's less than that. Let's say I'm just doing half. Let's do a little less. Let's say $6,000 a year savings and investing in the stock market, right? Once again, you adjust it a little higher, a little lower, whatever you want to do. And let's say we do this over 30 years, right? So if I start at 25, let's say that put me at 55 years old, not even 40 years. That might get me closer to a traditional retirement age. And as we saw in stocks that we could get, around a 10% return on a rate, maybe a little bit lower. Certainly we don't know what the near-term future is, so let's go real low. Let's say, we could get 7% on our stocks. We're not going to say 10 or 9. Let's be pretty conservative on it. And if we have an overall diversified portfolio of stocks and bonds and cash, we might even put a little bit lower number on that. But let's start with 7 just to see what it is. Make additions at the end of each period. So that means at the end of every year, you'd add $6,000. You could be investing every month too as well. That's actually a better strategy. But for the purposes of the calculation, here's our numbers. We start with nothing. We're investing $6,000 a year over 30 years, 7% annual return. Let's see what our number ends up at the end by investing if we can get a 7% return on our stock market portfolio. And you can see we're at $566,000. So, just by investing that every year and how it grows and compounds, we're over $500,000. If we let that grow to maybe a more full retirement age, so let's say 40 years, and as we got promoted and did things at work or in our careers and we were able to put away a little bit more, maybe we were able to do $9,000, still 7% interest, how would we do then? Wow, that's like $1.7 million. That's pretty good over a 40-year period. So you can see how stocks and things grow. Let's go back down to our 6,000 just over a longer period. And you can see even with 6,000 a year over a long period, 40 years, it'll grow and you're over almost $1.2 million. And if you're closer to your retirement age or you're closer to things, just adjust these numbers down. Maybe you need to put in a little bit more and take out less years to grow. The point of all this is that by investing in an asset class like stocks, which will be riskier but outgrow the market, you can see you can get some pretty good returns here over time, and that's what helps fund your future goals and your future dreams. So can you make money in the stock market? Yes. Now, is it risky? Yeah, and that's what we're going to talk about in the next lesson here, and we're going to look at the worst case scenario, and I think that'd be pretty interesting. Well, what's the worst that could happen? And that's coming up next. Okay, as we've seen over time, stocks can give us a pretty good return, maybe a great return, especially compared to inflation, especially over time, and especially as you use compounding and continue to add and continue to buy and let that money grow and compound over many years. It was actually Albert Einstein who said that compounding was the greatest discovery or the greatest phenomenon in the universe, which is interesting. He's the E equals MC squared guy, of course, and yet he recognized the benefits and the power of compounding. But stocks can go down too, and that's the risky part about it. And so we're going to take a look here. Well, what's the worst case, a worst case scenario? And at least what history tells us the worst case scenario was the Great Depression, right? Many, many years ago, and we actually have things in place now from governments and ways they get involved with monetary policy, adjusting interest rates up and down and things to try to prevent another Great Depression. But let's say that's the worst case scenario and it happened again. How could we survive that? Can we survive that? And what actually happened back in the past? So worst case scenario was the Great Depression and this big stock market crash. You might have heard of the stock market crash, and we're going to look at that. Otherwise known as Black Monday and Black Tuesday. And they weren't black because the numbers went up. They should have been maybe called Red Monday and Red Tuesday because the numbers went down, way down. The stock market crash went way down, worst of all time. And it was bad, really bad. How bad was it? Well, on Monday, the stocks went down, unexpectedly down 12.8%, almost 13% in one day. The entire market, one day, boom, down 13%. The next day, down 11.7%. 2 days in a row, down 11.7%, and then continued. So within 2 days, all of a sudden, 24% of returns of investments were gone. Think of that. A quarter of everybody's stock market portfolio gone, zero. Well, not zero, but gone 25%. in 2 days and how long that might take to make up for it. And we're going to do some interesting analysis here. I'm going to do a demonstration where you can kind of see, well, what was it like and how did the returns bounce back and how did people survive these worst case scenarios? And they actually did quite well. So we'll look at a couple of time periods of the Great Depression, 1929 to 1939, and 29 to 39 roughly, which was the beginning of World War II. Another big seismic traumatic thing in the world, right? World War II. And we'll see, well, what happened between, like, if I invested right, at the beginning of the Great Depression, maybe earlier in the year, 1929, through the Great Depression, how did I do? And how about 1929 to 1945, 46, as far as World War II? And if that's the worst time, how did that end up looking for folks? So let's go ahead and take a look at that. And I'm going to go back to MoneyChimp as a nice little compound interest thing to really help us do that, because they can look back at historical market returns and you can do some what if scenarios yourself as well. Okay, I'm back here at MoneyChimp.com. This is /features market, dash CAGR. If you just search MoneyChimp compound annual growth rate, or CAGR, CAGR, you'll find it too. Got the link there in the course as well. And you're looking for overall stock market returns. They have a CAGR where it's looking at future values, but we want to look at stock market returns historically is what we're going to look at. And we're going to do some date ranges and things and look at these worst case scenarios during the Great Depression and World War II. And CAGR, it basically stands for compound annual growth rate. So it's a different number than an average rate. You hear in averages, we looked at the first number was kind of average returns, things that in that portfolio number, we're looking at 10% average, but actually CAGR looks at things going up and down, and so it's more compounded, and it gives you a little bit better actually number, but a smaller number. Actually, you're going to get a smaller return number if you do it from a compound annual growth rate, if you get real kind of geeky about it, I guess. But we don't have to worry about geeky things. We just want to look at returns over the years. And you can see on the left-hand side here, how they have the returns for every year. So if you're wondering, like, well, how was 2009? I heard that was a big bounce back from the the crash with the where the stock market went down 37% and bounced back up 27% during the Great Recession. A big dramatic time for us. But let's go in more recent history. But we're going to go back and we're going to look at the Great Depression, because we want to see. I want to know the risk here. I want to know what's the worst case scenario. So we'll look at the beginning here. I'm typing just the dates. Here's January 1st, 1929. So the beginning, the market crash happened in October. So there's a little bit of gains early there, but really that big crash wiped them all out. And we're going to go to 1939, the end of 1939. Towards the end of 39, of course, is when the World War II began. So this is really kind of covering that whole Depression decade. So I put in the dates. I'm going to include dividends, like we're reinvesting in dividends, and we're going to see what our return is, and we'll walk through this here real quick. So I hit calculate after I put my dates in, and we'll adjust for inflation in a second. I'll demonstrate that. But first, you can see the average return, even during the Great Depression, was 3.86. Now that's the average. That's not compounded, so a compounded number will be less. And that's where that annualized CAGR is, a negative return, because the stocks go up, but then they go down dramatically. It takes a little more to get, recapture those gains. So that compound annual number is a more conservative number. And you can see that's a negative 1.1%. All right. So even in the Great Compression, I'm not losing 30% every year. I lost 1%, but over a long period of time, over 10 years. Also, the standard deviation is a measure of risk. The bigger the number, the more volatile risk is. And 31% is huge risk. Lots of big swings during the Great Depression. So later in the course, we'll have some things around standard deviation and beta as far as measuring risk. And you'll learn all about that. It'll be real easy. But understand, this just showing this big number means that's really, really risky. And $1, if you invested $1 US, it would have grown to 89 cents based on a CAGR. Not grown at all. It means you would have lost money. Your investment would be worth 89 cents. And you can do the math if you had 10,000 or 100,000, how much less you'd have. But it's not the complete devastation that you might think of during the Great Depression, but it was for a long period of time. That's why holding stocks can be a more long-term game. Now, if we adjust for inflation, because something unusual happened, because think about the Great Depression, where prices, which is inflation means prices are rising in goods and services, were prices rising? Was it more expensive to buy something? And actually no, because think about it, all these people are out of work, the stock market's been crashing, so if we adjust for inflation, let's see what happens here, and we just calculate, we actually get a better return in comparison adjusting for inflation because prices went down, or deflation. So actually, even though my return was negative, when we saw it without inflation, now our return is actually a little bit positive. And our dollar, in effect, comparing inflation, actually grew a little bit because of the pricing pressure of this very devastating time. And you can see that here. Now let's play this out further. Let's say, well, we're a long-term investor. We invested at the great stock market crash, which we're not. This is just truly for academic, so you can see worst case scenario because it's so much better now, but we want to look back at the past as well. And let's say we go up to 1946, right? Right past the end of World War II. We took out the inflation measure. We're adjusting for our dividends. And what happens? We started in 1929 and we went to 1946. What was our return over that time period? You can see it's pretty low, right? It's still, well, 6.49, that's not so bad average, but our CAGR, our adjusted returns 2.77, not the end of the world, but not negative either. Remember, this is the Great Depression and World War II, and looking over the stock market over a period of time. Still high standard deviation, but our dollar grew as well. So even during like a worse period, and I'll show a better period here so we can see, and if we adjust for inflation, actually something unique happens here, or it should, yeah, where it went down, our overall annualized return went down, and our actual dollar grew less because we had prices start to come back as there was a recovery, right? So you can see even during these worst periods of time, over 2 decades, almost 2 decades of the Great Depression and World War II, in effect, my purchasing power and my return grew over that time. And you can have fun with this and, play with it during different time periods. I mean, if we were to, have fun and look at, let's say, 1990 to the year 2000, let's say 1998, you'll see some crazy numbers because that was during the time of the dot-com boom where the technology stocks took off because of the internet, there's new technology. You can see 18%, and our dollar grew, just dramatically. So you can see how you can have that, and then how the bubble can burst as well. So really the thing to take away from all of this is understand that your investments can grow over time, but there might be some ups and downs with it. But even worst case scenario, at least my feeling on it is you're going to be okay in the stock market, but it's got to be over long periods of time. You can't sell right when the stock market crashed over 2 days and went down 30%. You need to kind of stay with it and either continue to invest. And that's the other secret sauce on this too, is when we saw that Money Chimp thing looking at compound interest, this is not calculating in if I kept buying on a regular basis, because then as I'm buying low, it's actually going to grow even more over time. And if we look at this last chart here of the stock market history returns by decade, you can kind of see how the decades played out. This is the average number, but you can see some of these big numbers and some of these small numbers as well. All right, so this is great. So the good news is, yes, you can make money in the stock market. Yes, it's risky, but if you do it over time and if you continually to invest, you're going to be, in pretty good shape. And that's been certainly a secret of mine. Not really a secret; it's pretty well known among investors that continually investing, automating your investments, and continuing to educate yourself, and what we're going to do in the rest of the course, and making better choices in our stocks, our stock mutual funds, and exchange traded funds is going to really help us to be successful over the long term. Let's start with some really basic principles, and these are real basic. They may be too basic for you, but it's good to have a good foundational grounding of really how do you make money in stocks? What's the underlying idea behind all this? And stocks are fun to trade and invest and watch them grow over time. I mean, I certainly enjoy that, but in the end, what we really want our stocks to do is make money for us, so we can then use that money to fund our goals, fund our dreams, whatever that might be, buying a home, retirement, college education for your kids, whatever it might be. Stocks are a way to make money, and we want to learn how you can make money. And there's 2 big real ways that you can make money, and that's through growth and through dividends. So let's take a quick look at that. So first off, let's look at growth, or capital appreciation, if we've heard that term, capital appreciation. And that's the classic, I buy stock low and then I sell it high, right? Who hasn't heard of that? Buy low, sell high. And that difference between what you paid for and what you sell it for, well, that's your profit. That's how much you've made. And so that's your growth. You want to buy low and sell high. And the interesting thing about stocks is it's a trade, right? If I'm buying a stock, that means somebody's selling a stock. They're trading, right? So I buy and you sell. That means you might not think too great about that stock, or you think there's better stocks, or maybe you're just cashing out to, then spend the money. But I'm thinking I'm going to buy that stock because I have high hopes for that stock. So, and I'm hoping it will grow over time and capital appreciate. So the stock market is a very interesting thing where you're bringing together buyers and sellers, and both have different points of views on the exact same stock or mutual fund or whatever it might be. Now, of course, the beware around this, of course, is that stocks can go down. Sometimes they can go down and never recover. I mean, when companies go bankrupt, their stock price goes down, down, down. Eventually, it gets delisted and they're bankrupt and you're out your money, right? Maybe you got a little small claim or maybe a little bit, but most times they go bankrupt. As a stockholder, and we'll learn about this, you're kind of out. So that's the thing, stocks can go down, and they might go down, you might want to sell them because they're going down, and then somebody else is buying it, hoping that it will rebound and go up, and we're going to learn about all things like that. So capital appreciation, right? Simple, buy low, sell high. The other way you can make money in stocks is through dividends or income. You're basically getting regular income. It's very much a passive income thing. You don't have to do anything. By virtue of owning the stock, typically on a quarterly basis, you get a payout. The company that the stock you own pays you money. Wow, what a great thing, right? So even if my capital never appreciates, maybe even I might lose by the time I sell out on that stock, so I might not have any capital appreciation or growth. But if it's a dividend-paying stock, and not all stocks are dividend payers, but if it's a dividend-paying stock, it's going to pay me quarterly a regular check, basically, of income. And it's kind of a thank you for being a holder of the stock, but the big part of being a stockholder is you're an owner in the company. It's more than just a thank you. It's like, hey, you're an owner and you're looking to take that money out of the business and then invest it in other things or spend the money on something fun or a home or a vacation or whatever you might want to spend the money on. So, but it's regular quarterly income. And so that's why a lot of people like dividend stocks, because even if they don't get that growth, they're at least getting some regular income from the dividend coming up. Now, some growth stocks, like a high-end tech stock or high-growth tech stock, might make so much in capital appreciation that overall it does much better than even if you have a great dividend-paying stock. And so that's the trade-off between growth and income or growth and dividend-paying stocks. One beware around this, key beware around this dividend aspect is that companies don't have to pay a dividend. Now, companies like to pay a dividend. They've been paying it regularly. That's something they really promote, and people will buy that stock because they've been paying a dividend for 30, 40, 100 years in some cases. But at any moment, they could either reduce the amount of that quarterly dividend or the quarterly payout they'll give you, or eliminate it entirely, particularly when times are bad. We saw during the Great Recession of 2008, 2009, lots of companies were struggling, and just to stay afloat, not only were they laying off people and doing other things to reduce their expenses, but they were also reducing the size or eliminating their dividend. When they do that, it makes your dividend price, your actual price, what you paid for the stock, go way down, so you miss out on capital appreciation until it comes back up if you want to be a buy and hold type person, or you're missing out on that income that's coming in. So, there's a downside risk to dividends, but dividends are great to give you that regular income. That's why a lot of financially independent people or retirees like dividend stocks, because they get that regular check coming in that they use to help fund their retirement, basically. And then lastly, there's kind of like the in-between, right? There's like growth stocks and dividend stocks and things that, how you want to meet your goals with both those. But there's also, you might have heard terms like categories like growth and income. Maybe you've seen some mutual funds that promote themselves as a growth and income fund or something of that nature. And isn't that great? You get the best of both worlds, supposedly, all right? You get growth in the stock, they're looking at that, and then you also get some dividend paying too. And ideally, that's what we want, right? We want to invest maybe, let's say, in dividend stocks, but we want some growth as well if you want that combination platter. The challenge with that is sometimes companies are really great on the growth end and they don't pay any dividend. Well, that might be a better performing stock than a growth and income type of stock. Or stocks that are really, really good at paying a high dividend might not have that high in growth, but they pay a good dividend and it's a solid regular payer versus maybe something that's more in the growth and income kind of that combo category. So that's a basic overview. This is the pretty simple stuff, and then we're going to build from that. And when we start thinking about selecting stocks and looking at ratios and looking at things like, when you look at things like, can they continue to pay out the dividend? Things like a payout ratio is very, very important. But in a nutshell, as you go through everything in the course, understanding the different aspects of stocks and investing in stocks, understand underlying all of it is these two very big concepts of, is my stock going to grow up or grow up? Is my stock going to grow? Maybe it'll grow up too. Is my stock going to grow? And maybe it's mature. That's the growing up, right? So is it going to grow and I make money on that capital appreciation, or will it pay a dividend? And if you look at a life cycle of many stocks, they start as, maybe small companies, they don't pay a dividend, they have this high growth, and then when they get to a certain size, maybe then they've slowed down their growth and now they want to start giving back money in terms of shareholders to shareholders. into terms of like dividends. A good example like that would be Microsoft, for example, high-tech company, right? So for the longest time, they invested all their money back in their company and had a lot of cash on hand, and they just grew, and they want to be like any other tech stock that wants to really grow, but they started reaching some maturation points. They had such cash on hand that they just really didn't know what to do with, so they started paying that out in dividends and rewarding those owners. So it went from a small startup from many decades ago to a high growth company, to a mature company, to a more mature company that's still growing, but also is rewarding shareholders with a dividend stock. So if you've held Microsoft, for example, since the beginning, well, you've been very well rewarded. But either way, you're looking at growth and income or growth and dividend as a way to make money in stocks. Let's take a moment and talk about the difference between investing, trading, and gambling, because there is a big difference between the three, and it's important to know the differences. So if you think you're investing, but really what you're doing is trading or gambling, you really need to know the difference between that. Otherwise, you can kind of get in a lot of trouble as far as the returns or your success. So let's look at investing. So investing is really, think of that as long-term. It's a long-term play when you're talking about investing. It's not a short-term fix like gambling might be, or hoping to hit a home run or anything like that, in a very short term. It's a long-term play is how I would characterize investing, and you're really investing towards specific goals. You are putting in money to get a return on that money, to grow your money so you can reach a certain goal, whatever that might be, saving for college or university for a family member, or saving for your own retirement or financial independence are very common investing goals. So you're saving for a specific goal, and that you have a plan around it. And that's a big part of what this course is, and my Investing Success course is all about, kind of planning and how to have a plan around it and sticking to that plan and executing the plan. So investing, long-term play, specific goal, you have a plan, you rebalance as needed. So if your stocks really take off, or a certain part of your stock portfolio, maybe a large cap stocks or technology or something we're going to learn about later in the course takes off, well, then you can rebalance to kind of put your portfolio or everything that you own back in place, but it's still going towards that specific plan. You're still making these adjustments for the long term. And you can really succeed with investing with long-term basic principles that you can use over time. As we've seen and as we know about investing over time, it's all about time and time value of money, and let your money work and compound interest and all that working in your favor. So investing can be a little bit boring at times, but it's really all about that long-term play and saving towards those goals. Let's compare that to trading, because they're very close. They're closely related. Trading should be fun. I do some trading, and I'll talk about at the end, how I invest, how I trade, and even how I gamble. And trading is fun. It's more of that short-term play. Maybe it's something you're looking at, buying a particular individual stock, or something you might be trading or making more frequent moves. So if investing is more along the lines of, let's say, buy and hold, even some active part, but let's say more buy and hold for a long term. Trading would be something that'd be much more active. In fact, there's a concept called day trading you probably have heard of, where you're basically trading multiple times in a single day, trying to get that little bit of edge as you make these trades. So trading can take a lot of work. It might also need more money, as far as if you're a frequent trader and you want to have at least some diversification of 20 to 30 stocks that you might be trading in and out of frequently. So think about that as far as your investment of time, and concepts you'll learn in this course you can use in trading or investing, but think about your concept as far as the time that you have. And also you'll incur more transaction fees if you're doing lots of trading. So when we talk about fees, you'll learn about how each time you're buying and selling, you're incurring fees. So the more trading you're doing, the more actively buying and selling stocks each time that incurs a fee. So understand that your overall return maybe it looks great. Maybe you're a great trader, but all those fees eat away at it. And so many times a long-term investor will certainly outperform a very active trader in most cases. That's why you hear a lot about like index mutual funds, where there's very little trading going on within the fund at all, because it's basically buying the index, and we'll look at those. But that's the concept behind that. The other thing with trading for individuals is it can really run into more behavioral issues too, and things to be aware of. A lot of times people might be not willing to sell their losers, for example, because they have hope that it's going to come back, the stock is going to come back, and they ride it all the way down when they should have really just bit the bullet and sold it. So there's behavioral issues. Or maybe you're chasing after winners because you're chasing after somebody that your neighbor or your coworker said, hey, this is a great stock, go buy it, and you're getting in late and you're really buying high, and maybe you missed out on that, and now the price has gone down. Or so you're not buying high and you're not buying low and selling high, you're buying high and then selling low, which is, a loser's game, of course. So be aware of that with trading. Do you have the time with that? Do you have the behaviors to, make it work for you? Understand to get more diversification. If you're doing lots of trading, you might need more money for trading individual stocks. And it's really all about succeeding by personal skill. So it's you thinking that you can beat the market, that you can beat others who do this maybe full time, immediately looking for those little edges. And I do a little bit of it too. And I'm very successful with that, but that's not my whole portfolio. I'm more of a long-term investor with some trading that I kind of do for fun. Remember that first part about fun. Now gambling, if you gamble at all, that really should all be about fun. I mean, if you're gambling to try to think you're going to beat the house or be real successful, especially over the long term, that's really hard to do. If you're very successful at that, don't even take this course. Go gamble and be successful gambler. Maybe take a gambling course. I don't know. But the idea is that, gambling is, if you do it, is meant to be fun. You want to try to limit your losses, but the idea it's fun. It's not investing and it's not trading. It is gambling. And one thing that, any, many people will tell you is when you gamble, kind of expect to lose. I mean, think about these big, massive casinos that you see out there in Las Vegas or Monte Carlo or wherever across the world, these big, hotels and casinos. Well, they're funded on gambling money, your money and my money, right? So they're making a lot of money. So if they're making a lot of money, who's not making a lot of money? Well, it's the individual gamblers. So I approach gambling like if I'm going to gamble for fun, bet on horses or play cards or whatever it might be, that there's an expectation to lose and I want to limit my loss. Really, if I go to the track, for example, once or twice a year, I might go, watch the horses race. It's fun. They're beautiful animals, but I only bet very small amounts, $5 US or less sometimes, and only money that's in my pocket. I don't bring credit cards or anything like that. I'm just willing to lose a small amount. It's more about having fun than trying to, make a big score, so to speak. So one question might be, is something like day trading where you're frequently trading, is that kind of gambling? I mean, even in gambling, you're trying to evaluate, let's say a horse, or evaluate something and then make a bet on that. As day trading gets a little bit more like gambling, might be one way to think of it, versus long-term investing where you put it and you invest your money and let it work for a long period of time. So that's something to think about when you're looking at investing versus trading versus, let's say, gambling. Now for myself, to share, I'm all about investing. I'm a long-term investor. That's where I've had my success. And what I'm hoping you'll get out of this course is that long-term investing towards specific goals, rebalancing, making changes as you needed, and building a good diversified portfolio. Those are the ways to success proven over and over again. So I consider myself an investor, in particular a long-term investor. But I do trade too, as far as trading stocks. And you'll learn about different ways you can apply these principles from financial ratios to whatever we're in the course here, so you can do trading as well. And I do that because remember that part about fun. It's fun for me. It's interesting. It keeps me engaged in the market. It keeps me engaged in stocks. And I've had some success because I'm only looking at a narrow basket of stocks, and I'm maybe actively more trading versus my long-term buy and hold type strategy. But it's really about fun, and I make sure I watch my behavioral stuff. That I don't do something dumb like buy high or sell low or something like that. Just be aware of that. But understand it's not like what I'm doing 100% of the time. I'm an investor with some trading. And as far as gambling, as I mentioned, I might bet on the horse every once in a while, but that's all for fun. Lose very small amounts of money. I think the most I've ever lost was like $20 US or $30 US, something like that. Keep it very small, and I've won some too, but it's all about going out with a family or friends and having fun. So take a step back as we go through the course and think about yourself. Am I an investor, am I a trader, or am I a gambler? And I'm telling you, for long-term success, err towards the investing side. You'll be glad you did. Did you know that I actually own Google? That's right, I own Google and Apple and General Mills and Johnson & Johnson and Wells Fargo, a big bank. I mean, I own all these companies. Isn't that something? Isn't that spectacular? Well, heck, you can own all those companies too, and that's really what a stock is. We're going to talk about. So what is a stock really? And it's really about ownership. You can be an owner. Now, I might have a few shares of these things, so I'm not worth billions of dollars like, some major shareholders. But heck, if I have one stock of Google, I'm an owner in Google, or an Apple or whomever. If I have one share, I'm an owner. I'm a small owner, but I'm still an owner. And basically that's what a stock is. And we're going to talk about it from the perspective of a public company, something that's publicly traded that you and I can buy and sell stock in that company and be an owner and buy shares and be an owner in that company, or sell the shares and decide not to be an owner in that company or maybe a smaller owner in that company. So that's what really stock is from a public standpoint versus, let's say, private ownership, or you're starting your own company or something like that. But publicly traded stock is about you having ownership rights. You're basically buying that stock or giving, in effect, the company money through, at least the original folks who were with an initial public offering. I mean, when they first bought into the company, they're an owner of that, and then you can sell those rights to other people publicly. So you're an owner, you have a claim on the company's assets and earnings. So you, as an owner, you have a claim on that. And as they do well, maybe they might pay a dividend based out of their earnings, every quarter giving you money back, or certainly you make money as your stock price rises up. Those are the benefits of being an owner. More risky being an owner because the price could go down, or they could cut the dividend, or go bankrupt, or all sorts of things. So a publicly traded stock is sold on a market like the New York Stock Exchange or NASDAQ or Nikkei, or all these different types of exchanges that are out there where stock is publicly traded, and you can buy and sell stock. You have voting rights because you're an owner. Now, if I own one share of stock of, let's say, Google, and there's lots of shares out there, I have very little power on that, but you do have voting rights. Sometimes you'll get like things in the mail where I'll ask you about, to vote on something on the new board of directors or a change in the company or whatever. So sometimes you get voting things with there. But for most folks like you and I, it doesn't really impact that much as far as the company. But big major institutional investors where they might own, let's say, 10, 20% of a company, especially a smaller, medium type company, they're very, very strong and very powerful because they are owners in that company. Now, you're not involved with the day-to-day operations, so I'm not deciding whether the Google self-driving car is going to be released next month or something of that nature, but I want to be aware of what's going on with the company so I can decide whether I want to continue to own it or maybe I want to sell it and invest in something else. But you're not involved with the day-to-day operations. And the idea of owning stock, from our perspective, from an investing standpoint, is we want to get a return on our money. We like being an owner, that's nice, but we don't get lots of benefits from it. Really, what we want to do is invest that money, have it grow, have it get a return on that investment, and then be able to later use that investment to fund things in the future, things we want to buy, a home or college or retirement or financial independence, or maybe leave some money to our heirs, after we die, to help set them up for their future. So there's all these reasons why we invest, and we invest in stocks to get a return. And one thing about investing in stocks is we're looking to get a better return because it's more risky. Stocks are more risky than many other asset classes or other types of things like bonds or cash, which is much more safe, for example, or gold, or different things that you can invest in. Stocks is a part of your overall investment strategy and part of your portfolio by investing in stocks. And that might be a more riskier part of your portfolio, probably the most risky part of your portfolio, actually, for most people. And it's the one you expect the biggest return, especially over the long term. And that's why people invest in stocks, and we're really looking for long-term returns by being an owner, by buying in the stock. So stocks can have real short-term way ups and downs as far as movements, but over the long term, they can be very, very successful compared to these other assets, and that's what we're looking for. So that's really what a stock is. And so if you own a major index fund, let's say like the S&P 500 fund, which is the 500 largest United States-based stocks, heck, you own all sorts of stocks from McDonald's to Coke to Google. So, congratulations, you're an owner now. So where do stocks fit in a diversified portfolio? A portfolio being think of it as a basket of your holdings of your investments that you have, your various investments. Maybe you have some cash investments or bond investments, or you have precious metals like gold, silver, you have investments there, and investments in stocks. And within stocks, you have individual stocks or mutual funds or exchange trade funds, a lot of different variations, of course, on that. But your portfolio is basically your whole basket of all your holdings that you have as far as your investments. And so where do stocks fit in there, and how does that kind of relate to your risk tolerance? And a couple ways to look at it as far as building a portfolio. One is to think about how far away is your goal. If you're saving money, let's say, and you're investing money because next year you want to retire, let's say, for example, well, if you're buying stocks today that, a year from now you want to retire, that is a very, very risky move. See, stocks are have a lot more volatility or risk, as in they go up and down frequently, actually every day, but sometimes they can have wide swinging periods of return. So stocks typically are looked at from a risk standpoint as far as a longer term investment. I've seen folks say like 3 years or more, or things of that nature as far as holding stocks. You might even want to be even going beyond that. But the idea of investing in stocks is long term, think long term, versus let's say investing in cash where you get very little return on your cash, but it's something you can get at real right away and you're not expecting a great growth on it, but you're not expecting it to go down either. It's not going to go down 10% in a day like an individual stock may. So think about when you're building a portfolio and where stocks fit in is how far away is your goal. The further away it is, the more stocks that you can have as far as a risk idea. Think about your risk tolerance, and there's various tools and things we'll look at online in the as far as different tools you can look at to determine your risk tolerance. But even without using a tool to figure out your risk tolerance, you kind of know in your gut a little bit, like, when stocks go up, yeah, everybody feels good about that, but how about when they go down? How if they go down 10, 20, 30%? What if your stocks went down 30% in 2 months? What would you do? Would you sell? Would you feel really uncomfortable about that? Or would you be enthused and want to buy more of the stock, thinking you're getting them on a bargain basement deal? So if stocks go down 20% and you look at it as, hey, what a great buying opportunity, I'm going to take some of my cash and buy more stock. Well, you're a very risk averse, or you're a very risk aggressive investor. You're like, I want to take on more risk to get more return. If it's down 20% and you feel queasy or very nervous about it, well, then you're more risk averse, and that's okay. Just the key things you want to understand is where you're at on risk tolerance. Stocks are more risky, and so the more stocks you have in your overall basket of investments, your portfolio, the more your overall portfolio will go up and down. Particularly that down part is how do you react when it goes down. So understand stocks are more for the long run and are more risky, and understand how that relates to your risk tolerance. Lastly, think about need too. When are you going to need the money? Well, that's how far away is your goal, but what is it looking to do for you? Are you looking to invest in maybe stocks for a long period of time where you want them to grow and grow faster than inflation and grow very well because you're not going to tap into it for 20 or 30 years? Well, then you can take on more stocks, or you can take on more aggressive growth stocks. Or maybe you're like a retiree right now. Let's say you're going to retire in a year, or you're going to retire and you have a lot of income producing things like cash or bonds, which are made to give you income. Maybe you want to supplement that with a few dividend type paying stocks or dividend mutual funds, things that pay out income that are dividends, but they get you a little bit more growth because there's still a stock, still more risky, but less risky than, let's say, a high-tech stock, for example. But it's a less risky stock that'll still pay you every quarter some money or income, and you have that be a small part of your overall portfolio or basket of your holdings. So think about how far away is your goal, how is your tolerance for risk, and then kind of what you're needing out of this. Are you needing growth? Are you needing income? Are you needing a combination? Do you need safety? In that case, you might be have very little invested in stocks. So those are three big things to consider to get you started with that. And the next lesson, we're going to look at some sample portfolios. Like, well, okay, this is nice, but do you got some ideas? Like, if I'm a moderate investor or aggressive investor, what might be some ideas of returns and some ideas of some basic portfolios, what percentage to put in stocks and what percentage to put in something else to just at least help me get me started, at least start thinking around that? Well, we do, and that's the next lesson. So let's look forward to that next lesson and learn about different ways that we can make up a portfolio with a variety of assets, including stocks. Well, as you know, it's important to diversify your overall investment holdings to balance risk versus reward, or risk versus return. And so that's where you have different asset classes like stocks and bonds and cash and precious metals, maybe like gold and silver, and whatever else you might have invested in, the real estate, whatever it might be. You have a variety of asset classes that you're investing in. Now, within each of those asset classes, you want to have a variety of assets within that. Maybe you have some bond holdings. You want to have maybe short-term bonds and medium-term and long-term bonds, and maybe government bonds versus corporate bonds. There's a whole bunch of things you can do with just bonds. But this is a stock investing course, so let's talk about stock. So not only is it important to have a diversified portfolio of these different asset classes, stocks, cash, bonds, etc., you want to diversify your stock holdings too, whether they're individual stocks or mutual funds or index mutual funds or exchange-traded funds, whatever it might be of your stock-based holdings, your public stock-based holdings. You want to diversify those as well. And there's a variety of ways to do that. Three big ways that we're going to look at to really diversify. And then within those classes, you can hold a whole bunch of different types of securities or equities or stocks, all mean the same thing, so that you can have diversification within each of the categories. But to start, the three big things you want to look at is how am I diversification? What types of things do I hold in terms of size, style, and sector? And so what we mean by size is probably what you think. How big is the company? Is it a large company versus a small company? And in the next lessons, we'll look at the differences between like a small cap, mid cap, and large cap, or capitalization, a small capitalization stock versus a mid or large capitalization stock. And what does that mean, and how do we evaluate stocks based on their size? Next, we want to look at also how do we evaluate stocks based on maybe their style or style factors like, where do they fit? You probably heard the terms like growth and income, or maybe in value, right? So if it's a growth stock, maybe it's a high technology stock that's on fire and they're growing like crazy. Well, that's a growth stock versus maybe a 100-year-old company that pays a great dividend that might be a value or more of an income type stock. And where does value come in as far as, is it overvalued or undervalued? And is there a way to have a value-based strategy? And there is. Also maybe where they're based, domestically or international, is another way of style and breaking up the style, whether it's a stock, a mutual fund, ETF, whatever it might be. And lastly, sector. What sector does that stock, is it related to? Now think of it as like an industry, right? So if you're looking at ExxonMobil, a big natural or oil and gas type company, well, they're in the energy sector. That's what they do. Versus, let's say, Coke and Pepsi, which are beverage makers. They do other things too. And that's the thing where it gets a little weird sometimes. You have to dig a little bit, but they're primarily a beverage maker of soda drinks or carbonated beverages. Where I come from, we actually call them pop. So every culture might have a different way you might call Coca-Cola or Pepsi, but they're all within sectors. If you have a bank, that's in the financial sector, and then even within the financial sector, it can break down from there. Or the healthcare sector, you can break it down into subsectors from that. So for example, let's say healthcare, you have healthcare as an overall sector, but then within that sector, you might have things like hospitals is a subsector or a subunit. And then you might have pharmaceuticals, people who make drugs. Drug companies are pharmaceuticals. You have nutraceuticals, which is like nutrient type things and base things around that, or medical devices such as heart stents and valves and things like that that are more of a device to treat people versus, let's say, a pill or a drug like a pharmaceutical company might make. Or how do you do insurance? Maybe you have managed care or different types of healthcare that might fall under that overall umbrella of healthcare. So, and then there's also things like biotechnology. Or biotechnology stocks and things of that, like Amgen. So there's a lot, even within a sector, that you have all these different subsectors. So if you were to say to somebody, yeah, I'm invested in healthcare stocks, the person should say to you, that's great. Which sector of healthcare are you in? And then you can maybe talk about individual stocks. And some individual stocks might play in lots of sectors. Johnson & Johnson, they do medical devices, but they also do a lot of things in medical around, things in the operating room and some things around that. And you probably know Johnson & Johnson from Band-Aids and things that you can buy as a consumer. They make those. So it's very interesting as far as how you can break down stocks. So that's one way to diversify your holdings, is looking at these categories. And we're going to really explore that more in great detail next in the upcoming lessons. But think about if all I own is large cap stocks, well, I might be at more risk than if I had a mixture of stocks that might be small or medium versus domestic or international. And maybe I need a variety of sectors too, so I'm not all in energy or all in healthcare. And that's the way you want to diversify your stock holdings as a subset of your overall holdings. So think your overall holdings, stocks, bonds, cash. You have your stock section, diversifying it around size, style, and sector. And that's what we're going to look at now. Well, does size matter? Well, it does, at least when it comes to stocks and your portfolio and how you want to build your overall compensation or composition, that is, of investments. And so first thing a lot of people look at is size, big, medium, and small type companies. And it's not really organized that way, really, because you think, well, what is a big company? Does it mean it has a lot of employees? Is it like, in the top 10% in sales? Is a big company something that's very profitable? Or is a big company that has operations all over the world? There's small companies that might have 10 offices all over the world, but they might have only 40 employees total, really. They're just spread out all over the world. So in the stock market and investing, how do we determine what is a large, mid, or small size company? And how it's done is through a cap or capitalization. It's a market capitalization. So if you're looking at stocks, you might see this little thing in the stock screeners or all that, or around their quote, they're saying, their market capitalization is X thousands, or maybe it's, it might even say like large, mid, or small, like on a mutual fund. It might say like, we're a large cap mutual fund looking at stocks. And then they might break it down further, international, value, growth, whatever it might be that we're going to talk about in a second. But first step, let's look at large, mid, and small cap stocks. And so how this capitalization is calculated is looking at the stock price, what do you pay for one share of that stock, times the overall number of shares that are outstanding or out there that could be publicly traded as far as the number of shares. So you multiply those two numbers together, you get a big number, and you have your share price, right, or your market cap. And then from there, that's how organizations or how like things like mutual funds will break down whether somebody fits in large, mid, or small. And typically the numbers are, once you multiply your stock price times the number of shares, the general cap ranges, or what makes a large cap, are typically like 10 billion, the number will be $10 billion plus, right? So it's your stock price, which is a price per share, so it's a dollar amount or whatever, numerical value amount, but it's a money amount times the number of shares. So large cap is 10 billion. We would use like, US numbers. I have folks from all over the world. I'm very grateful for that. So bear with me as we use US dollar-based numbers for the sake of education here. So we have large cap would be 10 billion plus. Mid cap is typically between 2 to 10 billion, would be considered a middle size, not large, not small, but in the middle, a mid cap stock. And then a small cap would be anything that's less than 2 billion. As far as stock price times number of shares for your capitalization, a small cap or small capitalization stock would be 2 billion or less. And so why that's important is it's really a matter of how you put together your portfolio, right? So if you have a portfolio that's all these large cap stocks, that could be great, but maybe you're missing out on things that are happening in the small and medium area. If you're invested heavily, let's say, in small cap stocks, which tend to be a little bit more riskier than a well-established large cap or large company, but maybe give you a potential bigger return if somebody goes from being small and nothing in somebody's garage or a little small company and becomes Apple Computer, for example, becomes a large cap, well, that can be great gains for you. So you want to have a mixture within your portfolio of these different types of stocks, based on, your overall portfolio and what your long-term horizon is and what you're looking to do. I mean, if you're looking to have a portfolio that has real heavy on, let's say, paying out dividends, where you get quarterly income, well, that's going to typically almost always come from large cap stocks. They're well established, they got money, they can pay back money, where a small cap person might be like, we're just trying to stay alive and we're trying to invest in the company to grow. Same with mid cap, so we're not going to pay a dividend. So those are things you might want to look at as we go through the course here. So you want to have diversity inside your asset class, so you have stocks, and so size within there is a way to do that. It also helps reduce your overall risk. Let's say large cap stocks have a period of time, and they have, like all asset classes, where they've struggled, while possibly small cap stocks might be outperforming them, or mid caps might be outperforming them over that same period of time. So if all you invest is, let's say, in one asset, like large cap, you're going to ride that elevator up and down within that class, and miss out maybe on things that might be helping as far as with small and medium. And also by doing that, you reduce your risk. You don't have all your eggs, so to speak, in one basket. You're not all in the small cap basket or the mid cap basket. You're in the large cap basket. You're all going to have diversity amongst those asset classes. So, and it also helps narrow your research down too. Maybe you're looking at your overall portfolio and you say, oh, I'm pretty heavy on small cap stocks because they've grown recently and I want to rebalance. Maybe one way to rebalance is I'm going to buy some new stock, and I might want to look at large cap or medium cap or mid cap to try to be myself more in an overall balance. And we'll look at these different types of balance and diversification, but to get an idea of an overall balance of your overall portfolio within the stock section of your bigger overall portfolio. So size does matter, and it really is very, very important. And one thing you see with folks is they might have more creeping or movement towards one area, and it's really good to look at if you've got some stocks or some investments now, maybe some mutual funds, to look at what you have and look at it from these three factors and say, wow, am I really, over-invested maybe in a particular size? And it might be an opportunity, as we'll learn in the course, how to pick out stocks and mutual funds and ETFs and index funds and all that, to maybe apply these principles to say, oh, let me, maybe now invest in this other size of asset class. So that's one way to do it, is looking at size. Now we're going to talk about style and sectors. So you can evaluate stocks based on your overall portfolio and your stock portfolio on size, large, mid, or small cap stocks. And then any of those stocks, whether they're large, mid, or small, can be evaluated based on their style. Are they a growth stock? Are they more of an income stock? And income and value stocks are very related, a little different. I'll explain why here in a moment, so hang on to that part. But we're going to talk about growth, income, and value. If you've looked at, let's say, mutual funds, you might see like a little square box with all these little squares inside it. There's like 9 squares within it, and it might say things at the top for a stock mutual fund. It'll say, or on the side, depends where they put it, but it'll say like growth in value or growth and income on either end. And really what they're looking at is the style of that stock. What is it related to in terms of other stocks within that style type thing? So Coca-Cola, for example, is a different style stock than, let's say, Google. Doesn't mean they're not successful companies, one versus another, both very successful companies. Just how they behave and some things that you might use to evaluate them, whether you want to invest in them, might be different between the two. So let's take a look at that. So first, let's look at growth stocks as compared to income or value stocks. So growth stocks, think of those as you're looking for growth. You're looking for the price of your stock to go up, or capital appreciation. You're looking to make money. You're looking for your capital to grow. And so these are stocks that are projected, or you're projecting, or people are projecting, for these stocks to grow and outgrow and grow faster than the market, and in particular grow faster than their rivals within their industry. Whenever you're looking at stocks, think about the industry. Some industries might be growing faster as an industry versus other industries, so you want to compare within the industry. So growth stocks are all about high flyers, right? They're the high flyers that things look great and you want to see them keep climbing and really reach a peak and then maybe sell high later, but right now you're looking to buy and have that really grow. And the idea is that the earnings are things that drive up stock price in a large way, or maybe later will pay out money or invest money into the company again. That earnings are growing faster than the industry and market. That's one way to basically recognize a growth stock, that earnings are growing faster, typically much faster than industry and market. So if you look at, let's say, some particular ratios or things that people are interested in growth stocks look at, they'd be interested in things like along the lines of revenue or sales. Are your sales and revenue growing? How's your cash position, your cash flow? Do you have a good flow of cash coming in? Are you running, are you running below? Are you incurring lots of debt or something like that, and you don't have the cash to support that? So looking for cash and revenue that are rapidly rising is typical of a growth stock. They would have a higher price to earnings ratio. What's our price relative to our earnings as a comparison, as a ratio? So these would be high price to earnings ratio, higher than their industry, probably higher than the market. And then a higher price to sales. You're paying for those sales. You're paying a high price. And when I say price, the stock price. So higher price to earnings would be the stock price to its earnings. This would be higher price, the stock price in relation to its sales as a financial ratio as a measure to compare, let's say, an individual company versus others as an example. So you can see the trend here. It's all about high, all about growth, all about, yeah, I might be paying a lot for the stock, but that's okay because it's going to keep growing and it's going to be great, And that's the idea, is that it's investing in the company to have that future growth. So typically growth companies, if you're interested in dividends or companies that pay out money directly to you in terms of cash, maybe on a quarterly basis, a quarterly dividend where they're taking their earnings and rewarding you as a stock owner, rewarding you as an owner in the company, a part owner of the company. Growth stocks typically don't pay a dividend because the idea is they don't want to give you that money as an owner, and you should actually not want it. And here's why. They want to reinvest that money into the company because the prospects look so great that we want to keep reinvesting to grow that company. So the management of the company will say, we don't want to pay out that money. We need that money to invest in things like research and development, or research into quality control, or research into new markets, or maybe into mergers and acquisitions, and buy new companies or buy smaller companies to help fuel our growth. So it's all about fueling the growth. So typically they won't pay a dividend. A good example of a company like that is one you're very familiar with is Google, right? Look how the explosive growth of Google, certainly of its stock price from 10 years ago or 8 years ago, whatever, how it's rapidly growing. A very typical technology stock. Technology stocks a lot of times will be growth stocks because you're investing in them with the idea that they're going to invest in new technology and build new technology and build crazy things like self-driving cars and all that that'll change the world. And when that happens, then their stock price will go up and you'll be rewarded for your patience as a stockholder. So that's growth stocks. You're looking to invest in companies that will really grow and grow rapidly versus, let's say, like income stocks. So if growth stocks are about reinvesting in the company and not paying out money to their shareholders, to their stock owners, to you and me, income stocks are the opposite of that. They want to pay a dividend, and that's the whole idea of your investing in them is you want that income, you want that dividend. That's income basically coming into you that you can use any way you want. Maybe you want to buy more of that company stock. Maybe you want to buy another company stock or a mutual fund or invest in bonds or something else. Maybe you want to go on vacation or use it to help fund retirement or financial independence. Whatever it is, that's cash that's coming to you that's being paid because you're an owner in that company and you own that stock. And we'll talk about dividends and more and all that too, but that's the idea is that you're going to get paid these dividends. You're going to be actually paid money by owning the stock. And that's what you're looking for if you're looking for income stocks versus, let's say, a growth stock, which is all about capital appreciation, the stock price going up. You're looking for, yes, you want the stock price to go up. You might hear like mutual funds called growth and income funds where they want some capital appreciation, stock going up, but they're also looking to grab that income as well too. And some companies, they don't grow as much. They're really all about income. So you still want that growth. You want that price increase, but you might be sacrificing some of that to get some current income now. And having dividends increase over time is also important as far as that growth phase. Not only stock, but you want your payout to increase over time as well. And that's a good thing to look for when you're looking at dividend stocks. And we'll look at about dividend growth rates and things of that nature, as far as over time. So let's say an example of a company like that would be, let's say, Coca-Cola, right? They make beverages like Pepsi, the competitor Pepsi. So Coke pays a dividend. If you own stock, for every share of stock, you get paid out on a quarterly basis a certain amount of money or a certain percentage of money that gets paid out to you as far as being a holder of the stock itself. So Coca-Cola would be considered like an income stock versus, let's say, like Google, which is totally a technology growth stock. Now, that doesn't mean that Coca-Cola doesn't want to grow. They definitely want to grow. They want to expand in new markets. They want to expand their product line by buying other types of beverages or creating new beverages or maybe getting into food and snacks or who knows what. They want to continue to grow their company and continue to grow their stock price. But they know people invest in them because they're not a high growth company. They're a steady growth company, and that people want to get income because they might be giving up some of that growth by not investing in more risky technology stock. They want to be in a less risky stock, maybe like Coca-Cola company, and get paid that income and get paid that dividend. Both types fit within a portfolio, right? You got small, medium, large cap type stocks, but then you have growth stocks and you have income stocks. You might want to have some balance between that, or weight one side a little bit more than another. So sometimes also with income stocks, the whole primary purpose is income. You'll see like utilities or things that might pay, things like communication companies or electric companies, natural gas companies, energy companies might tend to pay a little bit higher dividends or pay out that. And sometimes these people might think of income stocks as value stocks, and that's okay. I mean, the idea is you're paying for value, you're getting that regular value. But I look at it, and we're going to look at the section on value as more value of looking for underappreciated or underpriced type stocks. Could be growth or income stocks, but a lot of times you see value and income used together. So don't let that confuse you. Just understand that they could be a little bit different. Especially in mutual funds, you might see it where it says growth and value, and you might be thinking, oh, well, value, those are like what Warren Buffett invests in and other folks. They want that underappreciated stock to buy it at a discount. No, really, like in the mutual fund world, they're really talking about income stocks. So do be aware of that. And that value is more of an investment strategy, more so than how you might bucket something. Because you can find undervalued companies, or value companies, whether they're growth or income. So income stocks, the whole idea behind that, if you're interested in those types of stocks or having that part of your portfolio, is they're going to pay you income. You might have some tax consequences of that because you're getting money now. But for people who are, let's say, want to balance their portfolio, or a lot of people who are financially independent or retirees, dividend stocks are a huge part of that for them because they want that income coming in to help pay for their everyday needs is one way they can do it. So growth and income stocks. Now let's look at another type, which is kind of value. I look at things mostly from growth and income, but let's talk a little bit about value stocks. So as we break down this whole classification of how you can evaluate stocks, the different buckets they might fall in, or mutual funds or exchange trade funds, where they kind of fit, we're talking about like growth and income. And then the other thing under style that gets in there a lot is value. As we mentioned, you see that in mutual funds where it might say it's a growth fund versus a value fund, which really is more growth versus income if you ask me. This is my opinion on it when you're looking at it. Though, once again, with value, you see a lot of income stocks, dividend-paying stocks that get wrapped up in that, particularly in mutual funds. But a lot of times you hear about value being associated with purchasing of stocks or fundamentals or evaluating stocks. And the idea is that you're looking for stocks that are of value, as in underappreciated, underpriced. It's like bargain hunting, right? You go to the store or whatever, and you're looking for something that's on sale. Well, that's the idea of a value stock. How I look and how others look at this stock is on sale. And there's something going on with the stock that might have driven its price down. Maybe they had a bad earnings quarter, or they had a bad announcement, or said something, sales are going to start slowing, or something was happening in the global economy, whatever it might be. But you feel that they're underpriced, they're underappreciated, and that their long-term prospects are good. And you're kind of bargain hunting. You're looking for that great value, and you're looking for great companies basically at discounted rates. Looking at their things like their cash flow, and looking at their debt ratios, and looking at some things we'll be learning about as far as ratios. To look at what could be a higher long-term gain with that stock. A lot of times value stocks can have a greater risk. That's where they differ from income stocks, true income stocks. A true income stock is usually a larger company, pays a regular dividend. Maybe it's a company like Johnson & Johnson that's paid dividends for 50, 60, 70, 80 years. Companies that paid for hundreds of years of dividends coming out, so they're probably not very risky overall. But value stocks can be risky because whether they're a growth stock or a dividend-paying stock, the idea is they're undervalued. And maybe they're undervalued for a reason. Maybe they're struggling for a reason. Maybe they're about to go bankrupt. Maybe they are going to have a period of long-term decreases in earnings and sales and all that, and it might be a bad investment. So understand that a lot of times value stocks, they could keep going down that elevator. So be aware of that. True value stocks can have a good upside, but like anything that's risky with a high upside, it might have a higher downside as well. It just may be a dog and really never recover. So when you're looking at it from a style standpoint, think growth. For that rapid growth is what you're looking for. Price appreciation, income, where you're going to get dividends and get that regular quarterly money with some capital appreciation would be great. And value, you're really on that bargain hunt, and they could really fall in either of those styles, in my opinion. So just be aware of the differences between those. So the third way that we can break down where stocks, mutual funds, these different things can kind of hang out or be evaluated or separated from an overall diversification perspective. We talked about growth and income, or style that is. We talked about the size, as large, mid, or small cap. Taking both of those into consideration, now you can break it down by sector. And what we really mean by sector is what part of the economy does this company belong to? What area do they play on? What is their primary business? Think of it like this is the industry they're in. This is what we do. We're a retail sector, or we're in healthcare, or we're in financial, or we're in energy, we're in entertainment, whatever it might be. Think about, well, this is what they do. And it's important to compare companies inside their own sector and within their subsectors as well. Because if you compare, let's say, an energy-based company that might be experiencing slower growth, or a utility, for example, that might be government regulated, but you can still invest in, maybe get a dividend from. If you're comparing that to a high-flying technology growth stock, it's not going to be a fair comparison in either way. You might say, oh, that technology stock's terrible. They don't pay a dividend like the utility company does. And the other way, you might look at, say, boy, the utility company sure isn't growing as fast as that technology company. I want the capital appreciation or the stock price to go up faster and maybe take on more risk for that. So that's why when you break it down by sector, each sector might have or industry might have things that are, or do have things that are particular to that industry, and you want to compare companies within industry. Because you could have a utility company, for example, that might be very risky, almost like a growth stock within its utility industry versus others. Same thing maybe a little bit in technology or other fields. So when you're looking at things like ratios or fundamental analysis or qualitative analysis, evaluating the teams and all that stuff, you want to look at it within their particular sector or industry, and that's what we mean by sector. And then within sectors, you can have subsectors within that. I mean, you might think like, oh, well, retail is retail stores, right? I go buy stuff. Well, you have clothing stores, you have hardware stores, you have soft goods, hard goods. There's different ways you can even split those up. Like if we look at, let's say, healthcare is a good example of that, because healthcare is a good growing, I don't know about growing market. Certainly demographics are good for that. I like healthcare for a variety of reasons. One is the demographics. People are getting older. New medicines are being developed all the time. So healthcare might be an interesting sector to look at, for example. For me it is, I know. So, but within that, it's like, what part of that sector you have? Pharmaceuticals, which is like companies like Merck or Pfizer, which make drugs. You have medical devices like Boston Scientific or Medtronic that make like heart stents and valves and different, actual devices that people put in their bodies to be healthier or to recover. And you have things like Amgen, which is a biotechnology stock investing in biotechnology. And then you can keep going from there, from managed care and life insurance to hospitals to nursing homes, all these different ways that you can break out that healthcare sector. So within that sector, it's not fair to compare, let's say, Merck, who makes drugs, versus Medtronic, which makes medical devices. They're different industries with different things. They're still within healthcare, but they share some similarities around government regulation, demographics, people getting older, all that type of stuff. But their competitors and how they should be evaluated are different. So it's good to not only look at the sector, but then the subsector after that would be my strong recommendation when you're looking at sectors. So sometimes folks will buy, let's say, a sector fund, for example. We're going to buy all the energy stocks or buy a certain portion of technology or retail stocks. So you can look at mutual funds or exchange trade funds can really, look at the sector level. So if you think about it, it could be a growth and income stock, for example, growth or income, and it could still be within the same sector of healthcare. So they would be evaluated differently. So be aware of that when you're looking at them. And sometimes within sectors, it's hard to evaluate companies because they might fit really well in a sector, and other times they might play in multiple sectors and it can get a little confusing. So if we look at, let's say, for example, like Coke and Pepsi, they do lots of different types of side businesses and things too. But when you think of Coke and Pepsi, they're the two primary big competitors in the beverage market, in the carbonated beverage market. That's their direct competitors versus, let's say, an alcohol distributor or somebody like that. Coke and Pepsi, you can really evaluate real closely together. Or if you have a new company coming up, like a Jones Soda or somebody who's small, you can kind of compare that way. So they fit within that beverage area very well. Versus, let's say, if you look at like Disney, how do you evaluate Disney? Now you might be thinking to yourself, well, Disney, they have the parks, right? I can go to Disneyland Paris or Tokyo or Disneyland in the United States and California or Orlando, Disney World. You go to a theme park, you ride the rides with your family, it's fun, that's Disney, right? Well, and other folks might think, well, that's sort of Disney, but Disney's really all about movies, right? They own 3 big movie franchises. They own, recently, not too long ago, bought Star Wars from Lucasfilm, so they own the Star Wars franchise. They own Pixar, the folks who made Toy Story and those types of things, Frozen, all those types of animated movies. So they own Pixar, and they also own Marvel. So if you like Iron Man and the Marvel type comic superhero movies, well, that's Marvel is owned by Disney. So you'd be like, oh, well, they're a movie company, like Warner Brothers or MGM or somebody like that. They're a movie company. And they are, but then they do theme parks, and there's some relation between them, but the business for theme parks is probably really different than the business of movies, and they own these multiple parts. So how do you evaluate Disney, and what are you truly investing in? You're investing in the overall company, but understand those different parts of the company might make a difference. Maybe the theme parks are going great, but something has happened in the economy or in technology, like streaming of movies and things of that nature, of people staying at home more, watching movies on bigger, wider screen TVs from a technology standpoint. So that might hurt, let's say, the movie business in the future, but maybe their theme park business does great. Or maybe vice versa, something happens with the theme park business and Universal Studios opens up more places and a direct competitor of the theme parks for their theme park business. So all those things you would take into consideration with that. So even within sectors, it's kind of hard to evaluate within there. And then companies tend to move in concert within their sector. Not always, some outperform, some underperform, of course. But if you have an entire sector or an industry that's suffering, they're all going to kind of suffer together. They'll all kind of pull each other a little bit down versus one that might be rising. Rising tide lifts all boats. So a lot of times you might see where, things might follow along. It's not exact, but just understand that sector can impact even good performers. If a poor performing sector could impact a good performer within the sector unnecessarily, which might be a good value opportunity for the long term, by the way. So if we look at, let's say, something like the Vanguard Energy Index, which looks at energy companies, you might see that how that index compares to the wider S&P 500 largest companies of all different types of sectors. Might be a little bit variance, but if you're Exxon, an energy company, and you're part of that energy index, you're going to tend to move in concert with the index, and maybe not as much in concert with the overall S&P 500 fund, but even still, all those things go together, especially now that we're in a more global economy. Things will tend to kind of go together a little bit more than maybe in the past, where you could have one sector just do tremendous and another sector be bad, and the overall economy is bad, but somebody's standing out. You always have maybe some of that, but it's harder because everything's so intertwined now. So things to look at. So when you're thinking about your diversification and when you're looking at your overall stock portfolio, keep that in mind too. Maybe you've been buying dividend stocks and you like income from it, but you might look and say, oh my gosh, all my dividend stocks are pharmaceutical companies. Johnson & Johnson, Merck, Pfizer, all these different big pharmaceutical companies, and I'm missing out on small and mid cap. I don't have anything in other sectors, and maybe I'm at risk around things like regulation around pharmaceuticals that brings everybody down. And then I'm like, oh, I'm exposed myself to more risk because I'm only in that one sector. So when you're looking at your overall portfolio, these are three big areas to look at. Look at the size, small, medium, large cap, the style, growth, income, maybe it's a value opportunity, and then the sector and the subsector, and understand where you can push to one side is great to get a bigger return, but you want to understand the overall impact of the different diversification, the different things that you own. One thing that's very important to understand is risk. No matter what investment you're making in, understanding that risk and its relationship to reward is very, very important. In fact, risk is the other side of reward. It's like, yeah, we want these great rewards. We want our stock to go up or our bond to pay us or whatever it might be, but there's risk to that. It's not a free lunch, so to speak. So risk is the other side of reward. And if you want more reward, what you need to do is take on more risk. If I have cash in my pocket, well, that's less risky than if I invest in a stock, for example, because that stock could go up, which would be a great reward, but it could also go down. In fact, it could go all the way down and I could lose everything, versus having cash in my hand, I can go buy something now today. Very less risky with that cash than with stock. And all investments have a matter of reward and a matter of risk, and it's really evaluating between those. And there's different types of risk. So let's take a look at the different types of risk and understanding that. And so there's some good news with risk as well too that we'll talk about in a moment. So first off is understanding the different types of risks that are out there. And the big one that's out there is market risk, or systematic risk. You might hear it, stated out there. And that is like that the whole market does things. You've seen like the S&P's up, or the Dow's up, or the Nikkei's up, or whatever is up, or it's down, and it's pulling everything up or down with it. So there's a systematic or market risk that's associated with different markets you invest in. If you're investing in the stock market, that's a market. The bond market is another market. So if interest rates rise, that's going to affect bonds and negatively affect bonds. So the bond market will struggle. So understand that there's systematic risk in no matter what you buy. So stocks as a systematic or market risk are more risky than investing in cash, and thus you get potential, especially over the long term, a better return on stocks than you would cash over the long term. Over the short term, anything can happen. They could go up or down, and that's why stocks have more volatility, or they change in prices quickly, because they can go up and down much more quickly than, let's say, cash. So there's market or systematic risk. Next one is business risk. The threat of, let's say, the business failing, that particular business you're investing in failing. That's like things like bankruptcy. So if I buy an individual stock, that stock could suffer, or they could go bankrupt. They could completely fail. Maybe I mitigate that risk by buying a bunch of different stocks, or maybe I buy a mutual fund or exchange traded fund that has a lot of different stocks, thus reducing my risk of having the business risk of one, let's say, company struggling or going bankrupt. Though the whole industry could struggle too. Like, it's a little be more of a business and systematic risk. So risk around that, what is that individual investment, or maybe let's say like a company in terms of stock, what is that risk associated with that specific company, that business risk? Another one is credit risk. What is the idea of credit for that organization if they get downgraded as far as credit, so it's harder for them to borrow money, or more expensive for them to borrow money, or from a credit rating service, or from a credit standpoint, the solvency of that company, of a credit risk. Another risk that you have is taxability risk. What happens with taxes? Do taxes go up on a particular industry? Do taxes go down in a particular industry? And what about your own individual taxes that you might pay on capital gains of your investments going up, or paying on income that might come out in the form of dividend? It's risk to you as far as taxability, but then also organizations and things have taxable risk too as well. I know in the United States, the first incarnation of the Affordable Care Act, also known as Obamacare, you might have heard of, is, they had all sorts of things as far as health care in the act, but one of the things they had in there was an extra tax on medical device makers. So companies like Medtronic, Boston Scientific, Johnson & Johnson has a medical device area, St. Jude, all those, St. Jude Medical, all those had incurred an extra tax by that government regulation. So they had a taxability risk associated with that. So understand, a medical device maker might suffer more from Obamacare than, let's say, a pharmaceutical, which did not have a similar tax. By the way, that has been changed, and now it's better for the medical device manufacturers as far as the taxes. But that could change at any moment. People write laws and taxes all the time. That's what our governments do. Next is interest rate risk. What's happening with the interest rates overall in the global economy or within particular markets? What's happening in Greece or the European Union or countries within that, the United States, wherever, Japan, China, wherever it might be, looking at overall interest rates and what happens within maybe particular companies and then our countries and overall interest rates that might be happening all over the world. So for example, an asset class that has very sensitivity to interest rates is bonds. When interest rates rise, bond prices fall. So if you own bonds, your bonds are worth less. Now, if you're going to buy new bonds, you'll get a higher return or a higher interest rate because they pay off interest rates. That's maybe a good thing for buying new ones, but your existing ones go down. So if you own bonds in your portfolio and interest rates rise, especially if they rise quickly and substantially versus over a longer period of time and more smoother, that's going to really hurt you if you own, let's say, bonds. But interest rates can also hurt companies too. When interest rates rise, it makes it harder for companies or stocks, the stock you might own, to borrow money. So that might impact some companies who want to borrow money to invest in their companies. So that could hurt your stock portfolio as well. Inflationary risk, well, that's the cost of prices or goods going up for you or me. And that can vary by industry or sector. Maybe, dairy or milk products prices are rising faster than something else that might be more steady or more flat. I know, for example, in the United States, as one example, although we have things all over the world, but in the United States, the cost of higher education, college, university, and healthcare in particular, those two sectors, those two areas, the cost of inflation, the prices are rising much faster than the overall economy's inflation rate. And that could be good if you're owning stocks or certain stocks, possibly. They can charge more, or it could be bad too, especially if you want to send a kid to college and you're paying for that. That could be really bad, to have prices rise that quickly. So understand that inflation could hurt things. Things like commodities that you might be investing in, just like soybeans or agriculture stuff or pork bellies. I always thought that was a fun one. Pork bellies, these commodities, or oil is a good example too. If the prices rise or fall dramatically with oil, what is the impact of that? When prices drop really significantly, that hurt oil and natural gas and companies that are associated with oil or movement of gas or natural gas. As that might help us individual consumers. The gas prices are going down, but it hurts those companies, and you're invested in those companies. Well, understand that could be an inflationary risk there. Liquidity risk gets really around debt and liquidity of organizations. How solvent are they? You can look at things like debt and equity ratios. What is their ability to pay their bills? So that's kind of looking at liquidity risk. So if you're looking at a company, for example, and has a lot of debt, it might have a harder time paying its bills than a company with no debt. Now, you could also argue it might be a good way to invest in that money, and they're taking on debt to invest, and they're going to be a growth stock and really grow that price. That's great. But you have a liquidity risk where they might not be able to pay their bills and thus reduce their earnings, reduce their dividends, may cut their dividend if they pay dividends, or maybe even go out of business and get back to that business or bankruptcy risk. There's also social, political, and regulatory risk, right? We talked a little bit about the Obamacare or Affordable Care Act in the United States, but anything around regulations or social things or political things that might be happening out there. If you're investing in a particular type of thing and that's, now looked on poorly or whatever, that's a big risk there. So like Altria, which has an arm called Philip Morris. You probably know Philip Morris. They make cigarettes. There's been a large movement over the last several decades against cigarettes. The health problems associated with cigarettes. So, that stock is hurt by those types of things and regulations around that and fines around that and maybe other social, political things around tobacco. Doesn't mean they're not a successful company. They are, and they pay a pretty good dividend. You can decide whether you want to invest in a company. Those are called sin companies, things like defense contractors or gambling companies or tobacco companies, things that are kind of considered sin type companies. You can decide whether you want to take on that risk, but you have more, let's say, political and regulatory risk with, let's say, a tobacco company than you may, let's say, with some other companies. But all companies are susceptible to risk around regulations, societal changes, and politics. Next, we have currency or exchange rate risk. What happens when a currency rises or falls? And what does that impact maybe your holdings if you own currency or cash, or if you're owning things like even individual companies that might be global companies. So if a company, let's say, is a United States-based company, but most of their sales are overseas, the rising dollar makes it harder to, let's say, sell goods maybe in other parts of the world, and that could impact their earnings and impact their sales versus other companies. And last, a risk that's kind of really most associated with, or is associated with mutual funds and things where you have a fund manager making decisions on investments is fund manager risk. You might hear of this with like actively traded funds where a manager is making decisions on buying and selling versus like an index fund, which is not. It's all just following an index like the S&P 500 or a total stock market or a bond portion of the bond market where it's not based on individual choices of a manager. It's just automatic. You're following the trend or following the entire index. Fund manager who's actively trading, you're betting on that manager. You're betting that that manager of that fund is smarter than the other managers out there, is making good purchases and sales of investments within that fund. So if it's a stock fund, they're buying and selling stock that goes in that fund based on their experience and what they think is good. But there's a risk that that manager might be making bad decisions or bet on an area of the economy or sector that ends up going downhill and they made a bad choice or a bad decision. Or let's say that fund manager has been around a long time, very successful, but then they decide to leave, they retire, or they leave for another company or something. Well, now you've got a new person coming in. How are they going to do in that fund? So there's risk along that too. So sorry to be a little long-winded on this one, but there is a lot of different types of risk and risk types out there. Now, the good news is that you control the amount of risk that you want to take, right? We have all these risks, we have all these factors in there. The good news is you can decide whether you want to take on a lot of risk or less risk. You can buy a lot of stocks and individual stocks and take on more risk, or have a more diversified portfolio around cash and take on less risk. Remember that risk and reward are intertwined together. More risk, hopefully you'll get more return is the idea behind that. And also risk is reduced over the long term. An individual stock could go up wildly within a day, 10, 20, 30% sometimes even within a day. Hopefully not that much, but it can happen. It has happened, up or down. So in a day or two or a week or a month, they can be real volatile with things like stock or change their prices quickly. Versus over a long term of a year, 2 years, 5, 10 years, that's going to smooth out that risk over time. And that's the idea, is you want to maybe reduce that risk by having a diversified portfolio of a lot of different assets, stocks, bonds, whatever, and then within those assets having diversification in that to reduce your risk, large cap, small cap, medium cap stocks, growth and income stocks, different sectors or industries they're in to help mitigate that risk. But overall, the thing to take home is that risk takers are rewarded. At least what all the back history shows as far as the markets, long-term investors using things like compounding interest and regularly investing, especially if they can automate that investing, are very, very successful. And I speak from that from very personal experience, and I'm very grateful for that. I'm grateful for those powers of compound interest and things, and being a saver and being an investor over time, because that risk has been mitigated. But when it's happening, when it's going down, it doesn't feel good for sure, but over a long period of time, risk is mitigated and reduced. So here, now you know a lot about risk and risk types. Don't let it freak you out too much, but just understand that when you're making investments, that there's risk there, and different categories of investments have more risks than others. A big consideration for any investment, and particularly for stocks, is an understanding of the risk of that particular investment you're going to make, whether it's an individual stock or a stock mutual fund or whatever it might be, and how to calculate that risk so you can kind of compare when you're making investments, so you have an understanding of hey, this might be a very risky stock or risky stock mutual fund versus one that is less risky. And when we talk about risk, we're really talking about volatility. How much does it go up and down? What is its ranges as far as the returns on this type of investment? Because that's important as far as understanding what might be to your own level of risk and how much you can kind of stomach as far as something going down 30%. Can you handle that? Or having these wide swings, or do you want something that might be a little safer investment and less wide swings? So you're looking at that variance, that volatility. Now there's two big measures around there. There's a lot of measures, but the two big ones that are out there, which are standard deviation and beta. And standard deviation, you see a lot around mutual funds. A lot of stock mutual funds talk about standard deviation. And then a lot of individual stocks, you see in comparison, they're looking at beta. And they're two different things, similar as they calculate risk, but how they come about it are a little different, standard deviation, beta. So we'll follow along those same principles and think about standard deviation around mutual funds and stock mutual funds, and beta around individual stocks. And we'll take a look at that. In the next lesson, we have some examples where we'll do a demo and we can kind of see where to find this information and, and see how it kind of works. So let's get started with standard deviation, and let's think about that in terms of, let's say, mutual funds, but it could be anything. But really, let's think about mutual funds. And the idea is that you're trying to get an idea of the variance or measure how the fund compares to its own average. It's not comparing to an index or anything. A beta actually does that, but comparing it to its own measurements, its own range of highs and lows, all right? And you're really trying to look for that variance, that deviation from the standard or the mean, the average, right? You're looking for that variance. So, for example, if you have a 12% annual return, or average annual return, that is, a 12% average annual return, over a period of time, like let's say 3 years or 5 years, whatever, you're looking over a period of time. If yours is 12% average annual return, and your range of that is some years it's 8%, or some years it's 16% over that period of time, say 3 years, anything, that would be a standard deviation of 4%, right? You're 4% below and you're 4% high. That's your range and that's your deviation behind it. As far as a quick way to think about that in terms of, let's say, returns and returns of a fund or returns of an investment. So basically, the greater the swings, the higher the standard deviation. So if I have something that trades in a more narrow type of gap of, let's say it's a 12% return with a high of 13% and a low of 11%, well, that would be pretty good investment by itself, but let's say that's only a 1% standard deviation. That's pretty safe, actually, and less risky versus something that has a high standard deviation, a high level of volatility. And the more volatility, that's another way of thinking about the more risk that you have on it. You actually don't realize these gains until you sell, of course, but you can see how it might vary over time. That's why stocks with a high standard deviation over a short period, you might lose money because you're only going to hold it for a year. Well, you don't have a chance to maybe come back if it ever does, or a mutual fund to come back. You still might want to make that change just from better investments, but that's why stocks and stock mutual funds are a longer term investment, because they have higher standard deviations than, let's say, like a bond or cash. So that's standard deviation, comparing highs and lows versus its own returns, its own measurement. Another way to look at stocks and stock risk is beta. And beta is really good to use for looking at individual stocks. So a lot of people use standard deviation with mutual funds. You could use beta with mutual funds too. But a lot of people use stocks or use beta for individual stocks. Because the difference between that and standard deviation is standard deviation looked at the individual investment comparing itself. Beta looks at the overall market and compares that individual investment towards the overall market or an index, or comparison within the index, for example. So if it's an S&P 500 index that's being compared to, and you have one S&P 500 stock, let's say it's Apple or whatever, you can get a beta measure to see what is the volatility as compared to the index. So if you have a real volatile index, like a stock index or a technology stock index, the whole thing is going to be more volatile than maybe something like utility companies, which are just by nature less volatile. But you can compare to a larger market using beta. And there's a measurement or a number behind that. You don't have to worry about calculating the number. In the next lesson, when we do the demos, I'll show you where to find the number fast and easy. But basically how it works is the beta of 1 or a 1.0 matches the index or matches what you're comparing it to. So if it matches the index, it's going to have a beta of 1. Let's say an individual stock is going to match an index. If it has a beta of greater than 1, versus, let's say, the index, then the higher the number, the bigger, the greater than the number of 1, well, then that's the more risk or the more volatility in comparison to the index. So if it's greater than 1, it's going to go up and it's going to go down more than the index as terms of risk and return and reward over terms of volatility. If the beta is less than 1, that means it has less risk in comparison to the index. So if the index is way up, this won't go up as far, but if it goes way down, it won't go down as far either if it has a beta of less than 1.0. So in a nutshell, 1.0 is kind of the standard comparing to the index, and if you're above that number, you're a more risky individual investment or risky stock, more volatile, and if you're less than 1.0, you're less risky or less volatile, less changes in your price over a period of time. So standard deviation and beta are a good way to look at things and say, boy, is this a risky investment? Is there a numerical measure I can use? And yeah, these two will help you out with that. So in the next lesson, let's take a look at a couple mutual funds and a couple individual stocks so you can kind of see where to find this information and what it looks like in action. Okay, now that we've learned that you can measure risk by things like standard deviation, particularly for mutual funds, and beta for individual stocks, let's look at a couple examples in mutual funds and stock mutual funds and stocks, individual stocks, and how you can find this information really quickly without having to dig real deep or do a lot of calculations. So let's look at a couple as far as a case study and kind of compare several against each other. And you don't have to calculate this. You can find it very, very easily. A lot of different sites do it, Yahoo Finance, a lot of different places you can find it. I found really easy and real fast is just to go to google.com/finance or Google Finance, and you'll find it very, very quickly. Because all you have to do is, once you get to Google Finance here, you just go into the search finance, you put in the name of the company or the mutual fund and the ticker symbol, and boom, there it is. You can find it easily. So I'm going to show you right now how that kind of works, and we'll look at a couple different funds and individual stocks so you can get kind of a comparison between what we were looking at with standard deviation and beta. So let's start with standard deviation. You can use that for stocks too, but a lot of times that's used really for mutual funds. It's a very common measure for mutual funds. So let's use it in terms of mutual funds. So let's look at it. I'm going to look at a fund called Oakmark Select. I start typing in Oak and I can find it, or I happen to know the ticker symbol here, but this is Oakmark Select. Oakmark Select is a very concentrated fund. It's invests in large cap stocks and mid cap stocks, but only holds 20 stocks in its entire mutual fund typically. So it's not like a big S&P 500 fund with 500 or some fund with more than 500 individual stocks. It's got 20, so it should be more volatile because it's got less stocks around it. It is certainly a more volatile type stock. So we want to use this as a first comparison. You can see it's a large blend. It's got mid value and growth type stocks here off to the right, and it's also got some mid cap in there, but tends to more to the large right now in this particular snapshot. So if we looked at down here where first they'll come up with Oakmark Select, you can see the price. If you just scroll right down real easy, right underneath where it says risk, whoa, what a concept. You'd find it there. They actually list the beta and some other risk measures here as well. But we're looking for standard deviation for our purposes, and here it is right here, standard deviation. And they give it to you over 1, 3, 5 years, 10 years. So you can, it's really nice so you can see if there's any changes around risk that might be happening over time. Sometimes with an actively managed fund, you might have a new fund manager come in, somebody's managing, they're making choices that might be either more risky or less risky than the previous fund manager. And so that might have an impact there, or just as far as their philosophies change. So if you can see over the past year in this particular snapshot, 18.82, pretty high. That's a very high standard deviation, at least over a year. Now, that's only a short period, but that's a very high standard deviation. Even these are high, 13.76, 14.0 over 3 years and 5 years. And certainly over its life, it runs a high standard, over the last 10 years has a high standard deviation. And that's what we would expect, a fund that's investing in a real concentrated amount of stocks. You have less stocks to kind of offset that volatility, and the way they invest, looking to get a great return, they're going to be taking on more risky type stocks. And they talk about that in the prospectus, and they give you warnings and things like, if you're investing in this fund, we're hoping for great returns, but this is not the fund for you if you're looking for a real safe dividend payer. Let's look at this fund. So we got, let's say 18.82 and 13.76 over the last year and 3 years in the 14. Let's compare to something that is a dividend type paying fund, something that has more stocks, has a whole bunch of stocks in it, and is really made for dividend paying out dividends. And we're going to look at the T. Rowe Price Dividend Growth Fund as far as our comparison purposes. Once again, I'm not recommending any of these funds. I'm using it to just show examples, so these are just examples as far as different funds that we have. I may or may not own these funds actually. I did own T. Rowe Price Dividend, or I actually have a small holding in that. I don't own Oakmark, or the next one we're going to look at here. So just to give you a feel for that. But this is strictly for education. Anything could change any moment, so we're looking at education. All right, so the Oakmark Fund, real concentrated, less stocks, pretty high volatility, looking at that 13 to 18 type range over the 1 and over the 3 in the 1 year period. Here with the T. Rowe Price, dividend payer, standard deviation 11.2 over 1 year and 10.2 over 3 years. You can see over, over 10 years a little bit higher, but over the last 3 to 5 years around 10, much, much lower. So less deviation, less changes, less volatility, and you expect that from a large cap, kind of growth oriented, though a dividend payer actually. So you'd think it would fall more in the value category, but still a lot more safety in there, a lot less risk as far as large caps, big companies that pay regular dividends out there. And if you were to search a little further, you can just even look at the top 10 holdings, give you a feel. Big drug company like Pfizer, General Electric, Danaher Corporation, Microsoft, United Health, Pepsi. These are big companies that pay regular dividends out there and have for some time. So they should be less volatile than let's say, that Oakmark Select Fund. And maybe this fund might be more volatile than something even safer than that. But this is a less risky, less volatile fund. Let's look at one more to give you one last example. And we're going to look at a technology fund, a sector fund that is concentrated in the technology field. So before we pull this up, think to yourself, technology, is that going to be, and it's a sector fund, so it's really investing strictly into technology stocks, is that going to be more volatile, more risky than maybe this dividend growth fund we looked at with T. Rowe Price? Well, if you answered yes, you're right on. I mean, that's the nature of technology. You're looking for growth, you're taking on more risk with the hope of a bigger payout. And a mutual fund might help, make it a little bit more easier than, let's say, an individual stock, but still, it's a technology concentrated fund, so it should be even more risky. So we're going under Google Finance, under risk, standard deviation, and boy, this is even more risky than the Oakmark Fund, right, which invests in a lot of different types of stocks. It's not limited. This is strictly technology, so now we're at 19.58, 14.96. You can see 16, last 10 years, 22, lots of wide swings in growth, technology type companies. So when you're looking at standard deviation, here's a nice easy way to find it amongst other types of values. You can see this technology fund, look who they're investing in: Apple, Facebook, Alphabet, which is Google, different things, Microsoft, Yahoo, real high technology companies. So you're going to have more of that volatility. So here's a way to get a feel for what your risk profile is and whether you like risky stuff or not risky stuff. You can look at like the standard deviation if you're looking at a mutual fund in particular and see, some are less volatile than others. You don't want that to be your only decision-making thing, but it's a real key thing when you're making choices. Because if you get something that's really volatile, you might sell it right away at a loss, and you don't want to do that. You might want to have something that fits you a little bit better. Now let's take a moment and look at beta, and we're going to look at that for individual stocks. So we're looking at mutual funds and standard deviation. We can do the same thing on Google Finance and find beta real quickly for individual stocks, and it's really, really super easy. So let's start with a real safe, well, I don't want to say safe, that's not a good word. Let's look a real less volatile type stock. Its prices don't change all that much. It's a real steady Eddie dividend payer, and falls in that category of utilities, which utilities are known for being companies that are, usually government managed a little bit more, and they pay out regular dividends. Utilities were always the home of, grandma or the widow who owns some stock because they pay out that income, pay out those dividends. And we're going to look at a company to get us started here called Xcel Energy. It's a United States-based company. It happens to be, and Xcel does utilities like electric utility, those types of things. And as far as finding its beta, you don't find it here under risk like you do with the mutual funds, though they do have some nice, good stats and things in the bottom right here and some information. But to find just the beta, it's real simple. It's right at the top here. You can kind of see it right at the top here where it says beta 0.11. All right, and so as you remember from our lesson on beta, beta is equal to the market of 1.0 is the market, is like the index. So if this stock happens to belong in the S&P 500, which it does, large United States stock, it's, the index is at 1.0. If you're greater than 1.0, that means it's more volatile. And an individual stock would be more volatile than its index. So an index has volatility to it because it's still a stock index. And if it's greater than 1.0 and it's beta, that means it's even more volatile than the index. So that's a lot more risky, a lot more price changes, a lot more volatile. And if it's less than 1.00, it's less volatile. And as you can see with Xcel Energy here at a beta of 0.11, it's a very, very low number, very much less volatile. So if you wanted something that was, low volatility, maybe pays out a good dividend, which this does, a 3.26 dividend yield. So owning the stock, you're going to get 3.2% back on your money just by holding the stock. Once again, assuming they don't cut the dividend or anything, as we learned, so just be aware of that. But if you want a real safe, less volatile, type of dividend paying stock, Xcel is at 0.11. I'm not recommending it. I'm not recommending utilities. Everybody's different. I'm just saying if you look at it from a beta, if you were to ask me, is this a low beta stock? I'd say it's an extremely low beta stock at 0.11. Well, let's move up the chain a little bit and let's look at another type of stock to see if that's a little bit more volatile. Let's look at, let's say, Coca-Cola. I happen to know Coca-Cola is KO. Otherwise, I can, in Google Finance, I can just start typing it in and it will find it for me. But KO is its short ticker symbol, KO. Coke, by the way, this is the bottling company, different company. So if you're looking at Coke, regular old Coke, big international company, Coca-Cola sells Coke and Diet Coke and a lot of other beverage products. You can find it here, and you can see our beta right here, right at the top, real easy to find, 0.57. So it had a similar dividend yield, by the way, to the utility company, but it's going to be more volatile because it's got a bigger number in its beta than the utility company of Xcel at 0.11. Still less than 1.0, still a lot less than its index, once again the S&P 500. So this stock is a very less volatile stock, and that makes sense, right? It's a 100-year-old company, been paying out dividends forever, big international company, solid company. From a balance sheet standpoint on it, it's going to be less volatile. It's not a high-tech, high-growth company. It's a growing company, but it's going to be a lot less volatile than some other companies, and much less volatile than the index at 0.57. Remember, if the index is at 1.0, less than 1.0 is less volatile. Over 1.0 is more volatile. Let's look at two others real quickly and see some more volatility as we move up the kind of the list here. Let's look at Amazon, right? Amazon.com. If you were to guess, you'd probably guess that is going to be more volatile, probably more volatile than Coke, and probably more volatile than the index, right? As a large company stock. Again, we're looking at large company stocks for fair comparison. And it is. It's 1.11. So it is above that 1.0, and this would be a more volatile stock. And we would know that, right? Just from watching the news, we know Amazon's pricing and all that goes up and down. The stock price goes up and down, more wider swings as far as for Amazon. As far as its volatility that occurs over a period of time. We could even look here at the 52-week range of pricing, where you can see over the last 52 weeks in this particular thing, it was $474 to $790, so a pretty wide range. But we're looking at volatility as a good measure for that. And 1.11, that tells us, okay, I'm going to be taking a risky stock, but maybe I like that for a lot of other reasons why I want to invest in, let's say, a company like Amazon. Just understand it's going to be more volatile. The last one we're going to look at, let's look at a real volatile, like crazy volatile stock. I mean, you think Amazon's volatile. I mean, most people like buying individual stocks in Amazon got to have that iron stomach because it's going up and down, up and down. And we're going to look at SanDisk here. And SanDisk, they make the cards and things for like your photo, for your devices, memory cards, all that kind of stuff. So it's SNDK. Or you can just start typing it in, or you can find it, SanDisk Corp. And SanDisk has been up and down. They've been having some hard times at this period of time we're looking at, but some potentially good times too. So they're very volatile right now, real speculative in a lot of ways. And you can see that in its beta of 1.92. So think about how crazy volatile Amazon is at 1.11. Now something that's a lot more volatile than Amazon, not twice as volatile, but getting there. You're at 1.92. That is a very, very volatile stock. And understand that your risk and your reward could be great, but it could also be, on the other side too, as well, as far as in terms of volatility. High-tech stock with a lot of volatility or risk in it. So understanding if I'm investing in SanDisk, I might experience more fluctuations in price than I would with Amazon. And if I want something a little bit more safer that pays me a nice dividend, well, then I'm thinking Coke. And if I want something more, even super less volatile, then it might be a utility company. And that was the example of Xcel. Okay, so we've looked at some companies. Really the thing I want you to take away from this is where to find standard deviation, where to find beta, so you don't have to calculate it. You can just get it real quickly and find that information out and understand how it fits in your overall portfolio, that things that are more volatile are in a sense more risky and can cause you a little bit more sleepless nights. So with that, that concludes this lesson. Okay, I just typed in investment risk calculator, came up with a couple of different options, whole thousands of different options really, and I happen to chose one of the top ones that are out there. This is from VISSF. They're an Australian-based financial services firm. I don't do business with them. I don't really know them, but I popped up with their calculator. I thought they had a kind of a nice, easy-to-use calculator that kind of looked nice on the screen too, but it was a nice, easy to calculator. So I'm at VISSF in Australia. Here's the link up the top there, and it's under calculators risk profile. All right, so we're going down here. It says risk calculator. What risk profile is right for you? And then a lot of times what these calculators do is they'll give you a series of questions, and if you answer these questions, they'll give you an idea. They'll spit back a report saying, oh, you're an aggressive investor, or you're a conservative investor, or you're somewhere in between. So like here's an example of a question. I seek the maximum possible return even though it may take several years to recover from potential losses in an extended down market. Am I willing to take that risk or not? So let's say I agree with that statement. You might be different. Let's say I agree. Maybe I don't strongly agree, but let's say I agree. And then I click next. And then there's more series of questions. I'm uncomfortable with potential losses during extended down market. That way I prefer investments with the lowest possible risk regardless of return. So if I'm really risk averse, I might be like this and I would strongly agree, but I'm less like that. I'll say I disagree on that as well. And then you go through these questions and what do you want to keep up with inflation? Yeah, I certainly want to do that. I'm willing to take risks to do that. Maybe I'll even strongly agree with that. And you go through and you answer the questions. There might be like a dozen questions typically in these types of risk calculators. I've done it, so I like a cooking show, where they show you how to make the item that they're cooking, and then they show you the finished product, so you don't have to watch it bake. Well, it's kind of the same thing. You don't have to watch me answer all these questions, but to give you an idea what my report looked like when it came out. It said I had a score of 31. I'm not even sure what that means, but it does say that I have a balanced level of risk. And then it gives usually like a little statement here that I'm prepared to take with their goal of achieving high returns over the long term, so I'm able to take some risk, but I want those high returns over the long term. Yeah, that's certainly me. And I prefer to invest in a combination of growth and income assets, weighted more towards growth. And when they really talk in the green here with growth assets, they're thinking like stocks, and income assets being more like bonds would be another way to say it. So sometimes these calculators will spit out like this much in stocks, this much in bonds, this much in cash as the three main interesting. This one is kind of like growth and income, green for, I would say, more like stocks, and gold there or yellow for income. And it may invest 60 to 8% of your shares in property and stuff like that. So the breakdown of that number as for 60-80% breakdown between the two balanced levels. So I have this balanced level of risk where maybe I have 60-80% in growth and maybe 40 to 20% in income assets, or some type of balance with that. If I was a real heavy aggressive investor, it would be mostly all green, and if I was really more conservative, it would probably be mostly all yellow. And this is different for me. We were talking about how investing changes over time. When I was a younger investor, definitely would have been much more green, would have had some gold, but I had that longer time horizon. Now that I'm a little bit older and I'm looking at financial plans, I'm looking at retirement, I'm looking at what the future holds. I've had success with investing. Now it's a matter of maintaining and holding on to that and generating income from it. So that's where I'm still more balanced, even though I'm still looking for a lot of growth. Hopefully we'll live a long time, and so still have a long time horizon. But that's where where I come out on the score. It's not a yes or no, this is definitely who I am or definitely who you are. It's a way to get the conversation started and start thinking about the types of investments that you want to have in your portfolio. So for the stock portion of your overall investments, you could have a collection of individual stocks, mutual funds, or exchange traded funds, or a combination of these types of things. So we're going to look at each of them in turn, and most folks have a combination of these different types of vehicles, but you don't have to. You could have just stocks, just mutual funds, just ETFs. So let's take a look at that. So let's say you want to make a portfolio of just individual stocks, or what are the advantages of owning individual stocks versus, let's say, a mutual fund or ETF. So with individual stocks, you have more control. You get to decide when to sell and when to buy, of course, but when to sell stocks. So if you think about a mutual fund, you have maybe a fund manager, or maybe it's an index fund that's automatically buying and selling stocks to balance the index, the fund to the index. Or if you have an active manager, like in a stock mutual fund where you have somebody actually making those decisions for you. You buy the mutual fund and they decide what they're going to buy, what they're going to sell, and when they're buying and when they're selling, and all of that. So you give up that control to get that diversification and that expertise. But they're making all the decisions, where if you buy an individual stock, you have all the control. You get to decide when you want to buy it, and you can decide when to sell it. Because of that, it makes individual stocks more tax efficient. Mutual funds are constantly buying and selling stocks. Some do more so than others. If you're looking at mutual fund, look at things about around turnover. A higher turnover number, like 100% turnover, means they're essentially turning over all their stock holdings each year on an annual basis. So high turnover numbers is causing lots of buying and selling, which causes possibly tax implications. Now, a good active fund manager will try to balance what they sell versus what they buy and try to mitigate those tax things. But either way, they're making the decisions and they're incurring possible tax implications for you by that buying and selling. Otherwise known as churning too, where they're kind of constantly doing that to try to, drive, some great returns. Hopefully is what you're looking for them to do. If you own individual stocks, it can be much more tax efficient because you don't pay taxes on the stock until you sell the stock. If you buy it at this price, a low price, and you sell it at a higher price, that difference is your gain or your capital gain, and that's what you're paying taxes on. But that only occurs for the capital gain portion when you sell the stock. So if you buy a stock here and you don't sell it for many years, or maybe for a long time, decades even, well, you're not incurring any taxes from a selling or a capital gain type thing. So I own some stocks, for example, that I've held for decades and more than decades, and they've really gone up in value, which means when I sell them, I'm going to have a big tax consequence. But by holding them, they'll continue to go in value. I think they're good stocks. They pay dividends. And so they're much more tax efficient, and I'm not incurring that cost now. In fact, those are some stocks I might pass on to my son or my heirs that, they can maybe, with some different tax vehicles, tax advantages, take advantage of that and have it become part of their own portfolio after, I die. So I can put off that tax implication. Now, one thing about that, I'm talking about the gain, the price that you sell high and buy low, and that difference, that's your taxable gain in terms of tax efficiency. You can put that off. But many stocks pay dividends, or income type of stocks. They pay you a dividend, they pay you a quarterly dividend, and that's income coming into you. So that is basically potentially taxable income depending on where you live. In the United States, that would be taxable income. So either way, with individual stocks, because you have that control and how you can buy and sell when you want to, there can be much more tax efficient. Also, individual stocks are more targeted. You get to buy that individual stock. If you're buying a mutual fund, you're buying a basket of stocks. I've seen some mutual funds have as low as like 25, 30 stocks, and really, really concentrated, but you're still buying those 25 or 30 stocks. If you buy, let's say, like a Standard & Poor's 500 fund, well, you're buying 500 different types of stocks, or buying into that in different weighting or different percentage of those stocks, but you're buying all those stocks. But with buying individual stocks, you can buy that one particular company. Maybe there's a company that's really of interest to you, and you've done your research and maybe applied some of the things in this course as far as the fundamentals and the ratios and all the analysis that you're going to be learning. And then you're targeting more courses, targeting your stocks based on that. And that's a great thing. So you can be more targeted and build your own basket of stocks. Now, the downside, by buying individual stocks, you can be less diversified. I mean, you want to maybe get 15, 20, 30 types of stocks. Well, that's still a lot less stocks than, let's say, a portfolio that owns 500, or a mutual fund that owns 500 stocks, or maybe it's the entire stock market index that holds thousands of stocks. So you will have less diversification, which can be good if you want to be more concentrated in some areas, but could be bad as far as having less diversification. When you're buying individual stocks, the onus is on you now to do your research, your due diligence, and to see, by picking those stocks. So apply the things and be more actively involved in your investing. Versus, let's say, picking a mutual fund and just letting it be. Maybe a real passive investor. Active and passive are good things, depending what you're looking to do. But let's say I want to buy just an index fund, and I want to have just the 500 largest stocks, or I want to buy an index fund that tracks small cap stocks, or whatever I'm looking to do. I can buy that fund and kind of set it and forget it, and that mutual fund manager will make the decisions for me, or if it's an index fund, it'll track that index. It does it automatically. I don't have to do anything more. I just do my research, pick out the fund, and I'm done. Where with stocks, much more hands-on, I got to pick out the individual stocks from all these tens of thousands of stocks out there and pick the ones that I feel are the best for me and for my goals. And then once I pick those stocks, I got to track the results. I got to see how they're doing and what's happening in the industry and make changes as they go. Now, some stocks, especially like a dividend-paying stock, you might feel real comfortable buying and holding that forever, and it's going to pay you dividends along the way. But stocks go up and down, especially individual stocks are more volatile than a mutual fund of many stocks. So I have to track that much more closely. So if you have individual stocks in your portfolio, you want to really track that closely. And that's the same thing too. If you want to have an entire portfolio of just individual stocks, well, having 3 or 4 is so little diversification, it can be very, very risky to do that. Or putting all your eggs in one basket and buying one stock or buying one company stock, maybe the employer you work for, that's really, really risky to do. So, most experts are saying 15 to 20. I think it's good 20 to 30. As far as all you have is individual stocks, you want to have that breadth across different industry sectors, different size of market cap, different types of organizations, large, medium, and small market cap, and maybe even have a variety of growth and income stocks too, depending, once again, on what your goals are. But if you have 10 or less, you're not getting the diversification you could really benefit from at least having 15, 20, or 30. And so to be more diversified, look at different industries, different sizes of organizations within those industries, and the style too. Is it growth, is it income, to build your overall portfolio. Now, a strategy I like around individual stocks is actually to kind of pair it with mutual funds and in a setup where you have like a core of mutual funds and maybe some few core mutual funds that are your core things, and then you have individual stocks kind of circulating around that core, so to speak, to round out your overall portfolio. So you have both a mixture of mutual funds and individual stocks. As we'll learn in the mutual fund area, there's advantages and disadvantages of mutual funds, so we'll look at that as well. But a good strategy to get you more diversification, get you a broader breadth of things, particularly in areas that you might not know as well or want to research more or let somebody actually be more of the expert in that area, is maybe to get mutual funds in that area. A good core too might be some safer index mutual funds that are very low cost, so you're not paying a lot in fees, and to hold those, that can be your core, and then you build around that individual stocks. So one way you could do is, let's say 80% of your portfolio, of your stock portion of your overall portfolio that might have bonds and cash, but of your stock portion, maybe 80% of that's in mutual funds or an exchange traded fund or something that's really maybe more low risk. And gives you that diversification by being invested in a lot of different areas. Maybe a total stock market index fund or an S&P fund or an international type fund, or maybe you have those core ones and then you add a couple other funds that might be more actively managed, maybe in a sector like energy or healthcare where you want a more active manager, for example. Or you could go with an index in those areas too. There's different advantages of all those things, and we're going to learn about that within the mutual fund section. But the core is mutual funds, and then you add individual stocks around that core. So you don't have to worry about trying to track or buy 20 to 30 stocks and being on top of it and being pretty risky investment in just those small holdings. You can have that big core, and then around it, then buy individual stocks on things that you can maybe get a little bit of an extra return out of, because you might know those stocks are done really good research on a few stocks versus trying to build a whole portfolio of individual stocks. And that way you can really vary your holdings. It's a real advantage for individuals. You can have varied holdings. You maybe want to buy a couple healthcare stocks or whatever, something. Maybe it's something you have experience in a particular industry in, maybe an industry you work in or have worked in, or you just have a real strong interest in it. You can buy some individual stocks there and take advantage of some of those tax advantages where you don't have the distributions or tax consequences for mutual funds. You can really maybe buy and hold individual stocks for some time. And it can be challenging and fun. I mean, part of taking this course is to learn to trade and buy stocks, whether it's a mutual fund or ETF, but part of this might be you want to do some with individual stocks. You'll have some knowledge to do that from the course, so put those things into play. And it can be challenging, it can be fun, but it's a little bit less challenging and maybe a lot less risky to have that core mutual funds and then maybe building up your individual stocks as you get more experience and as you try some new things. But you can always have that core of mutual funds. Remember, boring sometimes wins the race, right? You're not trading, you're not gambling. It's just kind of that investing. It can be a little boring, I guess, but I find it interesting. But it can be even more interesting if you're buying individual stocks. So that's one strategy you can do, one that I use, and it works very well. To have the core and then buy individual stocks around it. But you can buy just all mutual funds or just exchange traded funds as well. And we're going to talk about those next. So in the old days, many old days, all you could do is buy individual stocks. That's what you did. You built your portfolio and you bought individual stocks. But the financial industry, always looking for ways to sell more products actually, but also hopefully serve their customers too, came up with some ideas, and what was born was the mutual fund. We were basically mutually buying stocks together, almost like an investment club, but you're doing this with people you may have probably have never ever met. It could be from all over the world. So let's talk about what a mutual fund is so you have a good understanding of that and how it can maybe be used. So first off, and you might be very familiar with mutual funds already, but this is a good primer in case you aren't or want to refresher on that. So first off, a mutual fund is a pool of investors. It's me, it's you, it's people from other parts of the country, people from other parts of the world possibly, and we're all deciding to invest in this mutual fund. And by pooling all of our resources and our money together, and pulling it all together, we're able to share the risk and reward. We're basically hiring the mutual fund to manage those stocks, let's say in the stock mutual fund case, to manage that for us. And maybe that's an active manager who's buying and selling stocks and really managing, like we're hiring that person. Or maybe it's an index fund that's giving us some passive income and passive growth by following an index. Either way, they're managing that for us. We're not actually going out and buying stocks. We buy the mutual fund, and then the mutual fund takes care of that for us, and we share that risk and we share the reward as a pool of investors. The other advantage of aspect of a mutual fund is it diversifies the holdings. Sometimes within asset classes or across multiple asset classes, you could buy a mutual fund that's an asset allocation fund, for example, that buys stocks and bonds and cash and gold and all sorts of stuff. It could be that diversified. Or within a stock category, like we're interested in talking about here about stocks. So maybe I want to buy a mutual fund that just buys large cap stocks, or I want to buy a mutual fund that buys international stocks, and you can get even more specific, international small cap stocks, or stocks that pay dividends. You can get really, really finite as far as what you want to buy with a mutual fund. But either way, I'm getting a diversified amount of holdings. Now, the amount of holdings varies by mutual funds. I've seen some as low as 20 holdings, still more than maybe if I was buying individual stocks for most people. But still, it's 20 holdings, so it's more diversified, more things that could go up and less things that go down, so to speak, or as many as 500 or 600 or 1,000 types of holdings within there to get to even a broader amount of diversification. So a big advantage of the mutual fund is they're managing it for you and they give you that diversification. You also get professional management, right? So you've got some folks, let's say it's a fund manager, a person who's in charge of the fund. They would have a team of people that work with them. And they're going out researching and they're selecting stocks and they're picking the best stocks for that fund is the idea. That's an active fund. So they're going out picking the best stocks for those funds. Or the manager might be just simply more of an administrator in an index fund where we're going to match this index, let's say like the S&P 500 index of large 500 United States stocks. But there's other indexes out there too. They basically just match that index as all they're doing is lower cost, and they're basically tracking that. Either way, you have professional management doing it on your behalf because you're part of the pool of investors. And lastly, with mutual funds, what they provide is liquidity, or the easy ability to buy and sell. Now, individual stocks are very liquid as well. You can go out and buy and sell them through an online broker or a financial planner, different ways that you can buy and sell individual stocks, the actual mechanics behind it. But a mutual fund does all that for you, buying and selling. But then if you want to get rid of the mutual fund or buy a new mutual fund or sell your mutual fund, it's very easy to do. It's basically, by the end of the closing day, it all kind of, equals up, so to speak, and then you can, sell that mutual fund. So if I own a mutual fund, and let's say that day I decide, hey, I want to sell that, I can go online typically and just, click some buttons and I can sell that fund and it'll give me money in my account, or I can transfer it, I can sell that fund and do an exchange, what's called exchange, and then buy a new fund. All very easily. You can do it pretty much all online or through financial service firms as well, depending on where you have your funds. But the idea is it's very liquid. It's not like a house where it might take months to sell a house, maybe even longer than that. It can all happen within a day, basically, as far as selling mutual funds. So mutual funds, pool of investors, diversified holdings, you get some professional management and great liquidity. And it's a great product for people, particularly for newer investors or even experienced investors, to get those benefits very, very easily without having to build their own portfolio of just individual stocks. Okay, we understand mutual funds or pool of investors and all that, and give you some diversification. We talked about actively managed funds where you have a fund manager making decisions on buying and selling. You're basically hiring that fund manager to make decisions. So what are index funds? Where do index funds come? And what is the main advantages and disadvantages of index funds? And really where index funds came from was particularly from Bogle, who was a founder of Vanguard. So that's why Vanguard is so well known for index funds. Early start with that, and they do a great job. Is index funds mean you're trying to match the market. You're trying to match that index that's tracking a particular market or subset of a market. You're not trying to beat the market. You're just trying to match the market. You're trying to be average, so to speak. And the advantage of trying to be average is you can have some low costs and things associated with the fund itself that helps you to perform better than actively managed funds. And we'll get into that in the advantages and disadvantages in a second. So an index fund tracks a market, tracks an index. So a famous one I mentioned a couple times before is the S&P 500 fund, Standard & Poor's 500 index fund, the 500 largest United States market cap stocks. So if you want a fund that looks at large U.S. stocks, and it's an index and you want a broad diversification of 500 different stocks, well, maybe the S&P 500 stock fund is for you. By the same token, you could get indexes for different types of things and have funds that track that. Another popular index is the Russell 2000, which is the 2,000 smallest U.S. cap stocks. So if you don't want large cap, you don't want the big stocks, you want the small ones, maybe you're looking for growth and stuff, and you want a broad diversification, 2,000 stocks, well, you can get a Russell 2000 stock index that tracks the Russell 2000, or you can get index things that track a certain sector, like just energy stocks or just healthcare stocks, whatever it might be. You can have indexes that track virtually almost anything. And the idea is that you're trying to match the index. That's the whole key. It's very passive investing where you're not looking to buy and sell stuff. You don't have a fund manager who's actually actively doing that. You just basically have an administrative team that matches up the index, and if things change in the index, one stock leaves the index and a new one comes in, then they might buy and sell at that point to match the index. So their whole goal is to match the index and get better returns by matching the index. And let's take a look at how that works. So if we think about the advantages of index funds and why they're so very popular, is their low cost. When you own a mutual fund, you're incurring costs. You're incurring annual costs. We'll have a whole section on costs and understanding costs in mutual funds. But understand that by holding a mutual fund, you're incurring costs. Versus, let's say, an individual stock where you incur the cost of buying that stock and then selling that stock. Those are transaction costs. Mutual funds hold a bucket of stocks that they're constantly buying and selling within that. Now, an index fund has less of those transactions occurring within the fund. They have some, but they have a lot less. So their costs are lower from a transaction standpoint inside the fund. Also, you're not having to pay a team and some expensive folks to manage the fund, or a team of people to do research and all the stuff that goes into picking stocks at an expert level. You're basically just passively trying to match the index. So another way to reduce cost. And you have the potential within an index to have more diversification in terms of lots of different types of companies, because you can get, the Russell 2000, for example, is 2,000 small cap stocks. The bottom 2,000 of the Russell 3000, which is also U.S., which is all the stocks, or essentially all the stocks. So by getting those Russell 2000, the 2,000 smallest stocks, you don't have to pay somebody to research all those thousands of stocks and pick the best ones for a fund. You just match the index. And so with the low cost, what happens is if you have similar returns, or even if an actively managed fund actually does better than the index, which is rare, but let's say does better than the index, their expenses that are associated with it actually will bring it below the index. Also, they might have more tax implications with those actively managed funds too, thereby also reducing your potential return. So the idea is an index fund doesn't have to do as well to beat an actively managed fund. In fact, there's been all sorts of studies around about index funds, and that they beat like 80% or more
of their actively managed peers, and even more so over a longer period of time, because they don't have all that stuff going on. So something to very much look at, particularly if you're looking for a low-cost fund, something very much more safer, let's say, than maybe a very actively managed index fund or actively managed fund. So those are some of the advantages. So what are some disadvantages of an index fund? Because they have disadvantages too. Well, one is you have no fund manager. It's all administratively done. So you don't have a fund manager with a vested interest in it. In an actively managed fund, the fund manager gets paid on how well the fund does. And they get paid big money. These teams get paid big money to do well, to have their fund be the best actively managed fund or a top 20% actively managed fund. Index, you don't have that vested interest. You're basically trying to match the index. So you might lose out on a really strong fund manager or somebody who could consistently beat the index returns that it's matching up against and be a strong fund manager. It's hard to find them, but they're out there. So understand that you're giving up that as far as the fund manager. Also, if you're buying into an index, you might have a situation where the entire index is down, and so you're going down with that, for example, where a fund manager can actively sell out of something that might be going down and maybe buy something that's undervalued. If you're buying the index, you're fully vested in that index, and if it's going down, you're going down on that ride with it. Same idea as if it's going up, you're going up with it as well. It can be less diversified. Yeah, it can have a lot of holdings like the Russell 2000, of those small cap US stocks, for example. But it can be less diversified and like, I'm just owning that. I don't own any international and I don't own large cap in that index fund. That doesn't mean I can't buy other index funds to give me that. I could buy an S&P 500, or I could buy an index fund for Japan or Europe or whatever. That might also help so you can build your portfolio around it. But each individual index fund itself is just, wouldn't be diversified with that type of thing that might be beyond the scope of that index. So something to be aware of. And they can be one also real tricky little thing to be really aware of, and really looking at the holdings within an index, is it can be heavily weighted in a few positions or a few stocks. For example, the S&P 500 fund, you think, oh, that's 500 stocks. It's 500 equal stocks. It's not. It's a weighted index, which means the bigger of the 500, the top 2, 3, 4, 5, 10, 20, have a much bigger impact than the other, let's say, 480 stocks in there. So things like Google and Apple and Johnson & Johnson and ExxonMobil have a bigger impact on that than maybe the 400th stock in there. And so you're really maybe a little bit more heavy in current times in technology stocks than you might have anticipated, because there's some big technology stocks in the S&P 500. Also, it might be something that's weighted if you have like a sector index fund. I saw a good example of that. Like if you look at the energy sector, for example, you could buy an index fund that tracks the energy sector, which sounds great. I get all these different types of energy companies, oil companies, gas companies, pipeline companies, people who build platforms for drilling, anything related to energy. Maybe even alternative energy is in there too, or is in there too, like solar power and wind power, and boy, that's great. I can have all this diversification in energy. Sounds good, but if you look closely at the holdings, there's a big chunk of it. It's like 20-30%. I think it's 20% of the holdings of the energy fund within, let's say, a Vanguard energy fund, or the energy index, not Vanguard, but within the energy index. ExxonMobil dominates it because it's such a big company. That 20% is ExxonMobil. So if you're looking to play more in that alternative energy space, for example, and wind farms and solar energy and all that, really what you're buying when you buy an energy index, you're buying a lot of ExxonMobil, a big oil company. So something to look at when you look at your indexes. So think of the indexes, think about what they're trying to, style-wise, what they're trying to accomplish, but then look at the holdings too to see if that's what you want and what you would like to have within your fund. And also because they carry lots of different types of stocks in there, there might be some stocks in a large index fund that you might not like. Maybe there's defense contractors in there, or tobacco companies, or alcohol companies. Where if you're buying individual stocks or you're buying individual fund managers, or even actively managed funds that are only buying stocks and things that are not related to what are called sin type things like gambling, defense, tobacco, alcohol, firearms, all that stuff. You can buy actively managed funds like that versus an index fund that's just going to kind of have this broad index. So index funds, some great advantages and very much in vogue versus actively managed funds, which have been struggling. If you look at the overall numbers, index funds historically have been consistently beating actively managed funds, but those few actively managed funds that do well might eke out a little bit better returns, but it's a lot harder to do with all the costs that they have on it. So now there's been a new hybrid that come out, which is ETFs, or exchange traded funds, which are kind of like index funds, but not really. So let's take a look at those. What has been really gaining in popularity is ETFs, or exchange traded funds. Either way, exchange traded fund or ETF, they mean the same thing. And the reason they're popular is they're similar to mutual funds. They're very similar, of course, to an index mutual fund, but they've got some aspects of individual stocks in it as well, too. It's kind of this weird hybrid thing that can give you some different types of advantages and disadvantages around it as well, too. So let's talk about exchange traded funds and kind of how they work. So first off, an exchange traded fund holds a basket of underlying assets, like a mutual fund, right? It's holding different things, maybe different stock or whatever it might be, bonds, whatever that exchange traded fund is tracking. But let's talk about it as a stock fund. Let's say it's a stock exchange traded fund, and it's tracking a particular index is what they do. And it's just like index funds. There's all sorts of choices as indexes, from tracking the NASDAQ to the New York Stock Exchange to S&P 500 to international markets to sectors, whatever. You can find exchange traded funds that do all sorts of stuff, and that they're tracking an index or tracking a basket of stocks. Typically is how that would work. So it's very much like an index fund, right? Pool of assets tracking an index. They also, like an index mutual fund, have a low expense ratio. It's not related to active buying and selling. It's tracking an exchange, right? It's tracking the stock exchange, or it's tracking the NASDAQ, or it's tracking the S&P 500. It's tracking something from an index aspect. But where the exchange part really comes in is it's traded on an exchange, like a stock, really. So this is where it's that hybrid of mutual fund and individual stock. If you buy a mutual fund, you buy it, maybe from your employer. If you've got a government-sponsored program, in the United States it'd be a 401k. You could buy it from your employer through that, or you buy mutual funds through a broker or a financial planner, or you can go right directly to company websites like Fidelity or Vanguard or T. Rowe Price or whoever, and go and buy mutual funds right directly from them. But you're buying it from some of these mutual funds that are outside the actual stock exchanges or markets. Because then what the mutual fund does, they go on the exchange and they buy the individual stocks that make up their index fund or make up their actively managed fund. Exchange traded funds track the index, but they're actually traded like a stock on a stock market exchange. And so you get the benefit of more quicker liquidity. You don't have to wait till the end of the day. It's basically selling right there. It's priced every day. Its price constantly is changing like a stock would be, versus, let's say, like a mutual fund, which has an NAV, or net asset value. Basically, at the end of the day, it all trues up, and you have a number that's your price you'd pay on a daily basis for a mutual fund, one time a day. Exchange traded funds trade throughout the day. So if the market's really crashing, you can buy and sell immediately, where a mutual fund, you have to wait to the end of the day, and whatever its ending asset value is what you pay for it. So much more liquid with exchange traded funds. You pay a commission to a broker or whoever's, a transaction fee for buying and selling exchange traded funds, just like a stock, as part of that low cost in there too. And you can buy one share. There's no real minimums like you have with like mutual funds. One of the challenges of mutual funds is they might take thousands of dollars in many cases to invest in them. Some might have like a limit of $3,000 for some index funds. For example, some of the Vanguard funds, they typically start at $3,000, or I know in Vanguard they have Admiral class, which is lower expenses even, but you got to have $10,000 to invest in it. Well, not everybody has $10,000 to invest, but they'd like to invest. An exchange traded fund will give you all those benefits of index mutual funds by buying one share at a time. So if you want to buy 30 shares of exchange traded fund, you could do that without having to come up with maybe thousands of dollars to buy a mutual fund. So exchange traded funds, for all those reasons, have been really growing in popularity as a way of building out your total portfolio. Remember, your stock portion of your portfolio is part of an overall portfolio that might have bonds and cash and other things in it. And then within that, you could have things like individual stocks, active mutual funds, index mutual funds, and now exchange traded funds as well too. And you can build your overall portfolio that meets your needs and really helps you get to your goals. But exchange traded funds, kind of that hybrid where it's like a stock, buy and sell, very liquid, can buy at smaller quantities, but low cost as well too, and get you a wide variety of diversification as far as the holdings within the exchange traded fund. And they track their index just like an index fund would be. So exchange traded funds, check them out. One thing to look at and be aware of is a mutual fund style box. There's a term out there called style drift, where a mutual fund might say, we're a large cap value fund, right? A mutual fund might say that, and that might even be in their name. But then over time, maybe you have a new management team, or the management team, if it's an actively managed fund, decides to go a different direction. And so they're maybe investing, instead of large cap value funds, maybe they're or value stocks, maybe they're investing more in mid-cap type stocks or more mid-cap growth. The style box will show you the current position of the fund, the Morningstar style box, and go to morningstar.com, put in mutual funds ticker symbol, or search by the quote for the mutual fund, and you can find a Morningstar style box. Also, mostly all mutual fund companies have the Morningstar style box or a similar box in the description of any of their mutual funds, because they want investors to know, this is what our investment philosophy is for this fund. So it's important to look at this, and let's take a moment to just kind of look at the box and understand what's going on here. And the idea behind it is you have these different buckets, right? You have 9 different spaces basically, and your fund fits into one of those buckets, at least partially in there. That's the idea of the fund. So for example, on the right-hand side, you have large, medium, and small. As we learned, that's large cap, medium cap, or small cap based on their market capitalization. So it doesn't necessarily follow 100%, but typically, let's say a large company like Apple or Amazon will be a large cap company, where a smaller startup that is publicly traded might be a small or mid cap type company as far as its market capitalization. So if you're interested in, let's say stocks like Apple and Amazon, you want to look for large cap stocks. Then along the bottom, it has things like value, blend, and growth. And as we know, growth is growth stocks, things that you want to have outperform the market from a capital appreciation. You want to buy low as far as the stock price. You want the stock price to grow and grow rapidly faster than the industry, the sector, and the greater market, hopefully. You want these to be high flyers, so those are growth stocks. Value stocks tend to be more of the well-established stocks, the players who might be paying more dividends, for example. It's not necessarily value from a value investing standpoint as far as a beaten down or contrarian stock or an underperforming stock. You could have that with the other ones, and sometimes that's called value investing. But with these style boxes, value might be a little bit more oriented towards income or dividend producing stocks, or stocks that are not growing as fast as other stocks, but might be great stocks for safer, longer term growth, and maybe pay a dividend as well, which could be a great investment. So we have those two ends, value and growth. Blend would be where a mutual fund is maybe buying both of those types of funds, or excuse me, both of those types of stocks in an overall blend of each of those. So for example, the S&P 500, the S&P 500 stock fund, or any S&P 500 stock fund, Vanguard is the most famous for that, but Fidelity, Schwab, everybody seems to have an S&P 500 fund. If you take the 500 largest United States stocks, which is what an S&P 500 fund is, you're going to have a mixture of growth stocks like Apple and Amazon, and value stocks, ones that pay dividends like maybe Coke or Johnson & Johnson. And you're going to have that mixture in those big 500 large companies. So that's where it would be a blend. So you basically have a matrix here, right? So if I'm looking for a large cap growth stock, maybe somebody like Google, a large big company, but I want it to really grow, and I think it's going to grow, or the mutual fund that's buying it thinks it's going to grow, it would fit in that large cap growth box. And that's, when you look at a mutual fund, if you're looking for stocks that fit that box, this box will help you this matrix will help you to select that. Versus, let's say if I'm interested in small stocks, I want to get these newer companies, these just brand new, maybe publicly traded companies, these small companies, maybe a small high-tech company, but I want it to be a real growth stock, or maybe it's a pharmaceutical or healthcare company that's small, but they got a wonder drug that's maybe coming. So they might be on the small side, but they might be really, really a growth type thing. So I'm looking for it to be a small growth type stock. Like I said, the blend stocks tend to be those mixtures, like a mid cap or a small cap or a large cap, where there's a blend of each of them, and value tends to be dividend or income producing stocks. So if I'm looking for, let's say, large dividend paying stocks, which typically larger companies or companies that pay dividends tend to be larger ones. They don't have to be, but tend to be. Well, then I might be in the large value box as far as a large dividend income producing stock. So the idea behind this, it helps me to select mutual funds or exchange trade funds that might meet my needs based on this style box without having to go through a list of maybe 10s or 20s or hundreds of different types of stocks to try to figure out what it is. The Morningstar box does it for you and kind of says, this is this kind of box or this type of fund. And watch also for this style drift. Like if you're investing, looking for dividend paying value, large cap value, dividend paying stocks, and it starts to drift to more of a blend, well, then you're picking up more growth stocks and less dividend stocks. So that might be not what you're looking to do, because it's shifted. It's trying to move, away from that style box. Even though the name of the fund might say, the XYZ company, large dividend growth company fund, it might start to shift to be more of a just the growth part versus, let's say, the income or the value part. So that's the Morningstar Style Box, or a style box for mutual funds. And when you're evaluating mutual funds, look at that. You'll find it in the portfolio sections of a mutual fund or in the holdings area if you're looking at mutual funds, and look at that style box and make sure that style box is meeting your needs as an investor. Otherwise, look at another investment that does. Let's talk about mutual fund expenses, because unfortunately, there's no such thing as a free lunch, right? Mutual funds do some great things. They give you a whole basket of holdings. They give you diversification. They give you less risk possibly. They give you a lot of good stuff, and you got to pay for that, at least somewhat. So it's real important to understand the mutual fund expenses, because that can make a big difference between mutual funds. You might be surprised to know that there can be a wide difference in terms of what mutual funds charge you to hold their fund, and it can be really impactful as far as your overall returns. In fact, that's why index funds have risen in popularity so much, and then exchange trade funds, which are similar to index funds, because their expenses are so low, they have a less big hurdle to overcome to have a good return when you're comparing, let's say, two funds. And after this lesson, the next lesson, we're actually going to look at a little case study where we're going to compare a couple of funds, and you can really see this in action and what the difference is between them when you start factoring in expenses and how impactful that can be. So let's start talking about, well, what are some of the expenses out there? What should I be looking for? Because a lot of times your expenses are kind of hidden. I wish it was a little bit more upfront. Some are better than others as far as mutual fund companies, but these are the expenses you want to be looking for. This is the overall expenses that are out there. And there's really two big ones that really you'll see everywhere, and you really want to be on these first, and then you look further onto the other ones. And the two big ones are sales charges, or loads, and the expense ratio. So let's talk about these first, and we'll look at the others. First off, sales charges, or a load, and that's usually how it's referred to as a fund might be a load fund or a no-load fund. And what does that mean? And the idea of a load or a sales charge is that's the privilege of you to buy that fund. So if I'm XYZ fund, I have these investments, you can buy into my fund, but to do that, you might have to pay to enter. It's kind of like a cover charge at a bar, I guess, right? You pay to get into the fund. And that would be called a front-end charge or front-end load. Now, a no-load fund would have no charges in front. So typically, like a front-end load might be around 3%, let's say, for example. So that means if you want to buy into my fund and I charge you a front-end load of 3%, immediately, whatever you invest, whatever amount you invest, I take 3% off the top before anything happens, before any returns or anything like that. That's like, thanks for the money, thanks for the 3%, which is not insignificant. That's a big money. That means your portfolio, your investment in that mutual fund has already been reduced 3% forever. It's a one-time charge, by the way. It's not a recurring annual charge. It is a one-time charge. So that's the good news. The bad news is like it's taking that money right off the top, so you in fact have less money to invest in a front-end charge or front-end load. That's why a no-load fund that has no front-end charge, it takes zero of that, which means you've got more money working for you, and that'll help your overall return, because it's all about, not how much you make in terms of return, it's how much you keep. So things like expenses and taxes and some of these other considerations reduce how much you're keeping. So, please keep that in mind when you're looking at expenses. So front-end loads and front-end charges are all about taking money off the front right when you get in. Now, there's also what's out there called a back-end load or back-end sales charge. It could also be like 3%. So if you have a charge coming in, you may or may not. They actually have a charge as far as when you're leaving too, or as a back-end charge once you sell that mutual fund as well. So that can be real impactful. It's like, boy, I've grown up all this money, maybe I invested for 10 years or so, and now when I cash out, they're going to take money away from me. Well, that's kind of icky, right? So when you're looking at mutual funds, and there's so many mutual funds, so many good mutual funds with no loads, either in the front or in the back end, really look at that first to see in your universe of mutual funds you want to be looking at, because that really is a big impactful expense either in the beginning or the end. So look for no load funds, I would recommend, but if you're looking at a load fund, it better be a top performer, a top 5, 10% performer, and well outperforming its index, because you could get an index fund with no load. So that's first thing to look at is sales charges or loads. The next thing that you want to look at is expense ratio when you're looking at expenses. Expense ratio, and they typically average like 1%, by the way, but some are very low, like 0.2 or even less, like in an index fund, and some are very high, like 2% or more. And an expense ratio is the average expenses that you incur, basically what you're going to be charged on an annual basis, okay? So like a front-end load or a sales charge is a one-time charge.
Expense ratio is an every year charge. So if you're going to hold, let's say, a mutual fund for 10, 20, 30 years, you're going to have that charge recurring every year. So funds that have lower expense ratios make it easier for them to get you better returns and make it easier for you to make money. An expense ratio basically is pulling in things like the operating expenses of the fund, right? You have to pay things to actually operate the fund. So if it's an actively managed fund, I have somebody who's in charge of picking stocks, you got to pay the salaries of those people. In the index fund, you have people who are buying and selling, but it's all matching the index, so you don't have to pay as much or have as many people. Also, you have that might be wrapped up in there as a 12B1 fee or a marketing type fee that gets wrapped up in there, might be separate from there or inside it, so you got to look at that too. But your expense ratio is what you're paying on that annual basis. So in terms of expense ratios, the lower the number, the better. Also, there might be additional charges out there, and we're going to look at a couple examples in the next lesson on where to find these things, but there might be some miscellaneous charges that are not part of the expense ratio. Sometimes that 12B1 or marketing fee, which is basically all that 12B1 is just extra expense, just charging for marketing, printing the brochures. It's just an extra expense. So look for funds that don't have a 12B1, but that could be outside the expense ratio, so watch for that. But also they might have some miscellaneous charges, such as might be called a custodial fee or some type of maintenance fee or some other type of hidden fee. You're looking for things that might be outside the expense ratio on an annual basis, but typically your expense ratio is going to have everything in there. But when you're looking at the funds, be aware that there might be additional fees on that. And they'll list them. They'll list them in the prospectus. They'll list them in their site, and we'll take a look and we'll show you kind of where that looks like. Lastly, there is possibly a redemption fee, very similar to the back-end load, where basically you have this fee when you sell. Now, a back-end load or a back-end sales charge means that no matter what, you're going to pay this fee at the end. So that's why it's called a sales charge or a load. You're going to pay a back-end at the end when you sell. Redemption fees are put in there to prevent like frequent trading of a particular mutual fund, where if you charge this fee if you sell before a certain time, like if you sell before like 30 days, for example, might be typical, or even 60 days. Most funds don't have this, by the way, but many do, particularly like a technology fund or a small cap type fund, where they don't want people to buy a fund and then sell it right away and then buy and sell. They're really trying to discourage market timing. They're trying to discourage active trading. And so they have this redemption fee that if you buy, that's great. And if you sell after 30 days, no problem. But if you sell before 30 days, we're going to charge you a fee, which would be like 1%. So they're really discouraging market timing. That's where like an exchange traded fund is a little different, where it sells on a market exchange. You can buy and sell throughout the day and still get that diversified portfolio. So when you're looking at index funds and exchange traded funds and actively traded funds. But from a fee standpoint, redemption fees are a one-time fee that occurs if you sell before a certain time period, typically 30 to 60 days, versus let's say a back-end load where you're paying that 2-3%, whatever it might be, no matter what. So just be aware if there's dates around when you're going to sell, if there's any kind of type of fee like a redemption fee. All right, so you can see there's a lot of different types of expenses, right? And there's a lot of different things that you can get charged for. So when you look at the performance of a fund or whatever, when you look at your choices for a mutual fund as an example, take fees into consideration, because that can eat away at your return, either right off the bat with a load or over time as an annual expense ratio. That's why companies like Vanguard is real famous for really keeping their fees down and really promoting that, because that's their niche. They want to try to drive costs down to get more return too. That's what they're doing with their index funds, versus maybe an actively traded fund that might say, yeah, we've got more fees, but our performance is so good because our people are so good, or whatever, our performance is so good, it's well worth it to you to pay maybe a little higher fee than a low-cost index fund. So those are different ways they market their funds, but for you, you want to look at it from an expense standpoint. Last big thought here on expenses too. Don't let expenses and things like tax consideration totally drive your whole investment philosophy. It's good to drive down those costs, and certainly it's worth it to look at no load funds and low expense funds without a doubt. But you don't want to preclude from maybe getting a better fund that might be a little higher in the expense ratio, because they might be running a 3, 4, 5, 8, 10% better return, and you might just have to pay a little bit more in the expense ratio. So look at it as an overall return, but understand expenses can really, really eat away, and lower the expenses, the better off that is for you. Let's go look in the next lesson here, a couple case studies to look at a couple mutual funds side by side, so I can show you where to find this expense information, because it can be hidden sometimes, and how to compare these, compare some funds together. So when you're looking at your own mutual funds or other types of investments, you can kind of get a feel for, hey, where do I find this stuff? Okay, so there's thousands of mutual funds out there, but let's compare a couple so you can really get a feel for these expenses and how to find them in their mutual funds and online and their prospectuses, which a prospectus gives you the information about the fund in greater detail, and also how you can kind of compare and how to maybe evaluate funds from an expense standpoint. And we'll look at two here. We're going to look at the Vanguard S&P 500 fund, a real standard index fund that low expense type fund, so you can get a feel what that looks like. And we're going to compare it to a Quaker Strategic Growth, a fund I happen to kind of find here to give you some examples of a fund that might have some loads and some different types of expenses, so you can get a feel for how they might differ on maybe both ends of the spectrum. So let's go take a look at these mutual funds and see what we see. Okay, we're over here at Vanguard. You can search Vanguard or Vanguard Group in the Google or whatever, and you might see a home page like this. They change them every once in a while. And I want to show you this because it's sometimes a little harder to find some of their mutual funds. Things you can also search by the name or the ticker symbol might take you right directly there. But if you're looking at just wanting to look at their list of mutual funds, Vanguard's pretty popular. You just go under personal investors, and then you look under mutual funds. So we're going under investing and then mutual funds, because we're going to look at this Vanguard index type fund and kind of compare it to another fund. So we're going to browse index funds by class, because we're looking at a large cap US stock thing, because we're going to compare this to Quaker. And really what we're looking to do is just to look at expenses. That's all we're looking to do, is we're just going to look at the expense part. You can see Vanguard has money market funds and bond funds. They have a lot of different types of funds. So we're looking for stock funds, and we're looking for large cap. So here's stock funds, here's large cap. You can see they have different types, like dividend growth or growth index. Let's look at just the 500 index fund. This is their bigger fund, their Admiral fund, so it's a little bit more expensive again too, but at least you can get a feel for expenses and how it looks and differs. Whenever you're looking at mutual funds, you can kind of get a feel as far as different things to look for when you're going into the actual fund. And I'll show you a quick way to look up these expenses too at the end of this lesson, so you don't even have to go into the funds. But when we show you the quick way, you still want to know how to go deeper into the funds to find the kind of the small print, as they say. So if I pull up Vanguard 500 index fund, it's the top. Admiral shares is the top 500 U.S. stocks, large cap. It gives you a little overview and all that. And what we're looking for is fees, because this lesson's on fees and expenses. So we're going to click on fees and minimums here. On other funds, it'll say like expenses or fees. Either way, that's what you're looking for, is expenses or fees. And overall, you can start seeing here, Vanguard 500, real low. This is 0.05 expense ratio. Now you need like 10 grand to get in this fund. So it's not expensive to get into. The regular 500 funds like 3 grand to get into, and that's like a 0.18 or something. But it gives you a feel for how low the expense ratio can be with like an index fund compared to, let's say, the average of a little over 1% for funds. All right, so that's just the expense ratio. We want to know, is there any loads? It's like you can have a real low expense ratio, but if you have a 5% load or charge just to join the fund, well, that really eats away my return even if your expense ratio is low. This expense ratio being that annual cost. That's your yearly annual 0.05 you're paying. So we look down further here at fees. Purchase fee, that would be a load, is none. So great, there's no load to it. There's no redemption fee, so I could sell it after even only a couple weeks or whatever. I don't have to worry about holding it for a certain period. So there's no purchase fee or exit fee or redemption fee. There's no 12B1 fee or any other types of additional fees in there. If you had a certain account, like maybe in a certain type of trust account, they might charge you annually like $20. You'll find that when you go in to set up the actual account. But if we're just doing just investing regular old mutual funds, you can see, wow, this is extremely low, 0.05. A lot of mutual funds in the index category, you can find like around 0.2 to 0.3 as far as a fund expense ratio annually. And heck, there's no annual fee. So if you like an index fund and low expenses, this is an example of a way to go. Let's compare that to the other extreme, which is looking at a fund that's an actively managed fund that's got some pretty high expenses. And I chose this one intentionally just to show the idea of the expenses. And by the way, I'm not recommending one fund over another, though expenses and performance might be obvious with these two. But I just want to educate and show how you want to look at different funds. And this happens to be the Quaker Strategic Growth Fund. It is a large cap fund. It's a large growth fund, so it's a little bit more risky, a little bit more growth than maybe the S&P 500, which is growth and value, a little bit more of a blend, but they're still large cap funds. You can see they're not sharing too much with us right off the bat here. I wish they were sharing a little bit more here.
But at least this is the Strategic Growth Fund here. Let's look at the, a lot of times you might go to like a brochure or a fact sheet. Brochures are all just sales, sales, sales. So I like to go sometimes quickly to go to a fact sheet. But even fact sheets can be a little misleading, so you just got to be aware of that as well. So here we are in the Quaker Strategic Growth Fund. You can see they have different classes of shares, Class A, C, and I. I might be like an investor class where you can only buy that through maybe like a reseller, like a broker. And then they have different things like Class A and Class C, and they might vary based on their expenses and other requirements. A Class C might give you less expenses or maybe more, but they might have some other benefits to it. So let's take a look at this. And you can see the expense ratio here, just looking at their fact sheet, they have it right here, 2.24 versus a 2.99. You can see it's lower in the Class I, but you might need 40 grand to invest, and you have to buy from a broker possibly. I didn't go through super detail on Quaker, but that's the idea behind the two. But still, we're at 2.2, 2.9, even 2%. That's pretty high, considering you got other funds that are less than 1%. Even index funds are like in the 0.2, 0.3, 0.4 range. That's money you're paying every year. So every year, if you're in a Class C, you're going to pay 2.99 or 3%. You got to do better than 3% just to break even every year. So you can see how that impacts your return. And one thing I noticed here with Quaker that was a little like, I didn't like, was sometimes you see these things where they show like a growth of $10,000, happens to be US, and they show, like, oh wow, this is Quaker versus the S&P 500 total return. The black is the Quaker, and more the gray or brown is the S&P. And you look at it and say, look at Quaker, they're just kicking butt. Look how great they're doing. Well, the reality is this is since inception. This is not like the recent period. This is like since inception from 1996. So maybe back in 1996 it was a good fund, and because you had that good fund for all those years, it's still maintained it. But how's it done recently? Because that's what we care about, is a little bit more recent, because they might have changed a fund manager or something. So this is not the expense part, but just to give you a feel for it, you can kind of see here when they show returns, like average annual returns. Well, before sales charges, 7.5, but you have these sales charges we're going to talk about in a second. And otherwise, you're at 6.36 after the sales charges over the last 5 years. In this period, compared to like 12% for just a plain old vanilla index fund for the S&P 500, right? I mean, it's getting crushed over the last, last 10 years, right? Versus inception, it does great. So that was a little deceptive on that. I didn't really like that. But we're looking at expenses here. So what do we know so far? Well, we know Class A and Class C shares, they run a 2.2 or 2.9 expense ratio. That's really high. Let's just talk about that's really high. All right, so now what you want to know, is there a load? Is there a before charge? Because a lot of times when you have these kind of funds, they might have a fee or a charge in there. And there's more information here. They give you some things around what their holdings are and stuff. But I'm not seeing anything here on this short little fact sheet about loads or other expenses. It's just a short little fact sheet that just gave me some quick information, which is nice. I can look at this right now and say, at a 3% expense ratio, it better be crushing the index, and it doesn't, so that might be kind of worrisome. So what do you do, right? So you got this quick kind of like fact sheet. Well, the next thing you can do is go into the prospectus. That's really where you find all your detail on funds, on mutual funds, is the prospectus. You can see they don't even have a link for it here. You got to go up here, and then you find like this big prospectus with all their funds, and you got to kind of scroll through to find the fund you're looking for. So in the interest of time, because it was kind of icky, I already did that. And so here's from the prospectus, the Quaker Strategic Growth Fund, and this is going to give you a little bit more detail on a lot of areas, in particular like your expenses. So let's see if we can find the sales charge here. Let me blow this up a little bit, and why, yes it is. It's right here. You see where it says maximum sales charge or load imposed on purchases as a percentage of the offering price. So they're obvious, they're honest, they're saying this is what it is. And with Class A shares, it's 5.5%. Holy moly, 5.5% just to get in the door? That's pretty high. Now Class C and institutional, where you might have have bigger things or bigger things you can do, then you have to have more money invested. In fact, it says up here, if you and your family invest or agree to invest in the future at least $50,000 in Quaker funds, you might get a reduction on your sales charge. You might, So if I give you $50,000, maybe I don't have to pay 5.5%. Maybe I can get something a little less. And maybe if it's $100,000, I can get a Class C share. A little more details behind that. But either way,
That's pretty high. But even if I was a Class C share, you can see these are the management fees, 1.3. You know, they break down the fees, and there's 12B1 fees. So these are extra fees that are loaded, wrapped up in your expense ratio. These are your annual expenses. They got some other stuff here. They got fund operating expenses. They got all sorts of stuff in here. The bottom line is that you're going to pay 2.24 or 2.99, depending on the class of share you're buying, every year just to hold that. So if I bought, you know, I'm just a regular guy investor and I bought a Class A share, I'm going to pay 5.5% just to buy the fund. And then every year I'm going to get charged 2.2% on my holdings every year. Compare that to a no-load fund that's zero and might be less than 1% as far as, or average is 1% for even actively managed funds and less for index funds. And you can see then that makes it hard for a company like Quaker and their Quaker Strategic Growth Fund to do well. You know, they're really making their money on the fees that they charge, is really where that's coming in. So if I was evaluating mutual funds, you know, I would have some concerns about Quaker, and I'd certainly expect some big, you know, returns from them. Okay, so we dove into these funds and dove into things, you know, pretty deeply, and that's what you want to do, go in the prospectus and really get deep. But let's say I just want to find information fast. In Google Finance, Yahoo Finance, a lot of places have this. I think I like the Google Finances for finding out expense things, or can find it real quick. And you can just put in the different ticker symbols around that. So I know, or you could just type in the name. So if you're not sure, you know, what you're looking for, you could go into, let's say, Vanguard, and it will pull up all the Vanguard funds, and the more you type it in. In fact, let's look at the Vanguard regular old 500 index, the investor class. We were looking at Admiral, which had super low expense ratios, but you needed 10 grand. This one you don't need as much in, you need like 3 grand, but at least gives you an idea of something, a standard type of fund. Pulls up the current price and all that, but what we're looking for off to the right-hand side here is where we'll find our different expense ratios and expense information in there. And that's what we're really looking for, is there a load? Just if I'm looking quickly without going to a prospectus or really trying to search for all these different funds, I can go right in here into Google Finance, you know, just by going to Google and then Finance, or just searching it. I can look up the company name, the mutual fund, this is the Vanguard Index, and you can see here, front-end load is 0, deferred load, that would be your back-end load or back-end sales charge, that's 0, and expense ratio of 0.16 for this one, the investor classes versus their Admiral class, where you had to put more money in. So I can see, and there's no management fees or anything, so I can see, you know, no loads, real low expenses, index fund, that's how they do it. Let's compare now to Quaker. You can see how quickly we're able to get this information now. So if we put in Quaker, and if I knew I know Quaker's symbol, but if I didn't, I can just type in Quaker, and I can find their Quaker Strategic Growth, right? We were looking at that A shares, right? That had the big front end load. Let's look at that. So here's Quaker, and I can scroll down, and I can see right off to the side here, you know, front end load of 5.5% and expense ratio, the overall expense ratio, not broken down, but overall 2.24. It's all loaded in there. There's no deferred load, no back end charge, no extra management fees, but you don't have to worry about that. I'm getting 2.24 every year on that. And it's interesting, under their total assets, they've got 85 million, a little over 85 million in assets, so somebody's investing in them. I'm not sure it would be me, but these are the people who are putting in big bucks to try to avoid some of these charges and these loads. But for us regular investors, you know, that's a pretty hefty number. So yeah, that's where Google Finance is nice. You can just type in the ticker symbol. The ticker symbol is right here. That's like the thing you could look up as far as quickly looking up stock, if you know a ticker symbol. If not, just type in the name and you'll be able to find it in there. At the macro or bigger level, there's really two investing extremes. Buy and hold on one end and active trading on the other. And you can have a little bit of mixture between the two, but in the end, you're looking at buy and hold versus active trading. Because with both of those ends of the spectrum, so to speak, you can, you know, then invest in different stocks from different market caps, or use different strategies such as investing in growth stocks or value stocks, or using something more exotic like dogs of the Dow or something of that nature that we're going to learn about, or just tracking an index or buying individual stocks or mutual funds. All these things are part of this. Those are the individual strategies. We'll look at the actual tactics. But in the end, you got the two extremes. Do I
buy these vehicles? Do I buy these individual stocks or mutual funds, or do I implement this strategy around buying, low, undervalued stocks as a value investor, or am I buying growth stocks, or whatever it might be? But once I buy them, do I hold them for a long period of time, which is buy and hold, or do I buy and maybe be more active in trading and switching those out? And that's what we're going to look at here in this lesson, is looking at buy and hold versus active trading. And then the future lessons, we're going to then see how we can then implement different strategies and tactics, but we still might, as an investor, be more of one side or the other, maybe a mixture, but usually you're one side or the other for the most part. As far as a philosophy that you have from investing in these investing streams. So let's look at buy and hold and active trading. So first off, buy and hold. What are the advantages of buying and holding, and what do we mean by buy and hold? Well, first off, buy and hold means you're buying something and holding it for long periods of time, right? You might be holding a stock for 20 years. You might be holding it for a couple of years. It's not something that you're turning over in less than a year typically. Something you're going to hold for at least a year, maybe 2, 3. And the idea is you really want to hold it maybe for 4, 5 to 10 or longer. You want to hold it to give it, time to, if it does go down, to recover and maybe pay a dividend or things along the way. But you're really buying and not incurring lots of extra transaction costs or anything. You're buying that stock with the idea that you're going to hold that stock for a long period of time. So the advantages of buy and hold is, one, it's easier to manage. You're not constantly buying and selling stocks. You buy it, you hold it, you put it offside. Maybe you buy another one down the road, or you buy a mutual fund, whatever it might be, and you're letting it ride, so to speak. So you're easier to manage that. You have great reduced transaction fees, because every time you buy something and sell something, particularly an individual stock, every time you buy an individual stock and sell an individual stock, there's a cost, there's a trading cost or a fee that's associated with that. So the more active trading you do, more buying and selling of stocks, the more fees that you're accruing each time along the way. If you buy it and hold it, well, heck, then you really reduce those transaction fees really, really dramatically. Better tax efficiency too, because every time you buy something and then sell it, whatever you have for a gain is then taxed. Your gains are taxed. So by buying something and holding it, let it gain over a long period of time, it might be more tax efficient for you to then sell later on. A lot of people use a strategy like, I'll buy now and then I'll hold it till I'm maybe in retirement, where my income is lower and my tax bracket is lower, and thus I'll be more efficient when I do eventually sell them. But until that time, they're basically growing tax-free if it's an individual stock. Mutual funds are a little bit different, where they have distributions and they do stuff every year to kind of true up. But either way, with buy and holding, the idea is it could be more tax efficient. And the other part of buying and holding is you have a philosophy that you're not trying to time the market. You're not trying to buy when the market's down or individual stocks are down so you can then sell them at a high, because timing the market, in history shows this over and over and over again, and some of the best investors out there talk about how hard it is to time the market. When the market's going to go up or go down, or individual stocks go up or go down. You can evaluate and do fundamentals to buy certain things that, when they're particularly down, an individual thing, or maybe it's something that's good for the long term, and that's what a buy and hold person is looking for, is the long term. But you're not doing like constant trading when you're trying to time the market. When the market's down, you're buying, and when the market's up, you're selling, and you're constantly researching and doing a lot of that. Buy and hold is like holding, being passive, and letting compounding and letting all these things, time work to your advantage so you can, be very successful. The disadvantages of buy and hold is you might miss out on opportunities. Maybe something's way down and you'd rather sell something so you could buy something else. You can do that with buy and hold, but the idea is you're buying and holding for long periods of time. So you might miss out on some opportunities. And you also, buy and hold, you might be reluctant to sell poor performers quickly enough. Sometimes with a buy and hold investor, they'll buy and hold it and they'll just keep holding and holding and holding. And if something happens with an individual stock, let's say, where it's really going bankrupt or getting crushed or whatever, maybe it is time to get out. But a buy and hold person might be a little bit more reluctant to do that because they bought with the idea of holding for a long period of time, and they're maybe hoping that that will recover. So even buy and hold investors have to bite the bullet sometimes and liquidate on things as if something turns bad for a mutual fund or an individual stock. You might buy, let's say, an actively managed mutual fund because you like that fund manager and you think they're doing a terrific job. But once that person maybe leaves the company or retires, you can't keep holding it. And you've got to really look closely at that and say, maybe now's the time to sell that fund because we have a new person coming in. Part of the evaluation of it, or an individual stock, the same thing. So buy and hold is about holding and holding for a long time to compounding and tax efficiency and all that, and reducing fees work for you. The other extreme is actively trading. We're not buying and holding. The idea is that you're making lots of changes. You're looking for these new opportunities. It doesn't necessarily mean you're trading constantly or daily. There's something called day trading where they're basically trading hourly in some cases. But it's something that with regular active trading, you're looking to trade and sell frequently. You got to be more engaged with the market, understanding what's going on, understand the positions that you hold as far as individual stocks or mutual funds, and really stay on top of that with active trading. And so you can take advantage of new opportunities that you might see coming around. And then you can sell those losers, real quickly. That's an advantage. That's another advantage. You can sell those losers really, really quickly. And if a winner has a quick run up, you can get out fast too and capture that income, capture that gain before it comes back down is the idea too. So you can sell losers, capture gains on winners, and you can reallocate too, particularly faster in a volatile market where stocks going up and down all over the place. Maybe a sector, healthcare's gone way up, you can sell that and you can buy that energy sector that's down, or vice versa, or those individual stocks. So you're actively more engaged in trading. And that's the thing, you're not buying, holding, and forgetting it. You're actively trading, you're actively involved all the time. And that's part of the disadvantages to it is you need more time devoted to your investing. So if you have a lot of time to that and you like trading and you want to do some of that, go ahead. Just understand to do it well, it takes a lot more time. And it is very difficult to time the market. I'm not going to say to anybody that you can time the market. Nobody, the experts are saying that you can't time the market, but you can have buying and selling opportunities. But the idea is you're going to need more time devoted to investing to really be on top of it. You're going to experience one of the disadvantages is increased taxes, increased fees. So your buying and selling has to outperform that. That's like when we learn about mutual funds, how index funds do well with very low turnover, very low buying and selling, so they have lower fees, lower active managed people managing it, so lower fees because they don't have somebody investing the time in it. Same thing as think of yourself as a mutual fund, but now you're investing your time to manage that fund, your investments, but also you're incurring taxes and fees with all those changes you make. So you need to outperform those extra fees that you'll incur. And really, investing overall really rewards patience and compounding, especially over the long term. Where in active trading, is a little bit disadvantaged. It's a little bit less patient with that. And active investing will typically underperform in the long term. I mean, we see that in the experts. I mean, you see these experts, high-paid people in mutual funds. They run these big mutual funds with millions and millions and millions of dollars, and they can't outperform their index, right? So few outperform their index. How can a question to ask yourself, how can I, as the individual investor, how can I do better than those experts who can't outperform the index or outperform a mutual fund? Now, how am I going to do that with active trading? So it's something to think about when you're thinking about active trading. For myself, just to share a little bit, I'm a big believer in buy and hold. I will say that. I like to hold things, hold them for long periods of time. I'm a big believer in buy and hold. I try to make sure I sell if something's going wrong or something changes, because I buy and hold with the idea that a mutual fund or a company is going in a certain direction, but if all of a sudden they change and they make a change from their business strategy or a change in leadership, I'll change too. So I'm not locked into that buy and hold. And so I have a little bit of active trader in me, certainly too, more than a little active trader in me. And also I like to buy and sell individual stocks too, more so from fun and more so also from trying to get that little bit extra performance by concentrating on maybe a few stocks as opposed to trying to build my whole portfolio and actively managing all the time. I got a lot of other stuff going on in my life with family, friends, making videos like this. So I can't be all my time being an investor. So I like buy and hold. I think it proves itself over time. It has served me very well. And a little active trading is fun on the side too as well. So think about yourself and your own personality and the time you have in your education and completing this course and other courses or readings to see if you want to be more of an active trader or maybe of the buy and hold. But those are the extremes, and then within those extremes there's lots of different strategies and tactics you can use to get the best out of your investments. When you're deciding on what types of stocks to choose, one thing you can look at is growth stocks or growth investing versus, let's say, value or income type investing. So growth stocks or growth stocks are ones that are going to be priced higher to the market or in their industry. The whole idea is these are high-flying stocks that you think will have a great future. Maybe they're a high technology company that's working on some kind of new technology, maybe around some new demographics or things around virtual reality or augmented reality, whatever it might be. Or it's a pharmaceutical company, maybe a small pharmaceutical company that's working on the next blockbuster drug or wonder drug, whichever it might be. And it can be in any industry. You're looking for stocks that are going to grow relative to their peers much faster. And we mean by growth, not only are they going to grow their sales and their revenue, and hopefully they're going to grow their profits and their earnings, which means it's going to grow the stock price. So with growth stocks, you're really looking for stocks that are going to grow your stock price. You're going to buy here, you're going to buy low, and you're hoping they're going to grow fast and outperform the market, so later you can sell high and make a profit there. These are stocks that don't necessarily pay like dividends or income or anything because they're trying to invest in that growth. So growth stocks are priced to be high to the market. You're looking for that momentum and that future to drive their price up. And they may not even be profitable yet. So they might be running, negative or hanging on there, so to speak, because they're investing in their company and they're looking to, then maybe come to market with something new. So they might not be profitable yet. Growth stocks are great for the long-term investor because you're really betting on that future. You're looking for that great future. So you need to be a long-term investor, and you need to be patient too. These are not overnight sensations typically. Sure, things happen, and when something gets announced, maybe the stock will rise dramatically, but it takes years maybe to get to that point, and you want to be in before that big announcement, or maybe before that blockbuster drug is released, or whatever it might be. So growth stocks could be something that might take some patience over a longer period of time. Also, growth stocks tend to be a lot more volatile or go up and down price a lot. They're more of a roller coaster because people are betting whether it's going to be great, or if they don't see it's going to be great, then they're going to pull out right away and maybe try to bet on the next great thing. Or there might be a bad announcement. Maybe they're delayed in their process for whatever they're working on that a lot of people are excited about the future for them, and maybe there's a bad announcement or a delay. So they can go up and down in price pretty dramatically at times. The idea is you also want to protect your downside. And we mean by that, if stocks are really kind of going down, even a growth stock, you might want to get out because it might not ever come back. I've seen reports where they talk about if you're down 20%, maybe that's the time to get out. Well, heck, maybe it's time to get out when you're down 2, 3, 4%. But there comes a period where you got to look at it and say, boy, this is way down, and I'm never going to recoup my money back, and maybe this just isn't going to work out as a growth stock. And you do all your fundamentals, you do your continual analysis. Maybe you're looking around at other companies, and you just have to bite the bullet, so to speak, and take those losses. So understand with growth stocks, they can have a great potential, but they can also have a bigger downside. So be aware about that and protect your downside. What you're looking at from a fundamental standpoint, or maybe like financial ratios and things, is that they have fast rising sales and earnings. The whole idea is that they're growing quickly. They're outperforming the market. So when you're comparing within an industry and compare to the market, but really compare within their industry, technology, health, energy, whatever it might be, see that they should be growing their sales and their earnings faster than their peers. And when we get in the ratio area, we'll talk about that more. But growth stocks grow faster sales and earnings. Also look for growth stocks that have low debt. That doesn't mean they necessarily have no debt. Debt's okay because they're taking on debt to help fuel that growth. But if they take on too much debt and they're not growing their earnings, or maybe they haven't had earnings yet, or they're not growing their sales quick enough, they might have a hard time servicing that debt, or basically paying off that debt. And that could hurt them and hurt their results, and really maybe constrain their growth because they're too busy trying to pay off that debt. It didn't turn out the way they wanted to. But some debt's okay, just so it's not a high level of debt compared to the industry and their peers. And the lower the debt, the better in this case for growth stocks, looking to ride that sales and hopefully earnings ramp up, and not all the ways up and down, and certainly not down. So from a ratio standpoint, look for that. A couple tips around growth stock investing and some things to look for. One is think about the industry as a whole. If you're a growth stock, but you're in a bad industry or a poor performing industry, you might be great, but the industry is going to hold you back. You won't have that. Investors will look at that industry and maybe stay away from it just because they don't like the industry at all at that point of time. You could be a growth stock, let's say in the buggy making industry, for making buggies for horses, and you could be like, wow, I'm the best at making buggies, and we got a brand new buggy coming out. It's going to be terrific. But you know what? Nobody's really excited about the buggy making industry versus, let's say, maybe an alternative fuel car, whether it's electric, but even getting things like hydrogen cars or solar cars or self-driving cars. Those are the high-tech industries for those that people are excited about and want to invest in that. So if you're a growth company in that industry and things look great for you, you're going to get a lot more investors, and that'll drive your stock up. So look for growing industries as a whole. So that's one thing you can look at as you're evaluating growth stocks. So think about the growing industry. Think about also trends that are out there. some of that qualitative data. What's going on in the market? What's going on in the world? What are you seeing? What are you just kind of observing in the world around you? Or maybe you're seeing some facts and figures coming from think tanks or government sources or education, research or whatever, showing here's some big trends that are happening in the world, some big mega trends that are happening in the world. So, for example, you have a lot of folks in the baby boomer generation, right? The older generation that are retiring now. So that's a growth area for people who might manage money for people who are retiring, and how to get more income and manage money for that might be a growing area. Or it might be a growth area for pharmaceuticals or medical technology firms. There's a trend is there's a lot of older folks, a lot of boomers out there, and they're living longer, which is another big mega trend, which is terrific for all of us, that we're all living longer. But it's terrific if you're making things to help ease that life or help maybe people to live longer. Those could be great growth stocks in the areas of like healthcare or biotechnology, whatever it might be. So those are some trends that we're seeing now. And as well as on the other spectrum, where there's a large amount of millennials out there now. There's, what does that mean for how do they act and how are they different than maybe the boomer generation? And you can go beyond just trends of people and demographics. Look at other trends, from technology to what might be happening in the world around trends, from eating trends to everything that's out there. Globalization certainly is a big trend that's going to be impacting us for many, many years to come. How can you play in a globalized market, for example? And how can a company be globalized or ramp up quickly too as well, as far as looking at these overall trends? Another is the thing about if that growth stock has a strong brand, which would be kind of a barrier to entry. If they're the first mover, let's say in the industry, or at least in a segment of the industry, and they've got it kind of nailed, they're doing great, and they're growing fast, that first mover advantage can be very, very strong. It's a barrier to entry for others to come in. And there will be competitors and others will come in, it's just they might be more reluctant to go take on somebody who's really dominating an area and really growing. I mean, think about how much energy does it take, how much resources does it take to compete against like Google in search, or Facebook with social media. I mean, these are big moving companies who are they're growth companies, and it's hard to compete against them. Doesn't mean you can't find your niche and maybe take little pieces away from them. Just saying if you're going to compete head to head, that would be a barrier to entry versus something that it's easy to maybe get involved with, maybe a local restaurant or something of that nature. Another thing for growth stocks, and that maybe have been growing for some time, is look at what the insiders are doing. What are the management team, the CEOs and the executive team, what are they buying? And we have a section on insider trading which talks about how to look at, and how to see where people are buying and selling at the top level. But you can go waste online, Yahoo Finance, or go onto the annual report, or go onto their site, and you'll see publications or things that shows whether they're buying or selling stock. So if they're buying lots of stock, that's another good trend for a growth stock. If they're all piling out and cashing in, but maybe they're piling out because things are going to maybe look bad in the next couple upcoming months, that's something just to be aware of. Doesn't mean if they're cashing in, maybe they're just trying to take that money out for themselves personally. But if everybody's piling out, that's a warning sign. So just be aware of what the insiders are doing. And then lastly, from just an overall fundamentals type thing, some guidelines. These are not hard or fast, but some guidelines when you're evaluating growth stocks that can maybe help you as far as evaluating them and evaluating them against their peers in the industry. One is we talked about sales increasing and earnings increasing. Well, they should be at least increasing by 10% or more per year is a good guideline to use. So if they're growing even faster than that, great. But if they're really only growing like 1%, 2%, 3%, heck, if they're growing like 1%, they're not even keeping up with inflation. Well, they're not really a growth stock and shouldn't be evaluated as such. Maybe they're a good income stock, but they're not a growth stock. So look for sales and earnings rising above 10%. And then look for debt that's decreasing debt, at least lower than the previous year. Look at like their debt ratio and look at the amount of debt that they're carrying. And if they're continuing to add debt on top of debt, well, they might be having a hard time paying their debt, but also financing their operations. So they're kind of like taking out extra debt to try to make it all work. And in the end, if you pile on too much debt, well, then it's like a house of cards that'll all fall down. So be aware of anybody who's increasing their debt year over year. If they're decreasing their debt and they've got sales and earnings that are rapidly growing, hey, that's a great sign as far as some things in growth stocks. And lastly, look at ROE, or return on equity, about 10% plus as well. It's another way to show how is your investment, your equity, what are you putting into the firm, the equity that's going in the firm, how is your return coming on that, and looking at that 10% or more when you look at the ROE figure. And we'll look at that in all the whole ratio section. But here's some good fundamental things to look at when you're looking at growth stocks. And and some growth stocks might, like I said, might not even have earnings yet, so they might not be making 10% or more a year. It doesn't mean their stock won't go up. Amazon, those kind of companies. It doesn't mean their stock doesn't go up. Just it's something to look at when you're looking at growth stocks, and some good rules of thumb and guidelines around ratios. So if we use some examples of growth stocks to wrap up this section, household names that you would know would be categorized in this, like Amazon and Facebook and Apple, of course, and Biogen and Uber, right? Uber is new and growing. It's a kind of this new thing. And Starbucks, of course, is continuing to grow and adding. At some point they'll grow so far they might become more of an income stock, or they might plateau. We'll see. But they're considered a growth stock. But Uber is a good example where it's a tech stock. Really, it's a tech stock that does ride services, cab services. Really, a new way to kind of look at that. It's it's new. It's in its infant stages still, and it's really kind of growing. And it's got a lot of markets it can still get into and grow. Doesn't mean it doesn't have issues like regulatory issues and all those things. And some countries adopt, some don't. Unions in some countries are opposing it for the taxi unions versus Uber and how Uber works. So those are things to take into consideration when you look at. But they would be like a growth stock like these other ones as well. So growth stocks, to wrap up, great for long-term investors. That's the idea. You want to get that capital appreciation, buy low and sell high, and maybe your next stock will be if somebody bought Apple at $5 and now look how big it is, with many stock splits along the way. So that's what you're hopefully going to be for you when you look at growth stocks. When we look at income stocks, they're also many times known as dividend stocks because they're paying a dividend. Income stocks, really the idea behind them is they're going to pay you money. They're going to pay you a dividend. They're going to pay you income. So if I own the stock, just by holding it, they're going to basically pay me, typically on a quarterly basis, a stream of income based on a dividend. And that's a great thing, right? I just buy the stock, I own it, and they give me money. What a wonderful world, right? And that's one reason that dividend stocks or income stocks are very, very popular. They won't grow as fast as far as their capital appreciation, your price, what you paid for it, and what you can potentially sell it for. It won't grow as fast as, let's say, a growth stock. That's the idea of growth stocks, is that capital appreciation. But growth stocks are not paying that dividend. They're using anything they could pay in a dividend to finance their operations and continue to invest in their company. Where an income stock might not grow as much as far as the capital, the price of the stock, but it's going to grow by giving you dividends and then growing those dividends and consistently paying those dividends. So they're a great way to get current income in there from income and dividend producing stocks. They're great for retirees. Is a very common way. It was always the traditional way that retirees would have a basket of bonds and cash and then maybe some dividend stocks. Now that people are living longer, you're actually seeing retirees with more growth stocks in addition to income stocks in their portfolios because they're living a longer period of time, which is terrific for all of us, hopefully. So retirees are depending on that income. So they own these growth stocks. They get a little price appreciation, but then they're getting that quarterly check that they use then to, finance their life. Go on vacation, buy things, groceries, whatever it might be, or continue to invest. So they're great for retirees. They're also great in a low interest environment. And why is that? We've been in a period of very low, record low interest rates for a long period of time. When you have low interest rates, when people buy things or invest in things like treasury bonds or cash or other types of bonds, government bonds, corporate bonds, the interest rates are low, right? That's the low interest rate environment. So people are not getting the return they're looking from those low interest rates on things like bonds and cash. So they're looking for alternative ways to get income coming in, maybe at a better rate with maybe some capital appreciation. And that's where dividend stocks come in. It's like if I'm going to get only 2% or 1% of my cash, why not take that cash and invest in a dividend stock that might be paying me 2 or 3% in dividends or dividend in yield. So I'm going to get 2 or 3%, and then I might have the stock go up over time. That seems almost like a no-brainer in a lot of ways. Now, the stock could go down. They could cut the dividend. There's more risk. We get that. But that's one reason people like dividend stocks in a low interest rate environment. By the same token, it can be risky, or it's less popular in a very high interest rate environment because you can get your return or that income from other sources than stocks or dividend paying stocks. So be wary if we're in a low interest environment and it rises quickly, that might impact or hurt dividend paying stocks. But low interest rate environment, they're great. Also, they're great for more risk adverse investors. People who don't like that volatility, the stock continually going up and down. Now, dividend stocks can go up and down. Sometimes they can go up and down in big swings, but the idea is they don't. They're more those large, long-term companies, steady eddies who always pay a dividend. That's kind of what you're looking for. And they're just steady, good companies versus maybe a growth stock that might be a great payoff in the future, but might be real volatile in the near term, and maybe it never takes off and it just becomes a dog and hurts you overall, and you got to sell it at a loss. So if you're looking for something that's less risky than a growth stock, then look at these income or dividend stocks. They're typically large cap stocks because these are big companies that are then paying a dividend, and so you'll find them typically in large cap. You can find some small, mid cap, but rare. It's mostly all the large cap brand names, like Coke and Exxon and all that. You're looking for consistent dividend payouts too as well. Sometimes companies get in trouble or they struggle to make their dividend payouts and they might cut their dividend or eliminate their dividend. When that happens, you get less income coming in, which hurts you, but also by them doing that, their actual stock price goes plummeting because people are investing in those companies because they want the dividends. So dividend paying stocks try not to ever cut their dividend if they don't have to. It happened, especially in like 2008, 2009 during the Great Recession, that many really good companies cut their dividend. It really impacted them overall. So be aware of that and look for those companies that pay these consistent dividends out over many years, 5, 10, well, more than 5 or 10, think 10 or more years, 20 years. There are some that pay even much longer than that, and those are great consistent dividend paying stocks. Okay, so let's look at some tips around income paying or dividend stocks. One is look for companies that are very stable. Not only are they stable as a company, but their industry is stable as well. I mean, you could be a stable company, but in a real screwed up or volatile industry, that's going to affect them negatively. So look for good, solid, stable companies that have been growing and doing great for a long time and paying those dividends for a long time, and maybe in a real stable, normal type of industry versus something, crazy or wacky that's more of a growth industry. So stable companies, stable industry that can pay those consistent dividends. Use the same fundamental analysis and ratios and things to evaluate dividend paying stocks like you would any stock, but there's a couple of them you want to key in on for income and dividend paying stocks in particular and really look closely at. One is the dividend yield. You might see it when you look at quotes and things, you'll see dividend yield, and we talk about this later in the ratio section, but dividend yield, which is basically looking at if I buy that stock and it's going to pay me a dividend, it's going to pay me income, what is the percentage on that? What in effect interest rate might be a way to look at, is it equivalent to? So if I've got cash paying me 1% and the dividend yield on a company is 2%, well, I'm making more money just on the yield, or I'm making more money just on the payments they're sending me, just like interest on a cash account, or savings account, they're paying me cash directly in the form of dividends and at a rate of 2%. So I can then compare them. Now remember, they can raise or lower dividends at any time, so it's more risky than something you might lock into like a CD or a treasury note or something like that in terms of cash. So they're going to pay that income, then you can look at the yield. You also want to look at the dividend growth rate, which means not that the stock is growing, hopefully it does that, the stock price appreciates or capital appreciation, but you want the dividend to grow as well, what they're actually paying you, and they do over time, some more than others. So it's not a consistent flat rate that you own forever. The dividends will grow each year as well, some faster than others. So a good growth rate will not only, it'll kind of give you that great double whammy, you get that consistent income each quarter, but then every year it goes up a little bit more, so then that following year you get a little bit more. And the year after that you get a little bit more, and then a little bit more. So after 10, 15 years maybe of holding a dividend stock, what you paid, you're getting a lot more income than you did originally. And isn't that a good thing? It's appreciating. You're looking for those consistent dividends, of course, so look at their dividend payout history. You see if they've, a lot of companies will tout that we've paid a dividend for 20 straight years or 30 straight years or whatever. So look for those types of things, maybe an annual report or looking at, history of dividend payouts, so you can search for that and see that they're consistently paying that dividend. And then the last thing that's a little bit of sneaky number, but real important, that gets missed a lot, is the dividend payout ratio. And compare it with its peers in the industry, overall market too, but really look at the peers in the industry. And what that ratio means is it's looking at the earnings or the cash that is coming in a period, and how much of that is getting paid out in dividends, right? They could take all those earnings once all their assets, all their expenses are done, their revenue, their sales, they have their expenses, whatever's left over is their income. How much of that is getting paid out in the form of dividends? And then how much is going used to invest in other things in the company or finance other operations? The reason the payout ratio is important is if companies are struggling and they're either losing money in a period or a period of time, or they're struggling to make ends meet, well, one thing that they could cut is dividends. Remember, that's free money that's basically coming out to you. If they cut or eliminate their dividend, that's money they're now keeping in the company, and then they can then use it to right the ship or invest in themselves. Now, companies that pay dividends hate to do that, because if they reduce or cut the dividend, everybody who bought into that company looking for dividends immediately runs out the door and their stock price just goes plummeting. So they really don't like to cut dividends, which is good for you and me. So the payout ratio is showing that percentage of their income they're paying out in dividends, and you want that number to be as low as possible. So if it's, like, say, anywhere from 0%, of course, would be, well, not 0%, but let's say 50 to 70% of their income, if they're paying out in dividends as a dividend-paying stock, that's pretty good. More towards the 50, 60 range is good. Sure, they're paying out half or a little more in dividends. That's okay. That's what they're there for. They're a dividend-paying company. They're focused on that. A lot of utilities will pay much more than that. For example, like, oil or gas or electric companies will pay more than that. And that's okay. Just look at how their industry peers are doing. If you start getting about 70% in payout, that's a lot going out. That's a little more concerning, especially if you start getting the 80% plus of income coming in is going right out in the form of dividends. Well, that makes it real hard to withstand a shock to the system or a bump in the road or a decrease in sales or something that happens. They're really living on the edge then. So if you're investing in companies, watch out for any that are paying 80% or more in particular in the payout ratio. And really, if you're in a volatile industry, or looking at different stocks in a volatile industry, those ones that have a lower payout ratio can be better. Even if they're paying out less in yield, it might be a better investment because it's going to be more consistent and more safe. So that's something to consider as well. So there's lots of companies that pay out dividends. Let's take a look at some examples here. And there are really a lot of them are household names, right? They're the products you might use every day, are these big, long-term, Fortune 500 large international companies that pay out these dividends. And some may pay out for a long period of time. I've got an example here. A long-time paying dividend stock is Johnson & Johnson. They make Band-Aids, and they do medical equipment. They do things related in the health industry. Things that you might even be buying yourself in the grocery store every day, or in the market related to health type things. Johnson & Johnson is really involved with that. So with Johnson & Johnson, they've been around, 50, 60, 70, 80 years, a long time, and they've been paying out dividends consistently for the last 53 years, and have been growing those dividends every year for 53 years. I mean, think about how consistent that is, that they've been growing dividends for 53 years. And they were founded in 1886, and they've been paying out dividends for 100 years. So in 100 years and more now, they have been paying out a dividend. In the last 53 years, every year in the last 53, they've grew their dividends, so they pay a little bit more each year on that dividend. What a great, consistent company. And their payout ratio tends to typically be around 50%. So it's a very popular stock as far as people want that consistent dividends. Now, there's no guarantees, and Johnson & Johnson gets sued all the time, by the way, because they're involved in medical devices, pharmaceuticals, a lot of things that can lead to problems or issues if something goes wrong. So be aware of that. Their stock price could drop anytime, their income could drop anytime. But if you're looking for somebody who's been, at least has a proven track record, well, there's a good example of one, and there's others out there that have these long time growing dividends. And if you're looking for the safety, that's maybe a great place to look, is for those type of companies that have been paying out dividends for 20, 30 years or more. So are examples of companies that have been doing dividends for a long time. Procter & Gamble, it makes like toothpaste and all that stuff. A lot of stuff you buy at the store. They own Gillette, which makes razors and things. They bought the Gillette company, so they own do razors and stuff like that for men's razors and women's razors. So they do a lot of products. You go to procterandgamble.com and just look at their product offerings. You'd be amazed at all the stuff they offer. So Procter & Gamble have been paying out dividends a long time. General Mills, which makes cereal and other products like Cheerios, Lucky Charms, they're making cereals. Wells Fargo, a big bank here in the United States, makes is a bank. It's, they have hundreds and hundreds and hundreds of retail locations, plus they do mortgages and other things. So paying out dividends a long time. Company you might not be familiar with is there's a lot of utility companies out there, and that's where a lot of people go for dividends, because utility companies by law at least in some countries, have to pay out a certain amount in dividends out and have to pay that, or they look to do that. They don't have to, I guess, but that's their main focus is paying that out and are known for that. So like Xcel Energy does, does coal, but does energy. They sell energy to households and businesses through the North and Midwest of some of the western states in the United States. So they're very good there, and they are involved now in alternative energy too, like wind farms and things. Have been heavily investing in that, some nuclear energy, but a lot of it is electricity. So as a utility company, they have paid out a dividend for a long time, but during the 2008-2009, they cut their dividend, and that really impacted their stock in a negative way. And now they're back to paying dividends and been paying them pretty well. So Xcel Energy would be an example of a utility company, and then others are out there like ExxonMobil, big oil and gas company, energy companies. A lot of those will pay out pretty good dividends too as a yield or a percentage. Once again, the stock price could go up or down at any time. How much they pay in dividends could go up and down at any time. They could stop paying a dividend at any time. So be aware, there is risk there, more risk than something like a bond or cash. They are still a stock, but they're a less risky stock than maybe like a growth stock or an undervalued stock. So if you're looking for income and maybe some growth, dividends might be, and dividend paying or income stocks might be the way to go for you. Let's talk about value investing as compared to like growth stocks, where you want that price and the sales and earnings of the company to grow rapidly over a period of time. You're looking for that long-term, that big growth number, or income stocks that are paying dividends and regularly paying dividends. Value stocks are something that's a little bit different, more of a contrarian approach. Now, sometimes when you look at, let's say, especially mutual funds, they might, in their style box talk about growth stocks that might be in a stock mutual fund and value stocks, but it's really more about value in their case, talking about a value stock. They're considering one that's paying a dividend and more dividend payers. So value and dividends can kind of work the same way, or income. So just be aware whether they're compared the same way. It might not necessarily be an undervalued company. It might actually be a very strong company that's been paying out a dividend a long time. So you got growth, you get income. Sometimes the mutual funds, they'll associate value with income. But what we want to talk about, how we associate value investing, and you might see other courses and things around value investing, is that's what you're looking for is undervalued organizations or companies. You evaluate companies, you put a value on them, and some might be undervalued, or they're hidden gems, right? That's what you're looking for, is this. Something has happened, and some reason they're undervalued, their stock price is lower than it should be, and it's a great opportunity to kind of buy low. And the market has undervalued them for some reason. Maybe there was some recent bad news, right? Maybe things have been going good, but they announced some bad news and had to close some locations, or their new product is not doing as well as they thought, or whatever. There's some recent bad news that drives the stock price down. And maybe their long-term fundamentals is good, but that recent bad news has really devalued their stock price, so it might be a hidden gem and it's on sale, so to speak, so you can go in and buy this undervalued company on sale. So I think value investing, you're really looking for undervalued stocks that you think will really grow in the market, and you're kind of getting that built-in cushion of a return because they're lower than what they should be, is the idea. So to find some undervalued stocks, some key ratios just to start with as far as what to compare to the average within their industry and to their peers is what you want to look at. And these are some ratios. We'll talk more about ratios in great detail, but just to give you an idea of a starting point, you're looking for value stocks that might have a lower price to book ratio than their peers in the industry. Price to book is really talking about, if you were to take their assets and take out their liabilities and say, well, the company is really worth this. This is their book price. If they were to sell the company to another company or liquidate the company, just liquidate it all and sell it all off and sell all the assets like a big garage sale or yard sale, you're just selling everything off, that would be the price in comparison to that book value. What is it book value worth? So that would be, if it's a lower price to book, well, that means that it's undervalued in comparison to really what its underlying assets are. I mean, I've seen retailers have gone way down. It's like, gosh, if you just sold all the inventory, you would make up, what their price should be in terms of a stock thing. They have such a low price to book value. So sometimes that can be an opportunity. So look for a low price to book value. You're looking for a low PE ratio or low price to earnings. So, high price to earning stocks will tend to be those growth stocks. People are paying a higher price in comparison to the earnings that company is actually driving because they're expecting that future growth. Well, an underperformer or an undervalued, I should say, maybe it's a good performer still, but it's undervalued in terms of price or in stock price, will have a low price to earnings. Maybe they got great earnings, but their stock price has been driven down for some reason recently. Maybe it's that bad news or something. If the company happens to pay a dividend, it will have a high dividend yield. Where yield, we're looking at the percentage of of dividend paid out compared to its price, so it'd have a high dividend yield because the price has come down, but the dividend is the same, so you're actually getting more for your money. The percentage you're going to get out is going to be better because the price has come down on that side of the equation. Companies that have rapidly rising prices as far as their stock price have lower dividend yields. So compare it within the industry once again. And look at things like the future. What's the future look like? What's the growth look like? What's their cash flow looking right? Is their cash flow good? Are they able to pay their bills? They have low debt. Things like that might be also be good signs around a value investing strategy. And the whole idea of value investing is it's a real contrarian strategy. You might even hear called contrarian strategy, contrarian being opposite, right? If the market says this stock's no good, it's a dog, let's drive the price down, people are selling like crazy. Well, and you're the one saying, no, the market's making a mistake here. I'm going to buy into this because it's just getting driven down way too low. I think there's a good upside in this stock for a variety of reasons. And we'll look at an example here in a moment, one from my own life that I can share with you. But that's the idea that you're kind of doing the opposite of what the market is saying. So it can be very subjective if you think about it. Sure, we can look at ratios. Sure, we can do a lot of detailed analysis. But in the end, you think it's undervalued. Others think it's overvalued and they're trying to get out of it. I mean, you think about just that its nature of stock trade. It's somebody who's selling a stock for whatever reason. They don't think it's any good anymore. They're going to do some other things. And there's somebody buying. It's a trade. There's always a buyer and seller. So if you think it's undervalued and you want to buy, that means there's somebody else on the other end who thinks, no, it's not so good. I want to sell it. And they're looking to get rid of it. So they think it's going to go down further, and you think, well, hopefully it's going to go up. And it's also like one thing with value stocks or contrarian investing, it's hard to time the market. It's very impossible to time the market and to buy at the absolute rock bottom, right? So it's hard to do that, real hard to do that. Experts can't do that. I mean, people do this for a living. Professional people sit in the Wall Street office all day long trying to do that, not successful with it. But you try to buy maybe near the bottom is great with a contrarian or a value investing strategy. So don't be surprised if you're taking a bet on a company, on a contrarian or underperforming company, that it goes down for a period of time right after that. That's natural. That's normal. It might go down as it reaches its bottom for a few months, maybe a few years, for all you know. But if it's a long-term thing, it might be so high in the long term, especially if you're looking at holding something like a buy and hold investor and you want to hold it for 10 years, well, you got a lot of time for that to make it up. If you really think it's a great stock that's just been, in the shorter term, whatever the shorter term is, been undervalued. So value investing is great if you like to buy low and sell high. Well, I guess who doesn't, right? If you like risk, because they can be risky, because they could be on that elevator down or that lift going down, and they just continue to go down. They never come back, and you got to get out and capture what you can because maybe they were a dog, and sometimes that happens. And you want to let time work for you. If it really does go down a bit and then turns around and you're now coming up, you want to let that time, reap the reward of that time, and then you sell it later when it's reached more of a peak or start on that upper end. Once again, you can't really predict the very top or the very bottom, but you're in that range and you're trying to buy it at the low end of the range. So value investing, these are underperforming companies in the market saying that. They could be growth companies that were growing and now they're a fallen star. They're not growing as fast anymore and people are getting out, so they're getting out of a growth company. They could be a large income or dividend company that has struggled, or maybe they're struggling making their dividend or whatever, and now they've gone down in value and people are saying, oh heck, maybe they'll come back, and they're investing in them. A lot of times you might see that also after with a large dividend or income company where they're paying out a dividend. If they've had bad times and they cut their dividend, especially in that Great Recession, 2008, 2009, we saw lots of companies cutting their dividend who were good companies. They were just trying to do things to kind of stay afloat a little bit and make the cash flow a little bit better. And if you bought into some of those during that period, their price might have gone way down because they cut their dividend, immediately the stock drops. Well, maybe you get in, and if you're patient, it might come back and they might start raising their dividends again. And then you're now bought low and could sell high or reap the benefits of this dividend by buying it at basically a lower yield or lower dividend yield or at a lower rate because the stock price dropped. So value investing, I do a lot. It's great, and but it's not for the faint of heart because it could continue to go down. So look at some of these ratios, look at some of these things, and in the end, you got to say to yourself, I just think this company is going to do better. I've done some due diligence. I've done this research. I think there's people making a mistake. I'm going to take a risk on it, and I want to buy this company that's on sale. Okay, so let's look at a value investing or contrarian investing case study or example. And this is a real life example from my own life. I actually bought this stock, and we're going to go in good detail on what my thought process was and what I bought it at and what's that now and all that. So you can kind of see the process behind buying this this contrarian or value stock. And you can see how it gets to be really subjective in a lot of ways as well. I still own the stock and it's done well for me, but I could sell it any time, so like any stock. So I'm not making any stock recommendations, by the way. I'm just want to use this as an example of a process. This might not be the right stock for you or anything. Heck, like I said, I could sell it at any moment. So it's not a stock recommendation. It's really a tool to use to understand value investing a little bit more. Just a quick example. Okay, so let's take a look at the example. This is with Wells Fargo. The ticker is WFC. If you go into quote and put in WFC like in a Yahoo Finance or whatever, it'll be Wells Fargo. And Wells Fargo, if you're not familiar with them, is a large banking institution in the United States. Right? So they're headquartered out of San Francisco, I believe. They used to have a big company called Norwest that was in Minneapolis, and they bought them, and they bought other people all around the way. So they're a big bank company. And I bought them in 2009. So I made an investment in Wells Fargo, individual stock, bought some in 2009, early 2009. So what's going on in 2009? Do we remember what was happening in early 2009? Well, it was the start and really some peak times and bad times of the Great Recession. Globally, it was a Great Recession, and particularly with the United States and particularly with banks, because they're a big part of it, and banking stocks were way down. So, but before that even happened, Wells Fargo was always on my radar as far as a stock that I was interested in. I happened to be a customer of Wells Fargo. I've done a lot of research on them. I know what they do well. I know what their strategy is. So from that whole qualitative just standpoint, understanding the company and understanding the industry a little bit, I was like, yeah, Wells Fargo, I'd like to buy them someday. They're a great stock. And I've had stocks like that have been on my radar that I've never bought because they've never really got to the price range that I've been interested in. But Wells Fargo was one that was always high, but it was always in my range. If it ever went down, maybe I'd buy them. Well, what happened was in 2009, the banking stock sector, the entire industry and sector got crushed, just devastated. And because a big cause of that 2009 period was around the banking sector, right? Remember hearing things about really weird derivative investments that banks were making that they didn't even understand themselves, let alone their customers, that were really strange and actually, caused a lot of problems and caused entire companies to fail. So you have these derivative things, and also you had the subprime home mortgage crisis here, particularly in the United States, where people are giving out mortgages or home loans, and Wells Fargo was a big home loan vendor or bank that does lots of home loans that were to really risky people, right? And they weren't doing their due diligence, and people were defaulting and foreclosing, and there was foreclosures in homes. They couldn't pay the homes, and then the whole economy went down, so people were losing their jobs, so they couldn't pay on their home, which means the banks weren't getting paid. And you had the derivative thing, and people hated the banks, and so bank stocks went way, way down. And so I'm like, oh, well, I've had Wells Fargo on the radar. The banks are getting crushed. Everybody's thinking, got to get out of banking stock. So as a value investor or using this strategy, contrarian, I'm thinking, maybe Wells Fargo is being unusually punished versus maybe some other banks who really deserved to go down, and many went bankrupt, actually. But Wells Fargo, a long time, 80, 100-year-old company, strong company. So when I looked at it, I knew Wells Fargo and did more additional research. Wells Fargo was a high-quality bank that did a lot of home loans, but the home loans they did were considered high-quality home loans, not subprime. They did some because, they did a little because everybody was making a bunch of money before the bottom or the bubble fell, but they were doing high-quality loans to high-quality prospects, and thus they didn't get caught in that big downdraft of subprime mortgages, poor, results on the mortgages versus others. They had good high-quality mortgages, so they were a lot more solvent than a lot of other banks and doing better. Also, they were a big banking retail banker where they have thousands and thousands of locations across the United States. And so they do business with people who come in and do banking, right? They deposit money, they take money out, they do loans, they do all kind of that retail bank. You go to the bank and you do business. That was what Wells Fargo was known for. And from a strategy standpoint that I understood as a customer and doing more research, and having worked in the retail industry for a while too, understanding the concept of upselling, Wells Fargo was tremendous and great and many accolades around upselling. You go into there to the bank and you make a deposit, well, they would make a suggestion like, oh, I see you don't have our credit card. Would you like a Wells Fargo Visa card? Or, oh, I see we have this special on this, home mortgage rate. Would you be interested in that? So they would be making suggestions and selling things inside the bank. And they had really good people who took care of customers and sold stuff. At least my opinion. I've been a long-time customer. Your results with any bank may be different. But that was my experience and what I've been seeing their price appreciate for many years before 2009. Then what also happened right at this time is they bought Wachovia Bank, which had 3,000 locations, a big bank that was frankly poorly run on its retail locations. They were making a ton of money on these subprime mortgages. So when that bottom fell out, they were about to go out of business. Wells Fargo bought them cheap. They got some government assistance even from that, or some special tax breaks that were kind of hidden in there that I found out about and thought, oh, this is pretty good for them. Maybe not great for anybody else, but they bought from some special things because the whole industry was struggling and the U.S. government was trying to prop up the industry. So they got these 3,000 locations on the cheap, and then they could use their expertise to turn them into high-quality Wells Fargo locations. And yeah, whenever there's a merger like that, you close some of the underperforming locations, which is tough for the people in those locations, of course, but it's more profitable for the bank. So I saw all these things and said, yeah, banks are getting struggling. I'm looking at their fundamentals. The rest of their numbers are good. They're not cutting, their dividend seems okay and all this stuff. I'm going to buy Wells Fargo Bank. And I did. So I bought them for, at the time, $32.50. So what happened? They immediately went down further. They were in this big downdraft. And they went down to $27.50, right? And I'm thinking US dollars. And I'm thinking, gosh, I just lost $5 per share, and depending on how many shares you buy, that's could be quite a bit of money. And like, gosh, I'm buying it, with the idea that they're going to come back, they're a solid bank and a long-term strong performer. Well, currently they're at $46, $50. They kind of trade within that range, and they're still paying their dividend. They're paying, the current dividend yield is at 3.2%, much better than you could get with cash or other, safe investments. I bought it since cheaper. I got a better yield actually because I bought it on the cheap. But right now, I've made some capital appreciation. I'm getting a dividend. It's a stock I've wanted to own, and it's been a long-term good player for me, and it's something I'll buy and hold, hopefully for a very, very long time. But if things change, I could sell it at any time. So the whole point of this story or case study, and because sometimes it doesn't always work out, but here's an example of a case study where, yeah, I looked at the fundamentals, but I also did some, financial stuff. But I also used kind of my noggin a little bit to think through things. Do I know this industry? Yeah. Do I know this particular bank? Yeah, I've been a customer for a long time, and I've done additional research too about their strategies and their business practices. I saw where their strengths were not necessarily matching up with what was the problem in other banks. I saw them buy Wachovia really on the cheap. That could be a big boost for them once things turned around, and it did. And they did a great job with it. So I saw these things coming together, and that's where subjectively I could say with my research and everything saying, yeah, I could buy a bank stock, but this one for me is the best one for me. Now, it doesn't mean there weren't other banks that you could have bought at a better price. Maybe they've outperformed Wells Fargo since then. There's some that have gone even worse or gone out of business. I knew this company, and thus I invested in them, and it's turned out well for me. It doesn't always turn out well, and if it didn't, I would sell it, and maybe sell it at a loss. But I want you to take home with this part is just understand that if you want to be a value investor and kind of buy low and maybe someday sell high, that you can see some of the thought process going through here, and you want to have similar thought processes. I mean, if you're looking at an undervalued stock and you say, oh, I looked at the price of the book is low and I see this, that looks good, and that's all you got, I would advise you to know more about the company, know more about their strategy, and really articulate to others or to yourself, but even to others, like, here's why I'm doing this. And so when it went down to $27.50, I was articulating that to my wife. She said, boy, that was a bad bet on Wells Fargo. I would say, no, here's the plan. And it turned around within the year, actually, a few months, actually, and was starting to make money right away. So that's what you want to do as well. So no specific recommendation, but here's the thought process behind it. Okay, so we looked at this case study. Let's go ahead and move on to the next lesson. An interesting strategy that's in between growth and value investing is GARP. And it's interesting because it's a kind of cool kind of name, right? GARP. I'm a GARP investor. So it's kind of strange, I guess. But GARP actually stands for something. It stands for growth at a reasonable price. Right? So think about that. You want growth, but you want it at a reasonable price. You don't want to pay those high price to earnings, high PE ratios. You want something a little bit more reasonable, something a little bit more safe maybe. And that's the idea of GARP, or growth at a reasonable price, is you're looking for growth opportunities, these high flyers, but something a little bit more reasonable, where you're looking maybe for something that's undervalued and for some reason it's recently being punished that should be, turn around quickly and become a high flyer. So GARP, or growth at a reasonable price, is a combination of growth and value investing. You don't have to be on one extreme or the other. With GARP, it says, well, you could be kind of in between. and you're looking for somewhat undervalued stocks, so you're not looking for the bottom of the barrel biggest sale stocks that are on the big sale. Maybe you're looking at a little bit better stocks that are undervalued, just not the bottom of the bucket ones, because sometimes those bottom of the bucket really terrible stocks never do turn around. They just keep going down and go away, maybe even go bankrupt, where you're looking for something that's undervalued, but it's not all the way to the bottom. But you want to have, not only is it undervalued, you want it to have a really substantial and sustainable growth potential, right? Some reason it's undervalued, but you want it to grow. It's not necessarily an income stock or anything. You're looking for something that's going to grow, but for some reason it's taken a dip. Something has happened in the news, something has happened in an earnings report, something has happened from a company announcement, something has caused that stock price to dip, and you think, boy, it's undervalued, maybe not terribly, but it's undervalued, but the growth potential is great, so I'm going to apply some GARP principles on there. And we're going to look at some of the ratios and things that are associated with GARP here in just a second. One criticism of GARP, by the way, is you're kind of in between, or it's kind of wishy-washy, right? It's like, if you're going to invest in growth stocks, then just do it. Invest in these great, high-flying, high trajectory growth stocks and just go with those. But if you like undervalued stocks, then go with those and go with the really undervalued stocks, the ones that give you the biggest cushion for it to go up and things that might have this big turnaround and give you some great price appreciation, maybe even some dividends along the way. Go with the extremes to get the best return. GARP is too much in the middle, and you don't necessarily maximize the return either way with a good growth stock or a good value stock. And that's true. It just doesn't consider the element of risk. Yeah, if I take either end, potential is great at the extremes, but in the middle, I might mitigate my risk by looking at things that are just a little undervalued and maybe have some growth or some good growth, but just not a high flyer or a big underperformer. So how do we evaluate these stocks? Well, like any stock, you look at qualitative and quantitative information. In GARP stocks, that qualitative information is very important. Qualitative being, not quantitative. Quantitative being the numbers, hard, cold numbers, ratios, those types of things. Qualitative is more about, what is the business strategy? What is the executive team saying? What is the CEO saying? Do they have a new CEO? Did the CEO just left? What's going on with the company? What's going on with the industry? What are the trends in the industry? What are the overall demographics and things that might be happening in the global marketplace that might be affecting this organization? What is happening from a qualitative standpoint? And something probably has happened to drive the stock price down. That's why it's in that somewhat undervalued category. If it was way high priced, then it wouldn't be there. It'd be something has happened to maybe cause it to go down to get on your radar as maybe a valued stock. So that's the first thing. Something has happened to cause it maybe to be more of a value stock. At least somewhat a value stock. And then you want to look at the quantitative aspect of it, the financial or the fundamentals around it, to start evaluating that to see is it just slightly undervalued with some great growth prospects, or is it really just not a good stock? So quantitatively, just some guidelines and things to use. It can vary by industry, but and compare with industry, of course. But one thing to look at is look at its recent, past, and its future growth potentials. That's really what you're looking at, is what's happened recently that's maybe been not so good, negative, but what does the future look like? Does the future look great? Is it like maybe a pharmaceutical or drug company that just had a bad announcement because of a clinical trial, but they're very confident it's going to turn around and they'll have this great wonder drug. But right now the stock price is getting punished because they announced poor results from a clinical trial, or it's a technology firm that had a setback or something like that. But it'll be great in the end. Those are the kind of recent past and future growth you're looking for. The earnings per share will be more subdued. You're looking like a 15-20% range as far as earnings per share versus something like in a growth or in a value stock. So earnings per share is more subdued. And price to earnings is higher than a value stock, but lower than a true growth stock. Once again, maybe in that 15 to 25% range with currently with because we're in a high PE ratio period. Comparing to other industries or other companies within the industry, but look how it compares to its peers. That's maybe slightly higher, a little bit higher from a price to earnings aspect, but it's not way at the top like you might see some of those big growth companies. Another favorite ratio that's used with GARP are growth companies at a reasonable price. And one thing that really a lot of folks who like this strategy really hang their hat on is the PEG value or PEG ratio. And a PEG of less than 1 is something is something they're looking for. It might be something that's nearer to 0.5. And PEG is a favorite measure for GARP is looking at price and earnings in comparison to growth. We'll look at that in the ratio section, but just think right now, PEG of less than 1, something near to 0.5 would be would be great. And so the whole idea is you're looking for growth, but you're looking for the price to be reasonable, price being the stock price you pay. So, but understand it's kind of wishy-washy. It's kind of in the between. So if you're not sure you want to take on the big risk of growth stocks or take on the big risk of a really super undervalued value stock that might not ever recover, maybe using some of these principles and understanding that you're looking for growth and value together under GARP might be the way to go. Let's spend a moment and talk about technical analysis as a tool or a strategy to evaluate stocks. You might have also heard this known as charting or maybe momentum investing, all very similar. But really what technical analysis is, or really what it isn't, is it's not looking at fundamentals. Fundamentals investing would look at things like the ratios, for example, price to earnings ratio or PEG ratios or all sorts of different ratios that you can look at, return on equity to return on assets. You name it, there's lots of ratios out there, from debt ratios like debt equity to liquidity like current ratios and those types of things as well. So technical analysis looks at none of those ratios and doesn't care about ratios or doesn't care about how our sales or doesn't care how profits are. It doesn't care about how the company's maybe looking from a qualitative standpoint. It throws all that out the window and is really looking at it from a charting or prediction type thing where they're looking at past movements of the stock price and price and or volume of the stock, volume being how often it's being traded or how many shares are being traded on a daily basis, and looking at price, how's the stock price moving up and down to predict the future. So it's all about, if we can look at a chart and look at patterns, then we can maybe predict future results based on these past patterns. So it's all about looking at patterns, looking at scenarios, situations, and very much looking to predict the future, not based on analysis per se, but more so on analyzing charts or patterns. So it's very much a trading tool. It's supposed to, let's say, long-term investing, or you're buying this company, you're investing in this company, you are an owner of the company, is very much looking at the charts. And when the chart says buy, you buy, and when the chart says sell, you sell. So the assumptions around this, around charting and things, and we'll look at an example of one of these types of assumptions or ways that you can trade, is that the market price is the actual price as far as that all information is known. So it's thinking of it as, yes, what the stock price is selling for, all information is known, that it's a very fair price, and thus there's no value component to it as far as something being undervalued. Is looking at that, yes, that stock price indicates that it's a fully valued stock, and that all stocks are fully valued. So if you're a value investor or a contrarian investor looking for those stocks that are on sale or maybe underappreciated or undervalued, technical analysis or charting would say, forget all that. That doesn't mean anything. It's not even true that we're looking at these stocks that they're fully valued, because you have to have them be fully valued in order to have predictable stocks. If they're undervalued, well, then they can't be predictable from a charting aspect. And it's all about price movements, and the belief is that price movements in stocks are not random events. If you're a chartist or looking at charts, you're thinking movements of prices of stock and the volume of the trading of stock are predictable things that can be looked at in the past and predict in the future. So very much a trading type of tool, and very much all about looking at these charts. So you analyze charts over these various time frames, and you're looking for patterns. You're looking for trends. How strong a trend is. Maybe it's a trend going one direction that might say sell, or let's say buy, and the trend looks good, but maybe it's not strong enough to actually make a purchase. Or it might be going down the same thing, whether to sell or whatever. And the whole thing is, how likely is that trend to continue, and will it change or move in the opposite direction? And you have things that are called support and resistance areas, where it's supported at the bottom and maybe resists at the top. So you have this band of stock prices as they go, and they might get to the top and have resistance, or the bottom, and they'll come bouncing back up off the bottom. And you're using the chart to kind of predict all this. So if you're interested in things like charting and that kind of stuff, learn more about it. I mean, we're touching the real basics on, give you an introduction to it, but it takes a lot of information, a lot more training behind it than you'd have in a course. In this course, you'd want to have a specific course around technical analysis, charting, and read up on it, and really get comfortable with that and understand. I would say that's more trading versus, let's say, investing, but it's a tool that people use. So let's take a look at one of the example charts so you get a feel for what this kind of looks like. So when somebody does a technical analysis, they'll look at the stock chart, look at a kind of graphically how it looks. And at the top, you can kind of see the price movements, it's for low prices and then moving up to high prices. And this particular example, you can see they're kind of bouncing up and down as far as the stock price. And at the bottom is the volume, how much is being traded, and all that through this same period of time. So you look at a period of time, comparing stock price and volume, and you're looking for patterns to make decisions whether to buy or sell. This happens to be called an ascending triangle or a continuation triangle. A chartist would call it that. And you can see how it's kind of got this triangle, in this ascending type phase looking at the stock price. You see how it's reaching bottoms and then ascending up. So from that, you can predict, when am I going to be ascending up again, and when will I have this base of support along this bottom of this triangle? And when I get to the bottom of the triangle, maybe that's when I'm buying, because I'm going to go back up and then keep selling and trading all throughout within that triangle. So you can see where it's ascending. Obviously, there'd be one that would be called a descending triangle, where it'd be something that's going down and maybe you don't want to buy or you want to sell. So from a chart aspect, that's all you're looking at. You're not looking at price to earnings ratios. You're not looking at dividends. You're not looking at undervalued stocks. You're not looking at growth at a reasonable price. You're not looking at the industry or the sector or the business. You're not looking at large cap or small cap per se. You're looking at charts, and you're becoming an expert at looking at graphs and charts. Hey, it's great. A lot of people do it. If you want to do it, find out more. That would be my only advice to you. I'm not a big chartist. I will look at charts and things to help support some of the things that I do in a very basic kind of way, and look at how the prices are, especially if they're nearing like 52-week lows as far as prices, looking for undervalued stocks or comparing to the industry. But I'm not a strict chartist who would say, forget all that, just look at the chart. So if it's interesting to you, find out more. That would be my big advice for you on charting and technical analysis. Understand what it is and what it isn't, and find out more. And think about more of it as a trading tool and something that's going to be, going to take a lot more investment of your time and energy and expertise and really develop that. And maybe it's for you, maybe it isn't. It hasn't really been for me, and I've been successful well without it. But for others, they might love charting. So if you're interested, find out more. But that's charting and technical analysis. Okay, I'm going to share a strategy here with you now on the DART strategy that I do not endorse. I do not endorse this at all. In fact, I'm always skeptical of any type of foolproof strategy like Dogs of the Dow or Dividend Aristocrats or other things that might be out there, at least over long periods of time. Though some of their ideas are maybe good, like Dividend Aristocrats looking at good paying dividend stocks, have been paying and raising their dividends for a long time, and Dividend Aristocrats, 25 years. That's good. That's okay. I understand that. But to just say buy this portfolio of stocks based on one criteria or limited criteria, I can be a little more skeptical of it. And one reason I can be of this with a little skeptical is the whole darts theory. And it really is a theory out there. It's a darts theory where you have a dartboard and you put up like a listing of all the stocks in a stock exchange, and you throw darts, and whatever your dart hits, you buy that company. You're not aiming at anything. You're just throwing it at this dartboard. And you might be thinking like, well, that's kind of dumb. And it is. It's totally dumb. But the funny thing, a lot of times throwing darts at a dartboard outperforms some of these experts and folks saying this is how you go about it, picking stocks, or people picking stocks. Because things change in the market. They can be unpredictable in the market. There's no long-term planning behind it, or you're following this kind of a limited methodology. Or maybe for individual investors, it might be like, I have a gut feeling about this company, or I used to work there, I know they'll be good, all that kind of stuff that maybe doesn't turn out the way you expect. So the reason I bring up the DART thing is in my local newspaper, a newspaper from way back when. It was an old article they used to have way back when. I actually think they got it from the Wall Street Journal. But they had this competition in the paper where they would ask readers of the paper, they would get like 5 or 6 readers who would submit one stock that they said, this is a great stock pick I have. I'm picking this stock in this contest. And they would have, by each reader picking one, I think it was maybe 10, you'd have 10 readers, so you'd have 10 different stocks that would be the reader's portfolio, right? So this is what they're investing in. They say this is what's going to do good over I think it was like a 3-month time period. So it was not a long time period, but 3 months. So here's 10 stocks that readers picked, that each of these individual readers, they picked their best choice. And then they were competing against another portfolio, and that portfolio was picked solely by somebody at the newspaper throwing darts at a dartboard and picking stocks solely off the dartboard. And so you'd have 10 picks from readers who are reading the Wall Street Journal and reading this column and following, and maybe have learned a lot of stuff and all sorts of stuff. They're picking their 10 best versus their best one to make up a total of 10 versus these randomly thrown darts, the 10 stocks and randomly thrown darts. And the funny thing is, in most of the periods, not every, but more than most periods, I'd say it was 75%, I think it got that high, of the time the darts won. The darts won. How can that be? Well, A lot of people are investing without a lot of knowledge. Hopefully now you're going to invest with a lot more knowledge with hopefully taking this course is my goal, my idea for you. But there's people picking stocks for a variety of reasons that maybe aren't very reasonable. But the darts were consistently beating the readers. Just like when you read things like how index funds will consistently beat the high-paid, high-buck active managers of mutual funds, that index funds beat them. Well, that's why, because it's about long-term, it's about consistent investing, and it's not necessarily trying to pick that hot stock. So just threw the darts thing in here just kind of for fun. Even dogs of the Dow and aristocrats at least have more of a methodology. So don't do the darts thing, but it's kind of interesting that even with all this great advice out there, a lot of times the darts will win. So it might not be based on your expertise or anything. It might be just something happening in the market. The best thing that you can do is educate yourself and then make wise choices and then make adjustments as you go along the way, and then letting that compounding interest work over a long period of time. That's how you can kind of beat the darts or beat the randomness of the stock market. Okay, you've got an understanding of stocks and how they work and how markets work. Now you want to go buy some. Now it's time, the fun part, where you get to go pick them. And there's a lot of different ways you can go to pick stocks. I mean, some people might say, I like the look of the company's logo or the colors that are in the logo, or I went and saw a Disney movie and I thought it was a great movie, so I'm going to buy Walt Disney stock, for example. Well, that's okay. Not as expertise behind it, but a lot of people buy it that way, or they just regular buy their own company stock, which if you do too much can be a little risky, by the way. So be aware of that. But mostly folks are looking at a little bit more analysis, a little bit more data than that. And really the analysis comes down to two parts, qualitative information and quantitative information, or data that's become information. Usable data is information as we know it. So you're looking at qualitative and quantitative. And what's the difference? Well, qualitative is not numeric. It's kind of those those non-number type ways, and we'll look at that in a second here. And then quantitative is the numbers, it's the hard cold numbers. So let's take a quick moment to look at these two things before we start getting into things like ratios and really in-depth around different ways that you can evaluate companies. So first off, quantitative, as I mentioned, is the hard cold numbers, right? It's not opinion or anything like that. It's like, here's the numbers, here's what our sales numbers are, here's what our earnings numbers are, here's the stock price. These are all numerically based things. So that's the quantitative aspect. And you're looking at financial results. And from those financial results, you're developing or using, there's very many well-established ratios and things that will highlight us for some of the key ratios out there to evaluate companies versus one another. Whenever you're evaluating companies, and I'll say this many times over, so bear with me on this, but it's really important to compare a company within its own industry against its peers. I mean, it's hard to compare Google, a high-tech company, versus ExxonMobil, a well-established income dividend-paying oil company. You can. They're both large companies. They're both large company stocks. Like, there's aspects of it, but there's really kind of different industries. So you want to compare maybe Google versus Yahoo versus maybe ExxonMobil as a comparison. So financial ratios, you get those from different sources. And when we get into the ratio part, we'll talk about exactly where to find them or how to get them. And most of them are publicly domain anyway, so you never really need to calculate them. But it's important to understand where they come from. And they typically come from the business financial statements. And those are, the balance sheet, looking at the assets and liabilities of an organization. What do they own? What are their assets? Buildings, fixed goods, real estate. What are their liabilities? What do they owe in debt, or who they got to pay stuff to? So their liabilities, you subtract those two, you got what are your income or your net value of your company. What's your retained earnings? So if you're accounting, you would get all that. But the idea is you're a moment of time as far as looking at your balance sheet. Then you have the income statement, which is showing the inflows of money and where that goes from the income statement. And then the statement of cash flows is really analyzing cash and inflow and outflow cash and how's your cash position changing. Those three documents that are required to be published out there are very, very important, where a lot of these ratios come from. But those are the cold hard numbers. That's just like numerically, I'm not invested in it because I like the latest Disney movie. I'm just looking at what is the numbers on. Now qualitative, we compare that now to qualitative, that is not numeric. That's the quantitative part. So a lot of times with qualitative, you're using things like logic, for example, or maybe things like your gut or emotion or your knowledge about a particular industry or company. I mean, sometimes if you work within a company and you've worked in that company for many years and you worked in a particular industry, you'll know that industry well. That doesn't mean you're an expert as far as buying stocks in an industry, by the way. You still want to do your due diligence on it, but you'll understand that industry and what's working and not working in an industry better than somebody who maybe has not worked in that industry. For example, if I'm investing in, let's say, healthcare stocks, and somebody's a doctor that I'm, comparing to, a doctor is going to know more about healthcare and what's working, what's not working, how managed care works, all that stuff better than maybe I would as far as knowing the industry. Now, I might be a better investor though, because I know how to use analysis and quantitative stuff and how to build a better portfolio. But at the beginning, that person will know that industry from a qualitative standpoint. You also want to look at from a qualitative standpoint is what's going on in the wide world. What are these, demographics? What are trends? What is happening out there? So if you're interested in, as a good example is healthcare, understand that the population is aging, that we're having more longer lifespans, and there's more opportunities for companies who are in that healthcare field with their clients. Basically, in many cases, they're going to live longer. That means they can buy their products longer. Just that nature itself can be really good. What about for millennial generation? What are they buying? What types of things are they buying? The investment in technology and understanding technology, and that's maybe where technology stocks might target that particular market. What's happening from a global aspect? We live in a very global, interconnected world. I mean, I'm very blessed to have tens of thousands of people in my courses here, and I've got in my online courses, and I got folks from all over the world. I have folks from over 141 different companies that watch my videos, my training videos, and I'm very grateful and blessed, and thank you so much for doing that. But think about how the world has changed, that I can do this over the internet and offer this type of training and education where, even a decade ago, it just really wouldn't work well, and decades before that, it's like, forget it. You could just work in your local market, maybe go around and give speeches and give live training. Now we can reach people through the internet. So there's a change and a trend within the world. So what does that mean for maybe you're interested in investing in companies that do online training? For all I know, that might be an opportunity around that. So your sources for that, from qualitative information, is coming from what you know about the industry, from news, management statements that might be out there. So a lot of times when they release their income statement or the balance sheet, they might have a conference call or something where they're talking to investors or the investment expert community, and they're talking about future things that are going to happen. That might not be numerically based, but just saying, hey, we're looking to invest in this new market, or we're going to expand here, or maybe we're a retailer and we're going to close stores. So what does that mean for our stock? Or we're going to open stores. What does that mean? Or we're going to lay off people. We're going to hire people. So looking at these management statements coming out can impact a stock. And then also what some of these research analysts who are on these conference calls are listening to, what are they saying out there too as well? I mean, anything could change. There's a lot of information out there, but you have folks that are dedicated to researching stocks, let's say in a particular sector or field, and they give out statements and they talk about stocks around there too. So that could be part of your qualitative information. Warren Buffett and other well-known investors, especially Buffett, really talks a lot about understanding the company and the industry, and that you really understand that before you invest in it. And I know I've had some experience with that too. I've had better success with companies I've either done business with, or I really understand more so than maybe companies where it sounded good, it sounds like a great technology, and I'm just taking a chance on it. And sometimes it's worked and sometimes it hasn't. But I know in my own personal success, the more I can understand the company, the more I can understand the industry, the more I can understand that qualitative aspect, and then bring in the quantitative aspect to back up my decision making or make me make better decisions, that makes me a much, much better investor than just following some news or what's the hot stock now. That can always usually lead to trouble, because once there's a hot stock out there, people know about it and the price has been driven up, and maybe it'll go up, but maybe it won't. So qualitative information is not numeric. It's kind of that overall information that you're gathering, and then use it with the quantitative stuff from the balance sheets, the income statements, and the statements of cash flows, and those financial numbers together to make your choices. So now we're going to take a look at some of these really important ratios. And there's some real key ones. There's hundreds and thousands of ratios out there. Well, maybe not hundreds of thousands, but there's lots of ratios out there. But there's a few financial ratios that are really key ones, particularly depending on what you're looking to invest in, from growth stocks to maybe dividend or income paying stocks. So let's take a look at those. Before we look at individual ratios, these top ratios to look at from a financial perspective, just a couple real quick things to keep in mind whenever you're evaluating a company using really any ratio. First off, where do ratios come from? Well, the balance sheet, the income statement, and the cash flow statement. That's where their original numbers and things come from, and they then come from the operations of the business. So when they have sales, for example, that's all aggregated, and then that ends up in, let's say, like an income statement as revenue. So it's from the operations of the organization, but it's balance sheet, income statement, and cash flow statement is where you're going to see where these ratios come from. And one thing that's really, really, really important is to compare ratios within the same industry, or comparing companies versus one another in the same industry versus outside their industry. Because a company might look great compared to the broader market, but within its industry, it might not be as great a performer. Or there might be things that, like, technology stocks or something like that might have high price to earnings or high price ratios because they're very big growth stocks, and which could be a great thing, but you might shy away from them because you look at the broader market and see lower price to earning stocks or lower PE ratios and say, wow, those seem like safer bets. Well, they may or may not be. So it all depends on that industry. So do compare within the industry. Another couple key real important things is some ratios are more important than others depending on the industry itself. I mean, so if you think about it, not all ratios are the same. I mean, they're all the same as far as calculation, but some industries reward or it's more impactful for certain ratios than others. Let me give you an example here to kind of drive that home. Inventory turn ratio, which is how fast are you selling your products and goods, how fast are you turning that inventory. The faster you can turn your inventory, the better efficiencies you have, the better profitability you have. So inventory turn is an important ratio. It's a very, very important ratio for like retail companies. Because you think about it, a retailer has a lot of inventory, right? You go to a big store and they have lots of inventory. Let's say it's a clothing retailer. They have lots of different styles of clothing. Maybe it's different seasonality of clothing, winter, spring, summer, fall. And so they got a lot of different stuff just for a clothing retailer, let alone somebody who does hard goods as well. So how fast they turn that inventory is very important when you're evaluating a retail stock. It might be less important when you look at something that doesn't carry a lot of inventory, maybe like a media company, for example. It has assets, yeah, but it has digital assets, but it doesn't have those hard goods sitting on a shelf that's got to be sold, or are also going to be marked down as a loss or sold on clearance because summer has ended, winter is coming, and now people are buying parkas and they're not buying shorts or things for summer or swimwear, for example. So inventory turn is a real important in retail, or wouldn't be in other industries. So same thing with any of these ratios. Understand which ones are more important within certain industries. Also, some ratios are more important by the type of stock than others as well. Some are important across lots of different things. The only price to earnings is important, but it's a way to value growth and value stocks, for example. But if you're looking at, let's say, dividend stocks, dividend yield or dividend payout ratio, those things that are related specifically to dividends, well, those are life or death for you. You really are wanting to buy a company that's got a good dividend yield that'll continue to pay it. Well, that's very, very important. And you want to really compare companies and really analyze that dividend payout and that dividend yield versus, let's say, a technology firm or a health firm or somewhere that pays no dividend at all. Like, how can you compare a company that doesn't pay a dividend? Dividend yield doesn't mean anything anyways. It's no big deal. Or if you look at, we'll use technology again. There's some technology companies like Microsoft that pay a dividend, but are you going to buy Microsoft because it just pays a dividend? Well, you might, but maybe you want to go with more growth stocks in technology, for example. Either way, for dividend stocks, that ratio is more important than maybe even like a retailer with inventory turn. Maybe it's a retailer that pays a dividend and you might be more concerned about dividend yield. So the type of stock, whether it's a growth or an income type stock, can make a difference as well. And understand there's lots of ratios out there. There's hundreds of ratios, and I'm going to give you some here that are the real key ones, the ones that you see across the different categories, from liquidity to all sorts of things, evaluation. If you do these ratios, you're going to be fine. At least you'll get a starting point. Many people don't use ratios at all, but if you're going to use ratios, these are the key ones that are used over and over again. If you try to analyze a company by like 100 different ratios versus 10 other companies, that's just going to take a lot of time and might even lead to paralysis by analysis where you don't make any decisions at all, or maybe you start looking at some ratios that aren't important and thinking they're important. That can cause some, behavioral issues or cause some problems as far as investing because you looked at the wrong ratio that wasn't important because it was the number 30th ranked ratio for, that industry, so to speak. So when you're looking at ratios, here's some key ones that we're going to look at now that if you do these, they'll really give you a great start and really understand these well when you're starting off and really starting to compare companies. And if you want to go beyond that, feel free, and using your qualitative and your quantitative analysis. In this section, we're going to use what's called fundamental analysis. We're going to look at the fundamentals of a company or organization and see how they're doing, some measures or ratios to see how the company is doing, and what's really important to see how that company compares to other companies that we might want to invest in. One thing that's very important when you're looking at any ratio within any company is to compare it to its peers within its industry. You could compare it to the wider market, and that's okay to compare to the big wide market too, both domestic, international, whatever. But you really want to hone in on its comparable competitors that are out there so you can kind of see who's maybe doing well or who's maybe underperforming and look at how they're doing within the industry. So one thing, and I'll talk about this probably a couple of times as we get into the ratios, just remember to really compare it within its industry and versus its competitors. Now we've got the ratios broken down into 5 big categories that, there's a very traditional way as far as looking at, and then you have these individual ratios or numerical measures within these 5 categories. First category we're going to look at is valuation, or that's simply the price of the stock. You're looking to evaluate the company, you're looking to evaluate its stock price, maybe its dividends and how its dividends compare and how those future things might continue to go on. So you're really trying to get a price valuation to compare it to the pricing valuations of other companies so you can make a good choice based on what might be a good price for an organization or company, what might be a good fair price, something that you can maybe hopefully grow and appreciate that price. So we're going to look at valuation. Then we'll look at also profitability, which is pretty simple. It's what it says. How profitable is the company? What are some measures that we can use to measure profitability and compare it? Next is liquidity. We're looking at how liquid the company is, looking at things like current ratios and current bills, more so looking at things like current bills and how they can pay their current bills. Are they very liquid, or are they carry on a good amount of debt and are having a hard time making their current business bills or current things? So that's looking at liquidity. And then we'll look next at debt, which really goes even beyond liquidity and looks at more like solvency. Is this company solid? What is its debt to equity ratio? How can is it solvent enough to survive? And you want to see if somebody's maybe carrying high levels of debt, for example, that might be precluding it from maybe making future investments. Many companies take on debt, and debt's an okay thing, to invest in future investments with the idea that that debt they're taking on is going to pay off in a bigger way. But if you have too much debt, it can be a real drag on an organization and a real warning flag for us as the investor. And then lastly, we'll look at how efficient is the organization? How is its operating measures? How is it doing compared to its peers as far as being a good, efficient operation? And really evaluating the management basically with this, using financial measures to measure management effectiveness. So this is a good way to see, maybe it's a good company, maybe it's got some good other ratios, but how effective is management in running this company? As we know in business is all about managing scarce resources, right? We can't just add tens of thousands of more people to a payroll. We have to manage these different scant resources of people or personnel or equipment or whatever it might be. And the efficiency ratios will help us to look at that in a closer way. So looking at all these ratios together, you're going to look at these companies, you're going to compare them with the industry. Some ratios might be more impactful for particular industries or companies than others. Things that are looking at dividend paying stocks, for example, dividend-based ratios are very, very important. But if it's a company that is a growth company, a high, fast growth company, and they don't pay a dividend at all, well, then dividend ratios aren't very important at all to that type of company. By the same token, in certain industries, like turning over inventory or carrying low amounts of debt might be important for some industries, like inventory turnover is real important to like a retailer, for example, versus other types of industries. All right, so that's a quick overview of these different types of ratios and what categories they fall into. Now let's go into each category and see some of the key ratios that are out there that are really effective within that category. There's thousands and thousands of ratios out there. We can always keep continuing to add them, but these are some of the key ones we're going to look at that really every investor should be aware of. And let's get started looking at these different ratios. So let's start looking at valuation ratios. Basically, we're looking to evaluate the company from its idea of its price. What is its stock price trading for? And is it a fair value, or is it overvalued or undervalued? And how does it compare to others in its industry and its competitors, for example? And really the granddaddy of all valuation stock ratios, and really of almost all ratios, is the price to earnings ratio. You might hear it known as the PE ratio, or price to earnings ratio, or PE ratio. Very famous, one that's used all the time. If there's one ratio to know, this is certainly one of the big ones to know, is the price to earnings ratio. That's why when you go online maybe and you look up a stock price, a stock quote, usually right around there you'll see a PE ratio around that price somewhere. Certainly if there's a little bit of a quick summary of the stock, a little bit about it, you'll usually have a PE ratio next to it. Because you're really comparing the price to its earnings, and that's the formula or the ratio behind it. It's price per share divided by earnings per share. Now the nice thing about all these ratios is you don't have to manually calculate them. You can if you like doing that stuff. They're in most cases not hard calculations, but it's basically the price divided by the earnings is for the PE ratio. And you get that right off the income statement. So if you want to calculate yourself, get that earnings off the income statement, look at its current stock price, and dividing price divided by the earnings per share, or EPS, and doing the calculations around that. But you never really need to do that with any of these ratios. So I'll show you some places, a search form at the end of here, and we're looking at some ratios so you can kind of see where it's all done for you. But basically PE is the price divided by the earnings. And think of the price earnings ratio as what you would pay for $1 of earnings, right? So for every dollar of earnings, this is what you should maybe pay in terms of a price earning. Now, it doesn't necessarily match that way. Sometimes they're overvalued or sometimes they're undervalued, but that's kind of the idea behind it. And really all you're looking for with the PE ratio is to compare amongst other companies. And the general rule of thumb over many, many years was that low PE ratios are of a value. They're being underpriced in the market. Low could vary by industry, for example, like maybe a technology industry. All might have very high price to earning ratios as far as companies, because people are expecting high tech, high growth things from that, versus a more stable industry like utilities or things like a coal company or things that make electricity that might not have a very high valuation as far as a price to earnings ratio, as far as traditionally, or rule of thumb. Now, what we know in recent market times, rules of thumb can really go out the window in some areas, and certainly price to earning ratios are like that too, where you might see really high price to earning ratios of some utilities, and same thing with technology stocks might be lower, but they tend to be much higher as well too. So the thing is, if that's a higher number, if you have a PE ratio of 15 and another company has one of 10, well, that's a better value as the 10. It's price in comparison to its earnings. Now, there's a lot of other factors that go into picking stocks. Don't just go by the PE ratio, or any ratio for that matter, but it's something that's a good tool comparing. If you're comparing two companies and they're very close to you in terms of what they pay for dividends or income or growth rates or what you think of the company, everything's close, and one's got a PE of 10 and another one's got a PE of 20, well, that PE of 20 might be really overvalued. You're really kind of taking maybe a little more risk that you're towards the top of that stock versus maybe buying something with the lower PE ratio. That's the idea behind it. Sometimes you might hear commentators say, well, this stock is overvalued, or the market is overvalued, or maybe undervalued. But if somebody's saying, oh, the market's overvalued, or this particular stock's overvalued, when they're saying that, they're usually referring to the PE ratio. And they'll usually say, well, the whole market has a price earnings ratio of X, and only 10 years ago it was Y, and in the 50s it was this, 1950s it was this. And they'll have some discussion around that. So if you ever hear these terms about being overvalued or undervalued, or the market or something like that, they're probably talking about price to earning ratios, and use it as a good tool for you when you're looking to maybe narrow down your choices of companies and see how that company's price to earnings ratio compares to others in its industry, and see if that price maybe is overpriced and maybe you want to stay away from it, or maybe it's like really low and you're like, hey, this might be a great opportunity. Consider other things as well, but price to earnings ratio is usually a good place to start. Another very good and popular valuation ratio is the PEG ratio, which incorporates some things from the PE, or price to earnings ratio, in it, as we'll learn about in a second here. So the thing is, with the price to earnings ratio, a lot of people would say, well, that's great, I'm looking at stock price, I'm looking at earnings per share, but I'm not really considering, what are the future growth prospects for this company or this organization? Maybe I'm willing to take something that's a high PE or a low PE if there's a lot of significant growth out there that might benefit me. And thus the PEG ratio was born. It also comes from the raw data, comes from the income statement, and also looking at the current stock price. And the formula behind it, which again, don't ever do these formulas, but if you're interested in doing formulas, formulas, the PEG ratio is basically taking your PE ratio, your price divided by its earnings, and then dividing that number by the projected annual growth in earnings per share. So you're looking, what is our earnings per share? And calculate earnings per share and your projected annual growth in that earnings per share. Okay, so there's a lot more moving parts in here. Don't worry about that as much. I would just go out and try to find things that will list out the PEG ratio. You can find those out there. But that's how it's determined. The PE ratio divided by the projected annual growth in earnings per share. And the idea behind it is it's putting in a factor of earnings. What is our earnings per share of stock? So if you have more stock, the earnings are very important. And how is that growing? It's all about growth. So it's using that basic format of the PE ratio and then looking at looking at a growth factor. Well, a PEG ratio below 1 is considered to be a good value, right? It's an undervalued stock. It might be something that's a good value with maybe some good growth rates out there relative to its price and its earnings. That's where the PE ratio part comes into play. So if you're a value investors love PEG ratios because they're looking for companies that might be, whatever reason, the price has been driven down, but their future, and maybe their earnings have suffered in the short term, but their future earnings per share growth rate might be great, which makes a better, a PEG ratio, basically more below the number 1. So if anything below 1, take a look at it, and actually the smaller the number when it comes to PEG ratios, the better. So if you're looking at a company that's got a PEG ratio of 0.5, and the one you're comparing it to has a PEG ratio of 2.5, well, that 0.5 is a much greater value when you look at it in terms of price and its future earnings per share growth. So PEG ratio, great, particularly if you're looking for those undervalued stocks. Another way of looking at evaluating or the valuation of stock prices and picking stocks is a price to sales ratio. Not as used as much as a PE ratio and not used as much as like a PEG ratio for value investors, but it's still very, very important. And you get that off the income statement. You're looking at your sales and the recent stock price. And the formula is the price per share divided by the annual sales per share. So you're looking at it on a per share basis, the formula. But you can find these, they'll say P/S, a P price to sales. And it's like price to earnings or price to book or some of these other pricing comparison to something ratios. And price to sales, you're looking at, what kind of price did you get or what kind of prices are you willing to pay for $1 of sales is one way to look at it. And you're really kind of comparing firms based on their sales relative to their pricing in the market. So if you've got a company, let's say that has a price to sales of 2 or 2 times and another one of 4 times, well, that means you're paying a high price for that 4 times company. And you want to ask yourself, is it worth it to pay for that sales? Is it worth to pay that much? Or is it a better value maybe to go with the 2 times one? So it could be good or bad either way, but the lower the price of sales, you might be a better value when you're looking at stocks. A price of sales that's high might be a higher price relative to its sales. And a lot of people like price to sales. I like price to sales too. Amongst all these ones that we're learning about, all these different ratios taken together, all within the industry, so we keep saying that over and over again. But it's good because when you look at like earnings and things, frankly, there can be a lot of different manipulation around earnings. Some are criminal, and you might hear stories where there's criminal manipulation and hiding things off the books and all that, and that's terrible and illegal. But there's also some manipulation as far as when you receive money and when it's going out and what you're expensing and not. There can be a little bit more. You can play a little bit more with like earnings, and many companies do to hit a certain earnings number. They've projected earnings, and if they don't hit their number, their stock's going to down. So you might see a little bit around them. But sales is a harder number to manipulate because, you either made a sale or you didn't make a sale. It's either showing up on the revenue line of your income statement as revenue or sales, or it's not. So it's a little bit harder to hide that or shift it. But it can be done. Anything of these things can be done with magical accounting, I guess. But it's something that's a little bit harder. So a lot of people like price to sales because it's a little bit more consistent of a number and a little bit more reflective of an organization as far as a number. So it's just another evaluation and a good valuation to say, hey, in order to grow, in order to do well as a company, we need sales. We can always cut and reduce our expenses, and we can do that. But the bottom line, we need to grow sales and grow sales relative to our price to be a good value company to maybe buy. And if we're not growing sales and our stock price is maybe real high, that might be something to look at and maybe avoid. You're looking for companies with good sales, growing sales, and if their price is undervalued, hey, that's great. Have that lower price to sales ratio. So another thing to look at, something a little more consistent, is price to sales. But I would consider it with price to earnings and some of these other ratios as well. price to book ratio is another valuation stock price ratio. You're evaluating that stock price of that organization in comparison to others in the industry. And price to book, you get that off the balance sheet and its most recent stock price. The formula is the price per share divided by the book value per share. Now, you might be thinking, well, how do I calculate book value per share? It's actually already on the balance sheet. It's listed as shareholder equity. So if you like to do calculations or want to do it, just look for the shareholder equity section, and then you can compute that versus its price to book value. You can compare that, the price to the book value or shareholder equity. And really the idea behind it is the portion of the company that the people own. It's the shareholders. You and me are shareholders. So if I own 2 shares and you own 1 share, I own twice as much stock as you in that particular company. It's a matter of how many shares you have. And so you're looking at the book value and you're dividing by the number of shares outstanding to give you the book value per share, right? So you got shareholder equity, you're dividing that by the total number of shares, and that's how much it is per share, book value per share. And that you can then use to compare to the price per share. So you're making fair comparisons, the price per share versus the book value per share. And the idea of the book value per share is that's almost a gauge of what not only the shareholder equity, but also like what is the company kind of worth? It's a good measure to think, the company is really worth at least this. What is $1 of equity? How much are you paying for $1 of equity in this company? So sometimes companies that have fallen on some hard times, or there might be some big fast downdraft in the market, you might get really close to their book value per share. That should be higher than 1, but it might get close, or maybe even below. So you're like, boy, I can buy this company and get more of the company for my purchase of that price to the book value of the share. So if you're looking for really valued stocks or low price stocks, you'd be looking for some of the low price to book value is what you're looking at, or P/B. Or P/B. And if you see a company that's really overvalued, that's got a high price to book, it might also have a high price to earnings, maybe even a high price to sales, that's telling you something that people are really taking on more risk and really putting money into that company and paying a premium. They're paying a lot for that company. They're paying a high for the actual book value of that company because they're thinking hopefully that something's good going to happen in the future. And you have to decide yourself using your other ratios, your other types of investment things we're learning, decide, well, is this true or not? Because you are taking on more risk if you're looking at something that has a high price relative or comparison to its book value. And value investors, they love looking for low price to book value type shares. So you're comparing with the industry, but if you see somebody who's doing great in price to book and somebody who's low, that low company might have the opportunity to raise its stock price, is the idea behind it. Maybe it never does, it just goes down, we get that, but it might be something to look at when it's looking at its price to book ratio. If you like dividend stocks, and I like dividend stocks, I like high growth stocks too as well, but I like to have a mixture of stocks, and so I like dividend stocks. And if you like dividend stocks, I think dividends where they're paying you out quarterly income is great. Well, that's terrific. Then you want to look at dividend stocks. And they've got a couple of ratios that are very, very, very important when it comes to dividend paying stocks. If you're buying stocks that pay no dividend at all, well, then you can just forget this part. You don't need to evaluate it. This is only looking at stocks that are paying out a dividend. And one of the first things you'll look at is the dividend yield. You can get that off the income statement and the most recent stock price. And the formula behind that is you're looking at the dividend per share and dividing that by the price per share. Remember, everything's on per share basis. So how much are they paying in dividends per share stock that's out there, and divided by the price per share, and that will give you the yield or a percentage. And if you think about companies, dividends are the primary way that they actually give money back straight to the shareholders, to the owners of the company, you and I who own the stock, let's say, on a stock exchange. Of course, the other way is that we buy at a certain price and we hope that price grows over time, and then at some point we'll sell that and capture that capital gain by what we sold at the top there is the idea. Hopefully it doesn't go down below what we bought it for, but the idea is we get that capital appreciation. But dividends are things that are taken out of current earnings and are just money that's given back right directly to shareholders, so you can get that regular income. So if you're looking at that from a dividend yield standpoint, or getting that regular income, you'd be interested in a high dividend yield. If you're comparing two stocks and one has a dividend yield of, let's say, 2%, another one has a dividend yield of 5%, for, let's say they're in the same industry and everything, then you would want to look at that and say, wow, for every dollar of share, for every share I have of that, I'm going to get basically 3% more with this other stock. I get a 5% yield versus a 2% yield. One way you can even think of it is almost like interest, right? You put money in a savings account, you get 1% or 2% interest on your cash. It's kind of a similar thing. You're getting that 5% versus your 2% back on that dividend yield. So higher dividend yield companies means more money for you when you put your money basically in that quarterly dividend. You're going to get that on a yearly basis, that percentage back. So if it says 5%, that's usually like an annual or yearly calculation that you'll get 5% of your money back by owning it, like passive income through dividends. And so dividend yield is a great way to compare companies within the industry, particularly if they pay a dividend. That's where you're really looking at that pay a dividend. Now, a couple of things around dividend yield to be cautious of or be aware of. One is sometimes you might have companies that have a very high dividend yield. They're really outside the norm. They might be paying a 10% dividend yield where everybody else in their industry is paying a 2% dividend yield. And you'd be like, wow, why don't I buy the companies that are paying the 10% dividend yield? Makes sense. You're getting so much more money. In fact, why don't I put everything in that 10% dividend yield if I can get almost a guaranteed 10% back every year? And that's the problem, is the guarantee part. Remember, dividends are not guaranteed. A company could cut their dividend at any time. And what can happen is once a dividend yield goes way up like that, a lot of times how that's happened, if you think about it from the numerical or ratio aspect, it means their prices probably drop dramatically, maybe very quickly. Their dividend has stayed the same, so they're still paying that. But because the prices drop so fast, their dividend ratio is a higher percentage because the price is lower and the dividends stay the same. They don't go down together or rise together. The dividend is more of a fixed thing. It stays the same. So thus you get the higher dividend yield. The prices come down. Now you could buy that stock and a couple things could happen. One, the price could continue to go down, which could really hurt your ability to have any capital appreciation. And if they don't cut the dividend, well then you would get that dividend. Maybe you could hold that for a long term and at least you're getting the dividends, but you're not getting the combo of both capital or price appreciation and dividend appreciation. But also what happens when stocks have a very high dividend yield, that means their stock price has gone down, and probably for a reason. Maybe they're struggling with earnings, or they're looking at bankruptcy, or something is going on that's causing a nervousness with that stock and the price is plummeting down. And one thing that maybe people are afraid of is that they'll cut the dividend or eliminate the dividend totally. Dividends aren't guaranteed. They can be cut at any moment. And so sometimes you see these high dividend yield stocks where the price has gone down, the yield has gone up in comparison, and then the company comes out and says, oh, we've got to cut or eliminate our dividend. We're on hard times. We're having a hard time making our payroll or paying our bills, so we're going to eliminate the dividend. And then what happens? You get no dividend, so that's no good. And then the stock price usually plummets really fast, even further, 20, 30%, even more, because anybody who bought that stock originally for that dividend is now probably exiting out. So it's something you might be able to hang on to for a long time if you think it'll come back, but that could be a long road. So if you're looking at something and saying, well, it's got a high dividend yield, that looks great, just in comparison to the industry, just be a little cautious on that and really look at the company and how they're doing and how overall things, if they can maintain that dividend, will be the key thing. And then there's a ratio that actually helps us with that, and that's called the dividend payout ratio that we're going to look at next. So I know when I look at dividend companies, I look at how long have they paid that dividend, so are they consistent payers? I then, and are they safe? I then look at the dividend yield, just see what's going on with that. And then I look real close at this dividend payout ratio. That'll be a real help for you to see, like, what are my chances that dividend's going to continue to be paid? And that's what we're going to look at next. And a real key thing with dividend stocks, dividend payout ratio. Okay, we're looking at dividend stocks and the valuation of that stock price, and we're maybe looking at dividend stock that's pays us a regular dividend, which is great, and maybe it's even got a high dividend ratio or dividend yield, a high dividend yield, so we're getting a good return on our money, and that's exciting too. But one thing to be cautious about is, can they continue to make that number? Can they continue to pay that out? And is it risky? Is it in danger that it might be the dividend itself be cut or eliminated? And that's where the dividend payout ratio is really involved. And I would caution anybody who's looking at any kind of dividend stock to really look closely at the dividend payout ratio, because things that may look good in the first place may look good up front, like, wow, look at that yield. This company's great. Look at that dividend that's paying out. It might be hiding things that are going to be bad news coming later that'll cut that dividend and really crush your stock, not only from the price that'll go down because the dividend was cut and people want to get out, but also you're just going to get less or no money from your dividend. So let's look at dividend payout ratio and what that means and why it's so important. You're going to get this from the income statement too. Once again, they'll list ththese things. You can search for them, just search for the dividend payout ratio. You'll find them. I'll show you some things here at the end of this section about where you can find some of these ratios. But the dividend payout ratio is looking at the dividend. What is the dividend? Dividing that by net income. How much income or earnings net income do they have coming in? Because the idea of the net income is that is what pays out the dividend. I got money coming in as a company. I take a portion of that money to reinvest in the company, hiring more people, buy equipment, expand my business. But if I'm a dividend paying company, I also take a portion of that earnings that come in, that money that's come in, and I pay out directly in the form of quarterly dividends to my shareholders, my owners of the company. And they all get a little piece of dividend based on how many shares they have. If I own 100,000 shares and you own 200,000 shares, well, that's great. You're going to get more dividends, twice as much dividends as I would. So it's all about, can they continue to pay that dividend? That's what the payout ratio looks like, is looking at the income coming in and saying, can they continue to pay that dividend? And that's what you're looking at, is maintaining that steady dividend, and we'll continue to maintain that steady dividend. Now, you might have companies that paid out a dividend for 40, 50, 60 years, and that's great, and that's a great sign that they'll continue to pay it. But if they've got lousy income coming in, they could cut that dividend at any time. So just be aware from a payout ratio standpoint, that could be more of a challenge. And each company has its own policy regarding dividends and, what it thinks is the best interest rate or best amount of interest in the company as far as how much to pay out. But income investors should be really, really aware of this payout ratios and things along those nature, and keeping an idea of what is a good payout ratio. So in general, you want the payout ratio to be low as it can be. You usually will see companies paying out half their earnings and dividends and maybe half that they're reinvesting in the company. So you might see ratios around 50 to 60% payout. That means they're paying out 50 or 60% of their money back to you, which is great. And if you're in between like the 50 to 70% range, that's okay. That's pretty good. You can compare it within the industry, but even if you're at 70%, that's pretty good. They can usually maintain that as a steady pay on that dividend. Maybe you want to look at some of the other ratios like debt equity ratios to see if they're carrying a lot of debt, so it might be a problem in the future. But right now, if they're at 50 to 70% of earnings is getting paid on a dividend, you're okay. But you want the number to be as low as possible. When you start getting up to be 80%, 90%, that means a lot of other income coming in is just going right up to shareholders, which is great. But maybe that's a problem as far as something happens, their sales go down or their earnings go down. Now they can't make that dividend. They got to cut their dividend, and then bad things happen. The stock price goes down. You're getting less dividend. A lot of bad stuff around it. Now, certain dividend-paying organizations like real estate investment trusts or REITs, are by law will pay out 80% or higher. I think it's like 90% of their dividends out because of some tax advantages, at least the United States are around that. So that's why it's important to compare within its industry. If you're comparing real estate investment trusts or REITs, that's going to be a different number than maybe utilities or another type of like banks or another type of industry. So compare within its industry, but as a general rule of thumb, 50 to 70% is good. Anything above 70%, get a little cautious. You get above 80 and higher, you might want to stick away. Something's going to happen, or stay away. Something might happen. You just have to be cautious with that investment. If it's at a high payout ratio, that means the stock prices come way down, or they're having earning problems, getting money to come in to pay out. Think about that. Well, not necessarily the stock's down, but if they're having a high payout ratio, that means they're having a hard time getting enough money in to make those commitments around the earnings. And your stock price is probably reflecting that. It's probably has come down. So maybe it's a great buying opportunity. If more income comes in and they lower that ratio, then people will pile back in that stock and raise its stock price because they'll feel safer. Remember, most people that invest in dividends, especially a lot of retirees and all, are investing in dividend stocks because they want safety as well. So they like stocks that have a low payout ratio, low dividend payout ratio. And if that number gets higher, then those people like, I'm going to jump out of that stock and maybe jump into a competitor or another stock that has a lower payout ratio because I want to make sure I get that dividend of some sort, because I'm relying on that for current income. So think about that. I know I use dividend payout ratio anytime I'm looking at a dividend stock. So I'm not just chasing, hear the term chasing yield or chasing high dividend yield or chasing yield because you want that return. Understand, is that return sustainable? And the dividend payout ratio will help give you an idea if that return is going to be sustainable or if it's something that might have some bad news coming in the future. So in these big 5 categories where you can have different ratios like valuation and debt, whatever it might be ratios, there's also the section on profitability, which makes sense. We want to invest in companies that are profitable and that are using their assets wisely to continue to grow profits over a period of time, the period of time when we own their stock. And that's what we're really curious about and really want to key in on. And ratios can help us to evaluate a company as far as profitability and then compare within others in the industry and even the wider market, but really try to hone in on competitors within its own industry. And one of the more popular ones out there is return on assets, or ROA, right? right? You're getting this information from the income statement, the balance sheet. Formula on it is you're really looking at net income divided by the average total assets, or the total assets that are being carried, and looking at that in comparison to net income. Once again, these are formulas that will already be out there. You don't have to worry about calculating, but just good to understand, I guess, where they kind of come from. These different types of ratios. And this is really looking at assets. Assets are being things like a company owns, right? A company owns factories and equipment and different things that they own in order to conduct their business, right? So in order to do business, they have to have these assets that they own. And the ROA tells you how good is the company at making money and using those assets basically to make money. So if I'm investing in a new factory, or I'm buying additional equipment, or a capital expenditure to buy additional equipment, when I do that, am I getting a return on that asset? Am I getting a return on that investment in that asset? And that's what return on assets is looking at. So for example, if a company A has $10,000 in net income and owns $100,000 of assets, well, then it would have an ROA of 10%, which is nice, but doesn't mean anything until you can maybe compare it to others. So if another company, let's say, has the same thing, but it's $20,000 in net income for that same $100,000 in assets, well, they now have a 20% ROA, the bigger number. And the bigger number shows me that they're using that same amount of assets more effectively. Now, as we know, there's companies of various sizes within industries. So by using a ratio, we can now compare maybe a bigger company to a smaller company and compare how they're each using their own assets effectively as one ratio of many others that we might use when we're analyzing stocks to buy. So for ROA, or return on assets, think of it as for every dollar of assets you own or the company owns, how much in profit can it generate in profits each year? Maybe around 10% in profits is a good rule of thumb with ROA. So ROA, or return on assets, the whole thing you're looking at is a bigger number. So if I have company A has 20%, or in this case, company A had 10%, and company B, if we had a fictional company B, was 20%, well, that's at least telling me it's using its assets more profitably. That doesn't mean the other things are going good, like its price earnings or its dividend yield or what the future might hold. Those are other things, but we can at least say, at least this management team's pretty good at managing and using its assets. That's a good sign, because that means they have a better chance to be profitable than a company that is less efficient or less efficient with their assets. Another profitability ratio is return on equity, or ROE. Similar like to ROA, or return on assets, you're looking at how effective is the company being managed, how effective is the company. And you're really looking at it from a profitability standpoint. That's why it's in the profitability ratios category. So ROE, or return on equity, you're looking at the income statement, the balance in the balance sheet, and you're looking at net income dividing by the average shareholder equity. So where ROA was all about assets and how effective we're using our assets, that is taken out in this equation. This is about shareholder equity, basically what we own. We're the owners of the company. That's the equity, is another word for ownership, so to speak. And really ROE is saying how good is the company in rewarding its shareholders? How much money are we making per our dollar or per our investment? So as an investor, ROE is something we're very concerned on. We want to make sure that companies are giving us a good return on our investment from an operational standpoint, or return on equity. So for example, if a company, let's say company B, reported $10,000 in net income, right? So that's great. They got $10,000 in net income, and the shareholders have $200,000 in equity. So in that shareholder equity, there's $200,000 out there. Its return on equity is thus 5%. So for every dollar of shareholder equity the shareholders own, the company is generating, in this case, 5 cents in profits each year, right? Or 5%. So my return on my equity that I put in there, I'm getting 5%. Now that may not necessarily be reflected in the stock price, or my return on my actual stock price, on my stocks going up or down. There might be other factors there, but this is another way of measuring, effectiveness of an organization. And this is looking at not from an asset standpoint, but looking at from a shareholder investment standpoint. So like return on assets, return on equity, the higher the number, the better. So if you're looking at two companies and one has a really high return on equity compared to the other, that is a good sign that they're really giving you a good net income, giving good earnings and good things compared to this other company. So in terms of profitability, ROE and ROA, return on assets, return on equity, higher the number, the better. If we were to talk about profitability just from a base level and you think, well, what makes a company profitable? Probably what's coming in your mind is like, well, profit margin, right? We sell goods and services and we get money in return for those, and we want to sell our goods and services for more than it costs us to produce or make those goods and services. And thus that difference between what we sell and what we cost to make it happen is our profit margin, right? And we make that margin on every sale. And that's a key ratio to look at, is what is a company's profit margin? You can get that from the income statement. The formula is, looking overall, the formula is net income divided by its sales, right? So we're looking at how many sales we're making in terms of dollars, and then what's our net income coming in, and dividing that net income divided by sales will give us our profit margin. How much are we making basically per sale? And we want to have good profit margins. The higher the number, the better, right? That's something pretty basic there. And it's kind of calculating, how well your sales are flowing through to the bottom line. If you make a sale, but you don't make much profit on it, it's not going to the bottom line that can then be used to invest in other equipment or invest in things, or used maybe to pay out dividends or pay out things to the shareholders or buy stock or whatever it might be. So higher margin is better, and higher profits are always better for shareholders too. And is that profit margin increasing, staying the same? Is it going down? Those are some things you want to look at. One thing that's very, very important, as I mentioned, all the ratios, I talk about how important it is to compare within this industry. But with profit margins, it's extremely important to compare within this industry, because different industries, by their nature, have higher profit margins than others. For example, large grocery store chains, where you can buy lots of food at a grocery store, or maybe retail is a similar way. Retailers, they run a very low profit margin. They make their money by selling lots of goods, and they have that low margin, but a lot of it gets to the bottom line because they're just selling so much of it. Think of it like Walmart or these large Target, these large retailers. That's what they do, is they don't make much per sale, but they have a lot of sales. Versus, let's say, a company like Google or some of these technology companies, Microsoft, they have very high profit margins. So they don't necessarily have to make as many sales because they're carrying less inventory or goods, or their costs or their expenses are lower in comparison to other industries. So compare within the industry is very important, because you might have a company that has what looks like to be a great profit margin, but in its industry it might be actually very low and a very poor, underperforming potential stock, versus maybe somebody in a lower profit margin industry that might be a good stock, especially for the long term. But overall, profit margin is about how money flows to the bottom line. So as shareholders, we like higher profit margin, and many people just like to exclusively invest in companies that have higher profit margins. It gives them a little more room to error. But remember, if you're not making sales, you're not making profit either. So it's that dance between what are you selling stuff for, the price, and then what's your cost, and how much is the spread between. But from an investor standpoint, the higher the profit margin, typically the better. But just make sure you compare within the industry and amongst other factors that you might be using when you're evaluating stocks. Let's look at some liquidity ratios now. Now, liquidity is all about short term. Can you basically pay your bills in the short term, versus, let's say, some of the debt ratios, which might be looking at longer term and longer term debt. But liquidity ratios are all about how liquid is the company, what is its ability to make its payments and service its debts in the short term. And one of the most common ones in the liquidity ratios, and one you want to look at, is the current ratio. That's probably the one that's used almost the most, along with the next one we'll learn, is the current ratio. And you get the balance sheet, and that's where you can easily see it really from the balance sheet. It's a very easy formula. You're looking at your total current assets divided by current liabilities, right? Assets are things we own, factories, equipment, whatever. And liabilities are things that we owe people. We need, short-term payments, that kind of stuff. We're looking at our current liabilities that are out there. Maybe we owe money on a lease or something like that. So that's liabilities. So with the current ratio, what you're looking at, you're measuring a company's ability to pay its short-term liabilities in comparison to its short-term assets. So you're really looking at short-term assets, short-term liabilities. That's the current part. The current assets are current liabilities. But once again, you don't have to calculate that. Just go look for companies. They'll have in its statements and things its current ratio. You can find that pretty easily. And the idea is, if the current ratio is over 1 as a numeric, that means the firm or the company has more assets than liabilities. It has the assets to pay its short-term liabilities. I mean, worst case, that means it could sell all its assets, take that money and pay all its short-term liabilities and make it that way. Now, you never want that, but that means it's not really insolvent or in trouble. It means it has the ability to make its current payments. That's very important from a long-term view of a stock, but also short-term. Companies that can't make their current payments, their stock prices go down pretty fast because people get worried about that company. Are they going to make it, or are they in trouble? So a ratio over 1 is good, and the higher the number, the better when you're comparing it. If it's less than 1, that means its liabilities are higher than its assets, at least from the current aspect. That doesn't mean they can't continue to service those liabilities. They got cash coming in, or maybe they got long-term debts that are coming off the books and they can then funnel that cash, or they're taking on more long-term debt just to meet its short-term obligations, or borrowing money from a bank to meet short-term obligations. So you can do things to keep solvent, but aren't those kind of not great things? You don't want to take out more loans to service short-term debt. If you're going to take out a loan, you want to use that to fund long-term, bigger growth type opportunities, not to service short-term debt. So when you're looking at companies, look for anything that's got a 1 or higher, and the higher the number, the better. But if it's below 1 in its current ratio, be a little bit more cautious on it. Really dig in deeper on that company and see if there's anything that might be problematic on the horizon, particularly for the industry as a whole, or that company in particular, because a short-term shock to the system in the industry or that company, if they're having a below 1 current ratio, that means they could be in trouble real fast. So if you want a riskier stock, then look for something with a low current ratio. But over 1 and above, that's a little bit more solid of a stock, meaning its current ratio, able to make its current payments. So when you're looking at liquidity to see if a company can make its short-term debts and make its short-term payments, current ratio is very popular, very good. It's usually a pretty good ratio. But for those who want a more stringent test, something that's a little tougher than that, that's where you'd look at the quick ratio, otherwise known as the acid test ratio. It's very similar to the current ratio, it's just tougher. It's a tougher hurdle to get over. It's something you'd look at the balance sheet for, and the quick ratio is looking at its current assets of an organization minus the inventory, and inventory being an asset, right? You own those goods that you want to later sell. So current assets minus inventory divided by the current liabilities. So it's like the current ratio, which was all your current assets and all your liabilities, current liabilities, and then you do that factor as a ratio. The quick ratio is taking those current assets, but it's taking inventory on it, basically reducing that current asset number. It's reducing the number of current assets if you take inventory out, which makes it a tougher number to have a number above 1. Let's say we said in the current ratio it's below 1. That's really troubling. It makes it harder because you've now taken out a whole chunk of inventory that has value. And the reason that it's done in the quick ratio, it's for somebody who wants a more stringent test of that current ratio, basically a more stringent test to say, or a harder test in terms of, can this company meet its short-term obligations? Because the thought behind it is, if you think about inventory, let's say you're looking at a retail company that has a lot of inventory. They might have inventory in warehouses, they have inventory in their stores, they might have inventory in these stores all over the country or the city or the world. They could be all over the place, right? All this inventory, and it takes time to sell inventory. You can have a sale and stuff and sell down your inventory, but still it's a lot harder to sell inventory than to just take cash out of your cash account as a company. So the quick ratio is taking that, saying, let's take inventory out of this equation because we know that's not as current as we'd like it to be. We want a tougher test, and we want a tougher test to see how strong this company is in its ability to make its current debt, to service its current liability, so to speak. And that's how we take inventory out. So the quick ratio only looks at those assets minus its inventory, and then all those current liabilities stay. So if you've got a company that's got a good current ratio, but then when you look at its quick ratio and it's really lower, it's going to be lower, but it's going to be much lower, maybe troublesome compared to other companies in the industry, well, that might mean that they're carrying a lot of inventory, for example. You might want to look at things like an inventory turn ratio or look at other things, because now that's a little troubling. It's like, yeah, we have a lot of inventory that's just basically building up our assets, building up our current ratio, but really to liquidate all that inventory, and we always need inventory on hand for our customers at some point anyways, that could be troubling. So if you see companies that have maybe low current ratios and you're really concerned about it, look at its quick ratio and see how that compares to the industry. Maybe it's okay, but it might also be a real indication that there's danger ahead. And you see a company that has great current ratios and great quick ratios, heck, at least with that company, it's great with its short-term liabilities and able to meet those short-term liabilities. And it's got great liquidity. Now, as we know, there's lots of other factors, the pricing factors, the equity, all sorts of different types of evaluations to look at. But when you're looking at these liquidity ratios, the current ratio and the quick ratio, using these two simple ratios will really help you understand a company and its ability to meet its short-term needs. When we talk about liquidity ratios, that's all about the short term. Debt ratios are all about the longer term. So where a liquidity ratio, like the current ratio or the quick ratio, is looking at current assets and liabilities, debt ratios are looking at more things of the overall or total picture than things like total liabilities and how they're able to service that. And one of the most popular in terms of debt ratios is the debt to equity ratio. In fact, things you have out there like PE or price earnings ratio that's used a lot. I think that one that's used also a lot from a lot of people is debt to equity ratio, because you're trying to see how much debt is out there and can the company service that debt, that long-term debt, and how does that compare to equity, which we're equity owners, we're owners of shares, and thus that's equity. So let's take a look at the debt to equity ratio, real common ratio that you'll be probably using quite a bit. First off, this is all coming off the balance sheet, like those liquidity ratios, and you're looking at the debt in comparison to the equity. So you're taking your total liabilities right off the balance sheet. What is the total? Not current. Now you're looking at total liabilities, and you're dividing that by the total shareholder equity. That's you and I as shareholders. How much shareholder equity do we have there? And we're comparing basically the debt versus the equity, because companies need money to expand and grow. A lot of that's coming from current income. That's where we want to grow, is from earnings per share. We want income coming in so they can then invest in the company, or maybe invest in us by giving us a dividend payout. So income is great. But this, we're looking at how much of our company is being serviced by debt, money we're borrowing, versus shareholder investment. And if there's a lot of debt, well, that's maybe not necessarily a good thing at all. And it measures that relationship between the amount of capital that's been borrowed, the debt, versus the amount of capital that's being contributed by owners or share owners like ourselves. We're comparing that debt to equity is what we're doing. And as that ratio increases, so as you have a bigger debt to equity ratio, the stock actually becomes more risky, because they might have trouble meeting that debt obligation or servicing that debt. If you can't pay your debts, well, what happens? You go into bankruptcy, right? That's a terrible thing. Or you got to continue to borrow more debt to service your current debt that's coming due, and it's this bad downward spiral. And you can sometimes see companies that they think they'll turn around, they say, yeah, we just another quarter, another year, we'll be fine. We're carrying a lot of debt. Don't worry. We got this new product in the pipeline. It'll be great. But meanwhile, they're piling up lots of debt. And if you see companies in comparison to their industry, where you want to compare once again, that are, or even the broader market in this case, that have these real high debt ratios, that should be concerning. So look for companies, when you're comparing them, that have low debt ratios is a good thing. Now, all companies, well, not all companies, many companies carry debt. That's okay, because they're borrowing money. They're going to invest that debt in equipment or factories, or maybe buy another company, a merger or acquisition, and looking at your ROE or return on equity, maybe they're going to take that debt and things will be great, because they're using this debt, and it's going to be they're going to make more on their debt than that they're paying out as far as interest on that debt, and overall paying the debt back is the idea. But that's like a smaller part. You don't want it to be a big number, especially in comparison. So overall, when you're looking at debt to equity ratios, bigger is not better in this case, bigger is better. So lower debt to equity ratios, or even no debt, is a much better thing to look at. But don't be surprised. Most companies have some debt. Some debt is okay. Some debt is good, actually, to help fuel growth. But just watch out for those big companies, or those companies with a big debt to equity big debt to equity ratio, because that could be really concerning. Now let's look at the interest coverage ratio, another real good ratio. It can get a little wacky as far as understanding it, so bear with me a little bit on this part. But the interest coverage ratio, in a nutshell, is looking at how is my firm, the company I'm looking to invest in, are they able to make their payments? Are they able to make their interest payments on their debt that they're carrying? Thus, it's in the debt ratio bucket as far as these different ratios that we have out there, like debt to equity would be in the debt ratio bucket. And if you got maybe a higher debt to equity ratio company, you might be thinking, ooh, that might be a little risky. I wonder if they're able to make their payments. How are they doing making their payments? Well, the interest coverage ratio is right there for you to help you out with that, answer that question. So it comes off the income statement, and you're looking at your coverage ratio, or your interest coverage ratio is calculated by looking at your EBIT divided by interest expense, right? And so you're thinking, oh, what's an EBIT? Come on, what's an EBIT? So EBIT is earnings before interest and taxes. It's a measure, a financial measure, accounting measure to look at basically your operating income. How much income are we getting from operations? And that's what you want to know in this case is, are we getting enough money coming in operationally to then service our debt, to service our interest? So that's why the interest expense is backed out of that, because we want to get a comparison of those numbers in terms of a ratio. This also can be known as the times interest earn ratio. ratio. So if you ever see TI ratios or times interest earned, or ICR or interest coverage ratio, essentially they are the same thing. So they measure really the same thing. And how well can a company, meet its interest payment obligations, right? If I can pay my interest, if I can pay my debt, then I can keep going and continue to earn more money and all that. Just like you might own a home or a car where you're paying regular monthly payments. It's the same thing. Interest coverage ratio is looking at those regular payments of interest, and can a company, service that debt, and are they making their payments? So maybe they have a large debt to equity ratio, but they're having enough operating income coming in that they have no problem paying their debt, and they're able to use that borrowed money to fuel this fast growth. Heck, that might be a great thing, particularly for a growth company. So any company that has a debt or an interest coverage ratio that's lower than 1 or 1.0, that's usually a sign of trouble, right? You want that operating income to be bigger than that interest expense, in terms of a ratio. So you want that to be a bigger number, and the bigger the better in this case. So if you see anything less than 1, that's really concerning, especially in comparison, in correlation, that is, with the debt equity ratio. You see with somebody with a high debt equity ratio, they're carrying a lot of debt, and they're having a very low interest coverage ratio, so they're having a hard time paying that debt. And then you might be looking at their earnings, their sales, and other stuff. There might be a lot of warning signs around that stock. You might want to move away from that stock and look at somebody who's carrying less debt and has no problems with their interest coverage ratio because it's above 1, and hopefully quite a bit above 1 in comparison to others. But certainly being above 1 is where you want to be in the interest coverage ratio. Okay, so there's some good ratios out there to evaluate stock prices and dividends and things, and debt and equity and all sorts of things. But we also want to look at a firm and say, well, how good is the management team? How good are they using some of these things that we're doing? And is there some numbers, so some numeric things, some quantitative data we can look at beyond just the qualitative data of, like, they say they talk nice or maybe they seem like smart, nice guys. We want something maybe a little bit more numerical to prove it to us. And that's where efficiency ratios come in. They're a quantitative or a numeric ratio that is looking at management efficiency, basically. And one of the most popular out there that you can look at is the asset turnover ratio. Basically, it's looking at how fast are we turning over assets in relation to sales. You look at the income statement, the balance sheet. If you did want to do the numbers by yourself, you don't have to. You can always find places that will list a company's asset turnover ratio, usually on their own website. But the formula is they're looking at sales. You're looking at your sales or revenue. You're looking at sales. You're dividing that by your average total assets, how much total assets you got. And when you're looking at it, you're looking at the efficiency of those assets. So it's similar to ROA, like return on assets. But the asset turnover ratio is really looking at how good is the company at using its assets to make products that sell, to make more sales, right? So you're looking at sales as a number and looking at assets in comparison. How fast are we turning over those sales in comparison to the assets? So, for example, if company A reported $100,000 in sales, and it owns $50,000 in assets, right? So that's its equipment, its factories, the different things it might have. It has $50,000 in assets. Its asset turnover ratio would be 2 times, right? For every dollar of assets that's owned, it's generating $2 in sales each year. And if you look at things like profitability margin and all that, you can kind of figure out, well, if I have $2 in sales, this is how much profit will come down. And then with that profit, how much of that profit is going to go into, shareholder equity, or how much of that profit is going to go maybe pay out in a dividend to me, which is great, or how much is being reinvested in the company. So you can see how some of these ratios tie together. But it's really about efficiency, right? Management and leadership in business is all about being efficient in managing scarce resources. So assets is a scarce resource. In this example, the company has $50,000 in assets. It doesn't have $2 billion in assets because they just can't afford to buy all that. So they have $50,000. But with that $50,000, how much in sales are we making with that $50,000 in U.S. Sales? And that's where the $100,000 comes in. So with asset turnover ratio, you can see the bigger the number, the better. If you had more sales in comparison to 50,000, you would have a higher number than 2. Or if your 50,000 was less and you still had the same $100,000 in sales, your asset turnover ratio would still be high. It would be over 2 in this case. It would be still a higher number. So more sales you have, the good. Less assets you're using to make those sales, that's great too, and that's how the ratio is using it in comparison. It's really about efficiency, and companies with a good asset turnover ratio in comparison to their competitors are saying, yeah, we're able to use our assets much more efficiently and better than our competitors. And that's a good sign.
In this lesson, we're going to take the ratios that we've learned about and use them in real life and actually compare a couple companies against each other and see how they compare about these ratios. And mostly what we're going to learn is where to find these ratios fast and easy. You can always calculate it yourself, which is very time consuming and maybe prone to error. You can always dig deep into the annual reports and stuff, and that's always good as well. But there's some nice sites as far as finding these ratios really quickly and easy. You can certainly look at Google Finance, Yahoo Finance. I use them a lot for a lot of different things, but found one actually with Fidelity that's pretty good, and we're going to show you that. We're going to do a demo in just a second here. A couple things when you're analyzing ratios. Reminder once again to consider the industry, that you're comparing companies that are in the same industry works best. I mean, that doesn't mean you can't compare companies outside of different industries. Just understand that different industries react differently with different ratios sometimes, or some ratios might be important in some industries versus others. Like if you're a retailer, inventory turnover ratio is very, very important to maybe a company that doesn't carry much inventory. So keep those things in mind. And when you're comparing companies, it's best to compare them within the same industry and compare them against each other. There's some easy ways to compare them. There's some good free online tools. We're going to look at one here that I like because it really gives me all the information really, really quickly, all in one site without having to jump around at least too much. Reminder also for this demo here, it's really for education purposes only. The purpose of this lesson is not necessarily so much analyzing companies as far as picking one over another, that's sort of a different type of lesson, but we're going to look at ratios and where to find the ratios, and that'll get you a starting point, and then from there you can kind of dig in deeper with the companies and figure out what fits best for you. So with this educational demo, I'm not making a specific stock recommendation as far as one company over another, but I am going to tell you which company's ratios might be better than another and other things you might want to look for or consider. So just think of that in your mind as well. Also, when we go into this, we're going to go into Fidelity, happen to have a good research type of tool. A lot of online brokers and things have great online tools too. So if you're using an online broker like an E-Trade or TD Ameritrade or something like that, they might have even better tools that you get by signing up with them, or your full service broker could do this for you as part of their full service. I'm going to show you something that's free that anybody can use, but even before we look at that, if you're already doing business with a company as far as who you're buying and selling your stocks from, then you might want to look at their tools because they might be even better. But this is a nice free tool. You can see the link here as far as looking at. And for the purposes of this particular demo, you can probably tell we're going to look at Coke and Pepsi, right? Coca-Cola and Pepsi, two big, large beverage manufacturers, and so we're going to look at them to learn about ratios. Okay, let's learn about ratios and kind of some tools to compare a couple companies against each other real quick and easy. And you know what? Fidelity, who is a big mutual fund supplier, has a nice comparison tool. I mean, you got Yahoo Finance, you got other people out there that are pretty good, but I kind of came across this. Fidelity's pretty good. So let's take a look at this one. It's free to open to everybody here. It's hard to find, so you want to go under this eResearchFidelity.com. If you go onto the Fidelity site, you can kind of search around and find it by the menus. Otherwise, just go right here to this particular site. It'll take you to their Stock Research Center. And once you're here and you know some companies you want to compare, over the left here is where you can enter your company name or symbol. We're going to look at Coke and Pepsi. So if you're not sure what the symbol is for Coke, you can just start typing it, and you can see it'll start popping up here. Coke, Coca-Cola, different things. I happen to know it's KO for Coke. So we're going to pull up Coke first. So we're going to pull up your first company first, and then we'll look at Pepsi side by side. But first thing you got to do is pull up one company first. So let's do that. So here's a snapshot of KO, or the Coca-Cola Company. They're a beverage manufacturer, of course. Make a lot of things like Coke and Diet Coke. They own a lot of other companies too as well. And this gives you information on them, just a quick snapshot. Price changes every day, of course. You can get more information over here on the left-hand side. But we want to go right here where it says compare, because we want to compare Coke versus another company, and then we're going to, from there, we're going to see where we can get the statistics real easy, or excuse me, the ratios real easy. So right now where we've got Coke up, you can see we've got a table here. Up in this little part here is going to be a real key drop-down menu where we can find different pieces of information that we're going to go into in just a second. It automatically defaults to key statistics, like its current price and a little chart and all sorts of good stuff that's in there as far as some current key statistics. So, and as you dive into it, you can start getting all the different ratios here for Coke by using these drop-down menus. But before we do that, since we want to compare two companies, we're going to figure out Pepsi as well. Now, let's say I happen to know that PEP is Pepsi, but if you didn't know, you can look it up. You can go over here and look it up like Pepsi or whatever. I just happen to know that Pepsi is PEP for its ticker symbol. So you'd want to know your ticker symbols beforehand. All right, so here's Coke, here's Pepsi. You can see it's Coca-Cola Company, Pepsi-Cola, you know, direct, very much so direct competitors. Now let's compare the ratios between these two companies and kind of see where we can find the information and how to interpret this information based on what we've learned so far around ratios. So we have these 5 categories, right? We had valuation ratios, profitability, liquidity, debt, and efficiency, and there were ratios inside each of those broad categories. So let's take them in order. Let's start with profitability. So on here, I'm going to go under the drop-down menu, and I'm going to find, or excuse me, not profitability, we're going to go under valuation first. So we're going to first go into valuation. So you can see off to the left-hand side here, here's valuation. I just click on valuation, and now it's, you know, changed my information here under Coke and Pepsi in these 2 columns. And as I scroll down, I can start finding some of these valuation numbers. Like we're looking for things like the price to earnings ratio or PE ratio or the PEG ratio or price to sales, you know, some of those types of ratios. So let's see what we can find here. So first off, price to earnings. You can see here is price to earnings. They got this year's estimate or versus next year's estimate. Let's say we want to look at something that's a little bit more oriented towards this year. You can, you know, pick either one, but you can see, you know, Coke is at 22.1 and Pepsi is at 22.2. They're pretty close. So, but that's where we'd find our price to earnings. By the way, at the end of the lesson, I have a spreadsheet all set up where we're going to have all the ratios together on one spreadsheet so you can see where everything's at. So you can get a kind of final determination, maybe, on these 2 companies as far as the information. So right now we're going to look at just where to find the information. So when you're looking at your own companies, you can find it. All right, so here's price to earnings. You can see that. Maybe you've looked ahead looking for some other things because you can find other things under here too. Like here's the PEG ratio. You can see Coke here's PEG ratio and Pepsi's PEG ratio. So we'll be capturing that information. We also want to look for price to sales and price to book, right? Well, here's price to sales down here at 4.22 for Coke, 2.45 versus Pepsi. And then price to book here as far as for both of those as well. 6.83 versus 12.43. And as a reminder, for all these valuation ratios, you typically want them to be lower the number the better. That means you're getting a good value for your price. The exception would be the PEG ratio, where if you want to both be under 1.0 as a reminder, once again, this will all be on the spreadsheet we'll look at the end, so you can see they're both a little higher than 1.0. So if you're a value investor, these might not be great value stocks for you at this point in time. And by the way, ratios and things like stock prices are all at a particular point in time. All right, so those are some valuation ratios, and that's why I like this site pretty nice here from Fidelity at the eResearchFidelity.com, because boy, I just found out all my information for valuation right there, except for dividends. Dividends was in the valuation category as well in terms of our key ratios. And we can find them easy because they have their own little spot. Here's dividends right under here in the second one from the top. So if we look at dividends, they'll give you all sorts of dividend information. How much is the dividend? We're looking for dividend yield, and we're looking for dividend payout ratio. So yield, the higher the number, the better. And here is a dividend yield percentage on an annual basis. You know, Coke 3.32, 2.86 for Pepsi. So Coke will pay us a little bit more per share if we own that company. Also, we want to look at payout ratio, which is, we want that number to be a lower number as far as the payout ratio, and we're also really concerned that anything that starts getting over like 70% might be a little concerning. So if we look at our payout ratio, you can see they both pay out pretty high. They're 80, 85, just something to keep aware of. But you can see one number that's not part of our top ones, but something I look at when I look at dividends is growth rate. You can see a 1 year and a 5 year average. You can see they're growing their dividends. So these are long-term dividend paying companies that pay a big chunk of their money out in dividends. So even though they're running a little high, they've been paying consistently for a long time and they're growing their dividends. If I saw a high payout ratio like this and dividends were at a negative rate or things look bad there and I dug a little deeper and they maybe cut their dividend or whatever, that'd be certainly a warning sign if you're looking at a dividend stock. But right now we know the payout ratio is at 80.46 and 85.03. So that's our valuation ratios. Now let's look at profitability, right? So can we find these ratios easily as well? See, everything's right here, really nice. So let's go into profitability. It's listed as profitability here. So easy peasy, as they say. They give you lots of ratios. Remember, there's lots of ratios out there. we're looking for three of them: return on assets, return on equity, and profit margin is what we're looking for. So profit margin, we scroll down here, or we don't have to scroll down too far. We're right here at profit margin. You can have the most recent quarter or the trailing 12-month profit margin. If you want a little bit more data or statistics around there, that might be a little better time frame. You can even go back, look in the annual reports and go back further, but they give you at least a starting point here, and you can see Coke runs a bigger profit margin, which is good. So every sale they make, they're making more money on it. So that's really excellent. Helps to pay those dividends and things. And if you scroll down, you'll see, return on equity and return on assets right down here at the bottom. Return on equity and return on assets. So Pepsi gives you a better return on equity, and Coke gives you a little better return on assets. Once again, we'll have the spreadsheet where we'll have this all summarized, so you don't have to memorize or record anything right now. We're just looking to see where we find this stuff. And maybe we're looking at things like ROI, return on investment. Higher the number, the better too. There's other types of information out here. Just don't get too consumed by paralysis analysis or paralysis by analysis. By the way, we're going to come later to an efficiency ratio, which is inventory turnover. They happen to have it here under profitability. The inventory turn, the higher the number is better. So you can see Pepsi here is a little better than Coke as far as inventory turn. So they happen to list it under profitability versus it's really more of an efficiency ratio. So be aware, sometimes they can end up in different spots. So let's look at liquidity. And one thing you'll know for liquidity, how are we able to meet our current debts, not our long-term debt, but our current debts? How are we able to make those payments? And if you see here, there's nothing that lists liquidity, because sometimes things are listed just in different ways. So on this particular site, it's under cash and debt, is a way to kind of find it, our current cash and our long-term debt. So you'll find that information under here. But if you're looking for liquidity in this site, you won't find it there. So if you're looking at other sites, be aware that your information might be hidden, or maybe not hidden, but just in a different spot. So we're looking for the current ratio and the quick ratio. How good are we at paying our current bills? And they're both at the bottom here on this particular site. Current ratio for Coke, 1.2 versus 1.4. Once again, you want these numbers to be greater than 1.0, that you're making your debts. And the quick ratio or asset test ratio is a tougher number than the current ratio, as we learned. So, that number should be lower than the quick ratio because of how it's calculated. And once again, if you're at a 1.0 or better on a quick ratio, that's really good. That means you're really, you're making your payments, so you seem like a very liquid company. You're not in trouble. If you're greater than 1.0, if you're way lower than 1.0, then that might be a little concerning. Well, more than a little concerning. Next, we want to look for debt. And we also find that under the cash under this cash and debt area, and we're looking for debt to equity, and we're looking for interest coverage ratio. So debt to equity, you can see that right here under total debt equity. You can see a trailing 12 months debt to equity, or a most recent quarter debt to equity as well. So you can see they're pretty similar. But you can see their debt to equity. So they have pretty good sized numbers as far as debt to equity. Lower the number, the better as far as your debt relative to your equity. And then lastly, we were looking for inventory. Why do I keep saying inventory? Interest coverage, our interest coverage ratio, and that's right here above the current ratio and quick ratio on the bottom under debt ratios. And you can see our interest coverage is right here as far as our interest coverage ratio, and you want that to be greater than 1.0, and they're both knocking that out of the park, so we're not worried about making our current interest. Anything could change at any moment, but right now it looks pretty good. All right, and then lastly, we're looking at our efficiency ratios as far as that category, looking at how fast are we turning over things, and there isn't really an efficiency thing in here. Sometimes it might call management efficiency or something, or it might be hidden in another area. So in efficiency ratios, we're looking at asset turnover and inventory turnover. What we knew under profitability was that inventory turnover ratio towards the bottom here. So that's our inventory turnover ratio that we'll capture. And the one thing that's the one downside on this site is no site's perfect, and this one doesn't happen to capture asset turnover. So if you really want to dig in deep and get into asset turnover, you can look at return on assets, which is a good number to look at if you're looking at assets. So once again, that's found under the profitability, the return on assets. Let's go down here. You can see return on equity, return on assets. But if you wanted to look up asset turnover, not on this site, I happen to look it up on the on their individual websites and things for Coke and Pepsi. You could also find it in some other places too as well, as far as asset turnover. So it's not listed in this site, but you can always get that right again from the companies themselves if you want to do your due diligence and get to every type of ratio. Other return on asset can be very helpful as well. So the nice thing about this site from Fidelity, once again, look at if you have your own sites that might be like you were hooked up with a particular like online broker or something like that. They have some pretty robust sites, but this is free, and see how we were able to easily get all the information. So we got all the information. Now I have a spreadsheet here so we can kind of compare, well, how they end up doing. How do we compare at this moment in time? And there's a lot more ratios. There's a lot more qualitative information out there too, but right now in this moment of time, how do they compare? And basically, I've got Coke and I got Pepsi here, and if it's highlighted in yellow, that means that they are better than the other company. Doesn't mean that's necessarily great overall, but they're certainly better than the other company. So if you look at, let's say, this PEG ratio here, 8.07, 4.18, we would like actually something that's below 1.0 generally is better in a PEG ratio. Particularly if you're a value investor and you're looking for those contrarian stocks, those stocks that are on sale, or something like that, you might look at these and say, well, their price relative to their future earnings growth, which is what a PEG ratio is looking at, as we learned. You're not seeing something that's really undervalued here. Doesn't mean it's not a good stock, not a good dividend-paying stock or anything of that nature. But if you're searching for low PEG ratio, below 1.0 stocks, you probably would pass up these two stocks, even though Pepsi has a lower number and might say, yeah, its price relative to its future earnings growth. You're getting a good price in comparison to Coke is how you'd look at that. Once again, for any of these ratios, review the lessons on the individual ratio to learn more about them in great detail if you happen to skip ahead to this one, or this is just kind of the summary and where to find all the information. So if we look at it, we can see, Pepsi has got a good price to earnings. Once again, how it compares to the market, industry, all that could be different, but comparison to Coke, just slightly better than Coke. PEG's a little better. Price to sales, it's got a lower price compared to its sales. Coke's got some good book value there, so that's a good price to book. So you're getting a lot of good company for your price you're paying. Better dividend yield and better dividend payout. They both are consistent growth payouts, but they're better dividend yield and dividend payout between those two. Let me go back to them because I put it in, I think, a wrong number there. Let me just double check that on that dividend payout. 80.46. So I'm looking at dividend payout. Oh, I was looking at the last quarter. So the last quarter they paid at 43.51, which is a good sign for the last quarter. But if you look at the trailing 12 months, they're at 80.46 and 85.03. So that's the thing with ratios. You got to kind of look at what you're looking at there. So if I'm looking at last quarter and most recent data, I'd say, boy, they're doing great. Under 70%, pretty good. But over the last 12 months, they're a little high. They're in the 80s. So maybe that would be concerning. You need to kind of figure out, well, how's it look maybe going forward? Profitability, they got good margins. Pepsi runs a real high margin. That's our nice high return equity, a nice return assets for Coke. I meant to say that Coke runs a real nice high margin in comparison to Pepsi. So if I'm looking at Coke, I'm thinking good dividends, good dividend payout, at least over the last quarter, good profit margins. So when they're making sales, they're making more money that can help pay those margins. Liquidity, they're both above 1.0 with these liquidity ratios, so no worries there with either one. Pepsi's a little better. Debt, the lower the better, and certainly interest coverage ratio, you want that to be greater than 1.0, so you can see that Coke's got a nice balance sheet around debt to maintain that debt. And then efficiency, we looked up that asset turn off site on their annual reports and different information on their website because it wasn't in the Fidelity site, but the 0.13, 0.12, they're right there. And then inventory turn, Pepsi has a nice inventory turn. So if you're concerned about slowing sales or concerned about, turn on inventory, that's where Pepsi maybe stands out a little bit better. So what does all this mean? If I was to look at this right now, I would say there's no clear-cut winner. There's some things I like about one versus another. I like this dividend payout for the last quarter, and I like that I get a nice yield, but maybe Pepsi's a little bit more on sale. I mean, actually lower the number is better, so that should be Coke here on a price to earnings 22.1. But they're so similar. It's almost a push there as far as Coke and Pepsi. But nice profit margins from Coke. Both are pretty good. Nice inventory turn from Pepsi, but nobody's standing out as a clear-cut winner. And if I'm looking for something that maybe is, again, a low value or undervalued stock, looking at that PEG ratio, I'm not seeing undervalued stock here. See, I see pretty good valued stocks relative to their future growth. Their earnings growth is how companies are evaluated as far as paying out things like dividends, or how they're evaluated from their potential earnings per share and their price to their earnings. Having earnings growth is really important for that. So Coke and Pepsi, good. And so where they typically fit, they're big companies, large cap, dividend payers, long-time dividend payers, good, solid Fortune 100 companies that are going to consistently pay you kind of a solid dividend. But if you're looking for something that's undervalued, or you're looking for that high growth stock that might have a real high price earnings because you're expecting it to be the next Google or something, then these wouldn't be the companies for you. One last thing here on this as well, we go back to our original kind of evaluation thing under the key statistics here, and you can kind of see their week over the last 52 weeks in this particular snapshot. Pepsi's done a little better over the last 52 weeks, 13% versus 7.64. You can compare that to the market and all that kind of stuff. But if you look here under sector and industry, you can see they're both in consumer staples, like consumer type goods is another way to think of that, staple, type goods. And they're both in the beverages category. They're not in retail, they're not in grocery, they're beverage manufacturers. They make beverages. So you would find them in the beverage category. So this means it's a fair comparison. Now it's easier with Coke and Pepsi because they're pretty national, international, known brands. So it's easy to know they're maybe in the beverage sector. But if you take another company that might be a smaller cap company or a newer company, you might not be as sure where do they fall in. Are they in the beverage sector, or are they in this another sector or something of that nature? Okay, so the whole upshot of all this is you can use this as a nice tool to get your ratios quickly. In this lesson, we're going to look at a basic stock screener. Actually, you can use it for stocks, bonds, and mutual funds, and that's from Yahoo Finance. And so we're going to navigate to that in just a moment here, and I'll kind of show you how to use these kind of screeners, at least from a basic level. And then on the next lesson, we're going to look at more of an advanced screener where it gives you more options as far as to choose from, and that's something you'll probably end up using more. But first, let's get started with this basic screener here and look at how to maybe sort down from all the thousands of stocks and mutual funds down into something a little bit smaller to look at. Okay, we're over at Yahoo Finance. Actually, where you want to go, you can see on the top here, screener.finance.yahoo.com. So it's a little bit hidden as far as finding, but it's a nice, real good stock screener, something basic, something easy to use. So first thing you want to do when you come here is you can see you have a stock screener, you have a bond screener, and a fund screener. And since this is of course, we'll look at stocks. You can look at individual stocks here or at stock mutual funds. In fact, let's start by looking at stock mutual funds, just something real easy to take a peek at. Then we'll look at individual stocks and we'll kind of screen for those as an example. With all these examples, once again, I'm not making any recommendations as far as individual stocks or funds or anything of that nature. Just want to show you educationally how you can use a screener or use tools that can help you with your investing. So with that said, let's go to a fund screener. So I'm going to click on fund screener. You'll see how the screen has changed. And at the top, you'll see this overview, and you have these different choices you can make. And that's the deal with these screeners, is you basically make choices, then it'll spit out some possible funds or stocks for you to take a look at. So the first thing is the category. We're looking at mutual funds right now. We want to look for stock mutual funds. You can see you can look at any U.S. stock fund or hybrid, or you get into bond funds or all sorts of things. And as you scroll down, you'll see there's lots of choices. See, there's all these bond funds and stuff. But let's say we're looking at, let's say a large value fund, or let's do a mid-cap, let's do a large stock fund. Let's say a large value, which is kind of like both a blend of, or excuse me, not a value blend, but let's look at a large value. That would be like a dividend payer, or something that's looking at, dividend type stocks, or you could go growth or blend of the each. Let's go blend. Let's go growth. A blend, which is a blend of growth and value. So you get a nice mixture of stocks. You can choose a particular fund family if you want, different fund families out there. We're going to leave that blank so we can kind of choose from anybody. Rank and category, do you want to be a top performer? Are you looking for maybe a bottom performer? They'll rebound. Not so sure about that. But let's say we're looking for somebody, at least in the top 20%, maybe top 10%, we can narrow it down. But let's start with the top 20. These ratings are from the Morningstar service. Morningstar also gives you good stuff with mutual fund searches and things too, and a lot more information beyond just the mutual fund's website too. And Morningstar gives ratings like on a 1 to 5 star rating. So, a 4-star rating is pretty good. 5-star would be the best. You can even get like a little information on returns, like high compared to other funds in that category or low risk ones. We'll leave that blank for now. You can choose if you want certain performance measurements that you want to look at. Note past performance, of course, is not a guarantee of future performance, but here you can see, let's say like a 3-year return analyzed, what that would look like. So let's say we were looking for a large cap blend fund, and we're looking for folks that maybe do better than 10%. Purchasing and fees, you can talk about initial investments, front-end loads, no-load, load funds, expense ratios. Let's see if we can find something below 1%. It might be a little harder to find, but let's see. And then you can go into different types of holdings, what type of cap, all that stuff. You kind of get that in the growth part. And you just basically fill in these basic blanks here. And then you can just hit find funds, and we'll see if any funds pop up. As you can see, lots of funds came up. There's like the next 20, and you can see there's all sorts of these funds here. So let's narrow our search down a little bit. You can see the ratings, the rank, they're all in the top 10%. Morningstar ratings are all 4 or 5 star or better. Low expense ratio, good 3-year return, so large blend stocks. So let's narrow this down a little bit further. Let's say we like that information, but instead of the top 20%, we want the top 10%, and we want 5-star rated funds. And so we want the best of the best. And here you can see we narrowed it all the way down to 1 page, and you can see at least from a 3-year analyzed return, it's got them ranked, or it doesn't have them ranked, but you can see 3-year analyzed return, 5-star rated, low expense ratios, top 10% of their category, large blend, and that might give you an indication of some different funds that are out there. So if you like dividend funds, for example, this T. Rowe Price Dividend Growth Fund might stand out, and then you can click on performance or risk and get more information, right from Yahoo as far as, more information than on the T. Rowe Price Dividend Fund, their ticker symbol, all sorts of information. Their top 25 holdings, against Pfizer, you can see these big large cap stocks. So that'd be like, let's say, getting after a large, looking at mutual funds. Let's take a look at Stoxo. Let's use this basic stock screener to look at some individual stocks. And same kind of thing, I clicked on stocks here, I got all these choices. This breaks it down by different categories or industry. You can leave that blank for anybody, but let's say we're interested in large pharmaceuticals, which in this part happens to be under drugs. So we're interested in drugs, right? Everybody's interested in drugs, right? But we're going to look at some drug, if I can spell, drug is spelled with a D. So we're going to go under drug, healthcare manufacturers. We're going to look at the major ones. Let's say we're looking for a high-end large company that pays great dividends that's in the healthcare market. That's what we're looking for. So we'll see if the screener can help do that for us. So we're going to look at drug manufacturers because we want a drug manufacturer. We could always go and look at this other too. But we're going to look at the big guys here and their major. You can choose if you want them to be hard index. You can look at their individual shares and market caps and all sorts of different things. Let's say we want big guys, so we want to have at least a market cap of, well, that's pretty big. Let's say 100 billion. Let's see what comes up. And let's say we want a dividend yield, so that's our a minimum dividend yield of let's say at least 2%. Maybe we want to go a little higher, and we want a high-paying dividend stock. That's what we're looking for in the drug area. So it's only going to pull up those drug pharmaceutical companies. Beta is, you remember, anything that's below 1 is less risky or less volatile than the index. If it's above 1, that means it's more volatile or more risky than the index. The price will change much more. So let's say we're looking for large cap, dividend payer, at least the index are less risky. So we got it as a minimum, we don't want a minimum. We want it to be a maximum risk of 1.0. So we don't want anything that's, super, super risky as far as volatility. And then you can get into like sales margin, profit margin, if you were looking for certain price to earnings or price to book ratios or price to sales. If you like value stocks, maybe you want something with a low PEG ratio, which looks at price relative to its earnings growth, and then you can even look at analyst estimates and all sorts of stuff. But we want to get a start here and see what pops up. We can always narrow down later in this basic screener. And as you can see, for a basic screener, it's got good starting information for you to kind of narrow your choices down and then really dig in deep with the financial statements and different things. I just clicked Find Stocks at the bottom here. I'm sorry I did that a little too fast. Down at the bottom here, I click Find Stocks. And with that information, really narrowed my choices down. I got down to 5 drug manufacturers, major drug manufacturers. You can see they're all big, large market cap stocks. They're all doing at least a 2% dividend yield. Some are better than others, as you can see, and they're all below 1% in terms of beta. So if I'm interested in big drug companies, big market cap, pays a nice dividend, but really less risk. This might be good in a portfolio where you want some income but less risk. Here's some nice companies that are out there from this search. And you can see they're name brand companies, right? Johnson & Johnson, Merck, Novartis, Pfizer, Sanofi. These are big name, big known drug companies as far as, that you can then, compare and take a look at. And the same thing, you could go into the profile, go on these different things and find out more information about them. So that's from the stock screener. I could go back if I wanted to. Oh, one thing it has here is a nice drop down too. So this is limited, it's got me my information. But let's say I wanted to look at some extra data, like let's say I wanted to look at valuation, some of those ratios. I can just click it, and of my ones that I narrowed down, it shows me some ratios like price to earnings, price to book, price to sales, that PEG ratio, all that. So if I'm looking at, let's say, something with a low price to book, something might be a good value type of play, or with a low PEG ratio, maybe that's where Sanofi stands out. If I'm looking for something, with a nice price relative to its earnings, at least as far as this group, Johnson & Johnson and Sanofi, stand out as far as that. Once again, in comparison to the industry, in comparison to the market, that's actually maybe a little higher price ratio, but you're paying more for, these good companies. That's the idea, is you're going to pay a good price for these, well-valued companies. And you can certainly look at their performance. Performance, of course, changes all the time, but it can show you, at least it's beta and all. It doesn't have return performance. You'd have to go back in there. So actively screened is what we looked for. All right, so there's a short little demonstration on the stock screener. Once again, you just choose your category, choose some information, and you can then at least narrow your choices down. And now that I've got my choices narrowed down to, let's say, 5 individual stocks, I can dig deeper into them and start doing more quantitative analysis and also more qualitative analysis as well. And then we'll also look at a more advanced screener where I can really narrow down and maybe do some more advanced things. That's what we'll look at in the next lesson as far as a more advanced screener. But to get started, play around with this screener here to get kind of started. And it's a nice little screener for the fun screener too. So it's pretty easy. Once again, screener@finance@yahoo.com. Give it a try and have some fun with it. In this lesson, we're going to look at a little bit more advanced stock screener called FinViz at finviz.com. We'll take a look at that. I'll show a demonstration of that for you so you can see something a little bit more powerful as far as narrowing down the thousands and thousands of stocks down there to maybe a few that you can then research further and find out more information, both quantitatively, the ratios, the numbers, and qualitatively from management, strategy, goals, all those kind of things that we learned about in the course, or learn about things as far as how to pick stocks. So right now we got to narrow our universe of stocks we want to look at, and this advanced screener can really help you with that. 2 other things real quick. One, I don't make any recommendations, of course, on any particular stock. I want to just educate and show how you can use these tools to benefit you. And also, if you happen to use an online broker, an E-Trade, Scottrade, those kind of guys, TD Ameritrade, or a full service broker, they can do a lot of those things for you. And a lot of those online brokers like Scottrade and E-Trade, they have their own stock research tools as well. So if you belong to them, check out, see what they've got for screeners. But we're going to look at one that's free for everybody, and that's FinViz. And you can certainly give this a try. It's actually a very, very powerful tool. So let's go take a look at it. Okay, so we're here at FinViz. At finviz.com /screener. You can see it up here in the corner as far as how to access that, and or just search for FinViz screener. You'll be able to find it as well. And this is a little bit more advanced, maybe a lot more advanced screener than other screeners that are out there, and it's pretty good. It's really pretty good. And you can use it for looking at individual stocks, or you can use it to kind of sort through a whole selection of stocks. So right now when you get to it, you'll see listed by its name and ticker symbols here, ticker and company name. There's 300 and at least 359 pages. It keeps going. There's 20 stocks on an individual page. So you can see, boy, if I'm trying to narrow this universe, I'm down like at least over 7,000 stocks right there and more. So we need to narrow this down. And the nice thing with FinViz it gives you these choices up at the top here where you can then, kind of narrow things down as far as what you're looking for. And we'll go through an example here and then how to compare, different stocks to each other as well. So this is nice for a comparison as well. So first off, we're right here. And we want to start narrowing our searches down. So let's use for the example the same kind of thing where we're going to look for a drug manufacturer, dividend payer, safe stock that'll pay us a dividend. And let's see what kind of comes up there and see if we can kind of narrow this down and get some information how we get there. You could type in the individual tickers if you know some stocks and stuff, but let's say we don't know. We want to search the big universe of this here. You can see at the top here under filters, this is how it will narrow it down. If you wanted to be on a particular exchange, like a custom exchange, you have to pay to be that, or else the New York Stock Exchange. I never put anything in there because I want to search whatever I want to search on. Same thing with index and all that. But let's say we're looking for a high dividend paying stock, or at least relatively high dividend paying stock. So here I see dividend yield. So let's say I want it to be at least over 2%. I could go even higher, but let's say at least 2%. Well, you can see it's narrowed my choices down now. You can see there's Apple, all these different companies, all these different sectors, and it keeps going. There's over 105 now different pages of information. But let's say I want to narrow this down further. A good way to do that is by sector and industry. So if you want to kind of think about if I'm interested in a particular sector or industry, this is a way to narrow it down. So let's say we're looking in the healthcare sector. You can see all these different sectors here, consumer goods, financial, whatever, technology, you name it. And we're looking for healthcare sector. And you see my screen keeps updating. Now I'm down to 2 pages. So this is really narrowing it down because I'm at over 2% dividend yield. So anybody in healthcare who does not pay a dividend is not in my screen right now. I'm not going to be able to see that. And let's say I'm looking for large pharmaceuticals, right? I'm not looking at medical instruments or anything, but I'm looking at these large drug companies. So drug manufacturers, major, right? I click that. And boy, now I'm narrowed it down to 10 companies, right? So now I've got a nicer screen, a little bit more detailed of a screen versus like what we were seeing in Yahoo Finance, and more information, right? I can see the industry, I can see the country, market cap, price to earnings, just on this very first page, which is the overview. From here along the bottom, you can see more information too. But I could keep going as far as how I want to sort this out. Maybe I want to, put in some more fundamental stuff. Right now I've got a dividend yield, healthcare, drug manufacturer, but I could click fundamentals here. And now I start seeing things like price to earnings, price to cash, these different numbers, debt to equity, things we learned about in some of our ratio type parts as far as if there's particular ratios I'm looking for. So for example, like a PEG ratio, price relative to its earnings growth, low price to earnings growth. If I'm looking for more of a value stock, I might want to look for a stock that's got a low PEG ratio, for example, versus like a high PEG ratio. So in different ratios we can look at long-term debt to equity, quick ratio, all those kind of things that are out there. So different choices that we have. So let's say I've got my dividend in there. I feel pretty good about that. But one thing with dividends, you can see in the lower right-hand corner here, is payout ratio. It's very important that they keep paying their dividends. And so the payout ratio, how much they pay out of their earnings each quarter in dividend is important. And as we know, anything over 70% gets a little bit concerning. So maybe we're looking for something that's at least under 70%. Let's try that first and see if that narrows our field down. Well, that really narrowed our field down a lot, for something under 70% payout ratio, because that narrowed it down to, 2 stocks basically, this Abbey's and this and Johnson & Johnson, and then we could keep going from there. But let's say we want it to be, we want to leave it at that 70%, and then we can then compare these 2 different companies. I'm very familiar with Johnson & Johnson. I'm less familiar with AbbVie, but you can see some of the information there. And then as you keep going through, you can see, valuation, here's a summary of the price to earnings, the PEG, all that stuff, different numbers that you have for different pieces of information that are out there. Or you can go into financials, and same thing, you can find your ROA, which is a little hard to find in some places, return on assets. I can see my dividend yield. This is where my dividend yield is. You see where Johnson & Johnson is 2.71. Abbey is going to pay me a better dividend yield at 3.6. And you can kind of see from there, different return on equity to return on investment, all these different things, debt to equity. Now, if I was to look at this, I'd say, wow, debt to equity and long-term debt to equity, a little higher numbers as far as with AbbVie. I might be a little bit more worried about them long term versus very low debt to their equity for Johnson & Johnson. If we look at current ratio and quick ratio, those are, can I pay my current bills, as we learned from different ratios. And if I looked at this, I'd say you want bigger numbers here because you're looking at your liabilities versus your assets and liabilities and things like that, your current and quick ratio. So bigger the number, the better. You can see Johnson & Johnson much better for short-term ability to pay as well. So those are really good signs that I would look at for, yeah, I might be giving up a little bit in dividend yield, but I might feel better that they're gonna pay that dividend. You can look at ownership, you can look at performance, how they do in year to date, at least some quick numbers. You want to go a little bit deeper than this gives you, but at least gives you something over the last year and year to date. You can see Johnson & Johnson's doing better than them there as well, but past performance, no guarantee of future performance. You can do some technicals type stuff. Here's your beta is where you find, so you can sort by beta as well up in the top here, but or under technical. If I went to the top under technical, you can see beta as a choice here. Beta being a measure of volatility or risk. Anything above 1 is more risky compared to its index. Anything less than 1 is more or less risky and less volatile compared to the index. And you can see Johnson & Johnson below 1 is a less risky. There's less volatility. It doesn't change up and down as volatility as high. And you can go through, you can do some custom stuff. You want to see some charts. They give you some charting stuff. Tickers is just the name of the ticker symbols, which we saw that, so we had to search for it. There's news, snapshot. You can get all the stats in one, you can't get all the stats in one spot. That's the pay one. But you can do a nice little snapshot where it gives you kind of the chart, a bunch of information, news, a description of the company, what they do, and different some insider trading stuff from the executives. So it shows you whether they're buying or selling, and you can get some information so you can dig a little deeper without having to go anywhere else. All right, so that's an example of, let's say, how to search for something as far as with these different type of companies. Real quickly, let's say I wanted to do the same thing. I wanted an overview, but I was not interested in healthcare. I'm interested in some other area, let's say financial. All right, so now it's changed. I've got the same numbers, but now I'm at financial companies. And maybe we'll do one more quick here, a 3% dividend yield. So I want big dividend payers, but I want to be safe. I want that good payout ratio. So I'm going to go, I'm going to go up here under fundamentals, and I'm going to go to the corner, and so that's under 70% payout ratio. I'm going to make that under, let's see what happens under 50%. So I'm going to really narrow it down. Well, you can see there's a lot of people paying good dividends out here with these types of financial type of companies. Maybe then I want to limit my market cap then to just the biggest, as an example, mega. Oh, nobody's falling in that, so now I got to go to large. Anybody there? Yeah. Okay, now I've got a couple sheets where I can continue to lower that down. I'm in the whole financial sector, which includes foreign regional banks, real estate investment trusts, asset management, life insurance. So that's a lot of different companies. Maybe I want to put that down to something more limited. And once again, I can go to the industry. I mean, the sector is financial. In the industry, let's say I'm looking at, you can see these different options as far as these different industries. I'm looking at, let's say, a bank. So let's say I'm looking at regional banks. This you can see them detailed as far as where they're at. Let's say in the Midwest, the central part of the United States. Sorry about that. So let's say go in the regional banks in the central part of the United States, and I pull that up, and then that'll narrow my search. That'll narrow my search down. I was just thinking about it for a second. So you can see you can have these different choices up here as far as how to do these different types of things, how to search and how to analyze stuff. So the key parts is to really look at this first part under the description, these different things you want to change. Then go into your fundamental, which is looking at these different ratios to sort it down further. And then technically, I usually use beta, but you can look at some other types of moving patterns or chart or changes, especially if you're into charts and doing charts and things of that nature. So with that, this is a little overview of FinViz. We're going to use a little bit more looking at some individual stocks here in a second, but understand FinViz is really nice as far as a screener to really kind of give you a good overview of different stocks. You can see much more powerful to play around with. So I encourage you to kind of try some things and play around with FinViz. In this lesson, we're going to do a demonstration on buying a dividend type of stock. And with all these kind of demonstrations, I'm not recommending any particular stock or anything of that nature. Really want to just show you some of the process that I might go through or others go through so you can use it for yourself when you're looking to make your own stock picks. And in this one, we're going to look at dividends, and we're going to look at a dividend stock. We're going to focus on the healthcare area and large pharmaceutical just as a demonstration and really show you the whole thought process behind it, both quantitatively and qualitatively as well. But first we'll start with doing some basic research on some stocks and using the screeners to kind of narrow our choices down so we can really focus more on learning about stocks that might pay dividends in the category we're interested in that might be of most interest to us without trying to search through thousands of stocks. So let's get started with it, and let's start with using FinViz, the advanced screener here, to take a look at that. Okay, let's go ahead and take a look at narrowing our choices down. First off, as far as looking for a dividend-paying stock, I'm looking here at FinViz, a nice good advanced screener, finviz.com/screener. And as you can see, they give you lots of different choices and things you can use to narrow your choices down to kind of identify and then research some stocks a little bit more. Because right now, if you look at the bottom, there's 359 pages plus of 20 stocks on each page from all over the world, USA, France, Canada, and more, all beyond Europe, you name it, they're there. And we need to narrow this down to kind of help make our choices. So for this education thing, I'm not recommending a particular stock, just going to use it for education, how we walk through maybe how we might want to look at a dividend paying stock. And we're going to say we're looking at the healthcare area in pharmaceuticals, drug manufacturers. So first thing we do is we could pick our sector, right? So we go here in the middle here under sector. You got different sectors like consumer goods or financial or technology, you name it. But let's say we want to go to healthcare here. So we're going to click on healthcare, and voila, it's already changed. It's updated. You see the sector is now all healthcare in this column here. Our choices are now down to like 38 pages there. Still a lot of choices. So we need to narrow that down further. So let's say we want to look at large drug manufacturers. So we're looking at drug manufacturers major versus, let's say, medical devices or something else. We're looking at drug manufacturers, large pharmaceutical companies. And you can see we're starting to see a lot of name brand ones here. We still got a lot of choices though. So let's say we want to narrow that down even further. Well, since we're looking for a dividend stock, we should look at dividend yield. I mean, if it's not paying a dividend, we're not interested in that. So let's look at dividend yield, and maybe we want to put in a number for a certain amount of a dividend. We went over a 3 or 4%, pretty high dividend. Let's say, just to start off with, we want at least something that pays us 2%. So we're looking for a 2% dividend. And now our choices are even smaller, right? Now we're down to 10 choices that we can continue to research as far as stocks that are in healthcare, large drug manufacturer that pay at least a 2% dividend. So any those stocks that don't pay a dividend at all or less than 2% on the yield, getting us a return of a 2% return with the dividend, those have been eliminated. So now we've narrowed our choices down. And maybe I want to look at a certain market cap. Maybe instead of these 10, I just want to look at some big companies, the biggest of the big, because I want maybe I want a safe company, a company that's a pretty big company that's been paying that dividend for a long time. So I could choose like large cap, mid cap, small cap. They even have a category for the super big, mega cap, so which is an extension of the large cap. So let's go to the mega and let's see what happens with our mega. Okay, well now we're down to 3 choices here, and 3 big name mega cap drug manufacturers here. We've got Johnson & Johnson, Novartis, out of Switzerland, and Pfizer. Big drug companies, big international drug companies that do a lot of things. You probably might recognize some of these names, if not all of these names. So these are all paying this 2% dividend, so I've narrowed those choices down a little bit. If I wanted to, let's say, go out even further, I could go beyond some of these things. I could go under fundamentals, and maybe if I'm looking at a dividend stock, things that might interest me might be the payout ratio, which is over here. You can look at price to earnings, and the PEG ratio is great here. If you're looking for a value type stock, and you want to look at PEG ratio, price relative to its earnings growth. You'd be looking for some of the low price relative to its future earnings. But let's say we're looking at payout ratio, which basically will tell us what's the likelihood that they're going to continue to pay that dividend? How much of their earnings are they paying out in their dividend? And we typically like 70% or less as far as paying out on the dividend. So let's see if anybody qualifies for that 70% or less. Certainly 60s and 50s are even better, but let's do 70%. Okay, so oh wait, I chose over 70%. That's the wrong way. We went the wrong direction. So we don't want that. We want somebody who's paying under 70% in their dividend payout. And that left us with just Johnson & Johnson, actually. So, you could, I'm not saying that's where you make your choice. You want to look deeper into three, but it's interesting that they're all paying dividends, but Johnson & Johnson's only one under 70%. If we were to go down further, if we were to say, gosh, is it even under 50%? No, you see, we have nothing there. So it's not super, super duper low. Let's go to 60, just see if it pops up, if it pops up there. And it does. So we know it's at least under 60%. So that's a pretty good payout ratio. But since we want to look at these other companies, let's leave that at any right now, because we want to still at least show these other three companies, even though they might be paying a little higher than a 70% payout ratio. That's not the end of the world, just something to be aware of. Okay, so I've got information in there. Maybe from a technical standpoint, I want to go in here and I want to narrow my search down further, and I'm looking at beta, and maybe I want somebody who's going to be at a beta of 1, of 1 or less, or if it's at 1, it basically is the same risk or volatility as the market as a whole. So, things, if you want something less risky, which you might in a dividend stock, you might want a beta under 1, for example, less risky or less volatile than the market as a whole. Let's see if that does anything with our updates. And they all have a beta under 1. So that's great news. So, not real volatile stocks. They're not going to not be real risky stocks. They're going to pay that solid dividend, at least 2%. Big companies, though I did like the Johnson & Johnson having the low payout ratio. But now let's look further. Now we've got maybe 3 companies. We've narrowed it down to, you can see on this overview tab, this middle ribbon here is how we're going to compare and look at more detail now. Now it's the next step. We've narrowed our choices maybe to 3 with Johnson & Johnson, Novartis, and Pfizer. You can see some initial numbers like the price to earnings. You can see Johnson & Johnson has a lower price relative to its earnings. That makes it a better value in terms of stock as far as what you're paying for it versus Novartis and Pfizer. And you can, kind of see volume and some different numbers as well there too. So let's just start going through this ribbon here, because this is going to maybe show us some more stuff. First is looking at valuation, some of these valuation ratios. We looked at that price to earnings. We saw that was lower. You can see in terms of market cap, Johnson & Johnson is even bigger than Novartis and Pfizer in terms of market cap, much bigger, big established company. Forward-wise, looking forward for this price to earnings, Pfizer looks like it's going to come down as far as its forward-looking price to earnings. Once again, that PEG ratio, if you're looking for something that's a lower price relative to its earnings growth, that's really true when we look at value stocks. So if you want a little value part of that, maybe something that's a little bit on sale, you can see Johnson & Johnson does well there too, lower than the other two as far as price relative to its earnings growth. And you can see these other valuation ratios too. Price to sales, price to book are the 2 big ones, price to cash flow. And once again, with those types of numbers, you want it to be lower price relative to its sales, relative to its actual book value. And you can see that's where they diverge a little bit. Pretty similar here in sales. Pfizer a little better. Price to book, nice value here with Novartis. Though once again, its PEG is pretty high too. So I would be wondering about that in terms of pricing. And then you can see like earnings per share over the next 5 years, earnings per share growth and all that, and you can see some okay numbers there. And so it looks like they're making money, and so these are big drug companies making money, which is something we want because we want them to pay our dividend. Now we want to go to financial. Let's look at financial, and you can see the dividend payout ratio. So we said we wanted it to be at least, not dividend payout ratio, dividend yield, or how much is the dividend going to pay us in terms of, you almost think of it like an interest rate, how much is it going to pay us a return on our dividend if we own that stock per share of stock. And you can see we wanted at least 2%, and that's how Johnson & Johnson got in the mix, because they're at 2.69. But Novartis and Pfizer are higher. They're at 3.34 and 3.50. So right now, if I was to buy those stocks, Novartis and Pfizer, I'd be getting a dividend yield above 3%, or a little better than Johnson & Johnson. So yeah, Johnson & Johnson has a better payout ratio. They're more likely to continue to pay their dividend possibly. But Novartis and Pfizer are paying maybe a little better dividend. That's not the whole story. We want to look at, what might happen with the price and other things. There's a lot more factors. But right now, if you were looking just at yield or chasing the highest dividend, well, the winner there is Pfizer. They got the highest dividend. But as we saw, there were some other concerning things with them. If you look at like some of those financials like return on assets, return on equity, or return on investment, I mean, you can see, yeah, Pfizer pays me a nice dividend, but look at these other numbers, which might lead to a higher stock price and certainly better safety and things in the future. Johnson & Johnson is just killing them in these other numbers. Bigger number is better. And if you start looking at, let's say, the quick and the current ratio and the quick ratio, which is short-term debt, can I pay my short-term bills? You want that number to be higher. You can see once again, Johnson & Johnson killing them again. So I'm taking a little more risk possibly here. We'll look at risk, we'll look at beta in a second, but you can see I might get a little more dividend, but I'm giving up on some of this potential price appreciation or taking more risk. Now, unless Johnson & Johnson was carrying a ton of debt or something long-term, and they're not. They're all very low in long-term debt relative to their equity. So those are all really nice, good numbers. I wouldn't be worried about any of them. They're all very good in terms of their long-term and their overall debt to equity. Profit margin, another key number that we'll look at. That means each sale you're making a little bit more on each sale. Johnson & Johnson running a little bit higher, well, not a little bit, a significantly higher profit margin, which means as they make sales, they've got more money flowing to earnings, which means that money can flow to our dividend, and maybe there's a chance of them raising dividends, and that's something we want to look at if we're looking at dividend-paying stocks or be aware of. And this is just relative, short, current prices and price change. We want to look at more a longer-term performance, which we will in a second. All right, so Johnson & Johnson, lower dividend, but a lot better in other numbers. Right now is how I'm seeing it. Right now, that's what I see. Recommending, I'm just saying this is what we're seeing when we narrow this group down. Ownership gets you an idea of how much is in-charge shares, how much institutions own. You can see, a lot of these are owned by big mutual funds and all that. Are things to look at, opposed to Novartis isn't, but others are. And then we click on performance here in this middle ribbon, and this gives you some more recent numbers, short-term things. Then this is just a moment in time, so this could be, when you look at this, every day the price changes, so these numbers change, so don't try to replicate this, but when you look at it, you'll see these numbers. It'll give you like the previous quarter, or performance for the quarter, or half year, or year, or year to date. One thing when you look at let's say year to date is think about where in the year you're looking at it. How many are looking at this later in the year, so this number maybe has a little bit more weight to it. Still, it's a very short-term number versus if I looked year to date in mid-January, well, that's only a few weeks. That's not going to tell me really anything. A better number, at least from what you can find from FinViz, from the initial thing, is a performance over a year, over a 1 year period. You still might want to look deeper into these stocks and look at the individual sites, their plans, and look how they've done over the last 3 years and 5 years. Particularly, you might want to think about what are they going to do in the future, because that's really what matters. Is what's going to do in the future. But it's still an indicating number as far as, let's say, performance over the last year. And let's see, Novartis is down 8.7, so maybe that's a good value buying opportunity. If you were thinking, well, they're down, maybe they're going to come back, they pay a dividend, maybe I can get them on sale a little bit. That's one way to look at it. Another way to look at it is maybe they're struggling, and having looking at those other like return on equity and looking at some of those other numbers, maybe they're just not being very successful. I'd want to look and see if are they having problems getting approval on certain drugs, or did one of their big blockbuster drugs now become where people can make generics of that drug is big in the drug industry. So what's going on? You'd need to dig deeper. But right now, they stand out as far as being negative, and maybe that's a buying opportunity, or maybe that's a stay away from them opportunity. As in, there's no opportunity, you got to stay away. Pfizer ran about 10% over the last year, and Johnson & Johnson, wow, up 31% over the last year. So at this moment in time, once again, anything can change on a daily basis, but it's showing, there's some good recent performance from them. Technical, it gets into some of the real kind of technical, especially you get into like Charty, over a 52-week thing. What I look for in the technical is the beta here on the left. That's, once again, you want it to be less than 1.0 if you want a less volatile or less risky stock. If I'm buying like a dividend-paying stock, I want it to be, something that can raise dividends. I want something to be maybe less risky, let's say, for example. They're all under 1.0. They're all good. They're all going to be less volatile. Notice a little less than the others, but this is pretty negligible numbers. It's not like they're running like 1.5 or something big. These are all less volatile, less risky stocks, things you can sleep at night on. Custom would be more making kind of custom type stuff. You can get a little bit in there, and you can adjust type things. Charts is just going to show you a chart here, and you can see Johnson & Johnson over that last year, pretty up, a little down. Novartis was up high and went, whoa, so something what happened, but they've come back. And Pfizer was down, and now they're kind of on an upswing too. So you get a feel for the chart. Tickers is just basically just their ticker symbols that we've seen here. Johnson & Johnson, Novartis, Pfizer is all that is. And then this is just some basic information that you want to get the chart and then the detail information on one page, so you can easily scroll through if you want to just see it all real quickly without having to go through the different things. And then there's news and stats you can pay extra for and get more stats, or you can just go right in a snapshot here and you get a chart, you get their summary, you get their news right here, whatever might be recently in the news. You get a little description of the company. So if maybe you know Johnson & Johnson, but you're like, I don't know much about Novartis. Tell me about Novartis. I'll tell you what they get involved with and some of the things they do, and at least give you a start on that. And the same with Pfizer. We know they're all drug manufacturers, but they might do other things. Like Johnson & Johnson, a big arm of them is doing things like in consumer goods beyond just being a major manufacturer of drugs. So this is the first step to kind of narrow our field down, into some choices, and you could research them a little bit more. Right now, I would say, Novartis might stand out if I was looking at something that might be undervalued as far as, the price is down because their stock went down. But then if I look at their price relative to their earnings growth, that's higher. And so that would concern me. That would make me kind of stop. And I'd worry about their payout ratio being over 70% if I'm looking for a dividend stock. Whereas, certainly, Johnson & Johnson pays me that less dividend, a 2.69, but it's still a nice dividend, and it's a growing dividend. If I research into them more, and I have done research just in prep for this, Johnson & Johnson has paid out a dividend and raised their dividend for the last 53 straight years. I mean, that's pretty impressive. We're going to go to their website here just so you can see what they do. And so that would be impressive. So I would weigh that pretty heavily that they're going to continue to pay that dividend. Sure, it's a little less than Pfizer and Novartis, but maybe that safety of them paying it is real important to me. Also, if qualitatively, if you know the company a little bit, you can learn more by, kind of going into like their products and things of that nature. Here we'll go into consumer care products. A lot of people know Johnson & Johnson, like Johnson & Johnson baby oil. If you know them for that, they do skin care, and this is beyond just their manufacture of the drugs. We'll look at that in a second. But you can see they got a diverse type of stuff they do. They do Band-Aids. Where I live, we actually call them Band-Aids. We don't call them wound care or adhesive care, whatever. We call them by their name brand, which is Band-Aid, Johnson & Johnson. How powerful is that brand of Band-Aid? So they have that. Listerine they own. Tylenol certainly is a big, over-the-counter drug that's out there, but they got some other big ones too, like Sudafed, Pepcid, Melanta, Zyrtec. Some of these, Imodium, you might know some of these, and then Vision Care as well. So Johnson & Johnson does a lot of different stuff, from medical devices, prescription products as well. The thing with Johnson & Johnson is, okay, now we've done some analysis with all three companies. We'd want to do the same thing where we want to learn more about Novartis and Pfizer too, and what types of things do they do. And that's the thing. We've now done some quantitative or numeric type analysis and narrowed our choices down, which is a good thing. I'm not having to search through hundreds and hundreds of healthcare stocks, let alone thousands of overall stocks. I've narrowed it down to these three, but now I need to learn more about the individual stocks before I can maybe make a choice. If you think about things like qualitatively, there's some things I need to know beyond just the numbers. Like, myself as an investor, how smart am I in this industry? Do I know the pharmaceutical industry well, beyond maybe just taking some cold medicine or drugs? How well do I know the company and going on their websites and looking at their annual reports, looking at their forward-looking statements? What do they mean as a company? What are some of their strategies? What does the future trends look like? I know for, let's say healthcare in this example, future trends are people are getting older and they're living longer. So that means they're consuming more healthcare products over their lifetime. That's a good thing for pharmaceutical companies. That's a win that will help their sales, so to speak. And overall, all this, it's got to fit in my portfolio. If I have a portfolio of 90% healthcare stocks, I probably don't want to add one more in there, even if it's a pretty good one. And not to get caught up in things like what's hot or what's cool or what's maybe a product I like. Maybe I had a headache and I took some Tylenol and boy, it cleared up my headache. And I'm thinking, wow, that Tylenol is great. Who makes that? Oh, Johnson & Johnson. I'm going to buy their stock. because it was a great stock, or maybe I liked another product. Pfizer makes Viagra or something like that. Maybe you like that. Whatever it might be. So the thing is, it's an art and a science to investing in stocks. Of course, the things will help you with that. And doing this analysis, and with anything, particularly like a dividend stock, you want to think about, why am I buying this? And what are the dividends going to do for me? Am I going to reinvest those dividends? And really think about where it fits in that overall portfolio, and importantly, overall in your goals. But here was an example of, as far as buying a dividend stock. You could then replicate this in different industries or looking at different stocks. You can do this lots of different ways. In this lesson, we're going to look at buying a value stock, something that's on sale, so to speak, that might be really beaten down. Maybe they've had some bad news, or something has happened that's caused the stock price to go down. And the idea of buying value stocks is we want to buy these stocks on sale with the idea that the stock will come back and rise in price. But a very good chance with value stocks, and something I would be aware of and maybe budget for, is that they'll continue to go down at least a little bit. It's hard to buy at the exact bottom. You might be buying near the bottom, but they'll go down a little bit. But the idea is that they'll come rebounding back and then continue on and be maybe a great stock for you, maybe a great stock long term. But to do that, we need to kind of narrow our field down. There's thousands of stocks out there, and we need to kind of compare and analyze that stock maybe against an industry, or maybe against the leader in the industry. And that's what we're going to do in this particular lesson. It's a demonstration purposes only. Once again, not recommending any stock, but we can use this for demonstration looking at a value stock. And in this one, we're going to look actually at a company called Skechers. Skechers makes tennis shoes and athletic stuff, and mostly shoes. And they're a big player actually in the United States. They're number 2 in the United States in terms of athletic shoes. The number 1 player, and number 1 overall worldwide by far, is Nike. And so we'll kind of do some comparison there. So first thing, let's go do some quantitative analysis and kind of see what the numbers tell us with Skechers. Okay, so let's start doing a little look here at Skechers. Their stock went way down. They had a bad earnings announcement, went down only 27% after their earnings announcement, and we want to look at that and see if there's a value play here. Is there a way to buy the stock kind of on sale? And we're going to look at some numbers and things to kind of narrow our universe down here real quick. And we can actually do that real quickly and real easily at finviz.com. Nice little stock screener there. First off, about Skechers, got their website here. Skechers, they do shoes. They do apparel, like athletic shoes. They're actually the number 2 supplier of shoes, of athletic shoes in the United States, behind the industry and by far world leader Nike. But they're actually ahead of Adidas in the United States at this period of time, because things change all the time, of course. But right now they're there. And look how happy she is. She loves her shoes. Maybe we should buy their stock just because she loves those shoes. Well, maybe not. Maybe we should do our due diligence and do some quantitative and qualitative research. So first off, this is a value stock. So we want to, it might be down in price and all that. We're kind of looking for that. So let's take a look at this. Now, FinViz is a nice way to sort. We're going to compare them to Nike. Now, we don't have to go through our filters and things and put in a lot of information. We know the 2 stocks we want to look at. Let's say in this case, Skechers and Nike. So we can narrow that universe down and just get to those 2. You can go right over here where it says ticker. Up in the upper right here, and you can just put in the 3 or 4 letter ticker symbol. You can go to Yahoo Finance or on Google, and you can look up Google Finance. You can find out their ticker symbol pretty easily from that. That's just a short abbreviation. I know Skechers is SKX, and I'll put a comma there. NKE is Nike, so I've got Skechers and Nike. I hit my enter key, and boom, there it is. Right here, Nike and Skechers. This is just listed by alphabetically at this point. They're not saying Nike is better than Skechers or anything at this. It's just how it lists it in here. And you can see they're on consumer goods. They're in apparel. Both the U.S.-based companies. Market cap-wise, you can see that Nike is huge, $93 billion. Skechers, decent, $3.4 billion, but certainly a lot smaller than Nike. And they give you the price to earnings ratio and the current price, and that's right there. So what we want to do is look at this middle ribbon here and now start comparing and looking for some numbers in terms of things that might help us. And if we're thinking about buying a value stock and we're thinking about buying Skechers for example. Here we're going to first off look at valuation, right? What's the price relative to its value? And this is where you see things like price to earning and PEG ratios and all that type of stuff. So we see Nike's got a 25.64, pretty high price to earnings. Skechers not bad, 12.27, actually a good size, good price to earnings. If it was below 10, even better, but it's not like it's crazy high, its price relative to its earnings. So that's a good sign. We're looking for low price to earnings. We're looking for like a low price to book or low price to sales because we're looking for that future, and also a low PEG ratio. If we were talking about price to sales and price to book, let's start with those. You can see those are right here. And Nike's pretty good value. You're paying for Nike, you're paying for that brand when you're buying that stock. Skechers, real low, on price to sales and price to book. So its future sales is price relative to its sales, the underlying assets of the company in terms of book. Good. If I'm buying a value stock, I want something that's got some meat underneath the bone, so to speak. That it's got some solidness to it without. Though I know it's been hurt on bad news or something has happened to the company or it's out of favor for some reason. A good number to look at that a lot of value investors really like is the PEG ratio right here, the price relative to its earnings growth. Am I paying a low price relative to its future earnings? Because those future earnings and the growth of earnings is what drives stock price up and other things that drives investors, drives future things, maybe even like dividends or reinvestments in the company. So a low PEG ratio is real important to a value investor. And certainly something that's under 1 is what you're looking for. Anything below 1.0 and a PEG ratio is good. You can see Nike here is at 1.82. That's really high. That might be something for like a growth stock or something like that where it's pretty high price, but you're expecting even better growth or something. That's not a value stock at all. Maybe it's a dividend stock, Nike might be, but maybe not. But certainly I wouldn't consider it a value stock looking at these, relatively high price to earnings or high priced earnings, and it's very, high PEG ratio. A low priced earnings right now is nice for Skechers, but even better is that PEG ratio of 0.61. I like that. That's telling me I'm getting a good price. I'm getting this stock on sale. Doesn't mean I'm going to buy it or anything. I'm just saying this is a good initial indicator of something to look for when you're looking at a value stock. It should be on sale. It's out of favor for some reason. You shouldn't be paying a premium price for it. Otherwise, we can also look here at things like earnings per share over the next 5 years, the past 5 years, but also the future growth projections and things. And they're predicting nice growth for Skechers at 20% versus 14. So that's a good sign too as well, that maybe I'm going to buy a stock that's on sale, but I can get some good earnings in the future. And then we go under financial here. And here we want to look at some of their efficiency things and dividends. So here, first thing, dividend. Well, Nike pays you a little dividend of 1.16 there. Not much. It's not a big dividend payer, but it gives you something. Skechers doesn't pay a dividend at all. So if you're looking for a dividend, and you can get dividend stocks that are also value stocks, that are underperforming or underappreciated. In this case, you're not going to get any dividends. So unless they have a dividend in the future, I wouldn't count on it, but anything can happen. But also, you're really going to make all your money on capital appreciation, buying low, selling high. So down the road, maybe years down the road, but you want to buy low on this stock. So it's real important, especially since it's not paying a dividend. You can see Nike is a much more efficient running company. It's return to assets, return to equity, return on investment. Its management functions better than Skechers, right? So you can see those numbers. Not bad. You got 19 ROEs, not bad, but Nike would be better there. One thing that's important I look at when I'm looking at, say, a value stock is, can they make their bills? Can they pay their bills? Can they pay their long-term debt? Because sometimes a stock is out of favor because it's struggling financially to pay its bills and it never recovers and goes down in price, maybe even goes out of business. So looking at things like around debt and paying their bills is important. You find them here with the current ratio and quick ratio, and you want these numbers in current and quick ratio to be higher. The higher the number, the better, comparing assets and liabilities and that kind of stuff. And you can see Skechers is right there with Nike, and right there pretty good as far as its current and quick ratio. It's not low numbers here, so that's a good sign they can pay their bills. Anything can happen, but right now that's a good sign. And then also looking at their long-term debt and their debt to equity ratio. You can see low numbers here, real low debt for long-term. That's a great sign. I like that because that means they're not having a big debt firestorm coming their way, years down the road. They're carrying right now low debt. Now, management could change their mind any time, of course, but tomorrow all of a sudden take on a bunch of debt for some reason. But right now, they're not carrying a lot of debt. So no dividend, but I got a low debt ratio, nice current payment. I saw in those other numbers some nice PEG ratio, so that was pretty good. If we look at performance here, let's see how the recent performance has been. Once again, year-to-date numbers and these short-term numbers, you got to think about when you're looking at that. If you're looking in February, you've only got a few weeks of data, so I don't usually look at the year-to-date number. At least this is the year over the last year, and you may want to dig deeper in Yahoo or other places to find 3 or 5 year type numbers. But this is over the last year, what it's doing currently. You can see Nike's been down here too, so Nike's down at 3.5. But look at Skechers there over the last year, at least at this snapshot in time. It changes every day. But in this snapshot of time, wow, they're almost down 55% over the last year. Holy moly, that's really down. If you bought high up there, you're down 55%. That's a bummer. So you got to ask yourself, somebody's buying and somebody's selling. Well, most people are selling, it looks like here. So as a contrarian or somebody doing the opposite of what the market's doing, you're looking for a value or unappreciated stock, a stock that's on sale. You could look at this number and be encouraged and say, wow, they're down 55%. Maybe they'll go down further, and I'm okay if they go down a little bit further. But then when they come back, they'll have potential for big gains because they're down so far. That's how a value investor would look at it. Or somebody might look at it and say, wow, they're down 54%. They could keep going down another 50% or 30% or more. Maybe this is just a bad dog stock and I want to stay away. So that's why looking at some of those other numbers like the PEG ratio and their debt and their current payments and all that kind of stuff are important when you look at it from a numerical or quantitative standpoint. And then we'll talk about qualitative in a second. But 54%, well, that really stands out. Technical analysis, there's a lot of different things you can look at technical. If you have charts that's there. I look at here for the beta. How volatile is it? And nice thing, Skechers really low beta, 0.15. That's surprising. I thought it would be a higher beta. 0.55 is actually very low for Nike. Anything under 1.0 means it's less volatile than the market. It means the price swings less than the market. But it might be just because Skechers is kind of going down a little bit. But it's a very low beta versus, let's say, a high growth stock that would have a high beta above 1 or 1.5 even, a high beta. So that's good as far as volatility on there. And you can look at like charts or do some custom things. We'll look at charts. Here's Nike, Skechers over the last year. You can see how Nike's kind of gone up and down, bounced around a little bit. And Skechers was bouncing too. Then they had this bad earnings announcement. They missed their earnings, surprised people, and went down, just went rocking down. And people in the market don't like when there's surprises. So there was a surprise here. And now you have to ask yourself, does this mean this is a buying opportunity? Is this more like plays in this range? Or is it going to keep going down? And that's part of why we're doing our analysis. You can get news and other information here. A quick way to get it is just to click on Snapshot, and it shows your chart. It shows a summary of stuff, of the financial information, all those different numbers. It shows your news right here, so you can look at news, and then it has a little summary of the company too. You want to dig deeper in this, but it's a nice little quick way to get information, insider trading as well. Here's Skechers. You can see that big drop off here, financials, different kind of news things. Now I don't buy everything in the store in the stories. You got to take that. But here's like here's an article. What more pain could be ahead for Skechers stock? What more pain could be ahead for Skechers? So that might be something I'd want to read to learn a little bit more. It might not influence me, but it might be something worth a look at. And then you've got a summary of the company as well too. So here's some financial information, some numbers we looked at. I certainly like that. That low PEG ratio I thought was pretty intriguing if you're a value investor. Once again, that low PEG ratio, looking at those better current ratios, quick ratios, long-term debt was good. Certainly its return equity and all that not great, but you can't have everything. And I'd have to ask myself, is this stock going to keep going down, or is this maybe a time to buy it on a low turnaround? And buying it near the bottom, but you can't time the market, especially if I was going to hold the stock maybe for a long period of time. I could say I could weather the storm longer and maybe do better in the future with this stock. And that's really the thing with investing in stock when you think about it now qualitatively is, how well do you know the industry? How well do you know the company? There's other factors beyond just the raw numbers as well too. If you look at it from a fundamental standpoint, a chart person would just look at charts. They wouldn't even look at all those numbers. They'd just look at patterns on a chart maybe is what a chart person would do. But if you're looking at fundamentals, you look at the numbers, and then qualitatively I look at the industry, the company, what's happening in the industry. Is there new changes in the industry? Is the industry growing? Are they growing in new markets? Is the company growing into new markets? Maybe internationally, maybe that might help them. If they're good in the United States like Skechers is, maybe they have great potential for growth outside the United States. That might be something I'd look at like future trends and things that might be happening around that industry. I'm not an expert in the apparel industry or in the shoe industry. My son owns a pair of Skechers. He likes them. I've owned some Nikes. That doesn't mean I know those stocks. It just means I own some shoes, I guess. And that's the thing about that. You can't buy or sell stocks based on just what's hot at the time or what's cold at the time or something like that, or because I like the product. Maybe I bought some Skechers and I walked around them and said, this is the best shoes I've ever worn. Well, maybe I may be interested in the stock in that, but don't buy a stock just because of that. That might be one reason beyond that, and you want to learn more about the company and all that because your taste might vary. And that's the thing with stock buying. It's an art and a science, so you're kind of combining them together. But if we looked at, like in this particular example, I hope you saw some of the things I was looking at, talking out loud on that, some of the ratios I was highlighting for a value stock, like a PEG ratio, and something I might not highlight for a different type of stock, like a dividend stock or something like that. You can see we didn't talk really about dividends at all because we're looking for a low price with a high price appreciation. So no recommendations on either Nike, Skechers, or any stock, but I hope this helps you, and then you can practice and try on your own to look at stocks maybe that interest you and start these comparisons and seeing what you see, and hopefully that helps you in your stock and your investing journey. Okay, now in this lesson we're going to look at buying a growth stock as a demonstration. You kind of see what kind of the process I go through, or start seeing some of the things I start talking about and looking at. And we're going to look for a growth stock, so a high-flying stock, a stock that we hope will maybe change the industry a lot or become a big player in there, or maybe change the world for all we know. But the idea is we're taking more risk on this stock. It might not have anything as far as current earnings even, so we're going to look at a stock that has some high potential. It's what you're looking for growth stocks. They're already probably maybe pretty priced high. The market is seeing this, and you might be saying, do I want to continue to ride that wave, or will it turn and change for the worse? So we're going to look at growth stocks, which tend to be a little bit more risky as well too. And we'll go through a demonstration, not a recommendation. Don't recommend any particular stocks, but we'll go through it as a demonstration. And in this case, we're going to do this demonstration looking at Tesla. You might know Tesla as the automobile manufacturer. They make high-end electric cars. They typically start around $80,000 or whatever as far as an electric car, a high-end sports electric car. But they recently, or not recently, they announced they have this Model 3, which is a big a big $35,000 car, something lower price, and that's really caused the stock to really react positively in that initial short term. And we might be thinking, oh, maybe they can make a car that's more affordable to the masses, at least at the high end of the masses, not an inexpensive car, but it's still an electric car. And maybe that's going to be something that will change the industry, maybe change the world. Tesla's done a lot of stuff as far as changing the industry, looking at maybe selling direct versus, let's say, selling through a dealer network like they do in the United States as an example. So we'll look at Tesla and we'll compare it to an old kind of company, Ford Motor, and less of a high-end growth company, where Tesla's more because they're trying to do something new with electric cars and other things around electric vehicles and batteries and other things that they're looking to do. So let's compare these companies, and let's start by looking at some of the quantitative or numerical analysis. Okay, we're going to start by doing some quick analysis of Tesla, and we'll do a comparison with Ford here at finviz.com/screener, nice good advanced screener to kind of sort through some stuff. But to do our quantitative or numbers, then we'll look at some qualitative stuff. I happen to have Tesla's website up here too. If you're not familiar with Tesla, they build beautiful looking, I think really nice looking electric vehicles. It's all electric, no gas in there. And for as a high-end sports car electric vehicle, and you can see these different models that they have out here. And what's generating a lot of excitement is this Model 3. You can actually pre-order these vehicles, these Model 3s, and something that's starting at like $35,000 as far as a car that's a full electric car with, giving you, it says here 215 miles of range for like $35,000 US, and it's caused a lot of excitement and a lot of buzz in the industry out there. So that's Tesla's Model 3, and as far as taking a lot of orders on that, as far as without selling them, but taking pre-orders on it at this point in time. So let's look at some numbers now. So here we are at FinViz, and we're going to type in the numbers here. So we don't have to do a big stock screening thing. We don't have to go through the automotive group. We're going to go in the upper right here where has the ticker. You enter the ticker, or you can look that up on like Yahoo Finance. Look up the company. You can find its ticker symbol. I know Tesla has TSLA, and we'll compare it to Ford. Old automobile company, pretty good company in a lot of ways, but their ticker symbol is just F. So we'll hit the enter key here, and we'll compare Ford and Tesla, and you should see probably some pretty significant differences between them. You can see in this particular time, Ford's gotten a lot of volume versus, like, so let's say Tesla. When Tesla announced the Model 3, their volume just went, as far as their stock trades in a day, went crazy. So you can see they're both in consumer goods. They're auto manufacturers is where they place Ford and Tesla. Once again, this is not a ranking. This is just alphabetical when you see this first list. So let's start looking at this, and we're looking at this for Tesla to be a high-end growth company. All right, so this is something where we want the price to appreciate on our stock price, and we might not get a dividend. In fact, we should expect no dividend on a high-end growth company. So let's take a look at that, and first we'll look at some of the valuation numbers. What's the price look like? You can see first price to earnings number. You can see Ford has a really low price to earnings. They're really kind of a good value right now if you're looking at price to earnings relative to its earnings, well below 10, certainly in the 5.38. So that's something interesting. But we're looking at Tesla, and you can see, and this will be very common with some growth stocks, they might not have any earnings yet. In fact, Tesla has not made any money ever. at least at the time of doing this. So their price relative to their earnings is not applicable. It's in effect zero because they have a price. Sure, you can buy them, but the stock, but they have no earnings against that. So when you look at things like price to earnings or price to earnings growth, which is the PEG ratio, you can see no numbers there. If you're looking at value stocks, by the way, a value stock something under 1 for a PEG ratio, Ford at 0.6 seems interesting there. So maybe more of a value play. But Tesla, we're going to look at it as a high-end growth play, something that's going to change the world, and we want to be on the ground floor on that. So, but we're not saying a price to or earnings, so we can't look at those numbers. We look at price to sales and price to book. It's certainly better than Ford and their price relative to their underlying assets, especially book. You're getting a pretty good price. They've got a lot of underlying assets. They own a big solar manufacturing facility and all, or not solar, a big battery manufacturing facility and expanding that. And actually, they're in the process of buying a solar company, which is a qualitative thing we'll talk about later. But you've got a good chunk of assets there. And future sales and future earnings per share over the next 5 years, they're expecting some high growth there. We'll see if they deliver, but that's the idea of buying these guys is, you're not looking at that, kind of slow, nice growth over 5 years at 9%. You want to get paid a premium for the risk you're taking on buying a high-end growth stock, and that's the idea of looking, hopefully, for an earnings per share that's, a nice growth number, like this is, 35%. All right, so that's that. So let's look at financials. Now, dividend, a growth stock should not pay a dividend because they should be taking all that money and investing in the company and to grow the company and really grow their share price for us as stockholders, right? So a company that's established, sitting on lots of cash, will pay a dividend. And once again, more of a value company. Ford's paying a pretty nice dividend at this moment in time. But Tesla, you can see no dividends, and you shouldn't expect a dividend. Return on assets, equity, and return on investment, negative numbers, kind of concerning there. Are we being efficient? Are we, getting some returns there? But once again, we're looking for that long-term growth, but that's something to be aware of. Also, you want to watch out for growth companies that might be taking on a tremendous amount of debt and having a hard time paying their bills and things. So you can see current ratio and quick ratio is paying their short-term bills. You want that to be a number above 1, and you can see that they're doing that fine, or at least at 1 with the quick ratio. So they're paying their bills, but they're not making money, but they're paying their bills. And long-term debt, yeah, they've taken on some debt. It's not a huge number for Tesla there, but they've taken on some debt, and they're using that debt to help fuel their company would be the idea behind it. I would want to dig in deeper into their financial statements and some of the things their CEO, Musk, has said, Elon Musk, around, how are we using that debt we're taking on? How are we using it when we issue stock to, finance the company? And are we using it to grow the company or maybe buy things that help us grow the company? But not scary numbers here. You can see Ford's got some scary numbers up here because they're trying to, service a lot of, big force of people, a lot of plants. They're also having to, take care of people with pensions and things that they have an obligation there too. And so they maybe are taking on more debt. But you can see not bad as far as with Tesla. And profit-wise, you can see they're not making any money yet. They're losing money, right? They have a negative profit margin because they're putting all that money into research and development and building these new cars and building the Model 3. So every car they sell, they're in effect losing money as when compared to looking at an overall profit margin as they build the market and build out their organization. Not uncommon for a growth stock, but it'd be nicer at least if they're making some money too. You might find that in technology where they can maybe turn some profit maybe a little bit faster just because you don't have the hard good costs or the people costs you might have in a big manufacturer like an automobile manufacturer. You can see ownership, who's owning the company and what, how much is insiders, how much is institutions, that kind of stuff. Pretty well bought between institutions and regular folks like you and I. If we look at performance here, this is over the short term, and this is just an initial snapshot here. Year-to-date performance, once again, make sure you're looking at when you're buying in the year. If you're looking at January, these numbers aren't very good because there's only a few weeks there. But if we look over the last year, you can see the Ford stock's down, automotive is down, Ford's down 7, but Tesla's down 21%. And we'll see in the chart here in just a second why that is, but they basically had a big run up with their Model 3 launch and everything, and now they've kind of come back. They've had some other types of issues and things, so they've come back, but maybe it's a growth stock that might be a little bit on sale, down 21%. It's something to be aware of and look at. But growth stocks, they'll fluctuate more. They'll have much more volatility and be bouncing around a lot more. In fact, let's look at technical, which will show us our beta, which will show us some volatility, and we should see a number above 1 and maybe a big number above 1, and we do. Tesla's 1.34. Ford at 1.29 is actually disconcerting for Ford. That shouldn't be typically that high, hopefully, for them, but it is. But Tesla 1.34, that's not unusual for a growth company, right? They're going to have fluctuations. They're going to be up. They're going to be down. If this was a low beta, like below 1.0, 1.0 and less means it's less volatile than market. The price changes less than the market, less risk. That would be even better. But this isn't scary bad, but just something to be aware of, that if you buy Tesla, the stock will go up and the stock will go down, and you have to be aware of wild swings with that. It's going to be much more volatile than the market. So if you hear people on the news and saying, oh, the market's real volatile, it's been real volatile over the last month. Well, with Tesla, you're going to be even more volatile than that. So just be aware of that. And then you can do like custom stuff. We'll look at the charts here. You can see Ford kind of went down here, this over the last year, and then bounced back and has been in this narrow kind of trading range here after maybe had bad earnings or something, who knows, and it went down. You can research that and find out. And then Tesla was going down, 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 and then they had this Model 3 in launch, and took off well better than expected as far as pre-orders on that, sight unseen. And look at the stock rocketing up there. That's what you can see sometimes with the growth stock. Like, whoa, look at it go. But then when do you sell? If you sell. See, now it's kind of come back down, and that maybe it's now down here. Is this going to be its price? Is it going to go back rocketing up? When that Model 3 comes, are they going to rocket up? Are they going to go down? Are they going to have other problems? How's the company running? So this doesn't tell you the whole story, but it's interesting to see down, 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 up, up, up. See that volatility there? If I bought here, I'd be like, oh my gosh, what a bad purchase. Maybe I'm going to sell. And then right when you sell, it's like, oh my gosh, I blew it. Look at it go. That's why stocks are for the long term. This is over almost like a 4 or 5 month period. Stocks are longer term investments, particularly when you look at that volatility, and certainly in my opinion. You can get news and information. I like just jumping right to the snapshot because it shows my chart, it shows my numbers all in one place for the particular company. It's got news right here. So if I'm looking at something right here, I can read different articles about the company. It gives me a little description of the company itself, plus maybe what insiders are doing here as well. If we look at Tesla here, you can see that big movement on that chart here, their numbers, different types of information out there that might be going on. Tesla update halts automatic steering if driver is inattentive. They've been having some troubles with their automatic steering. Great technology, cool, but if it doesn't work, it's going to cause the stock to go down. So there's some safety debates and things you can read along that. And there's some things around like over dealership laws and things within, because they want to sell directly. This is how they're disrupting or changing the market, not selling through dealers, but that states and unions and different people are resisting that. Small businesses might be too. So you can see what might be a positive for some might be very negative for others. So if we think about Tesla here, a good example of a growth stock, the idea is, it's going to have low earnings, maybe no earnings, maybe future earnings per share would be good. Financial numbers might be, no PEG ratio or anything, but maybe good price to sales or price to book. And certainly not a dividend payer, and but nice that their debt was pretty good. I like that. The debt was pretty good, though some of their other numbers, efficiency numbers weren't terrific, but good debt numbers there. And then it was interesting. You always see this high kind of beta type number here, as far as the numbers in it being more risky. And that's the thing with growth stocks. If we start talking about this now qualitatively, kind of more gut and more of our more mind kind of coming in there versus the hard cold numbers of quantitative numbers. We learned a lot from the quantitative numbers that we looked at, or we can certainly interpret a lot. Now we got to dig deeper to find out even more. What is Tesla, if we're using this as an example, what are they going to do? What are they doing in the future? I mentioned before they're buying a solar company, people that make solar panels. Is Tesla want to be an automobile company, or do they want to be an alternative energy company? And they make batteries to help, power their cars. Musk, as the CEO, has talked about using the home as being a central place for energy and alternative energy. And is that where solar panels come into play? Are solar panels used in these massive battery factories and these other factories that they'll use, and using solar to help power that as part of an overall strategy? Those are the things you'd want to dig in deeper in and say, does this make sense to me, or does it not make sense to me? And what is the long-term future look at it? Looking back at those basic qualitative things like the industry and the company and what's happening in the overall automotive industry. There could be some big macro events of the overall economy is just in the tank, like 2008, 2009, where we had the Great Recession. Well, all car manufacturers struggled during that time. And a company like Tesla, which is a high-end vehicle, alternative energy electric vehicle company, might struggle even more, which could put pressure on it as more of a startup, more of a growth type company. So
things to think about along that. Though their debt numbers were pretty good looking at that, so that makes me feel better that maybe they could weather that storm. And what are some of the future trends out there? Certainly future-wise, the growth of alternative energy is going to be continuing growing. Governments support electric vehicles and things of that nature with like subsidies or things to help people buy them. We see that in different parts of the world, and that helps companies like Tesla. But also future might be, if Tesla has great success, there's nothing that prevents General Motors or Toyota or Ford or any of these other manufacturers from trying to get in there as well. Tesla certainly has the cachet like an Apple or Google would have, but even still, when Samsung makes a big play in the phone market, the cellular phone market, for example, that does take market share away from Apple, even if Apple is the market leader. Well, Tesla's maybe the leader in high-end sports car electric vehicles, but if, let's say, BMW comes in, who's to say that they can't really erode that market share, maybe even take it over? And the one thing also, as we talk about like not being hot or too hot at products or cool on products, or read something in the news like Tesla is going to change the world, and you buy the stock, and then all of a sudden it drops in price because you need to do a little more due diligence on it. So be aware of that. You might look at Tesla as a good example. Where like, wow, that's a really cool car, and I think that Model 3 is affordable for many people, and that could be a big winner, and I want to be part of that. I want to buy some stock in that. And I believe in alternative fuels and alternative energy and alternative cars as far as electric cars. And those could be all things you feel, which could be very emotional. And you want to take that emotion out of it, because you could see like that chart where it went way down then rebounded way up. If you bought when it was way up and then it went way down so fast, you might sell or not feel comfortable with it. It's easy to say, boy, if I bought at the bottom and watched it rocket up, but you can see it's already down 20-some% from that high just in such a short time. And that's the thing with growth stocks, right? Maybe it's the next Apple, maybe it is the next Google, or maybe it's Pets.com or something like that isn't successful, or whatever. I can't remember the name, one of those internet bubbles that burst companies, but it's a company that may succeed, may not. It's great to buy Apple when they're low, and you've reaped all that benefit, but it's another thing to maybe buy somebody higher or buy somebody that fizzles and never succeeds. So Tesla is certainly a good example of a growth stock, real volatile, high beta, high growth potential. And when we think about qualitatively, you can also think back, what if they succeed? If they succeed, they could succeed and exceed everybody's expectations wildly. They could change the world, in effect. They could change how we consume or how we use automobiles, and certainly how that might look maybe 15, 20 years down the future. Maybe 20 years from now, everybody's driving a Tesla with an electric motor in it. Who knows? Or maybe Tesla, much like DeLorean, if you know DeLorean, much like maybe other manufacturers of automobiles, just becomes part of history. So either way, a longer lesson here, but I want you to show you not a recommendation for Tesla one way or another, but just an idea of what to look for and maybe what to expect if you're looking at a growth type stock and you're expecting that long-term growth, and some things to think about as you look at those types of stocks as a case study, as a demonstration. Best of luck to you, and best of luck in your future investing. Okay, so maybe you've learned a lot about investing in stocks and maybe picked out some stocks and things are good. And it's like, okay, well, that's great, but how do I actually go about buying them? What are the mechanics involved of actually buying the stock? It's like, I want to buy this stock, or I want to buy this stock mutual fund or exchange traded fund. How do I do it? Where do I go? Who helps me with such things? And that's where we're going to talk about here in this particular section, where we review all the different types of services that are out there on how you can buy and sell or trade stocks. We're going to look at the different types from full service brokers or brokerage houses, which is the traditional kind of, when you think about buying stocks, you go through a broker houses, but now there's a lot of different options out there. You have discount brokers or online brokers where you can get a lot more discounts involved with your buying and selling of stocks. There's online robotic or online robo financial planners where they're in between a stockbroker and a full service financial planner that gives you some advice or at least some ideas around building a portfolio. There's financial planners who not only help you with stocks, but they might help you with bonds and cash and other things and a total investment picture and all other things such as insurance and things a financial planner would be involved with. You can even buy, in some cases, a few cases, buy stock directly from a company. And we'll talk about how you can do that and which companies might offer such services. So I'll give you examples of well-known companies in each of these areas and different options that you have in there. I'm not recommending anybody in particular. It all depends on your particular need. You might like to use a financial planner versus, let's say, a stockbroker, or versus an online type solution. They're all a little different, but you're going to be able to understand from this section what are the advantages and disadvantages of each of these types, and then you can decide, well, what's the best fit for me? Also understand the information changes frequently, especially with online investing and some of these robo investors and others, where they might change things frequently. So be aware of that and always keep on top of that. And do your due diligence as far as what works for you. If you feel more comfortable with investing on your own, you've learned some stuff in the course, you're like, I can handle this on my own, well then maybe like an online discount broker might be a way to go for you, or even a robo financial planner. If you're somebody who says, no, I need a little bit more help and want some help around my whole financial picture, just not investing in stocks, but in bonds and cash and insurance and a lot of other things, well maybe a financial planner would be the best choice for you. Either way, it's about you and your choice, but here we're going to give you the information on each of these things so you can make a good choice. So with that, let's go ahead and get started in this section and learn about different ways that you can go about buying stocks. Now, most people, when they think about buying stocks, immediately start thinking about brokerage houses or full-service brokers or stockbrokers, right? You think, oh, I buy stock from a stockbroker. And that's really a full-service broker is. They're stockbrokers, and they offer more than just simple buying and selling. They offer advice as well, too. So they buy and sell stocks for you. They give you advice. They might call you up with a hot stock tip or something that they're recommending, or send you information or emails, or give you information to around research, or give you access to research, or they have access to tremendous amounts of research, and that's part of the advantage that they promote and say, hey, yeah, you might pay a little bit more for us, maybe a lot more for them, but the idea is you're going to get some stocks and recommendations that are very, very well researched. They basically can be set up to manage your portfolio on your behalf. You can decide how much authority you want to give them, but if you want to be completely hands off, maybe you'll have a conversation about like the types of stocks you have or how much risk you want, but you could say, you manage my portfolio for me. And that's how traditionally it was done, right? You'd hire a stockbroker and they would go and buy, sell stocks for you in your portfolio. Well, nowadays, people have a lot more access to information through the internet, through discount brokerages and online brokerages, and they want to be more hands-on with their investments. They want to be more of a do-it-yourself investor. So the use of full-service brokerages certainly have gone down over time, but still a lot of people use full-service stockbrokers, hoping to get better returns because of that expertise that the full-service broker will provide you. Now, some keys around this is one, trust. Your trust is not, you're dealing with a big, large brokerage house, maybe, for example, but you really are working one-to-one with a stockbroker, a particular person or individual themselves. So maybe it's a small company, maybe you got a team of people, but usually it's a one-to-one relationship. And the key part of that is you got to really trust that person. I mean, you're really betting on them to make the right choices for you. And you're paying a little bit more for that in comparison to other types of services. So you want to really trust that stockbroker and that they really have your best interests at heart. And that's been a real problem in the industry, where a lot of times stockbrokers are not necessarily looking at what's in your best interest. They might be looking more so on what's their best interest. We'll talk about that in a second here. Next is cost. Whenever you're evaluating any of these different options as far as actually the mechanics of buying and selling stocks, well, there's always a cost involved with that. When you buy stock, there's a cost. And when you sell stock, there's a cost. These are transaction costs or transaction fees of buying and selling. And then from there, you can have all sorts of different types of other fees or costs associated with how you might have your account set up, or other types of more, interesting ways of buying and selling stock, or setting limit orders, or things we'll learn about here in a moment. But the idea is there's a cost associated with that. And full service brokers, like anything that's like anything that is full service, costs more, right? You go to a bank, or you go to a grocery store, and it's more of a full service where they put your groceries in the bag and take it out to your vehicle and give you a lot of personal service. Well, that's more full service than if you go to a discount warehouse place where you kind of do it all yourself. And you should expect to pay more at the full service place. With brokerage houses and full service stockbrokers, the same concept applies. You are paying more for that extra service. You're paying more for that research. You're paying more for that expertise. And you just got to say to yourself, is it worth it for that extra value that they're promoting? So really look at costs, like at anything you look at, but particularly with full service brokers, really understand the cost structure behind that and see if you're comfortable with that. One thing that's really been common in the full service brokerage industry, and it's been a bad thing actually, and has gotten better, but still something to be really aware of, and it's still a bad thing. That's called churning, and be aware of churning. So what I mean by churning is you pay a cost when you buy or sell stocks, right? Well, that's money that goes into the brokerage house. That's how they make their money, is by buying and selling your stocks. So they have an incentive to buy and sell lots of your stocks and keep turning over your portfolio over and over and over again. In fact, the more that they can turn over your portfolio, the more fees that they collect. Remember, they get paid when they buy or sell a stock on your behalf. So that's called churning, when they're basically just buying and selling stocks with the primary purpose of enriching themselves, not necessarily in your best interest, which is illegal. Now, with that, companies will say, oh, we're not churning, we're not buying and selling stocks, but there's been a lot of problems around it. So if you have a relationship with a stockbroker and they're doing lots of buying and selling of stocks, more so than maybe you're comfortable with, ask them, why am I selling this stock? Why am I buying this new stock? Why can't I hold on to this stock? What's going on here? And they might tell you some good reasons, but if you see a lot of it where it's turning over and over a lot, and you're really incurring a lot of fees, and you start becoming uncomfortable with that, that might be the time to really look for another full-service broker if you want to stay with full-service brokers, or look at these other options where it's more do-it-yourself that we're going to talk about. So beware of churning, just the rapid buying and selling or the frequent buying and selling of stock with the idea of enriching the full-service broker. Now, full-service brokers out there, who are some examples of them? Well, many household names that you might have heard of, like Merrill Lynch, been around forever, biggest brokerage house out there. So Merrill Lynch, Edward Jones, UBS, Raymond James, Wells Fargo Advisors, Morgan Stanley, Smith Barney. I mean, these big banks, these big institutions, these big brokerage houses have been around for hundreds of years, providing services to clients and providing full services to clients. So what's really happened in the more recent time is we went from a period where stocks were a complete mystery and people who got involved in stocks had to hire a broker and they really relied on their broker and they talked about how good their broker was. Nowadays, it's more about them educating themselves, doing a lot more on their own, do-it-yourself investing, and really having some investment products that help them to be more, let's say, diversified, like with mutual funds or exchange-traded funds, and some lower-cost options than the full-service brokers. So the starting point is full-service brokers, top of the heap in terms of cost, in terms of advice too around stock trading and buying. But right now, there's a lot of other options that you might want to take a look at. So let's take a look at those. One of the biggest categories, maybe fastest growing category around buying and trading and selling of stocks and other products too, but particularly stocks, is discount brokers. So you might also know them as online brokers or online traders. And you might know of them like E-Trade and Scottrade, companies like that. And we'll have some more examples here in a moment of that companies that you can look at as far as that can handle your buying and selling of stocks and other types of products. So they're discount brokers, they're online. And the idea is that it's more put on you now. You decide on what you want to buy and what you want to sell. They don't give advice. It's not like a full service broker where somebody's working specifically with you. It's up to you as far as what you want to buy and sell. A lot of the online brokers, though, as you go check them out, have a lot of great articles and information about buying and selling stocks. They have a lot of great tools and calculators and things too to help you research and decide on stocks as well. So you can take maybe some of the principles in the course, sign up with a discount broker, and then start using their tools to help you pick out stocks, mutual funds, whatever it is that might be of interest and work for you. So the key is they don't manage your portfolio, and since they don't manage your portfolio, that's where the discount comes in. That's where the heavy discounting comes in. So their costs to buy and sell stocks are much, much, much less than a full service broker. Because remember, you're not paying all those fees for the full service advice. You're doing it yourself. And now the discount broker can use an online platform, drive out costs, reduce, personnel and all that on their end so they can give you great pricing to buy and sell stocks. So it's a great way to get started with investing, actually, especially if you want to start small. A lot of these discount brokers can let you start with a very small amount of money to get started with trading. Go to the different websites. They'll tell you how much you need to get started. It's very, very low. Versus a full-service broker that might need lots of money, thousands and thousands of dollars, of US dollars, let's say, to get started. So you have to evaluate between the two. So the key with a discount or online broker is you're doing it yourself, all right? So this is you applying your information, your education, things you're learning, and you're doing it yourself, and thus you're able to, capture a much, much lower cost. So you've got one extreme, the full-service broker or a full-service stockbroker that gives you all that advice and those high fees, and the discount broker, so it gives you lots of tools and access to maybe information and tools and research and calculators, but you're making those decisions on your own, but you're able to capture a much, much lower cost. So you can weigh versus your comfortableness between those two extremes. Some examples of some discount brokers and online brokers are names you've probably seen advertised a lot. They do a lot of advertising, so you might have seen them a lot. So companies like E-Trade or Scottrade or Charles Schwab, or there's new ones out there like Trade King and Options House. TD Ameritrade's been around quite a while. First Trade, Interactive Brokers, Merrill Edge, which is actually a part of Merrill Lynch. They have a discount arm, and even big mutual fund companies like Fidelity offer some discount brokerage and discount online things too. So if you have some mutual funds, look at your mutual fund provider. They might allow you to buy and sell individual stocks as well as mutual funds through them as well, and Fidelity has that as well. So you can see it's been a real popular area because the costs have gone down so much with buying and selling trading through this discount brokers that's really putting pressure on the full service brokers, and that's why some of those are investing and getting involved with some of that, like with Merrill Edge, for example. But the big players out there have been the big players for a long time. E-Trade, Scottrade, Charles Schwab, Trade King, Options House, and TD Ameritrade have been big players for a long, long time. And they got a lot of different tools, and when you go take a look at them, some you might like better than another, just the look and feel of the thing, but they all essentially do the same thing, which is buy and sell securities, equities at very, very low prices. But remember, with an online broker or a discount broker, you're doing it all yourself, which is great. You get that great discount, and then you can do the investing. Because remember, you can always change your mind and buy and sell at any point, but now it's more on you to be the expert and have some expertise around your trades. And my hope is this course really helps you with that, and that you can take advantage of somebody like an online broker and enjoy those cost savings. Another way that you can buy and sell stocks and other things such as bonds and mutual funds and other types of investments is through a financial planner. You have like stockbrokers, full-service stockbrokers, which are basically mostly about trading and buying and selling stocks. You have discount online brokers, which is all do-it-yourself, and also trading and selling stocks, where financial planners are real people that you would actually meet with, and their whole idea is to be a financial planner or a financial advisor for you, right? So they're not just focused on stocks, they're looking at your overall financial picture. So they look at things like stocks, bonds, cash, their whole investment aspect. But they would also typically look at areas such as insurance, long-term insurance, short-term disability insurance, health insurance, life insurance, whatever. There's a variety of products and services that they can provide that'll help you with your overall financial picture. And that's their key thing as far as a financial planner or advisor is they're there to advise the whole part of you, of your whole portfolio or investments, all the things that you're doing, and give you advice on anything related to financial manners. And that's their key thing and their key role they do. And with that, they can do all the other stuff too. They can buy and sell stocks. They can make recommendations. They can give you advice. They have access to lots of experts possibly or research. And their whole thing is they're supposed to stay on top of anything related to financial and the financial markets. And their goal is to really manage an entire portfolio on your behalf. So maybe with an online broker, let's say, where you're buying and selling stocks, well, that's just the stock portion. A financial advisor would say, how can we set up an entire portfolio of a mix of different assets, both stocks and bonds and cash and maybe precious metals like gold or real estate or whatever it might be? How can we set up a whole portfolio that meets your risk profile? And then my role as a financial planner or financial advisor, or their role would be to help advise you on what to do within your financial plan. With your overall financial plan. So let's say if stocks have a big run up, for example, they might say, hey, we're getting a little too heavy in stocks. Let's sell off some of those stocks and rebalance our portfolio, maybe buy some bonds or some cash to help balance the overall portfolio. So you can see their role is to be more about that holistic financial planning aspect. Some keys around financial planners is trust is so huge. We talked about trust in the full service brokers, of course, that's very trust. But a financial planner, I think you need to even have more trust in that person because you're basically discussing everything with them. You might be talking about things like wills and inheritance and things like that. They might refer you to an attorney or a lawyer to actually draw up the will, but they'll talk to you about the importance of having a will, for example, things that go way beyond just simply buying and selling stocks. So you need to have a lot of trust with your financial planner. And if you don't trust your financial planner, if you've hired somebody who's a planner advisor and you don't trust them, then you should really switch and get a different one because it's such a key part for your overall life and your overall financial life is this financial planner. So make sure the first thing is that you trust them. If you're doing it with a husband or a wife, that they trust them as well because you're a team in this and they should both agree on this financial planner and make changes as you need to. Now, financial planners, they need to get paid, right? Just like everybody, I guess, needs to get paid. And they're kind of in between that discount brokerage and that full service brokerage and the costs that are associated with that. And they can, and they advise on everything once again. And how they make money basically is either get a percentage of your portfolio or a flat fee from you. They also might make money on buying and recommending certain investments, certain mutual funds, certain investments too. And that can get a little dicey as well too, a little bit of conflict of interest. Are they recommending one fund because they make a little more money, especially like a load fund where they get paid a percentage right off by selling it versus a no load fund? That can be a little scary. Or is it something that's more about them helping you? Good financial advisors would be all about, if I can help you, I'll make my money by being good at helping you. And that's what you want to hear and what you want to see them do in action. So how do they make money? They make it on fees, and they make it either as a percentage of your overall portfolio, or they charge a flat fee based on the advice they give. So as a percentage of portfolio, it could be 2 to 3% of your overall portfolio on an annual basis. They maybe more actually. They charge a percentage of your portfolio to manage your portfolio of all your investments that they have with them. So if you have investments in different places, they might give you advice on that, but they're not managing that directly. It's only that you have with their particular company that they're managing specifically for you and giving advice to you on that as part of the overall financial plan. They might make money selling insurance and things too. So there's a lot of different ways they can make money, but the primary way is fees and as a percentage. So you got to say to yourself, gosh, if I'm paying this financial planner an extra 1, 2, 3% or whatever it is, that's a bigger hurdle I have to go overcome now in my return on my investments. Now the idea is from the financial planners, they're going to help you get there in a more risk-averse way too, because they're going to look at your portfolio. They're the smart people with the expertise and give you that one-on-one counseling and consulting around financial planning. But you have to decide if it's worth it or not for you. But that's what they do. Financial planners give you that consulting advising. The other way they can do it is to become real popular with investors is flat fees. If I pay X dollars, you'll give me this type of advice, and I pay a flat amount. I'm not paying an annual percentage fee all the time. I'm just paying a flat amount. One time I had a financial advisor because I wanted to get a different opinion beyond my own. Even though I'm a long-term, real successful investor, successful investors know it's good to have another pair of eyes every once in a while, look at your portfolio and make sure you're not missing something. So I found a good financial planner and paid them a flat fee of $500, it's $500 US, to just look at my overall portfolio, see what was working well, what wasn't, and what advice they would have. A one-time flat fee for that. It was well worth it in that case. It's not something I do every year or every 10 years or anything like that, but it was something that I wanted to do at a particular moment in time as I'm reaching a point of maybe switching a lot of my investments around something that might be more oriented towards financial independence or retirement, for example. So I wanted to get a view of that. Particularly also, I have a special needs son and who happens to be autistic, and I wanted to make sure I had some advice around that too, which is wrapped up in that flat fee and for things for him for when I might be gone. So I paid that one fee and boom, done, and that's it. So a flat fee could be a way to go too, especially at maybe milestone areas, milestone times in your life or every once in a while. So that's what financial planners do as far as looking at your overall investment and financial picture. In terms of financial planners that are out there, you could have some big national companies like Ameriprise, as big happens to be in the United States. Ameriprise, there might be some other large organizations out there. Some full-service brokerage firms might have a financial planning arm or present themselves as a financial planner as well. Many and most financial planners are smaller local firms. And many times they're just individuals, somebody working out of an office by themselves. Then maybe they have a couple assistants working for them to help with research, but they're basically working one-on-one with a portfolio of different clients that they have, helping advise those clients. And once again, these financial planners can be fee-based or as percentage-based. So if you're interested in financial planners and a full-service financial planner, ask them how their fees, how do they charge. That'll be one of the first things you'd ask them in their meeting. And some of the key things to ask any potential advisor about in a meeting, and some good notes here, is talk about like their licensing. There's a lot of sketchy stuff around licensing with financial planners. They don't have the degree of licensing requirements that things like possibly like a financial broker or a stockbroker would have. So just be aware of that. They do have licensing. They have like things like CFP, Certified Financial Planner, where you have to do regular testing each year and pass exams and show what you're talking about basically. So that's a good designation. So if you see people with that, that's a good designation, a CFP or Certified Financial Planner. But ask about their licensing. Ask them how long they've been in the business. How long have they been in business? How many clients are they managing? So you get a feel for their expertise and their experience level. Talk to them a lot about philosophy too. What is their philosophy around things, particularly about investing or risk and those types of things, saving for retirement or whatever it might be that's of interest to you, and see how that matches up with your philosophy or your dreams or goals too. I mean, if you're more of a risk-adverse person and you want to try to have a good growing portfolio but maybe more safe, and your financial advisor is like the wild and crazy guy, like, I want to put as much money into growth stocks as fast as I can for you because we know we can make a big bang for the buck on that, so to speak, that might not be as comfortable for you because you really want to trust that person and be comfortable with them. Another thing to ask them about is, do they have any kind of specialization? You see a lot where maybe you have like insurance people who sell insurance, health and life insurance, car insurance, but then they are able to do some financial investing on the side, and then they kind of put it together and say, I'm a financial advisor. And at the same time, you got people really more like investors, financial stockbroker types who might then put a little extra insurance or things on their side, and they say, oh, I'm really a financial planner now. And then there's traditional people who really are that holistic financial planning, that they really approach it from that way. And that's who you want to deal with. If you're interested in the financial planner category, get somebody who handles all the aspects of financial planning and ask them, do you handle everything for us? We want advice on our overall financial picture. Is that what you do? Or do you just do the insurance part? And then, because you can always get an insurance person, you can always hire a stockbroker or use online discount brokers or different things for your if you want to cobble all this together, which is perfectly fine, and have different people doing different things and different specialties. But if you want to have that one financial advisor to advise you on everything, just make sure that they do that, and they might have a specialty or an area of expertise, but they're just not trying to do something on the side and calling themselves a financial advisor. They should be able to give you good advice on everything. Okay, so we've looked at a couple of things here. So financial advisor, looking at your whole financial picture. Full service stockbroker, look at full service advising on stocks. You can do discount brokering online. Now we got a couple others we can look at too as well, including robo-advisors, which are really a growing area right now, these robo-advisors. So let's learn about robo-advising. So maybe you're thinking like, well, I like the idea of this financial advisor or somebody who can at least manage my investment portfolio for me. But I don't want to pay a lot of fees for it. Is there a better way? Is there a way I can get almost like financial advice online cheaper than like getting a full service in-person financial advisor? And the answer is yes. The wonders of the internet and the wonders of the technological age have really helped drive down costs and provide more options for people, particularly for investors. And this is a growing, very fast growing area called online financial advisors or robo-investors or robot investors or online financial planners or robot financial planners. And what's the robo or the robot part? Well, it's based on the wrong algorithms or based on putting together portfolios and then managing that along risk and doing that automatically without being more specific one-to-one to somebody, but putting you in a pool of investors based on things like risk tolerance. So let's walk through this real quick and it'll make a little bit more sense for you. If you've ever heard of like companies like Wealthfront or Betterment, and we'll look at some examples and specifically around them so you can really see them in action in just a moment here in the next lessons, but those are companies that are robo-advisors. So the idea of a robo-advisor is low-cost portfolio management. It's saying, no, you don't need to hire a full-service stockbroker. We can do this at a low cost. In fact, we can actually manage or make recommendations based on a portfolio for you, so you don't have to try to do it completely by yourself either. You don't have to be a discount online buyer and seller through an E-Trade or Charles Schwab. We can actually manage your portfolio for you at a much lower cost. So the idea is that they build a portfolio for you of stocks and bonds and different investments. They build it for you, and then they manage that investment for you, and they also rebalance. When things go up too high, they sell those off and then buy something that's low to continually rebalance to your portfolio so it stay within your risk tolerance. Sounds pretty good so far, right? They're going to do all that for you. They have very low fees, very, very low fees. And so they're going to do this at a much, much lower fees than certainly a stockbroker could do. But even then, like if you're doing it yourself from buying and selling stocks, like with an E-Trade or an online discount broker, or certainly a financial planner where you're paying a flat fee or percentage for just the advice part of it. So they're going to have very, very low fees. So how do they do this? Well, first thing they do is they use a few low-cost ETFs or exchange-traded funds. Right? We talk about index investing or exchange-traded investing where it's very passive. There's not an active manager buying and selling stocks. Just a reminder on that. So index investing is you buy the index and then you want to try to match the index. And it has the ability to have very low cost because you're not buying and selling all the time in that side of the mutual fund. They're just trying to max the index. So lowest cost mutual funds are index funds, or in this case, exchange traded funds, which are traded on a market but act like an index fund that are going to be very, very low cost. And then what they do is they have a very few number of different funds that do different things. It's a large cap stock fund and a small cap stock fund, or it's an international fund or emerging markets. Maybe it's a bond fund. They got some bond funds. So they have a few funds that they have chosen that are very, very low cost funds. Some might be from companies like Vanguard, for example. They might choose those funds because they're the lowest cost, good funds, follow the index, and they choose from those 5, 6, 7, 10 funds, whatever it might be, to build a portfolio. Now, how do they build a portfolio? They've never really met you or anything like that. How do they give you financial advice? Well, they build your portfolio based on your risk tolerance, right? So what they do is they have you do an online survey, and you basically from that it'll spit out, and you might give some feedback, additional feedback too, but it'll spit out saying, oh, I'm a very risk investor. I like to I'm aggressive when it comes to risk, so I can take on more aggressive stocks, or I might be more moderate. Or your survey might say, no, they're a very conservative investor. The survey might ask you things like how far away you are from retirement or reaching a certain financial goal to factor that in too, right? If you're 2 years away from retirement, you don't want a bunch of risky investments. You want more conservative or safer investments. Then if maybe you're 20, 30 years from retirement, if that's your goal, then you might want to take on more risk to get better return. So the survey that they do with this, basically it'll do all sorts of, you answer questions, it'll do all sorts of calculations, and it'll spit out saying you are a moderate aggressive, or you're aggressive, or you're a conservative investor, whatever it is. And then that will also then spit out automatically a recommended portfolio for you at this moment in time. And it'll be this much in a total stock market fund, this much in dividend stock or ETF fund, exchange traded fund, or this much in an ETF for bonds, and they'll build that portfolio for you. All low cost, all exchange traded funds. If you like, let's say index investing or building a portfolio of just index funds, that's what they're doing for you. They're just doing a little bit more because they're figuring in your risk tolerance, and then they're balancing and balancing these funds amongst each other continuously all the time based on the robot part, the algorithm part. So it's based around risk and reducing costs. As I mentioned, some examples are out there like Wealthfront and Betterment. So it's a great choice. So who's this a great choice for? Somebody who might be not as understanding of the market, somebody who wants to get involved with investing, maybe do a little bit more in investing than they've done before, but not ready to take the big plunge and buy and sell stocks on their own, for example, especially individual stocks. But they like the idea of that index investing. They like that idea of exchange traded funds. They love the idea of keeping costs low, but they'd like somebody to maybe give them some recommendations based on their risk tolerance and build something for them so they don't have to think through how to build it themselves. This course will help you as far as building yourself. You can do that. But these companies are providing a great service for someone to get started right away and start learning the market and get going, and pretty inexpensively too, to get started and start seeing how things are working and having a little bit more professional management behind them versus, let's say, totally just doing it yourself. So they're really growing in popularity, especially with the millennial generation, the technologically savvy generation, but whichever generation is growing in all those areas, and it's very popular because think about it. It's like I'm getting some okay financial advice. They're managing my portfolio for me, but I'm doing it at such a low cost, and I don't have to pay big bucks for some stockbroker who maybe I'm worried about if they're churning or buying and selling them, get enrich themselves, or a financial planner giving me advice. This is based on tried and true types of methodologies of index funds, exchange traded funds, bought and sold to rebalance, and driving down costs through these low cost funds. So if you like that, you might want to check out these robo-advisors, and it might be a good fit for you. In this lesson, we're going to take a look at one of the big robo-advisors out there, and that's called Wealthfront. So we'll go in there, do a screencast, and you can kind of get a peek around as far as what the site looks like and how it works. And I'll give you some opinions as we go along, and maybe Wealthfront or some of its competitors like Betterment might be right for you. We'll take a look. Okay, here we are at Wealthfront.
simply wealthfront.com there. And Wealthfront is a robo-advisor. They basically are in between that full-service financial advisor and you being kind of a do-it-yourself advisor. There's several other companies out there as well, like Betterment, that we'll take a look at. But first off, let's look at Wealthfront here. And we'll actually run through how they kind of do it and how they get started here. But first off, a couple things that they emphasize so you can kind of see what their positioning is from a company. They talk about how investing. And one thing that they do is that really stands out for them is they've got on their team Burton Malkiel, I'm probably pronouncing that wrong, and Charles Ellis, who've written some real famous books out there, particularly A Random Walk Down Wall Street is a very famous book, one of the top sellers. If you go on Amazon right now and look at top sellers of business books, investing books, Random Walk Down Wall Street will be there as well as Winning the Loser's Game. So on their team that's helping to advise them on putting together these portfolios for people are these two leading folks. And certainly as far as their expertise and philosophies really tie into that, and they really heavily promote that. Now, how involved are they in the day-to-day operations a lot? Who knows? I have no idea. Maybe they're just a consultant, maybe they're an advisor, maybe they're part owners, maybe they're really involved. Who knows? But they're trying to follow these kind of philosophies around it with these folks. So they really promote that. And these are good books. I'd recommend these books. I think they're pretty good books. So particularly Random Walk Down Wall Street is a very, very famous book. So they look at that from a philosophy standpoint. Next, they talk about costs. Well, what does this cost to do? And how they do is a little different than having a pricing chart. They got this kind of calculator here. And you can see on the bottom where it says account value, it currently says $100,000. One thing about both Wealthfront and Betterment, if you're not from the United States, it might be when you log in, let's see if it gives you in pounds or in your currency, or if you can even do it, because as we look further, there might be things that this may be limited to U.S. only, but something to take a look at. Because I'm based in the U.S., so that's what I'm seeing. So if your account value is $100,000, what you pay them every month is $18.75 as far as their fees. And they'll put together a portfolio, they'll manage it, they'll do these things we're going to look at in just a second, but you basically pay them $18 a month if you have a $100,000 portfolio. Now, the nice thing about some of these robo-investors, particularly Wealthfront, and Betterment too, but if you have a low amount you want to get started, and let's say your account value is $500, and they're going to ask you to continually invest in stuff, but you pay no fee at all. They actually have a way to get started without paying a big fee. Or if you have a small amount, like let's say, it's hard to slide this thing, but that's one criticism there, but you get the idea, is let's say my account is, I'm going to go on here, is $11,000, let's see, it just jumps up, $20,000. Well, I pay $2.25 a month on $20,000. And if you got a lot of money, you just keep sliding it over. If you've got $630,000, you pay $129 a month. So their whole thing is that they're going to put together a portfolio view of low-cost funds or low-cost investments so they can keep your overall fees down, is the idea behind it. So that's one thing why they put up front here is they're really trying to keep your fees down, and they're going to do all this investing for you, right? You don't have the time to do investing, they say, so they're going to manage it for you, which is really nice. It's really good if you want to have kind of a portfolio that's kind of automated and doing it for you. Once again, they're in between that full service advisor and doing it yourself. And different things they do some things like tax allocation, commission fees, diversified portfolio, all sorts of things that they set up there for you. If we look at, let's say, why Wealthfront, a couple of things on there. One thing I'd look at is, let's say, like our low fees. Once again, these things could change at any point in time. I'm just showing you, the current example on there. Also, I don't represent Wealthfront or any of these robo-advisors. I actually don't invest with them because I'm an expert in this, so I do it myself. But this is would be something, especially if you're a younger investor or less confident, maybe this might be a way to look at. And they talk about the cost here is first $10,000 is managed for free. That's pretty good. And then low 0.25 annual advisor fee. That's a typical index type fund thing versus, let's say, 1 or 2% or more on actively managed funds. They do look for an account minimum of $500, and you can actually invite your friends, basically be an affiliate marketer for them, and they'll give you a break on it. So FAQ and some things you can check out, and they give you an example of how fees add up over time, which is true. Fees add up over time. So they're very much trying to manage it for you, low fees, be tax efficient, and follow these methodologies as far as investing and passive investing, and let the indexes and things work for you. They'll talk about who we are, and they'll once again emphasize their different experts that they have in there that they've brought on board, and and how they kind of do it. And also, under what we do is they'll share a little bit more information on there too, the different types of accounts they have, retirement, non-retirement. Once again, this is another indication, might be really U.S. only, 401k, Roth, that's our USA type things. And it talks about the benefits of diversification and how they do their diversification. I believe I saw somewhere that they have like 11 different funds that they use to give you diversification. So not like hundreds or thousands, they keep it pretty tight, and you can see some of the examples here. But we're going to actually sign up, well, sort of sign up. We're going to get started with it so you can kind of see how it works, and and see if this is for you. So we go back to the home page. You can get started with Invest with Wealthfront. I'm going to go a little ways without having to actually sign up, but you can kind of see how it works. First thing they're going to do, and what these other robo-advisors do, is try to get an idea of your risk tolerance and get an idea of what some of your goals are. And so they might ask you some questions around that. And Wealthfront does a nice job of asking some good goals. Now, this is a little salesy too, because once you pick something like, I'd like to create a diversified portfolio, well, that makes sense. Like, great, at Wealthfront, we do that. Yay. Well, wasn't that something? So let's say I'd like to save money on my taxes. Sure. I like someone to completely manage my investments. Well, that's the main idea of having them. If you're doing it yourself, then you don't need Wealthfront. I'd like to match or beat the performance of the markets. Well, who wouldn't at least like to match, right? That's index investing. And, good news, they do that too at Wealthfront. Well, okay. But if somebody was really interested, let's say, on one particular thing, they could highlight that, and maybe it'd be all about, let's say, performance or something. But we'll pick all of them because they all sound pretty good. What is your current age? I'm going to put in here. There's a lot of folks that are younger actually use Wealthfront. They're probably about 2/3 to younger versus like millennials versus, let's say, boomers from an age range. So let's say somebody's getting started and let's say they're 27, right? Maybe they're going to start low. Let's say 30, just a round number. So let's say we're going to get started with Wealthfront. You're 30. You could put in whatever number you are, so you don't have to sign up. And let's say I have $30,000 US in pre-tax income. So this what is how much I'm making a year is $30,000, right? Let's bump that up. Let's say I'm now making 35. Let's say I'm making 35,000. Well, that's terrific. But you put in whatever number you're making. And what's following best describes your household: single income, no dependents, like no children, single income, at least one dependent, like a child, dual income, and all this kind of stuff. So I'll say it's dual income, no kids or dependents yet, just me and maybe the wife or your spouse. What is the total value of your cash and liquid investments? So what would you be bringing into Wealthfront is what they're kind of asking. It could be very small. It could be a large amount. Let's say I've got $30,000. I'll just leave this here. Let's say I've got $30,000. So I'm 35 years old, and I want to invest $30,000 with Wealthfront. I'm maybe transferring some stuff over and to get started. When deciding how you invest your money, what do you care about more? Maximizing gains, minimize losses, both equally. Somebody who's very risk averse would want to minimize losses. Typically they'll pick. If somebody was, let's say, I just want to maximize gain, I'm real risky, then I might pick that. So let's say we want to do both equally. We want to be kind of more of a moderate investor. We want to get some gains, but we don't want to get crushed in our losses. We don't want to be riding the wave all the time. So I click that. Global stock market is often volatile. If you lost 10% of its value during a month or a market decline, what would you do? So your whole portfolio goes down 10% in a month. This is a gauge to see what people do. Some would be like, oh my God, I got to sell. This is like terrible. I'd sell all my investments or sell some. Some would keep all of it. Some would buy more. You just choose whatever you want to choose. If you're a moderate investor, we're going to use this person as a persona, as a moderate investor. They might say, well, we might keep it all. We're just going to buy and hold, and we're going to keep. We won't buy more, but we'll keep what we got. All right, so answering those questions, they're now going to look to create, quote, the optimal plan for you based on their philosophies and things. Remember, this is their philosophies, which could change at any time. They're doing this for you. Then you put in your email and you can get your plan, and they can start marketing to you and get you all set up, right? But I'm going to close this just to take a look at the plan, because they actually give you that, which is really nice and transparent. I like that. That's pretty cool. All right, so this is a taxable investment mix versus, let's say, a retirement investment mix. Maybe if you had like Roth IRAs and 401ks, those numbers would probably change, and they do. You see, for a retirement mix, they get a little higher in income type stuff because of how retirement things in the U.S. and their IRAs and 401ks, there's some benefits to that. But let's say this is taxable. This is outside my 401ks or taxable account. This is just money I've got to invest. All right, so my risk tolerance, they say, is an 8. I don't know what that means. That's on a scale of 1 to 2 or 10 or whatever. But I can lower my risk or increase my risk level, and we'll see what happens to my investments or my portfolio. We'll do that in a second. So based on the fact that I am 35 years old as this example, and I have $30,000 to invest, and I answer the questions to be kind of a moderate type person. I could always go back and change my answers by the way here, but I'm a moderate person. In fact, if we go over here, it talks about how they came about with this thing based on your targets and your things. But here's your diversified investment plan. So they basically got me 35% in U.S. stocks, 22% in stocks outside the United States, 17% in emerging markets, got some dividend stocks, 8%, a little bit in natural resources. That's interesting. A sector right in natural resources are like oil and gas, that type of stuff, timber possibly, and municipal bonds. And this is why another reason why I wonder if this is really U.S. based, because municipal bonds are bonds by cities, and there's a lot of tax advantages in the United States if you own municipal bonds inside the state where you live. There's going to be a whole course on municipal bonds, but if you're one of my students who are outside the United States, and I'm really blessed to have many students outside the United States, go to Wealthfront and just see what it does. If it asks you things like what country you're from or whatever, it might. So it might not be for you. That's all I'm saying. Maybe this is strictly U.S. based. So with that, you can see, wow, that's pretty. I've got like 13% in bonds, and it's all in municipal bonds. The rest is in stocks. If you see this, natural resources, dividend, emerging market, foreign stocks, U.S., the rest is in stocks. And if you look at foreign and emerging market together, well, what is that, 22 and 17? That's 39%. That's pretty hefty, in outside the United States as far as what a lot of financial planners, a lot of people recommend. And that can change over time. Maybe their advisors and their team thinks U.S. stocks are overvalued, so they're looking for, these foreign stocks or emerging markets. At the time we're looking at this emerging markets, we're down, for example, so maybe they're trying to buy low. Okay, so that's my portfolio that they gave me. I could then sign up. I can change my answers and change my portfolio. I could change my risk tolerance here. So I could, go, let's say I want to lower my risk. Let's say it was originally 8.0. You see where it says I'm going to lower my risk tolerance. So I don't want to be as risky. See how my stock portion went down and my municipal bonds went way up? Because I'm trying to take out that stock, that volatility risk, and getting more into bonds, which will help minimize risk that way. But if we were back at our 8, or let's say we go higher to all the way up to 10, I guess is the maximum. So that's something real risky. You can see very little in bonds and all that. I bet if I change my answers, let's lower this back to the 8. And I bet if I change my answers, this is the whole thing here. I bet if I change my answers, then it would change too, but also it would change based on the original number I put in. Remember when I started here, invest with Wealthfront, and there was a part where it asked me my age and things like that. If I was 60 years old, it would probably give me less risk investments as well. So the idea behind all this, just showing you a little bit, once again, I don't work for Wealthfront, not recommending them or anything, I'm just showing you what they are. And the idea is that you could get this plan that basically they spit out for you based on these answers to your questions. And then they'll actually manage it, and they'll do some tax efficiency things where they're actually buying and selling types of stuff with tax loss harvesting. It's in the course talk about tax loss harvesting, where you're selling your losers, the things you've lost money on, and buying more winners, and that you can actually then use those taxes towards that. So there's some tax efficiency in there, which is good. They certainly talk about their low fees that we looked at before and how the fee structure works. That's working nonstop. You can set it and forget it. That's the whole idea. You just sign up, you set it, they do all the stuff for you, they buy and sell for you, and you can always check your account balance anytime, and the dividends are automatically reinvested for you, which is nice. You don't have to do anything. You basically set it and forget it. That's the idea of all these robo-investors, and that's the idea behind Wealthfront as well, too. So that's Wealthfront. If you're interested in them, check them out. There's a lot of other ones, too, like Betterment and others we'll take a look at, but that's Wealthfront, and might be it's a kind of a newer type thing where it's not a full financial planner where you go into the office and you sit with them and you have this whole discussion and big whole sorts of things about goals and stuff, but it's not completely do-it-yourself either. It really is in between, where it's like, I'll answer some questions and they'll spit out a portfolio for me. Though even look at the portfolio we did, for me even, who takes I take on a lot of risk and stuff, even I'm looking at that like, that seemed a little risky, but they're using their experts to make these recommendations, and who am I to say that they're not right? So Wealthfront might be a robo-investor for you to check out. In this lesson, we're going to look at another robo-investor or online financial investor that puts together a whole program for you, and that is Betterment, very much like Wealthfront. The idea is you put in some information, your risk tolerance, some other types of data, and they'll spit out a portfolio based on that information, and they'll automatically set it up for you and manage it for you and manage the taxes and everything for you is the idea. Very, very low cost. It's all done through the internet. So let's take a look at Betterment and learn a little bit more about that. And I'll share some insights and things along the way as well too. Just like any of these case studies, whether it's Wealthfront or Betterment or any of these folks, I don't do business with them. I'm been investing for a long time, so I do it myself. That's why I'm teaching the course. But it's a good thing for somebody who might be starting out investing, maybe doesn't have a lot of time and wants to maybe explore these options. So that's who it might be a little bit more for, something where it's in between completely doing it yourself and the other end of the spectrum where you have maybe a financial planner who you're paying to do it for you as well. These guys are in between with some low fees, all done on the internet. Very popular once again with younger folks, by the way, too, with the millennial generation is grasping on these programs more so than others. So let's take a look at Betterment. Okay, here we are at Betterment, betterment.com, and it's, I guess, better your finances is the idea behind it, right? So this is betterment.com. Once again, I don't get any kind of financial compensation or anything from them. It's just something that's out there that I want to make sure educationally that you're aware of with these robo-investors. So first off, Betterment, one of the larger ones out there along with Wealthfront. You can see they have $5 billion in assets. These web pages change all the time, so I'm not going to continually update the lesson here because you can go out there and take a look at it yourself. But the concepts will always remain pretty much the same with these guys. And we got a part here where it says getting started, and you put in a couple basic things and it gets you started. And we're going to do that in just a second. So, but I want to give you some highlights from Betterment here, but then we'll actually do a kind of a sample portfolio so you can kind of see what it looks like. So first off, what they do, they're pretty transparent. I like that about them. They talk about right up front, we invest in low-cost index funds, really it's exchange-traded funds, what they're investing in that as opposed to like a mutual funds. You can talk about how their fees compare. They give you personalized financial advice, but it's really more about you putting in the inputs and then that creates an output. So it's not like you're talking one-on-one with folks or anything like that. Maybe if you got like 500 grand in assets or more, they'll answer the phone. I don't know. But the idea is you put in the information, they'll then build a portfolio based on that information for you, and then they'll help manage it for you, buying and selling to meet your risk level too. So it's really very much a hands-off type approach from you once you get started. And like others, they have some team of experts here, and they're trying to automate, which is good. Automation is good, and trying to manage and lower taxes. They'll do things like tax loss harvesting to try to offset your gains with your losses as they manage that portfolio for you. All right, so there's lots of things that you can look at from there. One thing that's nice too is they actually share their portfolio, what they pick from in here. So if you go through, you'll see this is what it'll look like when we do it in a second here. But they'll create an optimized allocation. They use 12 different asset classes basically within stock and bond exchange traded funds. So it's not getting the gold or cash or anything like that. It's really stocks and bonds. So that's one limitation of many of these types of programs. But the nice thing that Betterment does is they actually tell you what they're using. They actually are very transparent with their stock and their bond ETFs or exchange traded funds. And exchange traded funds, once again, act like index funds. They're tracking the index, and their idea is that they're designed to be very low cost. And you can see on the left here some of their stock ones they have. They have a total stock market, large cap value, big cap stocks, mid cap value, small cap value, international developed stocks, emerging market stocks. And then over here on the bonds, you've got short term, inflation protected, which is the short term is U.S. Treasury, so that's United States based. Once again, this could be very United States based. So if you're outside the United States and you're watching this course, these robo-advisors might not fit you, and just be aware of that. So take an understanding of that. Because when they talk about IRA and 401k accounts, that's definitely United States. Those are types of tax advantage 401k accounts. Municipal bonds, those are cities in the United States. So and you get some tax advantages from those. And then they go to corporate, international developed and emerging market bonds, a little bit more riskier bonds. So this is what they're choosing from these 12 of all the gazillions of different funds out there. This is the 12 that they're choosing from in these broad-based, index-based exchange trade funds to drive the cost down. And you can see one thing they do nice is they show who is actually doing it. And these you can see there's a lot of Vanguard funds here as a low-cost provider. They got some iShares here as well, as far as with their municipal bonds. And the nice thing is these are real actual funds and stuff. They're not making up their own stuff. This is actually Vanguard. You could click on, let's say, this large cap fund, for example, and it would actually pull it out and put it right into into the Vanguard website and show you that particular website and show you that particular fund. So they're going to build this allocation for you, is the idea behind it. And if you go into, and they get different types of accounts you can open, from retirement to trust to different things. They give you some information and resources, which is nice. Let's take a look at pricing here real quick, because that's pretty interesting. Where Wealthfront had a little calculator and you kind of do the slide rule thing, they do it where they'll show you based on your account balance. So you can get started real low with these robo-advisors versus, let's say, buying just a particular mutual fund or trying to set up a financial planner brokerage account that might not like to do that with you. These guys, you can get started very low. I mean, you can see, you can do $1, I guess. This is all in US, but up to almost $10,000 US, your annual fee is 0.35, right? And that's if you keep putting in $100 a month every month into it. You pay a 0.35%, so very low fee on your account. And as your accounts get bigger, up to almost 100,000 or 99,999, you're at 0.25%. And if you're 100,000 plus, then you're at 0.15. And as you get to these over 10,000, you don't have to keep putting in that recurring deposit. Recurring being like, every month I'm putting in a certain amount of money. In this case, it has to be $100 a month to really qualify for this. Otherwise, you got to be at the $10,000. But they talk about some of their no fees that they do, no rebalancing fees. That's one of the big things with any robo or online investing service or program. Their whole idea is that they're going to automatically rebalance for you. You don't have to do that. You don't have to think about that. The whole idea is they're trying to take your thinking out of there. You're just basically going to put in inputs, and they're going to do the thinking for you. They're going to do the investing for you. And your whole thing, do it at low cost and manage dividend reinvestment and manage taxes. As far as taxes you're incurring, you still got to do your tax forms, but they're going to manage the taxes you're incurring and try to minimize that and do that all for very low fees. That's the whole idea behind these guys. And they'll give you some comparison here as far as versus, like, let's say, full service type financial planners. And they're going to be less expensive than a full service financial planner, without a doubt. That's their whole mode of operation. We're not going to give you a lot of advice. We're going to take some inputs and then we're going to give you some advice. So let's get started here. So as an example, right? So the first thing to do is they ask you how old you are. Well, let's say I'm 30 years old. Well, if you'll see my videos, I'm not 30 years old. I'm much younger than that. Well, actually, I'm older than that. But and then you put in, but we're going to use an example of somebody might be a younger person, because a lot of people use these services tend to be younger people. That's probably 2/3 of their business or more comes from 30 and under folks at this point. Whether you're retired or not retired. So we're going to say we're not retired. We're trying to save money to retire in the future, right? And they're going to ask you what your annual income is, right? So how much you make in a year. So let's say we're making, so you're 30 years old, let's say we're making $35,000 a year. Just you put in whatever number you want to put in, whatever's appropriate for you. I'm not 30, I'm much younger, older than that, and I'm making more than 35,000 too. But we can put this in. This is an example as a persona. So for this is where this 30-year-old making 35,000, and what it's going to do is it's going to ask me a question. So first I'm going to select a goal. Remember we talk a lot about in goals around investing. So maybe priority one is I want to save $8,000 for 3 to 6 months of unplanned expenses, right? So that's the number they're using based on what you put in. So let's say I've already got my safety net. I've got it in my bank, so I don't need a safety net. What I want to do is I want to save for retirement, right? And this will even say, I want to save for this type of retirement, let's say, a long-term type thing. And it's saying I'm going to be at 90% stocks and 10% bonds, and this will give me a retirement of $36,000 a year. I mean, in a regular taxable account, as opposed to, like, let's say some of these U.S.-based IRA other accounts. So I'm just going to set up a regular taxable account, and I'm going to save for retirement. And I could read more, but let's just select this goal. Remember, I'm 30 years old, 35,000 income. What I'm focused on is saving for retirement. This is what they're saying, so let's see what comes out. Okay, so what they're saying, a recommended allocation of 90% in stocks and 10% bonds, and that they're considering a moderate risk allocation. You can always adjust it, they say, but that's considered moderate risk. I will tell you that any financial planner would say that is an aggressive that is a more aggressive type of allocation. Now, this is their plan. This is what they're setting up, particularly with the potential for interest rates to rise on bonds and things. Maybe this is why they're trying to stay away from bonds, but that's a pretty heavy allocation to stocks.
And if this particular portfolio is going to go up and down a lot, it's going to be very volatile. But that's okay. Maybe I would say that's once again more of an aggressive investor, but I'm okay with that number because I'm an aggressive investor. Even me, I'm like 85 or 80-20, but I'm older. But at 30, you have a long investment horizon. Maybe that's the right number. You have to be comfortable with that. But I'm going to say that most investors, most people I talk to, that could be a little heavy for them. But it's up to you. It shows you can click on the little things and it'll tell you what's invested in each of these little buckets. Or easily you can click on details and it'll actually show you here, how much is invested in each thing. So not only am I heavy in stocks, they'll break it down like how much is in the total stock market, how much is large cap, how much small cap, whatever it might be. And as you can see here, what they've done is they've put a lot in developed markets and a good chunk in emerging markets too. So this would be outside the United States in developed markets, maybe like European Union, that kind of stuff in developed countries versus, let's say, more emerging markets that might be out there, like even Brazil and others are a little bit more emerging than, let's say, Nigeria, for example. All these countries are following one of these categories. So if I look at this, I can see 47 and 48% is going to be in international stocks of my stock portfolio, of my overall portfolio. That's a pretty big chunk. So this is going to add even more volatility around that too as well. And you can see my bond part, pretty minimal. And a lot of that's in real safe United States city bonds, or relatively safe United States city bonds. So, in bonds. So this stock portfolio would be one that in this example, and this you want to put in your own numbers, but in this example, I would say this is very volatile. It's going to go up and down a lot. And you better be comfortable with that if you want to do this portfolio. But they're saying this is going to outperform the market and this is going to work best for you. You put in there, they'll manage it for you. They'll lower your fees, and later on if they decide like, wow, maybe developed markets isn't the place to be, they'll sell off some of those and buy U.S. large cap or small cap, whatever. They're going to manage that for you. Once again, you're basically putting your trust in them to do all this automatically for you. The benefit that they're going to give you is that automation. They're going to do it for you in low fees and low cost to do it versus, let's say, a full service financial planner, or versus, let's say, you putting together your own basket of mutual funds or index funds or exchange traded funds. They're going to do it all for you. So that's why a lot of younger investors like this, people who have less education around investing, because like, oh, I'll just give you my money. You're going to be low cost, which I like because I hear these financial planners can be a little expensive, and just do it for me. And if that sounds like you, then this might fit. If it doesn't sound like you and you're learning stuff from this course, maybe you want to do a little bit more. Maybe you try a little bit in Betterment or none, or in any of these robo-investors, and you put together your own type of portfolio. That's certainly what I do. I don't have any money in Betterment. I don't have any advantages to promoting Betterment or anything, or Wealthfront or any of these robo-investors. I do want to make sure that you're aware that they're out there because they're really growing and they provide a nice service. Though as I look a little deeper in them, I would caution you to look deeper into them even still as far as if it fits you. But low cost and diversified portfolio, they can kind of do it all for you without you having to do it yourself. So that's Betterment. Their website might change every once in a while, so check out for the most current website versus what I'm showing you here. Oh, by the way, one other thing is I only put a little bit of information in here. They didn't really ask me a bunch of questions around my risk tolerance or too much around that. So that might have been a little concerning for me too. Maybe if I actually signed up, it would get in more detail and then really hone it down. So maybe it's not fair for me to say that they're going to always be 90-10 based on that criteria. So check it out for yourself, and it's low cost to get started. And maybe Betterment and Wealthfront and these other companies are for you. If not, do it yourself, or you can use a financial planner. But the things you're learning in the course will really help you with any of these types of services. One way that you can buy and sell stocks, even individual stocks, is sometimes through your own mutual fund company that you're using. You might be using Fidelity or Vanguard or Charles Schwab or some other large mutual fund company. You might not know they actually have a brokerage service or a brokerage arm of the company. As these companies start expanding their financial abilities to offer different products and services to people. So if you have already some existing mutual fund account, particularly if it's outside of, like, let's say a government or a employer-sponsored account that has some special tax advantages that you might have. In the United States, as an example, they would call it 401k. So anything that's outside that, look at them. They might offer you some brokerage services where you could buy and sell individual stocks as you want. What you're looking for is anytime they're referring to something like a brokerage account, it would be a separate account than maybe your regular mutual fund account, be separate than any kind of tax advantage account, and they could set that up as an account for you as far as a brokerage account where you could buy and sell individual stocks right through your mutual fund. And they'll quote you the prices and everything too there. It might be certainly lower cost than a full service stockbroker as well, and might compete very well with these online discount brokers. So if you have mutual funds out there, look for brokerage accounts. Now, if you don't want to try and buy and sell individual stocks anyways, you like exchange traded funds or mutual funds, well, your mutual fund company would do that all the time anyway. So then you can look strictly at mutual funds, looking at the stock mutual funds, look at the different style boxes, expense ratios, all those things we learned about, and go out and pick different mutual funds for your portfolio and your stock portfolio. One thing about mutual funds and exchange traded funds, as we learned, is exchange traded funds are like buying stock on an exchange. So there's no exchange traded fund company. There are, like, let's say, mutual fund companies that sell mutual funds and sell exchange traded funds, or the ability to buy exchange traded funds, or you're buying from other sources these exchange traded funds or mutual funds. You're buying it through the mutual fund company. So there's no Vanguard ETF corporation. It's Vanguard, and Vanguard sells mutual funds and they sell exchange traded funds. And by the way, they have a brokerage service too, where you can buy and sell individual stocks as well. And that's all going through a mutual fund. You can do all your transactions through them versus, let's say, an online discount broker like Charles Schwab, or like a better example would be like E-Trade, or a full-service stockbroker like Merrill Lynch, for example. So take a look at your existing mutual funds you have, and they might have already the different options that you were interested in: individual stocks, exchange-traded funds, and mutual funds. These big companies like Fidelity and Vanguard already have all that, and maybe that's the way to go to buy and sell stocks. Do you have a faucet that leaks or kind of drips? Well, that's no fun. That can be really annoying. But drips in investing could be a lot of fun and something you might be interested in, and can be serve you very well. So what is a drip? It's actually a thing. What is a drip? A DRIP is a dividend reinvestment program. That's what it stands for, dividend reinvestment program. So what's involved with a DRIP is you're buying stock directly from the company itself. So if you're interested in stock A, you would go to that company, and typically online, you can order stock directly from the company. You don't have to go through a discount online broker or a full service broker or a financial planner or anything like that. I can just buy stock directly from the company. And boy, isn't that a great cost savings potentially by buying stock directly from the company? It sounds great. And the reinvestment part is its dividend reinvestment program. Is the idea you're buying, this would be mostly for, there's a couple out there, I can't remember who they are, but it's mostly just a few, and it's only a few dividend paying companies that allow you to buy their stock directly, and then you can reinvest the dividends in the company, or cash them out too. And that's why they're called a DRIP, or dividend reinvestment. You're buying the stock directly from the company and then reinvesting those dividends right in the company too. So it sounds great. Now here's the downside of it. One, it's very rare. It's very rare for companies to offer because they don't want to manage all that. They want to be listed on a stock exchange, have people buy and sell their stock on the exchange, and then they pay out the dividends to their shareholders, or their owners in effect, like normal. They don't want to have a separately managed thing with employees trying to manage this whole investment thing of this DRIP, or dividend reinvestment program, because while they're doing the DRIP, they're still listing on the exchange. They're still paying out dividends directly or paying out dividends to the shareholders who bought through the exchange, bought the stock individually, or maybe own stock as part of a mutual fund or exchange traded fund. So they're doing all that already. So they don't like the idea of creating a DRIP just to handle this small group of people directly. But some companies do offer it, and it's a great way to buy stock. Particularly if you like a particular stock, check out to see if it offers a DRIP. Typically, like a big Fortune 500 company, a Fortune 100 company, good long-time paying dividend companies, they might offer a DRIP. So when you're on the website, what you're looking for in the investor section is you're looking or searching for DRIP, or dividend reinvestment program. One thing when you look at the dividend reinvestment program, if you find a company that's offering it that you're interested in, is really look closely at the minimums and other details such as fees closely, because it's usually a pretty good deal, but understand it might not be, depending if you have to maintain a certain minimum, or what you might have as far as rules around, that you have to reinvest the dividends, or can you cash out the dividends, or how long you might have to hold the stock for. Remember, they're just making up a special deal for you outside the market, so they have a little bit more control on the liquidity and the other rules around that stock. So you buy a stock on the stock market, you could sell it 2 hours later or 2 minutes later. Where if you buy it through a drip, there might be limitations around that. Also, you buy in a stock market, there might be different types of minimums out there as far as just needing to be able to buy the stock. Whereas in a drip program, it might be a real hefty type of minimum. And it all varies by companies. There's no standard with this, and only a few companies offer it. So I would say first thing is do your due diligence, look at companies, and if you're looking at dividend investing, narrow your field down to dividend investing stocks. And if you've got a couple in mind, check out their website. You'll be doing it anyways, doing your due diligence to research the company. But it might be worth it to go to the investor relations section of the website or of the company information page and find out, or you can just ask them directly, send them a note to the investor relations section. They usually have an email you can send quick questions to and ask, do you have a DRIP or a dividend reinvestment program? If they do, it'll be right there on the website, and you can usually pull up the document and you can see what are the different minimums and things involved. So DRIPs, rare, but if you find one and you like it, might be a great way and a little bit different way to invest in stocks, and particularly you're looking at dividend stocks that will then be reinvested. Okay, so you've settled on different types of companies or mechanisms to help you actually buy and sell the stocks, right? Now, maybe you're with a full service broker, or maybe with an online discount broker, but now that you're with them, you got to tell them the stocks you want to buy and sell, and there's different types of ways that, as far as you can set that up and how you want to buy that stock and how you want to buy and sell that stock, and that's called order types. Now, if you are investing, let's say, in a mutual fund or exchange traded fund, where all that's being handled by either the manager who handles the index or an active manager who's doing all that for you, you don't have to worry about any of this stuff about order types. So mutual funds, exchange traded funds, forget it, you don't have to worry about order types. But if you're ordering, let's say, through an E-Trade or a TD Ameritrade, or you're ordering through Merrill Lynch, they're going to have different types of order types. You have to tell them what is your order. It's more than just saying, I want to buy and sell a stock. You need to tell them, obviously, I want to buy this stock and what the ticker symbol is, like the 3 or 4 digit name, like Wells Fargo Corporation, the bank is WFC, Wells Fargo Corp, so that's the ticker symbol. And how many shares of that stock you want to buy too. And depending on the full service or discount broker, maybe they have a minimum amount of dollar amount you got to spend or minimum amount of shares you have to buy. So you want to look into that too. So basically you want to know the stock you want to buy, its ticker symbol, the online stuff can help you with that. Your full service person can do all that for you. How many shares you want to buy, which is, how much dollars you want to spend. So if a share is $100 per share and you buy 5 shares, well, you need to come up with $500, $500 US, right? So the ticker, the shares, and now you got to tell them what type of order type do you want to have. And here we're going to look at the most common order types that are out there, ones that almost everybody uses, 90% of the investors use, but I tell you, you can get really exotic too, real weird and more exotic types of order types. Well, let's look at the 4 main order types that people use day in, day out, every day in the stock market. The first order type we'll look at is a market order. So when they say, I want to place a market order, I want to buy 100 shares of Apple Corporation and I want it to be a market order. So what that means is you're buying and selling immediately at the current market or current price that it's selling at, right? So you're not waiting, there's no delay. It's as soon as they can process the transaction, they have someone who will sell them the shares, it happens immediately. And certainly with very liquid or stocks are traded on the most biggest exchanges and things, that's happened almost pretty much instantaneously once they put the order in. So a market order means I'm buying or selling immediately, and I'm buying whatever the current price is. So if the price goes down in the next 5 minutes, like 100%, well, then you're buying at that price. So understand a market order, you're buying and selling immediately at the current price. A limit order is where you want to set some maximum or minimum prices that you're willing to buy or sell at. So maybe the stock's trading at $50 and you put in a limit order and say, oh, it's trading at $50, I want to buy 100 shares, but my limit order is a 52 on the max, so that means I don't want to pay more than 52, and maybe a 48 on the, let's say on the max. On the limit order on the max part would be that. Or let's say if you want to sell a stock and it's currently selling at $50, maybe you don't want to sell it for anything less than $50 or $49, let's say, and if it dropped all of a sudden real fast to $35, you don't want to sell it, you want to hold it. So limit order is really setting the maximum and minimum prices you're willing to buy and sell. So that market order, it's just executed immediately, whatever the market price is. Limit order, you get a little bit more control on the maximum and minimums and setting a range for what you want to sell it at. So why wouldn't you always do it as a limit order? It sounds like more protection for you, right? Well, it is, but it also costs more per transaction. It's part of the fee structure and how these brokerage companies, whether they're online or full service, make money. So market order would be less expensive than a limit order. But either way, you can use it depending on what you're looking to do. Another one is called a stop order, and really is known as a stop loss order. And that's basically you're leaving an order out there. It's going to sit out there and it's going to be dormant until a certain price condition is met. So if you bought a stock at here and you want to protect your downside. Let's say you bought it at $50 US and if it got down to 45, you want to sell it right away. You don't want to write it all the way down to 30 or 20 or anything like that. You just want to stop that loss. That's why it's called a stop loss or stop order. And you can just leave that order out there for a period of time. They might ask you to renew it, and there's some costs associated with that. And then it only gets active, it only happens if that was to happen. So if you bought it at 50 and you put a stop loss at 45 and the stock keeps going up to 50, 60 and on and on and on, and that's great. That stop loss order never comes into play. It's never executed. It's only executed if the stock comes down. And so it's basically an order that's out there that's existing and ready to implement once the condition is met. Once again, a little bit more costly than, let's say, a market order where you're buying and selling immediately. Related to that too is a good till canceled or GTC ordered, but you typically know as good till canceled. That means you place an order to buy or sell is in place, and it's in place until canceled, right? Now the brokerage limit, and that's canceled by you, for example. I say, I want to buy this stock at, whatever, this price, and I want to leave this type of order in place, this limit order or this market order. I want to leave this in place. Well, not in a market order necessarily because that's immediate, but I want to put some type of order out there and leave it in place and leave that good till it's canceled. Now, and that canceled by me, the person putting in the order. Now, the brokerage house may limit the time on it. Typically, it's around, let's say, 90 days, both online or full service brokers. And they may limit the time you can have this good till canceled out there without having to renew it and incur some extra fees. But the idea is I have the order out there, it can sit out there, and it doesn't take place until certain conditions are met. So maybe I want to buy a stock, and maybe the stock is trading right now at $50, and it might go up to 51 or 52, and I don't want to pay that much, but heck, if that stock's a good stock and it ever got down to 45, boy, I would buy it in a heartbeat, right? Well, you place a good till canceled order, that says if this stock goes to $45, buy it at 45. Or it might go down to 44 and a half or something right around there. But once it hits 45, the order is implemented. And that's good till canceled. So maybe it's 52, 53, 49, and it's bouncing around, and then the 90 days passes, and the brokerage house or the online discount broker says, hey, your thing's going to expire. It's coming up in 90 days. Do you want to renew it? You can decide whether you want to renew it and incur some additional fees or just let the order be canceled or cancel the order. So that's a good till canceled order. So if you're not sure to take a market and just buy it right away, you can put a good till canceled order in there. Okay, so those are the four most common ways. You see how it builds from just a basic market order of I want to buy this stock or sell this stock and at the current price to getting things a little bit more exotic, a little bit more difficult maybe. It goes from there even further. But if you can master these four, you're perfectly fine. And in most cases, I'm just using market orders all the time anyways. It's not like stocks are selling at 50 and they immediately in 2 minutes drop to 30 or something. Yes, it happens, but and certainly when everything's going down and people are selling like crazy, you can have that volatility maybe, but or buying like crazy. We have extreme volatility, but usually you don't have to worry about some of these other orders as much, but they're out there and you can use them to your advantage. The only advice I'd have, the big advice I would have for any of this order type, and really most things like I said are market orders, pretty easy to understand, buy and sell immediately at the market or current price, but really understand the order you're placing there. So if you're putting in a limit order or stop loss or good till canceled or some other type of really weird exotic order out there, just ask yourself, do I understand what I'm doing here? Do I understand what my order is, and am I understanding what I'm trying to get out of it? Why am I placing a limit order here? Do I need to incur that extra cost and have a limit order? Could I just do a market order? Or do I need a stop loss? Can I just be watching the market and not have that? That kind of thing. So it's something to ask yourself as far as the order. But the main thing, understand what you're doing and what you're trying to accomplish with that order. What is your strategy behind that order if you're doing something exotic more so than a market order? And is it really worth it to do it? Those are questions you would answer yourself. But just really, for the most part, understand the orders you're placing. And you'll be way ahead compared to most folks who are just not sure. They're just trying different stuff. So when in doubt, just use simple market orders, buy the stock, and be done with it.
Initial public offerings or IPOs, for many investors think that's great. I can get in the ground floor of a company as it goes public and I can make a ton of money. And we'll find as we go through this, it might be harder to do that and actually to even make money. We got an example at the end of this lesson too, so stick around for that. I think you'll find it quite interesting. So first let's talk about, well, what is an initial public offering or IPO? Well, it's when a private company goes public, right? And by going public, that means it's listed on some type of stock exchange. It could be anywhere in the world, an established exchange like the Nikkei or the NASDAQ or the New York Stock Exchange or whatever. There's lots of stock exchanges. So, but private companies are not listed on those exchanges. Private companies are held by a smaller group or owners or maybe one person or partners, smaller group of insider, well, I don't say insider, but inside people who own the company, right? It's private. It's not publicly traded. I can't buy and sell stock in a private company. But a public company, I can buy and sell stock. And that's why companies go public, so they can buy and sell stock and be listed on the stock exchange to raise money and some other things to do around that. And we'll learn about that also in a second too. But first off, the understanding initial public offering or IPO, a private company is going public. It's going to be listed for the first time on a public exchange. And traditionally, it was only solid companies that went public, right? It was like, oh, we've been a private company, we've really grown, we're doing terrific. Now we can go public because we're well established and people will really value and buy our stock because we're an established private company. Traditionally, that's how it was, right? But then investing or trading is all about the future. So it's all about the future prospects of companies. I want to buy at a certain price with the hope that the future will be good for this company and I'll have some capital appreciation, maybe even some dividends along the way. But I'm looking towards that future growth. And that's what investing or trading is all about, is what does that future look like? And what is the first kind of mover advantage of some companies that might be larger or starting to go public within an industry? And it was always usually very, it's always speculative, but it was always kind of around these solid companies went private. And then the internet boom kind of happened. Well, more than kind of happened, I guess. And all of a sudden you had lots of companies going public that really had no establishment of facts or anything to really a leg to stand on as far as the quality of the company. Most of those companies actually never had turned a profit. They were just kind of like, we've been borrowing money or getting venture capital in here, people investing in the company in a private manner. And then we would go public, and then we'd raise more money basically from the shareholders. I'm buying stock, and that initial stock sale goes into the company. And the idea when companies go public is they want to take the money that they have coming in from that initial sale before it's traded back and forth between folks like you and I. But that initial sale of stock, that's a big infusion of cash that goes in the company. And they use that, the idea is they use that to grow their organization. That's what you're looking for. So companies are going to take that money, invest in their company, and grow their organization. Maybe it's a retailer says, we've been doing great in this area of the country, but now we want to expand to the rest of the country. We want to expand worldwide, and we need money to make that happen. So we're going to go public. You might have heard the term going public. So we're going to take our private company and go public. So that's one big thing as far as an infusion of cash to invest and grow the organization. That's what we're really looking for. Now, there's also an element of the founders or the owners, the creators of the company, have now want to cash in. They want to have their own exit strategy, right? They've put all this blood, sweat, and tears in the company. They've grown it to something. Now they've gone public, and this is where they can really cash in and really receive a lot of money, not only to the company, but money that they can then take for themselves, that they can use basically to pay themselves. And for many, it's an exit strategy where they grow the company, and their whole idea is not to maybe even continue to run the company. They just want to get the infusion of cash, take their part, and then leave the company and turn it over to others to manage. So think of IPO as the initial offering of a company for the initial offering of stock, and you're trading on the future, and hopefully you're looking for companies that will grow, and they're investing to grow, but there'll be some element of exit strategy or cashing out. Now there's a lot of internet, especially technology companies that might be smaller, and their whole goal of creating the company was to have an initial public offering and then raise a lot of cash for the founders, and then they cash out big time, and it's really not a sustainable company. Or it might grow to a point where maybe a larger company will buy them, they'll merge or acquire the company, and that's how they get their money too. So there might not really be much interest in growing the company long term, just a short-term gain. So you might want to watch out for those. And I was mentioning the internet boom. It was a real interesting thing because that's where it really turned in a great way during the early 2000s or in the 90s. That is, during the internet boom, where you saw these great valuations of companies, you saw stock prices really kind of booming, And you had companies like these internet companies, Pets.com is a famous one for that, and there's others out there too, where they really had never ever turned a profit. Their business model might be a little suspect. They couldn't even necessarily articulate it well. And what is the long-term prospects? But the money was growing so fast. We were really in a bubble, the internet bubble, the technology bubble, that you could almost launch any kind of company. And if it was technology, internet-based, people are thinking, oh, this is the dawn of the internet. This is the birth of the internet. I want to get in and invest in these companies that are really speculative and hopefully ride that wave. Well, many rode that wave up, but then they rode that wave crashing on down too, because a lot of these companies had no real business plan, no real fundamentals. And so we survived that period. Well, of course, we survived that period, but think about that, especially when trading or the market's really rising, when you're looking at maybe these younger companies, what are their growth prospects? So how does it kind of work? So how does initial public offering or IPO work? Well, first off, you have an investment bank that manages it, right? There's called underwriters, and they kind of put it all together. They help, determine like the initial price that this initial public offering will be based on their experience, based on the market, based on a lot of factors. And companies pay big dollars to these big institutions to help them go public. And so they really rely on that. And then when it hits the market and it becomes public, we can buy. Now, the challenge is a lot of the insiders and folks that are tied to these big investment banks, they get kind of a first shot, an early shot before it really truly goes public. So we're not necessarily buying at that initial price. You've got owners or founders in the company. You might have employees of the company that own stock in that company, private stock, and you have institutional investors and big investors who might have a crack at getting that before it goes public. And there's some scandals around that too. And we'll talk about like Facebook. There's all sorts of scandals around, insiders getting in first before it really went to the general public, and some things that happened after that. Now, so since we're getting a little bit later, you can still buy a stock at its initial public offering price, and maybe it'll go up or maybe it'll go crashing down. The investors, the institutional underwriters or investment banks try to get an accurate price, but once it gets out there, it's a free market at that point, and so the price could go up or down. In fact, history shows initial public offerings, the prices will tend to go down, at least for a period of time. So if you're thinking, I'm going to buy an IPO because it's going to go up right away and then I'll cash in, be cautious of that. It's a very, very risky strategy to do. So especially early on, the price can be very volatile, going up and down as the price kind of settles. There's also what's called a lockup period, and that's very important to understand. It's typically 90 days. And what that means is that 90 days, that's when the insiders can sell. So if I'm Steve Jobs and I founded Apple with Wozniak and we went public, well, there's rules around that where I can't sell my actual stock, my private shares that are now turned into public shares and worth millions and maybe billions of dollars. I can't sell those until a 90-day waiting period or a 90-day mark, as far as that waiting period for those insiders to sell their stock. So they have to wait 90 days. So what does that mean for you or I as far as that 90-day mark? Well, think about it. The thing goes initially public offering, we can buy and sell, and then the days start counting down, and then when 90 days hit, what can happen is a lot of those insiders are now looking to capture what money they've got. They want to take their winnings. They want to take their earnings. Maybe they're a venture capitalist that put a lot of money into the private company. Now they want to get their big payout out. So what happens at 90 days is the stock price can really take a hit from an IPO. Potentially can take a hit because all those folks are exiting the market and you have more sellers than buyers, and it causes the price to drop. So be aware of that 90-day mark. That might be a time, if you have a stock, to sell it before that. If you bought it on the open exchange, you're not an insider then. Or buying it after that 90-day mark too. And then you might have the price settling down a little bit, less volatility, and you'll have all those inside investors getting out, between that 90 to 100-day mark. And now you'll have a little bit more truer valuation of what might be happening with the stock. So that 90 days is real important. And really, the big thing I'd really caution folks is don't buy an initial public offering or something that's initially listed for its first day in the market just because it's an IPO. So many people get caught up in the behavioral economics of it or the emotion of it, like, oh, this great private company went public, I'm going to buy it now on its first day of publicly trading as IPO. You might be excited about the company, but I would urge caution on that. Do your due diligence, do your research. Maybe you feel still real comfortable about it, but I know history shows it can be a risky thing. So just keep that in mind if you're looking at something that's just gone public as an initial public offering. That doesn't mean it might not go public and go up from there forever. I'm not making a recommendation one way or another. I am saying that history shows initial public offerings right when they go public are very volatile and can be real problematic. And certainly if you're a risk-adverse investor, these are much more risky things when you're getting early into initial public offering. Let's take a moment and look at one case study or one example I think you might find interesting around initial public offerings, and that's with Facebook. So let's look at this initial public offering of Facebook as a case study and kind of show you how the volatility of these IPOs can be, and sometimes there's challenges and things around that. And a little background on Facebook. I mean, think about an exciting public offering. So many people were using Facebook. They were dominant in their market space of social media. Places like MySpace, remember MySpace, were gone or on their death throes. So Facebook is like, my gosh, they're the next Google or their next whatever. This is great if we can get in there. And there was a lot of excitement around the initial public offering of Facebook when it went from a private company to a public company. And a lot of people are excited to buy that. Now, a couple of little background things. There's some shenanigans as far as the pricing of the stock and who was getting insider stuff, who could buy it before the actual public offering or have this insider stuff and have some shares that they own. So you can read up on that, but there was a lot of stuff on lawsuits around that. I think Facebook actually was exonerated on a lot of those things too, but it was really kind of weird before the public offering. But let's look at it as an example of an initial public offering that could be good at some points or bad at some points, depending on your point of view. So let's start by looking at this chart, and we're going to look and see how the price changed over a period of time, basically over about a year and a half, almost 2 years, over a 2-year period, almost 2-year period. What happened since it was initial public offering of Facebook, and how did the price kind of move? Let's take a look at the chart and see how it went. Okay, so if we're looking at the chart here, you'll see on the, let's just analyze the chart for a second and set it up. On the far left where it says trading days after IPO, or how many actual total days had occurred after the initial public offering from its first day of being available to the public out to 640 days later. So you can see where it went public on May 18th in 2012, and this chart's looking at to February 19th, 2014. So that period of time, obviously we were well beyond 2014, so there's been lots of changes since then. But we want to look at that initial couple-year period to get a feel for what can happen with an IPO in its early days. All right, so the share price, or at the market close, or what the offering price was going to be determined was $38, right? So the investment bankers and Facebook all got together and said, yeah, this stock is worth $38. And behind the scenes, some people were saying that was way too high, but there's a lot of excitement, there's a lot of motion, so they're saying, okay, let's go for $38. And so its first day, May 18th, you can see where it says first day there on the left, it closed at $38.23, right? So it's right there, right at the close of the market or the end of the first day, they're at $38.23. If we go over to the second from the right column where it says 0.6 there, that means it was up slightly, right? They initially offered at $38 and it went up a little bit from the beginning of the day at 38 to 38.23. So up just a little bit, up 0.6. So the next thing is the first day of trading after the IPO. Now you'll notice how the date is like May 21st. That's because the weekend was in there and there was no trading days on the weekend. So that left-hand column is how many actual trading days, available trading days, is occurring after its initial public offering or after its first close. So after the $38 on this, in effect, the first or the full second day or the first full day of trading, not full day, but the first day of trading, it dropped. Oh my gosh, it went from $38.23 to $34, a little over $34. So it dropped 11% in a day and down 10% from its original offering price. So you can see how the daily change and then the overall change is on the far right column, and we really want to pay attention to that. Because you can see on the next day after that, it dropped to 31. It was down another 8.9%, or overall from its initial offering price, it's down now 18%, right? So that's the initial $38 price. So boy, we bought this Facebook stock, maybe you're excited, and all of a sudden in 2 days, you're down like 18%, like yuck. And then you can kind of see how it goes from there, 6, 8, 9 days, and you can see it continue to drop each day, little blips of going up, but you're basically down 24, down 22, down 27 on day 9. You look at day 19, down 21%. Day 68, August 20th, it's down to $20, right? So there's some bad announcements and things with that. Actually, it was a good day for it on the day, because on day 19 it was up 6.1 for the day. But on August 20th, day 68 after the initial public offering, it went up 5% for the day. But really what we're looking at is that far right column. Yeah, it went up 5% for the day, but by day 68, it was down 47%. So if you had bought that stock at $38 or $38.23 on its first day, that you could maybe buy it, that was available. By day 68, less than 3 months later, it's now $20 and you're down 47%. And you're like, gosh, boy, what a bad investment, right? Now, if you stick it out and hang on, you can see what's happening. In day 578, it had quite a rise. And day 642, it's been continuing the rise too. So at day 575, you're well in the black. You're made 45%. And at the end of that almost 2 years, you're down 79%. Now, when it's the bleak days and you're within 3 months and you're down 47%, you lost almost half your investment at that point. Are you willing to stick it out and hang in there? And then maybe you'll rise to that 79%, which it did, or maybe it'll continue to go down. You're not really sure. So you got to look at what's happening there around with Facebook and some of the acquisitions and things they were making in 2013, 2014. So with that, you can see kind of how it can really go down. I mean, it could have gone up too, but you can see how it really changes here. One note about like day 68, and as you're getting closer to those days, towards that 90-day mark, that's a lot of people are getting out a little bit early too, because they know the 90-day mark is going to come, and there's going to be a little bit of selling pressure from those insiders. So they don't wait till day 89. They're smart to know, like, we better get out at day 45 or day 50. Especially maybe when the stock's really going down. Sure, some of those insiders might hang on to the stock hoping it'll go up, but a lot of them are just in it to get whatever money they can, especially venture capitalists. So at that point, they're like, we're just going to get what we can and invest somewhere else. So this chart's a good example as far as Facebook. I'm not saying Facebook's a good company or a bad company. I'm using this as an educational purpose to show, the volatility, especially early when we're only less than 2 years out of an initial public offering or initial public offering stock. The word to the wise on all of this is understanding what you're investing in and think about, am I investing in this for a short-term gain? Am I investing in this because I'm trading or maybe speculating, maybe even gambling a little bit? Am I investing in this because I think there is or because it's an IPO and I'm just excited about an IPO? Oh my gosh, it's Facebook, it's an initial public offering, and I can get it for $38. Hooray! Maybe that was irrational exuberance around Facebook at that period of time. Or maybe you're a long-term investor that says, look, I know Facebook might go down in price or it might go up, but I'm here for the long term. I might own this stock for 5-10 years, and I believe with the advantages they built in, I believe in Mark Zuckerberg and on the executive team, and I think Facebook's going to do great in the long term. Well, you were well rewarded in this particular example or case study. Now, every case is different, of course, so understand that. But the last comment or thought to leave with you around initial public offerings, for some stocks, people get very excited about initial public offerings because they might be a well-known, maybe beloved public company or a private company that's now gone public. Or maybe people have a little greed in there thinking, oh, I can buy it at this price and it'll go up, and isn't this a great thing? So just be aware of those emotions. And are you investing because it's the right thing for you and your family and your portfolio? Or are you investing kind of more emotionally based? And if you are, you might want to check that a little bit and just, grasp those fundamentals, look at your goals and your long-term strategy, and then see if maybe in the first several days of trading, if some of these initial public offerings, fit in your portfolio. But they're certainly more risky than just stocks that have been established for years and years. Another thing you might find out there is preferred stock. Well, it's not find out there. They have them out there. Pretty much all companies have preferred stock. And these are preferred stocks, and we're talking about it from a public company standpoint. There's different types of preferred stocks, but since we're talking about investing in stocks and we're talking about investing in public companies on exchanges, like New York Stock Exchange or NASDAQ or whatever, we're going to talk about preferred stock from that perspective. And really, a preferred stock is about the dividend, really. Their preferred stock is giving you kind of a dividend or a payout. And it's a fixed type of amount. It's not a variable amount. With dividends in a public company or normal dividends, they could change that dividend up or down. They could cut the dividend or do different things with the dividend. So there's a little more risk on there, and you would expect more return as far as growing dividends and growing stock price too. The idea is the stock price would grow faster, and certainly faster than a preferred stock. So you're looking at it from more of that fixed income aspect of that dividend and more of a fixed type of dividend. In terms of like if a company was to go bankrupt and liquidate and sell off everything to pay off its creditors or debtors or the people it owes money to, preferred stockholders are ahead of common stockholders, or what we think of as regular publicly traded stock is common stock. They would get paid ahead of the common stockholders. So if you own a preferred stock or preferred shares in the company and I bought it on an exchange or through my broker and I own common stock, well, if the company goes out of business, whatever little dollars is left, you get paid first before I get paid. Understanding usually gets paid first is one, the lawyers always get paid first. Congrats to lawyers and attorneys. So they get paid first, and the government. The government, if you own anything in the government, they're typically, it depends on the country, I suppose, but typically the government's going to get their share first. So between the lawyers and the government, in a company that's going out of business, usually not a lot left. And then people own debt or bonds or things, they're going to get paid next, and then preferred, and then common stock. So even with preferred stock, company going out of business, you're probably not going to get much out of it. And don't invest in a company with the idea it's going to go out of business anyways, right? Preferred stock is a non-voting stock, so common stockholders, we get to vote on shares. But once again, if you have one share and other people have hundreds and thousands of shares out there, well, your vote's not going to matter much for regular folks like you and me. But preferred stock is a non-voting stock. It's callable, like a callable bond. If you look into bonds and things, it's a company can buy back at any time. So if interest rates are rising, they could buy your cheap preferred stock back and then reissue it at a higher rate to people. So so in rising interest rates, kind of like bonds, where bond prices go down and when rates rise, same with preferred stock, they could be callable, or the company could basically buy them back. And that's really how you want to leave the thing with preferred stock. Really think of it as more of a bond, more of a debt type thing. Think of it as a bond, and it acts like a bond, and it's more susceptible to things like interest rate risk, right? Interest rates rise, especially quickly, bond prices fall. Same thing with preferred stock. Preferred stock will fall and fall quicker than maybe possibly a common stock, at least historically or typically that is what it is. So if you like something that's a little bit more different, then look at maybe preferred stock. It might not be as liquid as maybe a common stock as well too. So when we're talking about stocks in the course here, we're always talking about common stocks, publicly traded stocks. You can buy and sell them very easily. And the idea is you want to get a great growth on your capital appreciation and maybe pay a dividend for dividend paying stocks. Where preferred stocks, like, yeah, it's stock, it's a little different, pays a little dividend or interest, and it acts really more like a bond. So if I'm looking at preferred stock, I'm thinking it's more similar to my bond portion of my portfolio than maybe my stock portion of my portfolio, even though it has stock in the name. You may have heard of stock splits. The stock splits are kind of cool things. So what is happening with a stock split, right? So first off, what it means is your stock is splitting or increasing. You're getting more shares of stock. So if I own 3 shares of stock and we have a 2-for-1 split, now I have 6 shares of stock. So that's a good thing, right? I get more shares of stock. For the existing stockholders. So that can be a good thing. Otherwise, you could also look at kind of diluting the whole mixture of stock out there. So that's a kind of a negative to it. But most folks look at a stock split as a good thing because they're getting more shares. Here's a better example for you on a 2-for-1 split. So sometimes you'll hear about a stock split where it's like, oh, it's a 2-for-1 split, or it might even be like a 3-for-1 or a 4-for-1. But the most common is like a 2-for-1, and the 3 and 4 acts the same way. It's just more splitting. So a 2-for-1 split, if let's say you own 100 shares of a stock, right? So you own 100 shares of this stock. And a 2-for-1 split would say after the split, you now own 200 shares of that stock. You don't have to do anything with that. It's all of a sudden, wow, I own more stock. My statement will say I own more stock. And in the old days when they actually had stock certificates, paper things you could put on the wall or put in your safety deposit box, they would actually send you another stock certificate, so with these additional shares you own. And you're like, well, great. I have 200 shares. I'm twice as rich, right? Is that terrific? No, it doesn't work that way. Because when a stock splits, not only do you get the double in the shares, but the share price goes down an equal amount. So let's say in this example, when it's 100 shares at $50 worth $5,000, let's say, we use US dollars for the sake of argument. It could be rupees, it could be whatever your currency is for a stock that's in whatever country. But let's use dollars just to keep it simple at this point. If you own 100 shares at $50 a share, you own $5,000 of stock. You now have a 2-for-1 split. How it works is you now have 200 shares, but your stock price has gone down the equal amount to offset that, or it's now worth $25 a share for that stock, or your same $5,000. So the key takeaway on this is when a stock split happens, I get more shares, but my actual value, I don't have actually more wealth or more money in that. Now I have more shares and as share prices go up, well then my wealth will go up or down, my wealth will go down. But I basically own more shares. Now the cool thing about that, particularly if it's like a dividend paying stock, if I have more shares, I get a dividends per share. So if they pay out $1 worth of dividends per share and I have 100 shares, well I got $100 in dividends. But now I own $200. So now when I get paid, that dividend might be $200 as far as with the dividend. So that might be something that's very good, right? So depending on how they set up the dividend. So with a stock split, I get more shares, but I don't have more value in the total dollar amount. So why do companies do this? Why even bother with doing stock splits at all? I mean, for the company, it doesn't change their value or anything like that. It's the same. For the shareholder, it's the same. It's the exact same amount of money. Yeah, I got more shares, but it's the same amount of money. So why do companies do that? Well, so a lot of companies' value does not change. The price doesn't go down. Their price might be really actually rising. And for many companies, they're like, boy, if our price gets too high, that regular retail investor, that regular investor like you and I, they might have trouble coming up to buy a $300, piece of stock. They would rather buy maybe 10 of a $100 piece of stock, or 30 of some other, $5 stock, or whatever it might be. Stockholders, especially at the individual level, like just lower amounts, especially if it's like under $50 US, they tend to like that. So in order to kind of almost, not want to say manipulate, but in order to adjust that price down, what they'll do is they'll do a stock split. And as we saw, it went from $50 a share to $25 a share in our example. Well, that might be more palatable for people who are buying stock. Maybe the stock is at $200 a share. They do a 2-for-1 now. It's at $100. Well, that's maybe more easy for investors to get their heads around and be willing to buy it. So the whole idea is a lower price is more attractive and easier for small investors. The values are all actually the same. It's just easier for that smaller investor. And by making it easier for the smaller investor, their hope is that will then drive the stock price up. Because remember, the company valuation around stock price is important, and these managers and CEOs and folks, they own stock too. They get stock options, they get all sorts of things. They want to see the stock go up. They want to see their company be featured as far as a good stock company. So that's important to them, and it's important to their shareholders. So to serve their shareholders, they're like, we'll do a 2-for-1 split, we'll lower our price, we'll drive in hopefully more retail or smaller investors, and that'll then drive our price up because we got more people wanting to buy. It's that supply and demand, buying versus selling. So people are buying, it'll drive the stock price up. When you look at big institutional investors, big banks or big institutions that are managing portfolios, it means nothing to them to drop $300,000, a big mutual fund to buy $300,000 of a stock in one moment, basically, or in one day. That means nothing to them for these big institutional investors. So it doesn't matter to them if the stock is $400 or $500 versus $25. It's really more of a play for that smaller retail investor. And as a smaller retail investor, once again, you and I, we like stock splits because if it works out and the company's stock then rises because of that and more people come in, we already own shares, great. That means we got more shares and the price increases, and that's a great thing for us. Especially as dividends and things might come along the way, owning more shares is always a good thing. Stock splits are great because we get more shares of stock, but another really, really great thing is stock buybacks or repurchases. If you hear a company you've invested in, you already own the stock, and they say, we're going to have a buyback of X millions of dollars, to a stock buyback or stock repurchase program, celebrate, yay, that means good things for your stock, and we're going to find out here in this lesson why this is great for you. So basically what a stock buyback or repurchase is the company is buying its own stock back, right? So they, years and years ago, maybe hundreds of years ago, they had initial public offering and they released all these shares of stock at an initial public offering price and people bought them. And once that initial public offering happened, well, then the stock is traded on exchange, and it could go up in value, it could go down in value. When a company buys its own shares back, it's basically buying shares off the market and then putting it into its own company, or they own the shares basically. It's part of the company valuation. So those shares aren't publicly traded anymore. So they're buying those shares back, which basically takes out shares out of the market, which is a good thing. Less shares in the overall market is good for you who own shares already. So why are companies doing this? Why bother buying their own stock back? Why don't they put money into equipment or hire more people or expand their operations or do a merger or an acquisition? I mean, they could do all these things, but one of their strategies might be buying their stock back. And a reason for doing that is they think their company is undervalued. Actually, they think it's really undervalued is what they're thinking. They're seeing their stock price. They know their price to book. They know what their future looks like. They're the insiders. They know all this stuff. And they're looking at it and they're like, what is going on in the market? Maybe the whole market is down. Or what's going on with our stock? Why are we not getting the love we deserve as a stock? We're a great company. So we see this as companies really undervalued in terms of stock. So what a great buying opportunity. We know it's going to be good in the future, in the long term. So why don't we buy our own stock back at this low price, and then we'll be kind of recapturing those dollars. And maybe you may think the same way on a stock that's gone down. That's part of value investing or buying some underperforming type stocks. So they're kind of doing the same thing. So when they do this, it's good for you they're not necessarily buying your stock, but what happens, it's good for you because what happens in the market. First off, market is all about buying and selling, right? You can't buy a stock until you have a seller of the stock. And if there's more buyers than sellers, well, then that's going to drive the stock price up, right? That's that supply and demand. Now, when you have stock buybacks or purchases, you have a very established, well-funded buyer in the market being very active, and that's the company buying back its own stock. So think about that. You don't have to worry about all small investors and things, who's going to buy my stock. It's like the big companies out there, their own companies buying it anytime they can get when they start seeing maybe fluctuations and buying, in their view, buying low. So you have an established buyer in the market who is publicly said we're buying this stock. They publicly say this. They need to publicly say this, and then they, at a certain point, and they continue to buy the stock. It's also a signal to the market. The company has come out and said, we think our stock is undervalued. This is crazy. We're going to buy our own stock because we think buying our own stock is a better investment than investing in capital or people or expansion or any of that stuff. Our price is so low, we got to buy our own stock back and capture that low price. So it's a signal to the market like, hey, if the company thinks the stock's low, maybe there's something to this. Maybe the growth prospects are really great. And besides, it's going to drive the stock price up anyways, typically. So we might want to pile in now, along with the company, to buy that stock. So it helps drive the existing stockholders' price of their shares up. So stock buybacks are great because your value increases, right? You have more shares in comparison to others. There's less dilution is what that means by that. So you have more shares than you had before in comparison. You still have the same amount of shares. If I had 100 shares out of, let's say, 100,000 shares total, I still have that percentage. But if now instead of 100,000 shares, there's 50,000 shares total, and I have 100 of them, well, my value of my existing shares are less diluted. They're more valuable. Particularly when you look at things like dividends, if they're going to pay out a certain dollar amount of dividends, well, that dividends doesn't have to be shared amongst 100,000 shares in that example. Those dividends are now the same dollar amount or same currency amount now shared among the 50,000 people, and I have a bigger chunk of that 50,000 in comparison. So my dividends might be bigger along the way too. So there's lots of good stuff that can happen with stock buyback. So whenever a company announces a stock buyback, usually its stock that day will rise a little bit too. You can watch it. It may or may not, there might be other things in the market, but if you see that, that's a really good sign and a really good news for you that when a company is buying back or repurchasing its own stock. Maybe you're watching television or reading something on the internet or reading some publication, and all of a sudden something comes across that says, Company A is merging or acquiring Company B. And it's a big headline. It's a merger or acquisition, or M&A, mergers and acquisition. And that is a big thing in these companies when that happens. And it's a big thing for stockholders like us, whether you own individual stocks or own stocks in a mutual fund. Whenever there's an M&A or merger activity or acquisition activity coming on or happening, that can be very, very impactful, either good or bad, for our stock. So it's something we want to pay attention to for certainly the companies that we own. And in a nutshell, what it means is that one company is buying or merging with another company. An acquisition would be Company A is, we're just buying you. We're going to give you so much money or maybe so much in equivalent amounts of stock that we have to buy you. Either way, we're buying you. We're buying from your shareholders, basically. So we're buying you. That's an acquisition. A merger is still somewhat an acquisition. Somebody's usually a little bit bigger and other doing more of the buying, but basically it's a merging or two companies coming together. So it's less of one company just buying out another one. It's a little bit more of a coming together of equals typically. But they might be all called the same thing as M&A or mergers and acquisitions, but understand the dynamics from a leadership or management standpoint of how the company is going to be run in the future, right? I've seen companies that were pretty equal as far as size, but once they merged, the one company kept the name, they kept the leadership, the CEO stayed the same, and really the other company kind of was then wrapped into that larger, or not even necessarily larger, but wrapped into that organization. So a merger acquisition can happen with cash or stock or different ways to help finance that, debt even, to help finance this acquisition. And why do companies do this? Why do companies buy other companies or merge other companies? Well, one is to enter new markets. That's a real common way. That's a good reason for it too, is we're going to enter a new market. And by entering that new market, and try to, instead of putting a lot of money into our own research and development, try to start from maybe ground zero to grow to be an expert and then compete against this maybe leading company in a market,
why don't we just buy the leading company, wrap them into our organization, and then now we can be the leader in that market through our merger, through our acquisition. So it's one of the key things is they're looking to enter new markets. Think about when Google, for example, bought YouTube. YouTube is owned by Google, right? So, but they didn't always used to be. They were kind of a startup and then rose up there. So Google saw something YouTube, saw video and the potential for video and said, boy, this really matches up well with our existing platforms, our existing strategies. Instead of trying to create our own Google Tube or our own version of YouTube, which they have a lot of money, they could maybe have done it. It's like, why don't we buy the guys who really know what they're doing and let them do their deal or do their thing, right? So they bought YouTube. And actually today, that worked out real well. If you think about it, the number one search engine, if we just look at search, internet search, or SEO searching, just looking at search, boy, I said search there like 5 times tonight. So for searching, Google is number one, right? It's even become the name. I'm going to Google it, right? For searching on the internet. Google's number one. You know what number 2 is, and you may or may not, but number 2, surprisingly, is not like Bing or somebody else. It is YouTube. More people search from first Google, then YouTube, just for general searching, and they're searching for videos is really what they're searching. But as far as actual searching, YouTube's number 2. And then there's Bing for Microsoft and Yahoo, and all the others are so far behind, right? So, boy, what a great move for Google in this case, but sometimes companies buy other companies that doesn't work out. But that's one of the ideas. You want to enter new markets, or you want to expand your reach. Maybe you're merging, maybe it's someone who's more of an equal and you want to expand your reach, not necessarily even into new markets. You want to penetrate your existing markets deeper. It's maybe the number 3 and number 4 guys getting together to help compete better against the number 1 and number 2 people or companies inside let's say a particular market. So trying to expand their reach into the markets they already have. A good example of that, the United States company, but there's others, they got some European operations, is Office Depot and Office Max. You can tell by the name, they're related to office stuff, and really what they are is they're office supply stores. They're retail stores that sell things like paper and pens and folders and supplies you would need in an office. And that's what they do. They're big retailers that sell office supplies. They're direct competitors. They share almost a name, and they were, nose to throat as far as competitors, Office Depot and Office Max. So what they decided was, instead of competing, with each other, let's get together and be a little bit better force in the market and compete against the third big competitor in the market, which was Staples, and we will compete better against that. Now even Staples looking to merge with the now new Office Depot and Office Max and trying to form all of them together, which can get into all sorts of monopoly or antitrust things. A little side bit on the retail thing, they're saying that online ordering of retail supplies and people like Amazon are actually now the big competitors for them, and they're struggling. So they're trying to expand their reach into the office supply market by merging with, together, maybe merging equals. Another way that the third reason why folks will really look a lot at mergers and acquisitions is that they feel they can run the acquired company better, right? They look at that competitor and they say, boy, that competitor's got a lot of good stuff going for them. Maybe they got a good lead in certain markets, or they're good in certain things, but overall, gosh, they run everything lousy. Their return on equity, ROA, or return on assets, all this stuff is bad, and they just don't know what they're doing, but they've got some success. That if we could just take that company over, we could get rid of the stuff that's not working, put more money and focus on the things that is working, and really do much, much better. And so that's, you might say, well, it's a little arrogant, but a lot of times, that's especially the leaders in an industry, that's what they look at when they look at the followers and say, instead of letting these guys maybe someday rise, we don't, and especially if they're poorly managed, to say, let's just buy them, add them to us, we'll expand our market reach, we'll expand being the leader, and that'll be a great thing. And we take out a competitor at the same time, and certainly can take an undervalued company and make it better. And now overall increase the value of the bigger company, which could be great for us as stockholders. So a good example of that would be like Wells Fargo and Wachovia. They're both banks, big banks, thousands and thousands of retail locations. And Wells Fargo, a very well-run, well-managed company, has been for years and years, hundreds of years, very strong company for a long period of time. And Wachovia, this is during, they acquired them in the 2008, actually early 2009, after the big banking crisis, when the bubble burst in the banks and the mortgage crisis, and all this stuff, when everything was bad in all these economies all over the world. Wachovia was struggling. They have all these locations. They were poorly run. They took a big bet on subprime mortgages or very risky mortgages that really hurt them. And they're struggling. Maybe they're looking at bankruptcy anyway, but they have these thousands of retail bank locations. So Wells Fargo looks at it and says, wow, we can get all these new locations, and maybe in some areas of the country where we're not in at all. If we buy Wachovia, they're running kind of not so good. Let's bring them in to the Wells Fargo way and take the good locations. We'll close the bad locations, or ones where we have duplication, where there's a Wachovia bank across the street from a Wells Fargo bank. When we close the Wachovia, but now we can get into some new markets and we can run that acquired company better. And those are things you're looking at from an investor standpoint. When you see a merger and acquisition, step back and ask yourself, why are they doing this? Is it for entering new markets, expanding their reach? Can they run the company better? And then you can make decisions whether you want to stay invested in the company or buy into the company. A couple last thoughts here on mergers and acquisitions. Short term, the buying company share price usually stays the same or usually actually goes down. So like in that Wells Fargo Wachovia example, it's like, well, everything sounds great for Wells Fargo. In the long term, it turns out it will be, but actually the stock price will go down initially because they're outlaying the money. They're taking the risk. They're buying the company. And the acquired company shares go up because in order to sell the company, to liquidate the company and be merged or acquired by this other company, shareholders want something for that, right? They bought these shares with the idea that the stock will go up, and maybe it's been going down for a long time, but they still hope it'll go up. So they want to get a premium on their stock price. They don't want to be paid whatever the market's paying. Anybody can buy it at the market price. They want to get paid a premium for someone to buy all the shares. And so share prices can go up, sometimes up double digits in a day when you have an announcement of a merger and acquisition. So if you own the acquiring stock, that's usually a good thing. And if you're the acquirer, the person buying it, long term it might be a good thing, but short term you might see your stock go down a little bit. After it's approved and done, then the combined company basically becomes one stock. They might even change the ticker symbol of it, like Hewlett-Packard used to be whatever it was, like HEW or something, or HP, and now it's HPQ when they bought Compaq. And then it's been splitting off since then, and different things happen there, so that's not even accurate now. But the thing is, their ticker symbol may change a little bit, but you basically have combined the two companies together. And so one strategy from an investing standpoint, and there's actually a whole thing for folks who really just focus on this, who are very active, maybe more traders, is they're looking for companies that could be acquired. Remember the part where acquired company stock can go up, sometimes even dramatically in a day or two once they get acquired. So they actually look for underperforming companies and look for companies that are in industries where they might have others that want to acquire something about them. Maybe it's an underperforming medical device making company. That's a small guy who makes one device and it looks like a good promising device, but they're really struggling right now. And they hope a big company like a Medtronic or Boston Scientific or somebody like that buys them out and pays that premium for the shares. So they're investing in these underperforming companies with the hope that they'll be acquired. Now the problem with that, if the fundamentals are still bad, the company's stock will still go down. And two things could happen. One, the stock might never go up, and they might not ever get acquired. The big company will invest in its own research and development and overtake them, and the company just goes out of business and you lost everything. Or you might have new competition coming in, because whenever there's a vacuum or somebody's underperforming, other competitors look at that and say, hey, if they're doing at least something, we could do it even better. Why don't we come in and invites new competition, which hurts you as well. So if the strategy is buy underperformers and hope they get acquired, if it works and it pays off, you're going to come out ahead. But that's a very risky strategy if that's all you're doing. But maybe you're looking at a company that says, yeah, I'm buying a value company. Maybe it's a little down right now. Maybe it'll grow up and grow its stock in the future. I have high hopes for it. The fundamentals may even look good. I might have confidence in the management, all these things that you're learning in the course. But there might be this little aspect too of like, maybe they'll get acquired too. Maybe there's some rumors around that they might get acquired as well. And that might be an opportunity to get a little shot in the arm for that company, maybe a big shot in the arm if that company gets acquired. So mergers and acquisitions, hear about them in the news less frequently than they used to be, but they're still out there. And when you hear about mergers and acquisitions in a stock that either you own or you were thinking about buying, it's on your short list of stocks to buy, either it's the merger or the acquire or whatever it might be. Really looking to see what's going on, because something big is happening when there's an M&A or merger and acquisition activity. Another type of activity that's very important to stockholders is when a spin-off occurs. So if we think back for a second, mergers and acquisitions, that means somebody's buying or merging with another company. A spin-off is the opposite of that. A spin-off was where you have a company, typically a larger company, and they're spinning off or selling off or creating a new division, or essentially not a new division, but a whole new company, right? And so it becomes two companies. In some cases, maybe even more than that, but usually it's two companies. So you have the one big company, and they spin off apart, and now you have maybe the big company is a little bit smaller, and you have the small other company, and you have two companies, two new companies. Though two companies, they're not necessarily new, there may be existing brands and all that, but they essentially trade differently on the stock exchange. The spin-off now becomes its own company, and you can buy shares in that spin-off, specifically just with the spin-off without having to buy it part of the overall company.
And that's the idea behind spin-offs, is looking at a couple things. And one is, if you spin off a company, you might have something that's really good, but you think it could run much better and be more focused as its own company. Think of like a big conglomerate that might have, like General Electric, that has, like, they're into banking and they're into engines and they're into software and they're into consulting and all this stuff, right? Well, maybe certain companies in there might be better if they split them off and let them run as their own company and they were a completely separate company. So companies will split off apart if they want to have more focus both in the parent company, the one who is the original company, and the child or the spun off company, to allow them more focus for both parent and child. Also, you can see better stock valuations. Is the idea is better stock valuations, because now that they're separated, investors can invest in either company more to what they're interested in, more to their liking. Sometimes when it's one big company, people are buying that stock because it's got this one little arm to it that they like, but there's also competitors out there that might do the thing the one little part does. And they would rather if the company split up and then people will like the big company will buy and then people like this new small arm that could grow, they can invest in that, especially if they're almost acting like two different type of companies anyway. So they're looking for better stock valuation for both the parent and the child as opposed to one big entity. So an example of that, a really good example of that, is Altria, probably pronounced that wrong, but Altria was the parent company that owned a lot of different brands, and one of the brands it owned, two of the brands it owns was Philip Morris and Kraft Foods. So Philip Morris, you might have heard their name, they're famous for cigarettes. Philip Morris makes cigarettes. I think they're the leading supplier of cigarettes in the world. I believe they make Marlboro. I don't smoke, so I'm not the expert on cigarettes, but they make cigarettes and they're the big player in cigarettes. Kraft Foods makes food, different types of foods, essentially particularly known for like cheeses and things that they sell in grocery stores, cheese and markets. So if you like your macaroni and cheese, you might like Kraft macaroni and cheese. If you like cigarettes, you might like Philip Morris, Marlboro cigarettes. The thing is, they're very different, right? If you think about it, if cigarettes versus food. If I want to invest in a cigarette company that might pay a high dividend, well, then I'll invest in a cigarette company. If I want to invest in a food company, I don't want to mess with cigarettes and all that. I want to invest just in a food company. So when they're together, it makes it more troubling to invest in. And particularly, and this is a good example too, where the parent company and the founding of the company was on cigarettes, and is known for cigarettes. That's why they changed their name from Philip Morris, that owned Kraft, to Altria, to change that up a little bit. Because there's lots of people that say, I would love to own Kraft Foods. I think it's a good stock. I think it's a good market. The grocery, the consumables, the consumer package type goods, all those things. I think it's a good market. But I don't want to invest in a cigarette company. I hate cigarettes. I don't want to invest in a cigarette company. And cigarette companies have all these regulations and things I'm just not want to get involved in. I don't want to just invest in the food company. Why can't Philip Morris split off Kraft Foods so I could just invest in Kraft Foods? And that's really what happened. That's what drove it. Is there's so many shareholders saying you need to split these two companies up because on their own they could be a great performing cigarette company or a great performing food company, but together they actually drag each other down. So they spun off Kraft, and now you can buy Kraft as its own stock, and the Philip Morris, or actually Altria, continues on, and you can buy a cigarette company through that. So are spin-offs good for investors? That's what we really care about. It's like, okay, I understand the business sense behind it. All right, now, is this good for us as investors? Well, the idea, and what studies show, is for both the parent and the child, it's good in the long run. In the long run, it's actually good for both companies to become more focused, and then people can invest in both of those. And but there is some short-term pressure on the spin-off. When investors get something spun off, they get shares in that new company, let's say Kraft, and they still have their shares in existing amount, as they split it up in Altria. And at that point, they might not want one of those. So if we spun off Kraft and I really like Kraft and I got some shares in Kraft, well, I might sell the rest of my Altria shares, my Philip Morris or my cigarette shares, and buy more Kraft or buy something else. So that can exert some downward pressure on either side as they get split up, depending on what people like and as they move between the two or move completely out of the stock. So they can have some short-term, poor pressure on there. Long-term good, typically, but short-term pressure. Also, the person that's spun off, the company that's spun off, may not pay a dividend like the parent company did. The parent company might be really established, well-known, hundreds of years, who knows, and been paying a long-term dividend, but when they spin off the smaller company, that may or may not pay a dividend, which can then also
short-term pressure, in this case on the spinoff. If I bought the big company because I like the dividend, now a portion of my shares is in the big company, but a portion now went to the small company, I'll sell that small company and buy the rest back into the big company so I can get back to my dividend. So that could be, that could be impactful too. And when they spin off too, they're not in an index a lot of times. Now Kraft might be because it's such a big company from a big company, Altria, but a lot of times when you might be a big company in the index and the S&P 500 or a large company index, and when they spin off another part, well, that other part might not qualify to be in the index. So what happens to its shares? Its shares go down because people, companies that are investing, or mutual funds that is, or exchange trade funds that are buying an index, once that spinoff happens, they get rid of that. They get some shares of that spinoff, but are like, hey, you're not in the S&P 500 index. We're an S&P 500 index fund. We have to buy those stocks, so we're going to sell you, and we'll buy back into the big company. So you have some short-term pressure there too. But the long term, the studies show good. I mean, there's been lots of studies around spin-offs, and long term, it does allow for the management teams in these separate companies to really focus on their business and what they do best. They can get rewarded with like stock options and things to focus on that part of the business as opposed to being tied in with all sorts of other things. And you do also start getting new investor money in too. So we talked about the downward pressure which happens, but now you also get new investors that come in too. Altria, once again, is such a good example. Like, maybe somebody would say, I'd never buy Altria. I love Kraft, but I'm never going to buy anything because I hate cigarettes. Well, once they split off Kraft, they're like, wow, I can buy Kraft now by itself, and I think the long-term prospects is good for that. Well, here's my money. Here's some new investment coming in that will help drive Kraft, and same might help Philip Morris by being more focused too, or Altria. So as you can see, spin-offs are more than just a management type thing. They're all about management and how to be efficiently managing scarce resources, effectively managing separated companies. But as investors, when a spin-off happens, you really got to start making decisions on what you want to buy and sell. And do you want to have your shares split with that spin-off and keep those portions? Or do you want to buy or sell one or the other to, balance your portfolio or make different decisions? So when spin-offs happen, look closely at the information that they send you from the company. They'll talk about in the information how much of the existing company shares you'll keep, how many shares in the new company you get, in the value and the price for all that. And then from there, you need to make decisions as far as now they're two separate companies. So treat them as two separate companies and treat them as two separate investments in your overall portfolio. Sometimes what happens with some stocks you own because you're actually owning the company is the companies might have some good news, but then all of a sudden the stock price goes down, maybe even down quite a bit. It's like, well, how can a company have like maybe a good earnings announcement and some good things to report, and yet your stock price goes down? Why is that? And that happens sometimes. Well, sometimes it might be they're announcing some good news or announcing good earnings during just a period when the whole market is going down. There's something happening in the global economy or maybe in a local economy that's driving the whole market down lower. So even though they might have good news, they're going down as far as their stock price. Hopefully, they're not going down as fast as the rest of the market. So sometimes it can be a bigger global type thing or a more bigger as far as a market type thing. But sometimes the company has good news, everything looks good, and their stock still goes down, and it's not related to the market or anything else. It's really related to that specific company. And usually it's something that they've said in their earnings announcement or something that they've said with all this good news that might cause some nervousness or fear among investors as far as what the future looks like. Because remember, stocks are all about the future. You're buying a stock with the idea that the stock price will go up. You're investing in a company with the idea that the company is going to continue to grow and improve. And the way they grow and improve is by growing earnings and thus growing their value and growing their stock price. So sometimes when they say we have good earnings, we had good recent earnings, good past earnings over the last quarter, well, that's past news. But then they say something about the future, well, that can cause some consternation sometimes, or some fear or uncertainty or doubt among the stockholders that are out there. Let's take a look at a classic example. It happens to be with Facebook. Facebook's got lots of good classic examples in a lot of different ways. So here's a good classic example with Facebook to kind of understand why a stock might go down on good news, and you can kind of use this to help yourself to understand maybe some stocks that you're invested in, why that can happen, and what to do next about that. And as we look at this case study with Facebook, it's way in the past, but we can give us an idea of kind of what can happen as far as with earnings calls or with good news. Even it's going to sound like some great news with Facebook here, and yet their earnings went down. So back on October 30th of 2013, so a long time ago, When you think about Facebook, and they're growing, a growth company, and they easily beat their earning estimates, right? So far they're having an earnings call and they're saying, hey, we crushed it. We beat our earnings estimates. Things look great. And they actually were able to show and demonstrate how they were beginning to profit from mobile search and people using mobile devices. And you think about that with Facebook, and you think about how now, years later, since 2013, how important mobile and mobile technology is. The fact that Facebook is starting to show earnings and beginning to profit from mobile back in 2013 in comparison to what ended up happening in the future, that sounds like great, like perfect. The stock should go up. And what happened? Well, the stock declined for 10 straight days. I was like, well, wait a minute, we beat our earnings, doing some good stuff and some new technologies and some new things that are advancing, particularly that is very, very important to Facebook, which is mobile and mobile search. How can the stock decline 10 straight days? What happened? And what happened was they had all this good news, all this great news, really, and if it was just that, it would be like their stock probably would have gone up, maybe even significantly. But Facebook also shared, in full disclosure, which is great that they did, but they shared that and admitted that younger users, especially teenagers, were not using the service as much as they used to. So think about this from an investor who's looking for long-term growth of a company, and Facebook has now come out and said to you, you know what? Teenagers, which are a very actually important part of Facebook, certainly Facebook's growth and beginnings from teenagers and college students is founded under the idea of social media and social sharing at Harvard. I mean, that core group, they're now admitting that, like, hey, you know, those younger users, especially teens, they're not using us as much as they used to. And what do we know from social media sites? That, you know, a lot of those early adopters are young people, and now if they're moving off Facebook, well, what are they moving to? Are they moving to something else? Snapchat, Instagram, who knows what else? Google Plus, what are they moving towards? And could that be a real problem for Facebook if they're losing that teenage and that younger audience? And so people got scared about that. They're like, wow, that's great news for Facebook, but my gosh, if they can't grow their user base from the young people or whatever, then they're going to be like MySpace and go out of business maybe, or this is a catastrophe. And so people got scared, and the stock declined for 10 straight days. So they lost sight of the past news of, hey, earnings are good, and even some of the future news, which looked great, which is the profitability for mobile technology, and got all wrapped around a real core part of the business, which is good to get wrapped around, a core part of the business, which is younger users and Facebook and not using it. So that's what happened as far as for Facebook, and their stock declined, even though they had good earnings and this good mobile search thing. And that can happen into a lot of companies in a lot of different industries. Maybe it's a pharmaceutical company that has a great earnings announcement and everything's going good, but maybe a new drug that's in their pipeline fails some clinical trial. You want to see a pharmaceutical stock go down? Hear about things about failed clinical trials will drive a pharmaceutical stock down pretty quickly. Or something that's related to consumption or changing demographics or changing patterns of purchasing and buying behaviors of their main constituents or their core customers. Things along those lines, or new competitors or new things that are happening, new technology that might be assisting or not assisting, maybe causing some challenges within the marketplace. All these things are related to business, right? You're investing in a business. So the Facebook example was like, hey, we've got a core customer base that's not using us much. Think about that as any other business that has a core customer base that's not using them as much or buying as much from them. And you can see where the stock could go down. So the key part of all this is, so when you have good news and stock still goes down, try to figure out, and usually analysts, and there'll be papers and things written about what is happening, and figure out, well, why is the stock going down? And then you make a decision as far as do you want to continue to be invested in that stock, or do you want to be like the others maybe and get out quickly? It might be an opportunity to cut your losses, so to speak. If you're looking at Facebook, you might say, and maybe how it turned out is like, okay, we're losing our core customer, but there's still so much growth in different markets in the world, maybe growing with older people, maybe they'll be adding new features that may capture back some of those young people again. And by the way, that whole thing in mobile looks great, and in fact, they're earning money is terrific too, so maybe I stick it out. That's one way to look at it, and you would have been rewarded for that. But another way would be like, hey, it's going down. I got to get off the ship before it totally sinks. So when you see these things happen, just analyze it, use your fundamentals, and use what's going on, and think about, when I invest in this stock, and the reasons I invest in the stock, is it still on that same trajectory? Is it still doing the things I want to do, or is something fundamentally changed with the company? Is the company moving in a completely different direction? And that might mean, hey, it's time to get out of this investment and into a new one.
But certainly it's frustrating when there's lots of good news and you hear things like, XYZ company beats its earnings estimate and then it goes down, the stock price goes down 10%. Probably is something that's hidden underneath that they shared with the world. In an area that's in any kind of investing that's really fascinating to me, whether it's in stocks or anything like bonds, cash, gold, whatever it might be, real estate, one thing that's very interesting is behavioral investing, or investing where you get a lot of emotion and things tied up into it, emotional investing or behavioral investing. Because if you think about investing, it should be this kind of quantitative, you're looking at numbers and you do things based on logic and all this stuff. And what really happens out there is things, there's some logic involved, hopefully a lot of logic involved, a lot of numerics and things that we're learning in the course that help us with that. But really, the underpinning of all this is that we are investing as human beings, and human beings have emotions, and human beings have behaviors, and some of these behaviors might not be the right behaviors. We might even accidentally or intentionally go against our best interest. The key thing with behavioral investing is understand that it's real, that's really out there, that we're not robots, that we are human beings that invest with a variety of reasons, and we have a variety of thoughts and feelings and, yes, emotions that can come into play. The big overarching things that really come into play as far as entire markets and things where entire markets might go up and down around behavior or emotion is really around fear and greed. This is what I've seen over the years. Fear, you see this a lot when the whole market goes down. There's some bad news, and maybe there's some legitimate bad news, like a financial crisis or a bubble bursting or something like that, like when the tech stock bubble burst, in the 2000, or when things burst as far as around home mortgages or derivatives or all these things. The markets go up and they go down. There's a natural cycle to that, but sometimes they go up too fast and they bubble and they break. It's usually greed that'll feed the bubble, and then when it breaks, it's fear that people are getting out, and it's can be a very traumatic thing. So when markets go down on bad news, or maybe a stock goes down, an individual stock goes down on bad news, it might be a little bit more of fear taking place as opposed to rational or logical thought. Now understand, your stock is still going down, but you can understand and think about it, is my stock going down because of something has changed with the organization or with the fundamentals or the market as a whole, or is it more of a short-term type thing? Same thing with greed on the other side of that, where we might hear of a hot tip, or we see an article, or we listen to maybe a financial expert who's touting the latest great stock, which, by the way, everybody's hearing at the same time, so probably the price is inflated already. But we hear this and we say, wow, am I missing out? The market's going up and I haven't invested enough in the market. I need to get in there. And it might be some of that greed kind of coming in possibly, or just the fear of missing out on that. So understand whether it's fear when the market's going down, or maybe a possible little bit of missing out when the markets are rising, or maybe you've got a hot tip that may or may not turn out so hot. So understand that that is part of behavioral investing. You're making decisions based on behavior, and that might not be, well, that is not necessarily the right way to go. You want to use some of the tips and things in this course you're learning and through other things as you continue your education and learning to make good, logical, rational decisions versus emotional decisions. You're always better off with a logical or rational decision than, of course, an emotional decision. So what do you do? What do you do when everybody's panicking? Or what do you do when everybody's like jumping on board and saying stocks are going up, for example? Well, first off is to know yourself, right? Know your own pressure points. Know what your strengths are and your weaknesses are when it comes to investing. If you're a risk-averse investor and you don't like a lot of movement up and down in the stock, well, understand that and maybe invest in stocks where they have less volatility. They're not a big up and down growth stock. Maybe they're a steady eddy dividend-paying stock, and invest in those kind of stocks. Or maybe you're somebody who likes to hold on to stocks thinking they'll always come back and you ride them all the way down. So if you've had that experience, think about, well, what are my pressure points? And maybe think, gosh, if I ever have a stock that goes down more than 15%, my thing is logically I'm just going to sell no matter what. And that might not be the right thing, but maybe it's better than writing down as it goes down 30, 40, 50% if you've had some bad experiences around that. But it all depends on you as the individual investor. So make sure you understand what your particular pressure points are. Also think about, how can I reduce those negative behaviors, things that might be impacting a person on that. One thing I do, and I really believe in, is automatic investing or automatic systematic investing. If you're on the dollar, it'd be like dollar cost averaging, or things like in the United States where the 401ks, where you're regularly putting in money. Either way, it's automatic systematic investing. What we mean is it's automatically happening every month out of your checking account. It's automatically buying into a particular fund, or maybe you've put into a brokerage account or put into a mutual fund company into a cash, a whole bunch of stuff, a good amount of money in cash, and every month it's continually buying some new funds or new stocks. Typically you have it where it's coming out of a paycheck, and you get that paycheck and you're either intentionally paying yourself first and putting that money into that account, that brokerage account or that mutual fund, or you're having it automatically done for you. If you have the ability through your employer, by the way, to have it be automatically done for you, that is the best way to go, because it takes out emotion out of it. It's just going to automatically be investing all the time. And sometimes you'll buy a little high as far as the market, and sometimes you'll buy when the market's a little low too, and that's good. Either way, you're automatically investing. You're not trying to time the market, which is always not a good thing. You're trying to just be in the market, continually buying and automating that. And I use that a lot, and it really, really has worked well for me over all these years. It takes out that whole emotion and that whole thought of like, am I buying low enough and am I selling high enough? You're buying it's buying part of it where it's automated, and then you can sell on a non-automated fashion. Also seek out trusted partnerships or partners. It might be your spouse, your husband, your wife. I've been very blessed with my wife that we are trusted partners and we work really well together, and we're really very honest and open with all our investments and other things that we do in our financial life as well as our non-financial life. If you have a partner like that, that's terrific, and really talk about things with that partner, and really be open with that person and say, like, I'm thinking about buying now, or I'm thinking about selling now. And they might be able to see, like, yeah, but are you doing this because of emotion or a behavioral issue, or are you doing this because this is the right thing? You should be able to use that as kind of a way of saying, if I can explain to my partner why we should do this decision, buy or sell a stock or mutual fund or exchange traded fund, whatever it is, if you can explain it to them and they can get agreement with you, well, then that's probably a better choice than just kind of going on your own. That's another reason why people like financial planners, right? A financial planner kind of will do more of that for you, whether it's an automated robot financial planner or an actual person who's actually planning your investments for you. So if you need some help that way, or want somebody to be more of a sounding board, well, that's where a financial planner can help do that and maybe give you some advice around that. It costs money to do that, of course, so you have to weigh the cost versus the benefits for you. But if you're somebody who really struggles with making decisions or emotionally wrapped up in decisions, then maybe a financial planner might be able to help you with that. Make sure you find a good one, a trusted one, and understand the costs behind that. There's also things out there you might find in your local town, investment clubs, where you get a group of investors together and they talk about investing, and they maybe have coffee or wine or whatever is the beverage of choice, and they talk about investing as kind of do-it-yourself investors, and doing it for fun and doing it for profit as well. And they'll share different ideas or tips or things that they're seeing happening, and maybe they see a certain stock or a fund that they think is good, and they'll share and talk about that as part of the club when you have a club meeting. So if you like that and you like that social aspect, you can join an investment club, a local one. There's probably some online Facebook groups and things too. Just be wary with those things, that everybody's got their opinion. They might have some bad ideas too, or some emotions behind in the investment club that they're bringing to buy the hot stock or get out of a certain stock. So just take that into consideration as well. But it might be a good place where you can share ideas and just sound off on things and say, hey, I'm really worried about this stock. This is what I'm seeing. What do you guys think? And you'll get some third-party opinions. There'll be some independent opinions. So to wrap up this section, understand that behavioral investing is real. It's a fascinating area, and understand the idea behind why you're making decisions, and is it based on logic or is it based on emotions? And so much of our investing, and so much of where we hurt ourselves with investing, is we get too wrapped up emotionally when we should be more focused on logical and rational, and maybe automating some of these decisions. Well, the old saying, there's nothing for certain other than death and taxes. So that's the thing. That's the other side of investing too. You've had some success, you made some profit, and you don't get to keep all of it. You got to pay some in taxes, federal or local or state taxes on your gains that you've had in there. And we're going to talk here for a moment about taxes, and understand it's not so much about what you make, it's about what you keep. So if you have some great gains, but you pay it all out in taxes, or a large part of it, you may not be keeping it as much as a more tax advantage type of investment or mutual fund
or whatever. But as we start this section, let's just get an understanding of how investing taxes kind of work, because it could be different or is different than, let's say, your regular salary or income that you might be getting, possibly. One thing with the tax section here, I'm going to give you some overall thoughts, overall ideas, but once again, I'm very blessed to have students from over 141 different countries all over the world. So what does that mean? There's 141 different ways that people are taxed. So look at your own government and your own type of tax situation. So you need to do a little homework on that and do your own little research, and I'll give you some examples here to at least help you understand what to look for and some of the terminology you might be looking for, like capital gains, for example, terminology that'll help you when you're trying to figure out your own tax situation. So with investing, there's taxes and there's fees. That's part of the whole, what you make or what you keep is more important than what you make. So that's where, like, on the fee part, just a side note on the fee part, that's why when you have mutual funds that charge high fees, or a full service stockbroker that's charging high fees, you're not keeping as much of your investment. So things that you can do to drive the cost of fees down is going to really help you as far as what you overall keep, as far as what you keep, in addition to the tax bite you have as well. That's why funds like exchange traded funds or index funds are very popular. They give you good diversification at very, very low cost. So those might be things to look at if you're finding you're paying a lot in fees. Now, but let's talk about taxes in this section. And as I said, taxes vary all over the world, so look at your own tax situation. But really, investing really breaks it down into two big buckets when it comes to taxes. The first one is capital appreciation. You may have heard me mention this a couple times in the course, but the first one is capital appreciation. That's the tax gain when you sell. And there might be other fees associated with it, like a transaction fee when you're buying and selling, so aware there's always fees. But when you think about capital appreciation, it's the taxable gain when you sell. So if I buy a stock at X and it grows up to Y, that difference between X and Y and its price and my value, my total number, like shares times the stock price, how much I made when I sell, that's a taxable gain. That's a tax event or a capital appreciation capital gain. So if you ever hear the terminology maybe where you live of capital gains or capital gains taxes, and they might be taxed at a different rate than your regular income type gain. At this current time in the United States, for example, there's a different rate on taxes, a better rate in taxes on capital gains than there is on your ordinary income or income you make on your, let's say, salary or your hourly rate that you're getting paid to work for somebody, for example. So think about the capital appreciation, what you sell it for versus what you bought it for. You might hear the term what you bought it for is your basis. So if you're looking at capital gains or reading stuff and they start talking about, well, you need to know your basis. Well, your basis is what you bought your stock at, your mutual fund or your stock at. That's what your basis is. That's where you started from. And hopefully it'll go up, but it could go down too. You're not paying taxes on things you're losing money on. Later we'll talk about tax harvesting as a strategy that will help you offset some of those gains. But for right now, you want to understand that you pay taxes on that difference between what you sell and what you buy it at. So it's important to keep records and know what you're buying your stocks at, because that's going to be your basis. Now, for a lot of things like mutual funds, for example, they're tracking that for you, or a lot of the online brokerages, and certainly a full-service financial planner, a full-service broker should be tracking your basis for you and including that in your reports. So when you're looking at the reports, you get started with somebody, or if you're getting started, ask them, well, how do I know what my basis is? Do I have to keep the records, or do you keep them for me? If you're like my wife and I, especially my wife, the accountant, she likes to keep every single record. So if you do that, that's a great way to go. So that way you have the record of what you originally bought it for and not relying on others. But the firms should track it for you as well. So what happens is when you buy a stock, it's when you sell that stock is when you have a capital gain. Now with mutual funds, it's a little bit different, because mutual funds are a basket of stocks, as an example, or bonds, whatever your mutual fund is, but let's say stocks, and they're continually buying and selling throughout the year. So then at the end of the year, they very likely could have a capital gain that they're going to pass on to you. So usually at the end of the year, or maybe a month or so before the year ends, they'll send you a sheet and tell you what your capital gain is, and that's taxable income that you have. So if you have a let's say a mutual fund that has a high turnover rate we talked about, or a high churning where they're buying and selling a lot, they might be incurring more taxes than something that's more tax efficient. Like an index fund typically might be more tax efficient where they're not buying and selling as much. They're just kind of trying to match the index. So that's one way you have a taxable event, is a capital gain. The other way is through income or dividends. And that's when you get paid a dividend, or money is being paid to you directly from the company. If you own an individual stock or a mutual fund or whatever, they'll pass those dividends through the fund and onto you. But let's think of it from an individual stock standpoint, that if I bought this individual stock and every quarter they're paying me a dividend, well, that's income that's coming into me. So you want to be aware that that income is taxable. It might vary once again by country, but certainly in the United States, that income is certainly taxable. As an example, I would think it would be taxable anywhere. What you want to look at for your income from dividends is in your country to see if they might have a different way of treating income from dividends. Sometimes they might consider it like a short-term gain, same even with capital gains actually, a short-term gain that is taxed at a higher rate than a long-term gain if they separate it out that way. So understand it could be that way as far as your different stocks and different things as well. Typically, if you hold something over a year, you're going to be in a long-term gain category, but not necessarily. I mean, once again, it varies by country. A lot of times also, dividends are treated as ordinary income, or treated as just like your salary or hourly rate. And that might be at a higher rate than, let's say, a capital gains type of rate, for example. So in the U.S., you might be at a 20% capital gains tax rate, where your ordinary income, you might be paying 30% or more on that part as far as ordinary income. So see a tax advisor around that as far as the different types of tax situations for you. And understand you're still making money. It's just you got to pay out a portion of that money. So that's all good. Capital gains and dividends are good things. You're making money. Just understand you're not making all that money because there's still a tax hit there too. And those are the two primary ways where you see gains in your portfolio, but also where you see taxes occurring. And think about capital appreciation might be known as capital gains, and then dividends would also might be considered income. Okay, so we have tax consequences on capital gains or dividends. So what can we do about it? What are some things we can do? One thing you can do is to buy tax efficient funds or vehicles. Mentioned earlier, like mutual funds, for example, that have a high turnover rate, they're constantly buying and selling, is going to incur more taxes than a fund that might be selling less or buying and selling less. They're just trying to match an index, for example. That's one way they can be more tax efficient. There's also funds like mutual funds that advertise and promote that they're tax efficient mutual funds. Their whole thing is they're trying not to incur taxes or incur tax type things to try to get you your end overall gain to be a little bit better too. So if you're in a high tax bracket especially, and you're incurring lots of taxes, for example, from your investments, you might want to look at a tax efficient fund. Another consideration or way you can avoid taxes is to buy and hold, because taxes don't occur until you sell that item. Now, a mutual fund is different because that's where they're constantly buying and selling inside the mutual fund. You don't have much control over that. A tax advantaged mutual fund might try to limit it, but once again, you don't have control on that. You're at the mercy of the person managing that fund. Where if you buy your own individual stocks, once you buy that stock, that's your cash basis, you don't incur a tax on that individual stock until you sell. You might not sell that stock for 20, 30, 40 years. You might not ever sell that stock and pass that on to your heirs. And maybe there's some tax advantages in terms of estate planning or what happens when you die, as far as is there a tax advantage to your heir, maybe to avoid taxes depending on where in the world you live. So look at that as far as anybody who's involved with estate planning or your attorney with that. But the idea is I might buy and then I might not sell till many, many years. Until I sell, I'm not incurring a tax on a capital gain when I buy and hold. I'm not incurring that tax on the capital gain. Now, if I'm buying and holding a stock for 20, 30 years and it pays a dividend every quarter or pays a dividend every year, well, every year I'm going to pay taxes on that dividend that comes out every year. But I won't pay taxes on the overall gain until I sell the stock. If you have questions around that, just throw that in the question and answer area too, by the way. It can get a little confusing on that. But, once again, when I sell, that's when I have my capital gain tax. And then when I have dividends paying out, I pay tax on dividends, every year. Another thing you can look at is tax advantaged accounts. And all over the world, they might have different tax advantage accounts. You might not have a tax advantage account where you live. I'm not sure. I've got 141 countries with great students from all those countries. I'll give you an example, though. I happen to be from the United States, so I can talk to that a little bit more specifically as an example. So in the United States, we have plans that are called like a 401k plan or a Roth IRA or IRAs. There's different things out there. Most popular are 401k and Roth IRAs. And the whole idea of that is you're taking income and you're putting a certain percentage of that into these tax advantage vehicles, so your gains grow without being taxed until later. Even you're not even incurring capital gains tax, you're not incurring even dividend tax while that's growing. It's in a tax advantage account. So that's a good place to put especially income generating investments such as high dividend paying stocks, for example, because then you're not paying right away on that dividend, or bonds and things too, things that are paying out regular income type things. Put them in a 401k or a Roth IRA. You can have them outside too, but if they're outside a tax advantaged account, well then you'll pay tax on it right away, and that's okay. Just be aware that's what's happening. But if you have something you want to defer the taxes on, you can use that with a 401k or Roth IRA. And these plans are a little bit different too. Like a Roth, once you make your investment, it could grow tax-free. Your gain is actually free, which is great, although Congress could change laws anytime. 401k, it's basically deferred. You pay taxes when you take it out as a retirement or distribution. So think about tax advantage accounts. And then lastly, as a recommendation, have a variety of accounts. Particularly if you want to retire early, or you want to have that ability, that financial flexibility, because if all your money's in a tax advantage account and you can't touch it without a penalty until you maybe reach age 62 or 65 or 67, without a big penalty, like a 10% or more penalty, and it's all in that one spot, well, that might limit you if you want to retire at 59 or 55 or 45 maybe, whatever your goal is. So you want to have a variety of accounts would be my recommendation, especially around if you think that someday you might want to retire early. Weigh that versus the tax advantage accounts, of course, too, because of that deferral, but it doesn't hurt to have a variety of accounts. That's what I have. I have a variety of accounts, and I'm really glad I did, because now I have flexibility as far as my own what I want to do with my life and what I want to do. So I have some flexibility with that. So that's something to think about too. And the last thing under the tax considerations is not to, unless you really high income or something where you really are getting killed on taxes or something, don't make investments solely based on the tax considerations. I mean, you might buy a poor, underperforming fund, but it's advertised itself as a tax advantage fund, and yeah, the taxes might be lower, but maybe you'd be better off buying that mutual fund that has such great results, and yeah, you pay a lot in taxes, but in the end, you're keeping more because the results are so much better, versus the fund that's not so good and you're not keeping, you made a little bit more as a percentage, but you're really not making overall more as far as a total because it's not as good a fund. As an example from a mutual fund thing. So, when you're investing, consider taxes, but don't let it drive your investment idea solely just based on taxes, unless you're once again getting really socked by taxes. And that's where you might be wanting to, spend a little money into a tax account or a tax financial planner that can help you from an overall tax type of strategy. But really think about what's the best investment for you. But in the back of your mind, also consider the tax and fee thing considerations, but don't let it dominate totally, because you might be missing out on some terrific gains. One strategy that many people use in terms of taxes, and I use a lot myself, or whenever I can, is a harvesting your losses strategy. It's legal to do, and there's some rules around that, and we're going to talk about that. But it's a great strategy to use to offset the gains you might have and things that you might be paying taxes on. Now, with harvesting your losses, once again, whatever country you're from, look at it for your particular country. I'll give an example from the United States, but really just look at your country and talk to your tax folks about harvesting losses and how much you can and can't do in those types of things. So the idea of harvesting your losses strategy is it's a tax management strategy. It's not so much an investing strategy as in I'm picking out certain funds or something like that. There is an element of it. It's really about managing taxes. So think about harvesting your losses as far as managing taxes, reducing my taxes so I can keep more for me and my family, for example. You're using your investment losses to offset your gains. That's really the core part of harvesting your losses strategy. So if I sold some stocks or some mutual funds and I made this much in gains, but maybe I had a couple losers where I sold them at a loss. So maybe I had, to pick out some numbers, $10,000 in gains, and I had some things I sold that year that I ended up having $3,000 in losses. what I can do is apply those losses against my gain to reduce my taxable amount. So it's the gain minus the losses equals the net amount, and it's the net amount that I'm taxed on. Once again, it might vary by country, but certainly in the United States it works that way, and my understanding most places in the world too. So what it is, if I have that, for using dollars, excuse me for using dollars, but $7,000 in that gain, 3,000 losses, I would then pay taxes on the net, or $4,000. So I will end up paying out less in taxes because I'm paying on a $4,000 gain versus versus let's say a $7,000 gain. So I'm using the losses to offset my gains. In the U.S., you actually have the ability that if you have no gains at all, you can each year take out $3,000 of your losses and apply that even against your ordinary income or your salary type income and reduce your taxes that way. So it's a great tool to use that if you've got some winners and you've sold off some winners, or you're getting a lot of capital gains or things from mutual funds or things that might be happening, and if you've got some stocks or things you want to get out of and they're at a loss and you're selling them at a loss, well, use it to your advantage to at least reduce your taxable income because you're paying tax on the net. And that's the idea behind harvesting your losses. Now, a couple of do's and don'ts around harvesting your losses in terms of a strategy. And I found this little matrix from Fidelity. Here, I got the resource here right there for you, and it's really good. So I like it. So you can go there and look at it too if you want. Otherwise, it's right here. So, hats off to Fidelity, I guess. So in terms of do, you want to still follow your strategy. It's never a good idea to just do your whole strategy only based on taxes. You want to fit your overall investment strategy. So don't be selling something just to harvest a loss if you really think it's got a great upside and you want to hang on to it. So, don't just do that just for a simple tax thing. You might save a little taxes, but you might miss out on an overall gain. So it should fit your overall strategy. So that's first thing, and most important thing is whether you're buying or selling anything that it fits your strategy and that you're researching it as far as your due on that side of it, that you're researching what's going on, you're researching these stocks, whether you're buying or selling, and as part of fitting your overall strategy, and that it's kind of working for you as far as the tax benefits of that. Particularly one thing you want to research is your cost basis, because the idea is you're selling at a certain price, and it's the difference between what you bought it originally or your cost basis as far as what determines the gain. It's the same thing when determining your loss. Whatever you bought it for is your cost basis, and if you sell it down here or sell it at a loss, then that's going to be your difference is between the cost basis is your capital loss, or how much you can apply against that capital gain to reduce your taxes. So those are the two do's. A couple don'ts here as well. And one is the flip side of that whole do part, which is, don't undermine your overall philosophy or overall what you're trying to do just for a short-term tax advantage. I mean, it's not about that. It's about your overall investing. You might see some opportunities to harvest losses and offset gains, and you should take advantage of those opportunities, but don't let it be the focus of your whole strategy because it might kind of mess up your whole strategy. You might sell off some potential winners. The other part is don't sell and buy things that are the same within 30 days. Now this is specifically the United States, but I bet it's similar in other countries too. And it's called a wash rule, kind of like you're washing, right? It's it's a wash rule. You in the United States and other places you can't buy, let's say a stock or a mutual fund. Let's use let's say the S&P 500 index mutual fund, 500 largest companies in the United States. If I sell the Vanguard S&P 500 fund, and maybe I've had a loss on that, so I'm selling that because I had a loss, but then I take that money and immediately buy Charles Schwab's or Fidelity's 500 index fund, which is essentially the same, just different company. And if I do that within 30 days of selling this Vanguard, selling this, either 30 days prior to selling it or 30 days after I sold it, so kind of 60 days on either side, 30 days before, 30 days after. If I buy essentially the same stock or essentially the same, let's say, mutual fund or exchange trade fund, that's a violation. That's an illegal thing. You could get a penalty around that in terms of the IRS having your tax system as far as what's called the wash rule. And really what they're trying to do with that is they're trying to avoid manipulation, right? It's like, oh, I'll just have this 500 Vanguard fund, I'll just sell that, and I'll buy the identical thing, in Fidelity, and for my investment, I'm pretty much the same. I'd just be able to capture some losses that I can use against my gains. And the tax folks, they know that. The governments know that. So you can't do that as far as, like for like. Now I could sell that Vanguard large capitalization company 500 fund and maybe get the Russell 3000 or Russell 2000 a fund of index funds for small cap stocks, or I could buy a bond fund, or I could buy individual stocks. I just can't buy something that's very, very similar or like for like. So that's the thing you want to avoid in a wash sale. Now, after 30 days, I can then do whatever I want after that point, at least under the rules within the United States. So think about your own country, or think about the United States. Understand the wash rule aspect, and don't run afoul of that. If you got a question on that, just pop that in the question and answer area. But that's the idea as far as wash rules, that I can't buy something, the like for like, because I'm trying to manipulate things. So harvesting your tax losses is a perfectly good and a well-used and really a great strategy. You just have to understand some of the don'ts behind it, and really the two big don'ts are the wash rule thing. So you just have to make sure you're buying whatever you're buying new, or waiting to buy back in after 30 days. You got to wait, put in cash, and then wait. And then really the last part of harvesting your losses is it's a small part of your overall investment strategy and ideas too. So and I can't emphasize that enough. That's part of your overall strategy. But if you can use it and use it in select situations, it can really reduce your taxes, which means you get to keep more money for yourself that you can invest or use with yourself or your family. Congratulations, you completed the course. That's actually a really big deal. Most people do not complete the courses they take on Udemy or any other type of online platform. So the fact that you're here is tremendous, and you'll actually do so much better with your investing because you have completed the course. You're so much smarter, so much more educated now, and it really is going to give you a great advantage. I've got some next steps for you now that you've completed the course, some next steps to do to kind of start putting the things you've learned into action, and some advice around that. So first off, one thing is to review your investment goals, because everything starts with that. What is your goals as far as what do you want this investment to do for you once it grows over time? What are your goals? What are your dreams? Are you looking for financial independence, saving for retirement, buying a home, whatever it might be, paying for a kid's college education? Whatever your personal goals are is what matters most, and matters most, of course, to you. So review those goals and figure out where stocks might fit within those type of goals, and is it more of a longer term goal, particularly because stocks tend to be more of a longer term investment. Next, I'd recommend that you start small. Don't go out and put all my money on, ABC company and buy an individual stock. Maybe you want to start small with some small investments. Maybe you want to start with some mutual funds and things to give you some instant diversification. Maybe that'll help you as far as with that to get started, and then play around and get started as far as small wise, and then you can continue to build on that and continue to invest and build that up as you get maybe a little bit more confident. It varies by every person, but when in doubt, especially if you're new to investing, well, it's okay. Go ahead and start small, but do build that up, especially the amount that you're investing. The more you can invest, and the longer you can invest for, the more it will compound and grow over time. So certainly recommend that. But as far as buying individual holdings, might be good to start small. Also good to diversify your holdings too, amongst different types of stocks, different types of stock mutual funds, and then looking at your overall portfolio too, that maybe you need to have a little bit in bonds, or a little bit in cash, or a little bit in something else, precious metals, wherever it might be. I know for myself, looking for long-term growth over a longer period of time, and still am, I have a large percentage of my income, even at this age, you can tell my age maybe a little bit, I'm like 75-80% in stocks right now, and that's pretty aggressive for many people for my age. Maybe you may something less aggressive, but either way, you want to diversify your holdings. And one thing that's very important is to invest regularly. In the United States, we call dollar cost averaging or money cost averaging, where you're regularly putting in money all the time. Maybe it's every paycheck or every month, because as you continue to buy and continue to invest, that money will be in there and it'll continue to grow, and you have a better chance of buying low or medium versus always just trying to buy high, because emotionally it can get hard for us. If the stock market's way up, we might not want to buy, or if the stock market's way down, we might not want to buy, kind of fear out of that. Where if we just regularly are investing, we don't think about those highs and lows. We're just more regular investing and letting the power of compounding work for us to our advantage and have that grow over time, and use that to our advantage versus our disadvantage of maybe trying to time the market, which is extremely, extremely difficult to do. This is more, of course, around buying and holding. I would certainly say less about trading. There's a lot of trading concepts in there, but if you get into trading, understand that's a lot more work, and it's something you're going to really be on top of a lot. I know for myself, I like to buy and really hold, and hopefully I make some great choices. If I don't, I'll sell it off, take a loss if I need to, but I'm looking for that long-term type of gain. And that's really what stocks are. There's even books called like Stocks for the Long Run, or things
things like that, because it is that long-term type thing. But they can be great investments. I certainly have enjoyed a lot of success with it, and my hope is this course has really helped you with that. And that's the last big kind of action step to do, is to continue your education, to continue investing in yourself, continue to take courses, continue learning, understand, look at anything with like kind of a good eye to it, because sometimes there's some different advice out there. Sometimes it's good, sometimes it's bad. Think for yourself on this. You've got some background now here with the course, but do continue your education. One last bonus step here for you, or really it's more a bonus step, I guess, for me and the future students, and that is to review the course, or to give the course a rating. If you love the course, if you thought you got something out, a 5-star rating is great and appropriate, and I love that, and it really helps students as far as deciding what courses to take now and in the future. So you don't have to leave a comment if you don't want to. You can just do a rating, but if you want to leave a rating and a comment, I appreciate that a great deal. I know future students do as well. And lastly, I want to say thank you. Thank you so much for investing your time with me here, and hopefully you learned a lot about stocks, investing in the stock market. But I know there's a lot going on in the world out there, a lot in your own life. So I really appreciate the time that you spent with us here, and I'm hoping I gave you some great information. But really, I want to say thank you so much again for enrolling in the course, and thank you so much. With that wraps us all up here. Best of luck to you, and best of luck in your investments, and good luck.